Hello, champions. I hope you are doing really well. It's the last leg of your preparation. You're in the last few days, and here I am with an absolute banger with your exam oriented marathon for CA Inter TT Jan 26 exams. Before you straight away get into the main part, you have to listen to this introduction. It will be really important. Alright. See, there are three objectives why I have made this marathon for you. By the way, it is 100% absolutely new recordings. Just in the last 2 days, from end to end, it is entirely newly recorded, especially for the Jan 26 students. So, there are three objectives because of which I had to make this video. Number one, I wanted to remind you of some crucial adjustments, some difficult adjustments. Like, for example, I know for a fact that section 112, 12.5% without indexation, then recomputing 20% with indexation, you're not very comfortable with that part. Then, number two, insurance maturity proceeds. When to exempt it, when to tax it, you're not too comfortable with that also. Then I've seen you all are getting so confused between clubbing and deemed ownership. When to apply clubbing, when to apply deemed ownership, when to club with the parent's income, when to club with the transferor's income. So this clubbing and deemed ownership confusion seems to be really high. So these kind of adjustments, these crucial adjustments, these difficult adjustments, that is what I'm trying to attack and solve for you through this entire marathon. Point number one, objective number one. Objective number two, in the recent RTP MTP. When I say recent RTP MTP, I'm talking about your September 25 RTP and MTP, your Jan 26 RTP and MTP, these two. So basically total 6 documents, Jan 26 2 MTPs and 1 RTP, September 25 2 MTPs and 1 RTP, these 6 documents. Then in your September 25 question paper and May 25 question paper, total 8 things I took, guys. In these 8 things, whatever new questions were there. New questions means what? A question which was not there in the study material, or a question which was not there in any of the past examination questions or RTPs or MTPs. So brand new questions which ICAI has introduced in these questions, which you would not find in any other question bank, which you will not find in any past RTP or MTP or PYQ. These kind of questions, those adjustments I've tried targeting for you. So you will not find anything repetitive or easy over here, okay? Now, the reason why I want to do these adjustments and these questions for you is because that way you will do it with me and you will finish it off, and there will be nothing left for you to do on your own. Alright, everybody? So trust me when I say this, everything new, difficult, challenging in these 8 resources I have covered for you in this video. But not just that. This video is totally 4 parts. What I've told you about these new adjustments, all of this, is only the first part of the video. The first part of the video is going to be 27 new questions. From these 8 resources I just told you, 27 new questions you will be finding over here. Then in the second part, ICAI has released your case-based case MCQ booklet, guys, especially for your exams. So though in that MCQ booklet, there are some amazing questions, guys. I've picked 13 case-based MCQs from there. They are actual exam level case-based MCQs. So even that I've covered for you. They're totally, I think, 20 MCQs. Only 7 I've left. The remaining 13 I've covered for you over here. Then in the third part, see, apart from these questions, okay, there were some more questions where rest of the question was easy. Only one adjustment was difficult. Whole question was okay. Only one adjustment was tricky. So these weird adjustments I compiled together and I made 3 questions. So these are your 3 questions, compilation of weird adjustments and calling them. That's your third part. And then in the fourth part, so if you see, in the first 3 parts, you're only solving questions. But in the fourth part, in the last part, 20 concepts I've taken. These 20 concepts are not important, but important concepts. Basically, they are those 20 concepts which are hidden in the nooks and corners of your study material. Like for example, you know interest on NRE account is exempt. But did you know that salary from NRE account, even that is exempt in some cases? So these kind of hidden points, guys, that I've tried to cover in these 20 not important but important concepts, okay? So first 3 parts is pure question solving and the last part is pure concept discussion. Okay, now this marathon is very different from whatever other marathons you would have seen on DT, because I'm not doing only concept revision over here, because in the examination for DT you don't have to write theory and come, you have to solve a question and come. So that is why I'm trying to give you a proper exam oriented marathon through questions and through some important concept discussion. Alright, trust me when I say this, you will find it really effective, alright, because through questions practice, through my first 3 parts, not only these questions, important questions in these resources will get covered for you, adjustments involved in those questions will also get revised for you, and the kind of practice that you need in the last few days before your examination, that practice you will get. Alright, but please ensure you don't sit over there and watch the session like one movie is going on. Keep your calculator, your pen, your paper with you, and keep scribbling along with me in your answer paper. Alright, that's how it will be as effective as I want it to be. Then, of course, you're going to flood my comment section and you will keep asking me about the questions handout and the classroom notes. Both of these you will find in my Telegram channel. You can take them from there. You can download from there. I will suggest, if possible, try to print the questions handout. Okay, it will be easier for you. And the classroom notes with all my solving also I have put in my Telegram channel. Now, one small request. 2 requests. Request number 1. Before you start watching this video, please set your mindset. I know it is the last few days before the examination, and in this video, in these last few days, by chance you come across a new adjustment. You should not get scared. You should not get tensed. You should not feel, oh my god, learning is not even getting over. No, that's not how the mindset will be. Our mindset will be like this. Whenever you come across a new adjustment, or whenever you make a silly mistake in the course of these questions, or whenever you realize you've forgotten something, you will tell yourself, you will be glad, you will be happy, you will tell yourself, oh thank God, I have seen this adjustment now during my preparation itself. Had this adjustment come in the exam and had I not seen it, it will be so bad. But see, good thing I have seen it now. Now if this comes in the examination, I will be able to tackle it. That should be your mindset. So with a nice, happy, positive mindset, it's okay. Let's be open to learning. Our mindset, our attitude will be, give me as much learning as possible before the examination, because I don't want surprises in the examination. Give me surprise now, it's okay. Don't give me surprise in the examination. With that mindset, you will start watching this video. Alright guys, and one last request. Trust me when I say this, this video is going to be extremely beneficial for you. So watch it till the very end. Don't keep skipping. Adjust the speed according to your ability to grasp, and also please do share this with all your friends. Help me. You got to help me reach out the largest number of students possible. You got to help me help other students as much as possible. Come on, you can continue watching. The main part starts right after this. So starting off with the very first question relating to clubbing of income. Very simple question guys. Let's read the question first. The question says, Mr. Gupta, a resident individual aged 65 years. So at this stage itself, you will be able to conclude that he's an individual, he is a resident and he's at least 60 years. So Mr. Gupta, you're a senior citizen. Okay. He earned pension computed of rupees 7,50,000. The word computed over here indicates to us that they have already done all the calculations, exemptions, deductions, everything. The final computed number they have given to us. So what's a taxable pension for your assessee? 7,50,000. Okay. Then the question says, the star adjustment of the question, read carefully. He gifted a sum of 3,50,000 to his minor daughter Anu in May 24. And what did the minor daughter do with this money? She has invested this amount in FD and she has earned FD interest of 18,000 during the year. Understood the question guys? So what has happened? Your assessee Mr. Gupta, he has gifted 3,50,000 to his minor daughter, and the minor daughter has put this money in an FD from which she is earning FD interest of 18,000 rupees. Okay. Then what happened? Mr. Gupta also earned 45,000 as interest from FD. So this will become his IFOS income. So he is having FD interest, how much? 45,000. Now come on. Assessee is having FD interest income. Does some section in chapter 6 come to your mind? FD interest. You will think about ATTTB guys. And of course you can give ATTTB deduction over here. Assessee is a senior citizen. Right? So in ATTTB, assessee has to be a senior citizen or super senior citizen. FD interest, savings interest, RD interest, all these interests you cover. The interest has to be from BCP, bank, cooperative bank or post office. So all your conditions are fulfilled. You will get section ATTTB deduction over here. Maximum limit is how much? 50,000, but here it is only 45,000 within the limit of 50,000. So 45,000 will be fully allowed. Okay. Then the question says, one last sentence. Mrs. Gupta provides online coaching. Mrs. Gupta, so assessee spouse, and her income from the coaching is 11 lakh rupees. So we have Mrs. Gupta. Her income is 11 lakh rupees. Okay. Now what are they asking us? They are asking us, how will the interest income earned by Anu be taxed as per Income Tax Act 1961? So, we have our assessee, Mr. Gupta. Then we have his spouse, Mrs. Gupta. Then we have assessee's minor daughter who's having FD interest. Where will this income be clubbed? Listen to me now. I'll tell you what will be the first thought that comes to your mind. The first thought that comes to your mind will be, okay, the minor child is earning FD interest of 18,000. This is from the transferred asset of 3,50,000. So let us club with the transferor. Are you thinking like that? Yes, guys, that would be a terrible way of answering. Listen to me very carefully. I'll tell you how to eliminate this mistake. Whenever it is a clubbing related adjustment, okay, remember the sequence. First, you will check whether deemed owner concept will apply. If deemed owner concept is not applicable, then only you will come to clubbing concept. Right, guys? Tell me over here, will deemed owner concept apply for this transaction? Deemed owner concept will apply if assessee is transferring house for no consideration or inadequate consideration to spouse. Or that concept will apply, deemed owner concept will apply if assessee transfers a house for no consideration or inadequate consideration to minor child other than minor married daughter. Here tell me, is assessee transferring house? No, guys, he's transferring money. So first of all, deemed owner concept is out of the picture. Now you will come to clubbing. Whose income? Minor's income. Minor's income, if it has to be clubbed, only two provisions, guys. Provision number 1, did the minor child earn income because of skill, talent, labor? No. Is a minor child disabled? No. So therefore clubbing provision will apply. Now you will club with whose income? What have you learned? Have you learned that you will club with the transferor's income? No. Minor child's income is clubbed with the income of mother or father, whoever's income is higher. Here check whose income is higher. Mother's income is 11 lakh rupees. What is Mr. Gupta's income? What is the father's income? Father's income is 7,50,000 only, guys. 7,50,000 plus 45,000 minus this 45,000. His income is 7,50,000 only. So whose income is higher, Mrs. Gupta or Mr. Gupta? Clearly over here, Mrs. Gupta, her income is higher. So the minor child's income, interest income of 18,000 rupees has to be clubbed with the mother's income over here. And of course, if Mrs. Gupta is following the normal regime, you will also give 1,500 exemption under section 1032 and you will tax only the balance. Crystal clear. Now come on, look at the options. Rupees 18,000 interest income will be taxable in the hands of Anu since it is her investment. No, Anu is a minor child. So in her hands, this income will not be taxed. It will be clubbed. Option B, 18,000 interest income will be included in the income of Mr. Gupta. No, just because Mr. Gupta has transferred the money doesn't mean the clubbing will be in his hands. Clubbing of minor child's income is with the income of that parent whose income is higher. So it is not with Mr. Gupta's income. Mr. Gupta's income is lesser than Mrs. Gupta's income. Then interest income is exempt. Crazy, not at all. 18,000 interest income will be included in the income of Mrs. Gupta. Yes, option D, the interest income will be included with Mrs. Gupta's income. Understanding? So this was your first question with respect to clubbing, just showing you what mistake is possible. You should not think that just because Mr. Gupta has transferred the asset, the clubbing will be with his income. No, minor child's income is always clubbed with the income of that parent whose income is higher. Now just 2 minutes, okay? You tell me, where have you learned the concept that if assessee transfers an asset to a person, then from this asset, whatever income this person earns, that income will be clubbed with the income of the transferor assessee. Where have you learnt in clubbing? I'll tell you. This point you have learnt when assessee transfers asset to spouse for no consideration or inadequate consideration. Then whatever income the spouse earns from the transferred asset in same form or different form, you club. Then also when assessee transfers the asset to son's spouse, here also you club the income with the transferor's income. Also when assessee transfers asset to HUF. So in these 3 places only, you are supposed to club with the transferor's income. But however, when assessee transfers an asset to minor child, okay, for no consideration or inadequate consideration, there is no concept of clubbing with the transferor assessee. This concept itself is not there. Understanding? The concept which you are trying to apply over here, that concept will apply only when assessee transfers the asset to spouse or to son's spouse or to HUF. When assessee transfers the asset to minor child, then in that case there is no concept of clubbing the income with the transferor's income. No concept like that. Instead, whatever income the minor child earns from that asset, it has to be clubbed with the income of whichever parent who has higher income. Okay, no confusion. Now only in these places you will club with the hands of the transferer's income. Okay, now come to the second question. One simple MCQ question, guys. So question number 2. The question says, which of the following statements is correct regarding the taxation of income under Income Tax Act? You have to find the correct statement. First subdivision. Income from agricultural operations on land situated outside India is exempt from income tax. Terrible. What's your equation that I've taught you? Agricultural income plus agricultural land plus in India is exempt under section 10(1). Here land is outside India, so no exemption. Then come to the second subdivision. Under the default tax regime, 115 PSC, guys, all deductions under chapter 6A are allowed. Terrible, guys. If assessee is following default regime under chapter 6A, only 3 sections you will get. Section 80 CCD subsection 2, section 80 CCH subsection 2 and section 80 JJAA. Only these 3 sections you will get. All deductions and all you will not get. Then third one. Income of previous year is always assessed in the immediately following assessment year. This is also wrong. Remember, we have learned 5 exceptional cases where previous year's income is assessed in the previous year itself. Like for example, assessee is a non-resident, shipping business, comes to India, earns freight income. Remember the 7.5% concept and all that. So in all those exceptional cases, previous year's income is assessed in the previous year itself, not in the following assessment year. So this statement is also wrong. Then comes the last point, unexplained credits. Thus, immediately some section come to your mind. Come on, everybody. Unexplained investments, unexplained credits, your cash credits and all. Section 115 BBE. Some tax rate comes to your mind. Effective tax rate, 78%. Come on, read now. So, these unexplained credits, not satisfactorily explained to the assessing officer, may be treated as income and taxed accordingly. Yes, yes, yes. If it is unexplained credit or unexplained investment for which you are not able to give any satisfactory explanation to the AO, it will be treated as if it is your income and you have to pay tax. How much tax? Remember, 60% tax plus mandatory 25% surcharge plus mandatory 4% says effective tax rate will be 78%. So still clear, guys? This was your question number 2 from your basics from 115 BBE. Now come to question number 3, one small question relating to TDS. It's going to be a mixture, okay? Clubbing, TDS, then basics, then IFHP, salaries. It's going to be like one big khichdi only. Come on, let's begin with question number 3. Mira and Co. LLP withdrew cash. Come on, everybody. TDS, withdrew cash. Which section comes to your mind? TDS, withdrew cash. Section 194N. And what's the most unique point about 194N? As soon as you think about 194N, there is one word that will flash across your mind. What is it? One word. Excess. In 194N, you deduct tax only on the excess. Okay, anyways, coming back. So, Mira and Co. and LLP withdrew cash amounting to 40 lakhs on 1st May 24, 35 lakhs on 7th September 24 and 55 lakhs on 28 February 25 from its bank account. Mira and Co. regularly files its return of income before the due date. TDS, guys, I've always told you, draw your diagram first. So, where are you withdrawing cash from? You're withdrawing cash from your bank account. Who is withdrawing cash? Mira and Co. LLP. How much cash are they withdrawing? Totally 3 withdrawals you're talking about. The first withdrawal is 40 lakh rupees. When did this happen? On the 1st of May 2024. Second withdrawal is 35 lakh rupees. When did this happen? On the 7th of September 2024. The last withdrawal happened on 28 February 2025. 55 lakh rupees. Okay, now try to recall section 194N, guys. So identify the section first. Section 194N. Then is it an R hijack section? It is not an R hijack section. Then will you check about personal, not personal and all in 194N? No. So therefore you will straight away enter into the section. Now once you enter into 194N, come and try to recall what's the first thing you check in 194N. You check whether this person who is withdrawing the money, defaulter or not a defaulter. But here question is very clear. Question says Mira and Co. regularly files its income tax return, which means Mira and Co. you are not a defaulter. So if Mira and Co. is not a defaulter, tell me the provision. What are the limits that are applicable? What's the limit? If you're withdrawing up to 1 crore, then there will be no TDS. If you withdraw more than 1 crore, then you will have 2% TDS. 2% of what? 2% of the excess above 1 crore. This is the provision that you have learned. Let me remind you one small point over here. If the person who is withdrawing money, if this person happens to be a cooperative society, then instead of 1 crore, what will be the applicable limit? 3 crore will be the limit. Anyways, here it's not a cooperative society. 1 crore limit will apply. Now come on everybody. When did the first withdrawal happen? 40 lakh rupees. Will you deduct any TDS? Will this bank deduct any TDS? No guys, only 40 lakh rupees within 1 crore, there will be no TDS. Then you withdrew 35 lakh rupees. So total withdrawal is now how much? The total withdrawal now is 75 lakh rupees. It is still within 1 crore. So here also there will be no TDS. Then finally, when you withdraw 55 lakh rupees, now you have withdrawn 1 crore 30 lakh rupees. So now you have crossed 1 crore. So on 28th February 2025, at the time of withdrawal, there will be TDS. So totally you have withdrawn 1 crore 30 lakhs. So what is the excess above 1 crore? 30 lakhs is the excess. On this, 2% will be your TDS rate. So 60,000, this much TDS will be deducted. Understanding under section 194N, when do you deduct tax? At the time of payment, that is at the time of withdrawal, the 60,000 will be deducted. 2% of the excess. Okay, so when you're withdrawing 40 lakhs, you have not crossed 1 crore, no TDS. When you withdraw 35 lakhs, totally 75 lakhs only. It is still within 1 crore, no TDS. But when you withdraw 55 lakhs, total becomes 1 crore 30 lakhs, which is more than 1 crore. So on the excess above 1 crore on 30 lakhs, 2% will be your TDS. Alright guys, now come on, let me go forward 1 minute. I think I numbered the questions wrongly. This was question number 3. And don't worry, okay, this PDF with the answers also, with all these annotations also, I will share both the PDFs with you. So let me make my answer PDF proper. Answer to question number 2 was option D. Now this was question number 3, subdivision 1. Now we have one more subdivision, subdivision 2. Let's read this one properly. Mr. Anil, aged 75 years. So at this stage, would you like to conclude something? He's an individual. He's at least 60 years. If he is a resident, then he will become a senior citizen. So he holds 8% savings taxable bonds 2003 with a face value of 2,50,000, 7.75% savings taxable bonds 2018 amounting to 3,50,000. So 2 bonds he is holding. He is holding 8% savings bonds 2003, 2,50,000 face value, and he is holding 7.75% savings bonds 2018 face value 3,50,000. He received interest income on these bonds on 31st March 25. TDS. Come on everybody. TDS on bonds. Bonds are securities. Interest on securities goes to which section in TDS? Interest on securities will go to section 193 under TDS. Now under section 193, there's a special provision with respect to these 3 bonds guys. So 8% savings bonds, 7.75% savings bonds and floating rate saving bonds. In these bonds, if the interest amount is more than 10,000, only then TDS will apply. And if TDS is applicable, section 193 TDS rate is what? TDS rate is 10%. Okay. And remember in section 193, when do you deduct tax? At the time of payment or credit, whichever is earlier. And one more point, don't forget, in section 193, your government securities, no TDS on interest on government securities. Okay. But anyways, focusing on the question over here. So in this question, we're talking about exactly these 3 bonds, guys. Out of these 3 bonds, we're talking about the first 2. 8% savings bonds and 7.75% taxable bonds. So we'll have to find how much is the interest first on these bonds. If it is more than 10,000, only then TDS will apply. So if you calculate on these 8% savings bonds, what's the interest? The face value is 2,50,000. The interest rate is 8%. So here your interest is going to be 20,000 rupees. And then you have 7.75% savings bonds. The face value is 3,50,000 into 7.75%. So here your interest will be 27,125. So if you see, the interest is clearly more than 10,000 over here. So the total interest is 47125 on this TDS rate, section 193. Hence 10% will be your TDS rate. So 4713 will be the TDS deducted at the time of payment or credit, whichever is earlier. Okay. So under section 193, even though on government securities there is no TDS on the interest, but these three bonds, even though they are government bonds, still TDS will apply at 10% provided the interest is more than 10,000. Alright. So this was one small discussion with respect to section 193. So two TDS sections got indirectly revised for us over here, 194N and 193. Now come on, let's go to the next question. Question number 4. Now let's read the question first. This is an interesting question. The question says, Mr. Gopal, age 33 years only, so he's clearly not a senior citizen. He's a resident individual. He sold one of his residential house properties for 60 lakh rupees. He sold a house, capital gains, on 31st August 24. So 60 lakhs becomes his full value consideration. He sold on 31st August 24. This becomes your date of transfer. It was purchased on 14th October 2021. So it was purchased, this was your date of acquisition. It was purchased for rupees 45 lakhs. This becomes your cost of acquisition. Okay. So with this we can compute capital gains, guys. So if you see, how do you start? We'll start with the capital asset transferred. So what are we transferring over here? He's transferring a residential house property. What's the period of holding? When did he buy it? He bought it on 14th October 2021 and he's selling it on 31st August 2024. So be careful. The date of transfer over here is clearly on or after the amendment, on or after 23rd July 2024. Now come on everybody. At this stage I always bring you to the margin. So on or after 23rd July 24, first of all you will think about section 50AA. Tell me, will 50AA apply to immovable property? No, guys. Then you will think about the index. First you will think about the period of holding. How many periods of holding are possible after the amendment? Only two, either 12 months or 24 months. Here it is immovable property. So your relevant period of holding will be 24 months. Then tell me, will you get any indexation benefit after the amendment, guys? No indexation benefit. So come on, let's continue. 24 months. This period is definitely more than 24 months. Therefore, it becomes long-term capital asset. So of course, you will try 112A first. But this is immovable property. 112A will not apply. 112 will apply. Now, in section 112, do you remember? If by chance you have to compute tax, then you have extra drama. If it is section 112, then you will check whether 4 conditions are fulfilled. If 4 conditions are fulfilled and by chance they ask you to compute tax, then you will do with indexation, without indexation, pick whichever is lesser. All that drama will apply. Come on, let's do a revision. It will be a good revision for us. What are the 4 conditions? Condition number 1. Who is the assessee? The assessee has to be a resident individual or HUF. Fulfilled. Assessee is an individual and resident individual. Fulfilled. Second condition, the asset that we are transferring has to be immovable property. Are we transferring an immovable property? Yes, guys. Then comes your third condition. Your third condition is that the date of transfer has to be on or after the amendment. Date of transfer has to be on or after 23rd July 24. Yes, date of transfer is after amendment. And last condition, the date of acquisition. When are you buying the property? That has to be before 23rd July 24. Yes, my date of acquisition is before the amendment. All my 4 conditions are fulfilled. That extra drama will apply. So by chance they ask us to compute tax, what will you do? You will take first of all the capital gains that you will compute without indexation. On that capital gains, 12.5% will be your tax. Then for the purpose of this tax, you will recompute capital gains. With indexation, you will recompute capital gains. Of that, 20% will be your tax. And out of these two, you will pick whichever is lesser. And don't forget, all this drama only and only if they ask you for tax. Okay, anyways, come on guys, let's step into the computation now. So we've identified it is a long-term capital asset. Let's start with full value consideration. Immediately 2 sections will come to your mind, 50C and 50CA. 50C will not apply over here. They have not given us any SDV numbers. 50CA also will not apply because it is not unlisted shares. So I'll take my full value consideration as it is now, 60 lakh rupees. No expenses on transfer, guys. So this itself becomes your net consideration. From this you will subtract the cost of acquisition. Now tell me everybody, can you index the cost of acquisition over here? No, right? You've already concluded that the transfer has happened after the amendment. So therefore, no indexation. Also, it is not 112A and all. So grandfather clause, all that will not apply. So cost of acquisition as it is, I will take. No indexation benefit also. So what's your cost of acquisition? 45 lakhs. So no cost of improvement, nothing. Easy this was. What's your 112 LTCG now? 15 lakhs becomes your 112 LTCG. Okay, then let's continue reading. Let's see what happened. The question says his old tenant paid him rent in arrears for the above property on 12th November 24. See guys, we have sold off this property on 31st August 24. Okay, after selling the property on 12th November 24, we are recovering rent. See, rent on the property. Of course, you will think about the IFHP head. In IFHP head, no doubt, assessee has to be the owner of the property. But you know, right, arrears of rent recovered, unrealized rent recovered, when the rent is being recovered on that, at that time, even if you don't own the property, it's okay, it will still be taxed for you. Flat 30% deduction, 70% will be taxed for you, right? So he is recovering arrears of rent on 12th November 24. No doubt, assessee does not own the property on the date of recovery, but that is fine. Arrears of rent recovered and unrealized rent recovered, this is an exception. How much is the arrears of rent recovered? 75,000, which was treated as unrealized rent. So actually it is unrealized rent recovered and not arrears of rent recovered. Okay, now he had to spend 5,000 for such collection. So in this question now, we are having IFHP also. Now in IFHP, how much rent are you recovering? What is your unrealized rent recovered? You are recovering 75,000 rupees. So I'll give you flat 30% deduction. So your taxable amount will now be 52,500. Okay. Now what about the collection expense now? He had to spend 5,000 for such collection. When you have to recover unrealized rent or arrears of rent recovered, whatever expenses you incur, we always ignore the expense. Why do we ignore the expense? Because all these expenses are already covered in this 30% deduction. So 2 points over here guys that we learned. Point number 1, when you're recovering the rent, at that point, even if you don't own the property, it's okay, it will still be taxable for you. Point number 2 that we learned, whatever collection expenses you incur to recover the unrealized rent, we ignore all that because we already consider all those expenses in this 30% itself assumed to be covered. Okay, then comes my third para, my last para. He purchased a residential plot on 8th December 24 for 5 lakh rupees, but no construction was started till date, although he earned 30,000 as rent from this plot in the last quarter of the previous year. See, let's break this adjustment into 2 parts. Let's talk about the adjustment till here. He purchased a residential plot. Now, he sold a residential house and he purchased a residential plot. Plot means land. Will any section exemption apply, guys? See, in section 54, you sold a house, you should buy a house. Did he buy a house? No, he bought a plot, he bought a piece of land, he did not buy a house. So therefore, he neither bought a house nor did he construct the house. Question is saying no construction was also started. So section 54 will not apply. Then 54B talks about agricultural land. That is of course not a matter of my discussion over here. 54D talks about your industrial undertaking. Even that we're not talking about over here. In 54EC, you should have purchased bonds. You didn't purchase any bonds, you only purchased a plot of land. In 54F, you should have transferred any long-term capital asset other than residential house. But here you're transferring residential house. So none of the 5 exemption sections will apply. Understanding? Had your assessee purchased a residential house, then you could have enjoyed section 54 exemption. Sold a house, purchased a house. But here he is purchasing a piece of land. And he's not doing any construction also. So therefore, no section 54, none of the exemptions will apply. Then the question says, he earned 30,000 as rent from this plot. Tell me guys, rental income. Are you thinking about IFHP head? No. In IFHP head, I need a superstructure. I need a building. But here it is rent from a plot. Rent from a piece of land. This rent will go into your IFOS head, 30,000 rupees. IFOS head. So under IFOS, we have rent from a piece of land. Understanding? Rent from a house property, from a superstructure, IFHP head. This is rent from a plot of land. This will come into IFOS head. Amount is 30,000 rupees. Okay. Now see, let's see what the question is saying. Mr. Gopal is opting for the default taxation, which means 115 BSE. Be careful, not normal regime. This is default regime. What are they asking us now? Determine income from capital gains and the exemption available. We've already concluded that there is no exemption available for purchasing the residential plot. None of the 5 exemption sections are applicable. So what's the capital gains amount now? Capital gains amount is 15 lakh rupees and no exemption. Option A. Alright. Then after this, your next question, compute income from house property. Income from house property also we have already computed 52,500. Whatever expense you have incurred to recover the rent, we will not subtract that. Straight away, I will give flat 30% deduction. Then the question is asking us to compute his total tax liability. Come on guys, this is going to be interesting. Don't forget default regime. Okay, so we're doing tax computation. Come on, try to recall the rule 0 that we made for ourselves. When you compute tax, rule 0, you first think about the regime. Which regime are we following over here? We are following the default regime. And under default regime, what's your basic exemption limit always? Your basic exemption limit is going to be 3 lakhs, right guys? So what is your assessee's total income over here? Assessee has LTCG section 112 of 15 lakh rupees. Then assessee has IFHP of 52,500 rupees and IFOS of 30,000 rupees. No other income. So what is your assessee's GTI? GTI will be 15,82,500 and no chapter 6A. So this itself will become the total income of your assessee. 15,82,500. This is the total income. Now, how many kinds of income are you having over here? You're having two types of income. You're having normal rate income and you're having 112 LTCG. Only one special rate income you're having over here, 112 LTCG. So my normal rate income is how much? 82,500. And your special rate income, your 112 LTCG is 15 lakh rupees. Okay, come on, find your tax now. How will you do the computation? Be careful, it gets interesting over here. This is your total income. Your basic exemption limit, you always adjust against normal rate income first. 82,500 you've adjusted. So normal rate income on this tax will be 0. Now how much basic exemption limit are you still left with? You have 3 lakh basic exemption limit. You were able to utilize only 82,500. So you still have the balance unutilized basic exemption limit of 2,17,500. Tell me, this unutilized BEL, can you utilize against 112 LTCG? Yes guys, you can utilize this against 111 ASTCG, 112 LTCG, 112 LTCG, you can utilize provided assessee is a resident. That's the only condition. And here Mr. Gopal is a resident. So your conditions are fulfilled. You can adjust this over here. So if I adjust 2,17,500 over here, then how much will I be left with? 15 lakh minus 2,17,500, 12,82,500 you will be left with. Now what will be your tax on this 112 LTCG? Come on, try to recall. Here only we had done the thinking. All my 4 conditions were fulfilled. So we had concluded that on this 112 LTCG, when I have to compute tax, I will compute without indexation, with indexation and pick the lesser number. So let's do all that now. So come on, what is my LTCG without indexation? It is 15 lakh rupees. Okay. And what's your unutilized basic exemption limit? 2,17,500. So your taxable LTCG is 12,82,500. So without indexation on this at what rate tax? 12.5%. This is going to be 1,60,313 guys. Okay, then I'll have to recompute my LTCG with indexation. How will you recompute? Your full value consideration is the same, 60 lakhs. So now your cost of acquisition you have to index. So what was your cost of acquisition? 45 lakh rupees into CII of the year of transfer. The transfer happened in 24-25. 24-25 the indexation is 363 divided by the CII of the year of acquisition 21-22. 21-22 your indexation is 317. So 45 lakhs into 363 by 317. 51,52,997. This will become your indexed cost of acquisition. Okay, so my full value consideration is 60 lakhs minus my indexed cost of acquisition 51,52,997. So now my LTCG would be after indexation 8,47,003. Okay, this is my recomputed LTCG with indexation. But don't forget, will this number ever enter your total income computation? No, all this is only a part of your tax computation. Your real LTCG number will stay 15 lakh only. That only will enter into your total income computation and all. All this extra drama that we're doing right now with indexation, without indexation, is all this only for tax computation. So when you recomputed LTCG with indexation, your recomputed LTCG was 8,47,003. I have unutilized basic exemption limit of 2,17,500. So my net number would be 629,503. 629,503. On this 20%, guys, 12.5% without indexation, 20% with indexation. So here your tax would be 1,25,900. So out of these two numbers, without indexation, my tax is 163,13. With indexation, my tax is 125,900. Out of these two numbers, you're supposed to pick whichever is a lesser number that will become your tax on section 112 LTCG. So your lesser number is 125,900. So here your tax is 125,900. So your total basic tax will be 125,900 plus no rebate, income is more than 7 lakhs. No surcharge, income is within 50 lakhs. So straight away we will add cess. So 125,900 plus your 4% cess will be 1,30,936, which you will remember to round off into 1,30,940. So they had asked us for the tax liability of Mr. Gopal. So tax liability is 1,30,940, option A. Understanding? Yes, the whole reason why we did this question. Come on guys, tell me what are all your learnings from this question. Let's revise. Our learning number 1, capital gains calculation was easy. There was no indexation also. Learning number 1 was unrealized rent when you recover in that particular year. Even if you don't own the property, it's okay. It will still be taxable for you. Learning number 2, to recover the unrealized rent, whatever collection expenses you incur, you ignore it because all those expenses are already covered in the 30% standard deduction. Learning number 3, you are having rental income from a residential plot. It will not go into IFHB head because there's no superstructure. It will come under the IFOS head. Learning number 4, my most important learning, was the way in which we computed tax under 112 LTCG. As soon as we identify 112 LTCG, I always make you do this thinking there itself, guys. So all your 4 conditions were fulfilled. They did ask for tax computation over here. So therefore, I will do the computation without indexation. With indexation, I'll see whichever is a lesser number, that will become my tax. But don't forget, all this calculation happens only for tax computation, right guys? The real LTCG number, the number which will go into total income computation, will still be 15 lakhs only, the number without indexation. Alright, and one more learning over here. If you noticed, I had unutilized basic exemption limit. This question is a good reminder of various points. We had unutilized basic exemption limit. Assessee was a resident, so I adjusted this against my 112 LTCG. But did you notice I adjusted it against both on when you were calculating without indexation also, with indexation also? In both, I remembered to subtract my unutilized basic exemption limit. All these are, the small hidden silly mistake areas that are possible. So simply just slow down whenever you do computation under section 112 taxation. Just slow down a little bit. Any unutilized basic exemption limit, don't forget to subtract and then see whichever is a lesser number, that will become your tax. Okay guys, easy only. Now come to the next question, guys. This question was a hell lot of learning. Come to question number 5 now. Simple question. TCS. So Mr. Shivam, a resident individual, has made the following payments to Messrs. ABC Limited to purchase an overseas tour program package. Overseas tour program, guys. Section 206C 1G. I'll give you a reminder of the provision here. If you buy an overseas tour program package, then if you're making the payment up to 7 lakh rupees, then you will have to pay 5% TCS, and if you are making the payment of more than 7 lakh rupees, then 20% TCS will apply. It's like a slab rate. Okay, so here how much are we paying? 4 lakh rupees on 18th May 24. So on 18th May 2024, it's only 4 lakh rupees, guys. So it is, what will be your TCS rate now? 4 lakh into 5%, because it's up to 7 lakh, right? So if it's up to 7 lakh, then 5% TCS. So 4 lakh into 5% will be 20,000. This will be your TCS collected on 18th May 24. Then what happened? On 11th of March 2025, you're again remitting 5 lakh rupees. Now here you have to be careful. On the first 7 lakh, 5%. So 4 lakh you have already utilized in the 7 lakh. So this 5 lakhs I will break into two parts. In the 7 lakh, how much more can I utilize? 3 more lakhs, guys. So 4 lakhs I've already utilized. So 3 more lakhs. And then the balance 2 lakhs. Understanding? This 5 lakhs I'm breaking into two parts, 3 lakhs and 2 lakhs. How 3 lakhs? Up to 7 lakh, 5% TCS. Now 5% I have enjoyed for 4 lakhs. I can enjoy it for 3 lakhs more. Here also 5%. So whatever is my balance above 7 lakh, on that 20% will be my TCS. So 3 lakhs into 5%, 15,000 will be our TCS, plus 2 lakh into 20%, 40,000 will be our TCS. So my assessee will have to pay on 18th May 24, 20,000 he'll have to pay. Then on the 11th of March 25, 15,000 plus 40,000, total 55,000 TCS he'll have to pay. So choose the correct answer now. 20,000 and 55,000, option C. Okay, so just wanted to show you that up to 7 lakh, 5% TCS. So you can enjoy 5% TCS on 7 lakhs. So therefore 4 lakh and 3 lakh, total 7 lakh. On this 7 lakh, I enjoyed just 5% TCS. Beyond 7 lakh, whatever was my excess was 2 lakhs. Above 7 lakhs, on that 20% will be your TCS. So this was your question number 5, 206C, 1G. Now come to question number 6. Even this is an MCQ question. The question says on 18th June 24, unexplained money. Again, unexplained money of 30 lakhs under 69A was detected of Mr. Mahesh. Expenses of 10 lakhs were incurred to earn the income. He also has brought forward business loss of 4 lakh rupees. Amount of income tax payable by Mr. Mahesh on such income will be how much? There's only one reason why I'm doing this question for you. If you have unexplained money, unexplained incomes, unexplained investments, unexplained expenditure and all, whatever is the amount, guys, on that 78% will be your tax, right? How much ever expense you have incurred to earn that income, I will ignore. It doesn't matter to me, I will ignore. Whatever loss you have unadjusted, you can't adjust against this. Basically, I'm just trying to show you over here that flat 78% tax you'll have to pay. So 30 lakhs into 78%, 23 lakh 40,000 will become your tax on this unexplained income under section 115 BBE. 23 lakh 40,000. Now to earn this income, how much expense you have incurred, how much loss do you have, nothing can be adjusted. Flat 78% taxation, no adjustments, no expenses, no losses, nothing you can adjust over here. Okay, in fact even basic exemption limit you can't adjust. Straight away 78% will become your tax. Okay, breakup of the 78% I told you even earlier. 60% tax, 25% surcharge and 4% cess. Alright, now come to question number 7. Nice total income question this is, guys. Let's read the question and then we will begin. The question says Mrs. S.C. Bose, aged 62 years. So what would you like to conclude over here? Assessee is an individual. Assessee is at least 60 years old. So if the assessee is a resident, then the assessee becomes a senior citizen. She is a widow of a public sector employee who died during his service in 2011. She earns income from the business of running a flower bouquet shop in Kolkata, and she has income from royalty from writing books of science and sells in India and abroad. P&L account they have given to us. So I do have the net profit number. So therefore when I compute the PGBP, I will use my indirect method. Right, guys? That is my 5 steps method. I'll use that. Then they have given us a lot of additional information. What are they asking us? Compute the total income of Mrs. S.C. Bose under default regime and under optional regime. Both, guys. Default regime also, optional regime also, both. But only total income they have asked. They have not asked tax liability. Okay. So come on, let's begin. Total income. I'll do the computation under normal regime first, and then we will recompute as per the optional regime. Okay, so of course they have given us a P&L account. So of course I have my PGBP head. I'll give reference to working note number 1. Now I'll open working note number 1, PGBP, and our usual 5 steps, guys. So we will start with net profit as per P&L account. Then we will add expenses debited but not allowed. This will be our first heading. Then we leave some gap and then we'll write add incomes. not credited but taxable. Second heading, then we'll subtract expenses not debited but allowed. And finally, we will subtract incomes credited but not taxable. Okay, so these will be our five steps. All right, now come on, let's start. Let's begin with the credit side. We always start with the credit side first. So the question says, by sales of flower bouquet. So we have sales, but sale revenue is 36,75,000 only. We think about any presumptive taxation over here? See, Ceci is carrying on a business, and the turnover, if you see, it is within 2 crores also, within 3 crores also. So actually you can think about section 4480, but I've always told you that especially when it comes to a total income question, 4480 can be a note, but it can't be your main answer. Okay, moving on, we have family pension from PSU through bank. Family pension, this will go into your IFOS head, so we'll have to remove this from our PGBP. How will you remove a credit? You will remove a credit by subtracting it. So I'll subtract it, income credited but not taxable. Over here we have family pension 3,60,000. I'm removing it from PGBP. I'll take it to my IFOS head. So I'll open a new working note number 2. After your working note number 1, working note number 2, IFOS. Here we will have family pension. Now, be careful. We're doing the computation right now as per the normal regime. Normal regime, family pension, you get one deduction also. How much deduction do you get? See, how much your assessee has received? 3,60,000. From this, you will subtract a deduction. How much deduction do you get? Either 1/3 of the pension, so 1/3 of 3,60,000, which will be 1,20,000, this number, or 15,000 rupees. Out of these two numbers, whichever is lesser number will be your deduction. So 15,000. Had it been the default regime, then instead of 15,000, 25,000 would have been your limit, right? So 1/3 of the pension received or 15,000, whichever is lesser. If it is default regime, 1/3 of the pension received or 25,000, whichever is lesser. So here 15,000 is lesser. So therefore, what's your taxable pension now? 3,45,000 will become your taxable pension. Okay, then comes your next adjustment, royalty. Royalty from California University for books sold, foreign exchange brought into India. Immediately some section will come to your mind. Immediately section 80QQB will come to your mind. But I always tell you, when it comes to royalty, don't think about just your chapter 6A. Also, you have to tax it in IFOS head. So I'll remove it from PGBP. So how do you remove a credit? Even this is credited. I'll remove it from your PGBP. I'll remove a credit by subtracting it. So royalty, the amount is 4,25,000. I'll remove it from my PGBP head. I'll take it to my IFOS head. So under IFOS, we have royalty income. The amount is 4,50,000. I'll put it in my inner column because generally we have expenses from royalty. And with respect to royalty, we will also have 80QQB. So 80QQB will go to chapter 6A. So after working note number 2, I leave some gap. I'll open working note number 3. Chapter 6A, and computation I'll do later, but at least I'll write and keep over here 80QQB so that we don't forget later. Why 80QQB, by the way? Why not 80 RRB? See, 80QQB is with respect to royalty for books. 80 RRB is for royalty for patents. This is books, so therefore 80QQB. Okay, then we have a dividend income, net of TDS, 4,50,000. Even dividend income I have to remove from my PGBP head. It will always come into IFOS head only. So I'll how do I remove a credit? I'll remove a credit by subtracting it. So dividend income, I'll subtract it from my PGBP, 4,50,000. I'll bring it to the IFOS head. So be careful, but the question says it is net of TDS. So you'll have to gross it up, guys. To gross it up, section 194 is what you will apply. Under section 194, your TDS rate for dividend is 10%. So when you gross it up, 4,50,000 into 100 by 90, you'll get 5 lakh rupees. 4,50,000 into 100 by 90, you'll get 5 lakh rupees. So this is your gross dividend. Now TDS credit, I will not bother about that because they have not asked for tax payable. They only asked for total income calculation. Okay, this was about your dividend point. Then comes interest on FDR. FD interest. Even this I will have to remove from my PGBP. So how will you remove a credit? You will remove a credit by subtracting it. So FD interest, the amount is 76,000. I'll remove this from our PGBP. I'll bring this also to IFOS head, FD interest. But however, here they have mentioned no TDS deducted, so no need of any grossing up and all. 76,000 as it is I will take. Now come on everybody, give me wholesome answers now. 76,000 FD interest. Does any other section come to your mind? FD interest, guys. You will think about chapter 6A. ATTTB, but ATTTB it will apply only if your assessee is a senior citizen or a super senior citizen. Assessee is an individual. Assessee is at least 60 years old. I'll assume assessee is a resident, so assessee becomes a senior citizen. So because assessee is a senior citizen or a super senior citizen, FD interest, RD interest, savings interest from bank, cooperative bank or post office, I will get deduction under ATTTB. So under chapter 6A, I will leave some 3 to 4 lines for ATQQB, and here I'll have section ATTTB. It is 76,000, guys, but under ATTTB you know very well, maximum how much deduction do you get? Maximum 50,000 only you will get. Okay guys, so this was about your FD interest. Then a closing stock, nothing to do. Now comes my debit side, opening stock, purchases, salary and wages, expenses relating to books authored by her. What about this? So from the book, whatever royalty income she had, we took it into IFOS head, guys. So therefore, don't you think even this expense relating to book, even this expense has to go into IFOS head? Okay. So first you'll have to remove it from your PGBP. How will you remove an expense? How will you remove a debit? By crediting it, by adding it back. So under add expenses debited but not allowed, expense relating to books. The amount is 75,000. So we are adding it back. We are removing a debit, we are reversing a debit by adding it back. Okay, this was about your expense with respect to books. But see, you've removed it from PGBP, but then you will allow it in IFOS head, right? In IFOS you're having royalty income, so against this royalty income you can subtract the expense relating to books, which is 75,000. So now tell me, what's your net taxable royalty? You will get 3,75,000, right guys? I hope you're solving with me. Don't just watch. Pen, paper, calculator. Actually sit and solve with me. Okay, you need that kind of practice before your exams. So this was about your expense relating to books. Then come on guys, very interesting adjustment. We have expense in connection with dividend. Step by step. First, what should I do in my P&L account? I'll have to remove this from my P&L account, guys, because this is not relating to my business or profession. So how will you reverse a debit? By crediting it, that is, you will add it back. So add expense debited but not allowed. Over here, expense relating to dividends. The amount is 12,000 rupees. So I'm removing it from my P&L. I'm reversing the debit by crediting it. Now it will go into which head? It will go into your IFOS head because it's relating to dividend. But guys, do you remember, against dividend income only one expense can be subtracted, and that is interest expense. And that too maximum how much? Maximum 20% of the dividend income. Here tell me, they're just saying expense in connection with dividend, but have they said it is interest expense? No guys. So therefore I will not allow this against your dividend income. Understanding? Had it been interest expense, then okay, I would have allowed it against your dividend income. Maximum 20% of the dividend income I would have allowed as the expense. But here they did not say it is interest expense. They're just saying it is expense. So therefore I will not allow this expense against my IFOS. But please know that in the examination, of course, you're free to make an assumption. You can assume that this is interest expense, and then you will check the 20% limit. So 20% of your dividend income, 20% of 5 lakh will be 1 lakh, and here your expense is only 12,000. It is within 20%, and in that case you will fully allow it. So according to whatever assumption you make, according to that your answer will change. But I have assumed over here that this is not interest expense, and therefore I am not allowing. Okay. Then comes your next adjustment, repair and maintenance. I'll assume it is relating to the business of my SSE. Nothing to do. Then amount paid to IIT for scientific research. Scientific research contribution to outsiders, guys. Under normal regime it is allowed. Only under default regime only it is not allowed. Then computers and other electronic items purchased on 1st December 24. What about this? Step by step. No tension. No hurry. First of all, what should I do in my PGBP? See guys, can you debit this expense in your P&L? No. You have to claim depreciation on this. So first of all, I will remove the debit. How will you remove the debit? By crediting it, by adding it back. So computers and electronic items, the amount is 4,50,000. First of all, I'll remove it from my P&L. I'll add it back. Then on this computer and electronic items, I will claim depreciation. So expense not debited but allowed. Over here, depreciation on computer 4,50,000. What's your depreciation rate, guys, on computers and all? 40% depreciation rate. Then purchased on 1st December 2024 only, guys. So even if I put it to use on the same date, definitely put to use for less than 180 days. So therefore you will get only half year's depreciation. Okay. And computers, electronic items, Assessee is not a manufacturer. So therefore I will not think about additional depreciation also. So your total depreciation will be 4,50,000 into 40% into 50%. This is going to be 90,000. Alright, easy, guys. And then we have the net profit number. Don't forget to write this in your PGPP calculation. 20,69,000. Easy. Yes, guys, not difficult at all. Till here, all fine. So till here, what were all our adjustments? First of all, family pension, we took this into our IFOS head and we remembered to give a deduction over there. 1/3 of the pension received or 15,000, whichever is lesser. Then royalty we took it to IFOS head and later we will also think about it in ATQQB. Then dividend, we took this also into IFOS head, we crossed it up. Then FD interest, this also we took into IFOS head and we also gave ATTTB. Then looking at the debit side, expenses relating to the books, we allowed this against our royalty income in IFOS head. Then expense in connection with dividend, they did not say it is interest expense and that is why I did not allow it. Only interest expense is allowed, no other expense is allowed against dividend income. Then scientific research, contribution to outsiders, we're doing computation under normal regime. Under normal regime it is allowed. And lastly, computers, guys, we give 40% depreciation. Okay, till here clear. Now come to the additional information. The question says purchase includes 2 lakh rupees relating to flowers and creepers directly purchased from a farmer in cash. Come on everybody, tell me the 3 golden rules of PGPP which I've taught you. When we talk about the mode of payment, we will think about 2 sections, 40A3 and 40A3A, right, guys? When they talk about the date of payment, we will talk about section 43B, and when they talk about TDS deducted, not deducted and all, we will think about section 40A1 and section 40A1, yes, the case may be. Here they're talking about the mode of payment. We've made the payment in cash. So therefore you will think about these sections 40A3, 40A3A. Now see, guys, clearly more than 10,000 rupees. You have made the payment in cash. Clearly you've made the payment in non-specified mode. But however, we have rule 6DD. Right, guys? Rule 6DD says there are a list of exceptions, right, in rule 6DD, to which section 48.3, 48.3 and all will not apply. So in that list, if you remember, one of the points is if assessee is making payment to a farmer, or if assessee is making payment to a dairy farmer, or if assessee is making a payment to a poultry farmer, or if assessee is making a payment to a fisherman, then in all those cases 48.3 itself will not apply. So in this situation, assessee is making payment to a farmer in cash. It's okay. Rule 60D exception will apply over here. So even though you made the payment more than 10,000 in non-specified mode, it's okay. There will be no disallowance over here. Okay, this was one interesting point. Then comes your next adjustment. Repairs and maintenance includes one-time deposit of 2 lakh rupees paid to electricity and water department. What about this, guys? Remember, we had repair and maintenance over here, 3,25,000. In this 3,25,000, 2 lakh is one-time deposit paid to electricity and water department. It's a deposit, guys. Is it an expense? No, it's not an expense. It's a deposit. So you'll have to reverse it, right? Because it's not a business expense. It's a deposit. So therefore, how will you reverse a debit? How will you reverse a debit? By crediting it, you'll add it back. So repair and maintenance, we have a deposit over here. The deposit amount is 2 lakh rupees. We are reversing it from your debit side. We are crediting it. Okay. Then comes your next adjustment. Be careful to make some corrections in your answer now. The question says computer and other electronic items includes 1 lakh rupees paid for television and washing machine for household use. So because you're using this 1 lakh rupees for household purposes, that is not for business or profession. Therefore, on this 1 lakh, you will not get depreciation. What did we do, guys? We allowed depreciation on full 4 lakh 50. In this 4 lakh 50, 1 lakh is not used for business. So therefore, you should get depreciation only on 3 lakh 50. So come on everybody. Recompute your depreciation now. 3,50,000 into 40% into 50%. 70,000 will be your corrected depreciation number. This was also easy. Now come to the next adjustment. Salary and wages includes salary paid 2,40,000 to her illiterate brother. Reasonable salary as per market rate is 1,80,000. Which adjustment comes to your mind? Market rate is 1,80,000. We are paying 2,40,000 to illiterate brother. Section 40A subsection 2 will come into your mind, guys. But I've always told you, don't straight away go and disallow the expense. Sing your whole song. What are your conditions? How many conditions? 3 conditions, guys. Condition number 1, assessee has incurred an expense relating to to business or profession. Condition number 2, the expense is excess or unreasonable. And condition number 3, who is the other party? The other party is a relative. And who is relative for the purpose of 48 subsection 2? I have taught you plus spouse with arrows, right? So which means if I am the assessee, then relative will include my brother, my sister, my parents, grandparents, great-grandparents, and so on, my children, grandchildren, great-grandchildren, and so on, and my spouse. Here tell me, are your conditions fulfilled? Condition number 1, has your assessee incurred an expense? Yes guys, salary is expense. Condition number 2, is it excess or unreasonable? Yes, it is excess or unreasonable. Market rate is 1,80,000. We are paying 2,40,000. So it is excess by how much? The expense is excess by 60,000 rupees. Then is the other party relative? The other party is a brother. Brother of the assessee will come under relative. So all my conditions are fulfilled. Now come on, go ahead and disallow the expense. So under section 48 subsection 2, be careful. You will not disallow the whole expense. You will disallow only the excess portion. It is excess by how much? It is excess by 60,000. Okay, your salary to brother, it is excess by 60,000. So the excess portion only you will disallow. Okay, now comes the fifth adjustment, a very interesting adjustment. The question says she purchased a residential house for 110 lakh rupees, for which a loan of 75 lakhs was taken from SBI. Okay, accrued interest was 3,37,500 till 31st March 25, which was paid on 10th April 2025. No principal amount and interest was paid by Mrs. S.C. Bose till 31st March 25. Ground floor of the house was used for shop and the first floor was occupied for her residence. So we have a property. Now in this property there are two floors. We have the ground floor and the first floor. The question says ground floor of the house was used for shop. So ground floor is used for business or profession, guys. So when you self-occupy a property for business or profession, this ground floor will go into which head? It will go into PGBP head. So all the expenses relating to your ground floor will go into your PGBP head. What about the first floor? The first floor was occupied for her residence. First floor is self-occupied by her for her residence. So therefore this will go into your IFHP head. Okay, no tension, slowly, little by little. Now read the adjustment again. She purchased the house for 110 lakh rupees. Number by number. What to do with this 110 lakh rupees? Anything to do with the purchase price in IFHP head? Nothing. But in PGBP head, anything to do with this 110 lakh rupees, guys? Yes. You come and think. You purchased one building. You're using it for your business or profession. So anything that you can claim, depreciation you can claim, no, on this shop, on the ground floor at least. So less expenses, not debited but allowed over here. Depreciation on shop. Yes guys, see, but I can't claim depreciation on the whole 110 lakhs. I can't claim because only ground floor only is used for business or profession. So only for half of the property only I can claim depreciation. And what's your rate of depreciation, guys? Building, office building, building used for business or profession, depreciation rate will be 10%. So, and let's say it was put to use for more than 180 days. So 110 lakh into 10% divided by 2. 5,50,000 will become your depreciation for this shop. Okay, moving on to the next adjustment now. The question says accrued interest was 3,37,500 till 31st March 25, which was paid only on 10th April 25. Now this interest, tell me, will it affect your IFHP head? Yes guys, self-occupied property, section 24 deduction you will get. So, but then half of the property. So therefore half of this interest only will go into your IFHP head. Similarly, the balance half will come under your PGBP head. Now the balance half in PGBP head, is it already debited to the P&L? No guys, when we were reading the debit side, we did not have interest at all over here. So we will allow the interest in PGBP head. So what is the interest amount? The interest amount is 3,37,500. So 3,37,500 divided by 2. So when it comes to interest, in our PGBP head, the interest that we now have to allow, we now have to debit 1,68,750. In our IFHP head, the balance 1,68,750. Okay, now see, be careful. The question says this interest amount was paid when? It was paid only on the 10th of April 2025. So tell me guys, was the interest paid during the year or was the interest paid after the year? Interest was paid after the year. Now in IFHP head, it doesn't matter when you pay the interest. In IFHP head, whatever is interest for the year, accrual basis we allow. So even though you did not pay the interest during the year, no drama in IFHP head. Life is simple. Whatever is interest of the current year, it will be fully allowed in IFHP head. Self-occupied property guys. So you will think about two limits. 30,000 limit and 2 lakh limit. Here if you see, the loan is borrowed on or after 1st April 1999. Loan is borrowed for purchase or construction of the property. Let's assume purchase construction got completed within 5 years from the end of the year of borrowing. 2 lakh limit will apply. Interest is within 2 lakh only. So IFHP head, no tension over here. Full amount of interest will be allowed. Now what about PGBP head? Tell me everybody. Again, think about the 3 golden rules of PGBP. They're talking to us about the date of payment. You will think about section 43B. So will 43B apply to interest? Yes guys, 43B says if you have to pay any interest to 5 people, to bank or to financial institution or to NBFC or to SFC, State Finance Corporation, or SIIC, State Industrial Investment Corporation, if you have to pay interest to any of these 5 people, you actually have to make payment of the interest within 139 1 date. Only then it will be allowed. Here, when did we make the payment? On 10th April 25. Okay, we made the payment after the year got over, but we have made the payment within 139 1 date, right? So therefore, under 43B also, no tension over here. In PGBP head also, it will be allowed. Alright guys. Then the question says, no principal amount and interest was paid till 31st March. About interest, we already spoke about it. What about the fact that no principal amount was paid? Had your assessee made the payment of the principal amount, then you may have enjoyed section 80C deduction for the principal repayment. There also you have conditions, but I will think about all those conditions only if assessee had made the payment. Here the question says no principal amount was repaid, so therefore no 80C also, and no interest was paid, that we already spoke about. Not a tension in IFHP head, and PGBP head also no tension, because even though it was not paid during the year, at least it was paid within 139 1 date. Alright, so come on, let's handle these 2 numbers now. So in your PGBP head, less expenses not debited but allowed. Over here, interest 3,37,500 into 1 by 2, 1,68,750. Then I'll have IFHP head guys, self-occupied property. So come to your main answer, IFHP. I'll open working note number 4. So after your working note number 3, I'll open working note number 4 for IFHP. Self-occupied property. Normal regime self-occupied property, you can enjoy the interest. Only in default regime, you can't enjoy interest for self-occupied property. First, we're computing under normal regime only. So NAV will be 0. Then less deductions under section 24. Only one deduction you will have for self-occupied property, which is interest. You will immediately think about 2 things, pre-construction interest and current year interest. Here, no pre-construction interest guys. They have not given us the date of borrowing, date of construction completion and all. Only current year interest I have, 168,750. I have already checked it is within the limits and all. So therefore, what's your net number now? You have a negative number, 168,750. You have loss from house property. Okay, and what do you do with loss from house property? What do you do with losses? You straight away take them to the margin. So you have loss from house property, 168,750. Self-occupied property loss, this is okay. This adjustment is also done. Now come on everybody, come to the next adjustment. She purchased an electric vehicle on 30th September 24 for 25 lakh rupees for business purposes. What are the things coming to your mind now? Think through it slowly. No tension, no hurry. She purchased electric vehicle. Immediately, first thing that will come to your mind will be ATEEB guys. But ATEEB, then you will check your conditions. See, first of all, ATEEB will be nothing but interest incurred on loan borrowed to purchase electric vehicle. Here it is electric vehicle, but did you borrow any loan? Are you paying any interest? No guys, the question just says she purchased an electric vehicle for business purpose. So therefore, no question of ATEEB and all over here, because there is no interest on electric vehicle loan first of all. Then what to do with this? She purchased a vehicle for a business purpose. So you will claim depreciation on this. That's all guys. So coming back to your PGBP, less expenses not debited but allowed. Over here, depreciation on your electric vehicle, 25 lakh rupees into 40%. Electric vehicle depreciation rate is 40%. 30th September 24, definitely put to use for more than 180 days. So 25 lakh into 40%, 10 lakhs will be your depreciation. No additional depreciation and all, because SSE is not a manufacturer. Okay, so that's all guys. Then we have one last adjustment. She sold 10,000 listed shares of SBCL Limited for 11,66,000. Your favorite adjustment, capital gains. She sold listed shares. So she sold listed shares for 11,66,000. This becomes your full value consideration. Sold on 11th December 24. This becomes your date of transfer, which were purchased for 2,65,000. This becomes your cost of acquisition. Purchased on 16th August 24. This becomes your date of acquisition. Then the question says STT was paid on purchase and sale both. So come on, capital gains guys. So come to your main answer, write down capital gains, give reference to working note number 5. Then after your working note number 4, open working note number 5, capital gains. Come on, your usual thinking process. We will start with the capital asset transferred. What are we transferring over here? We are transferring listed shares. Then what's the period of holding? When did we buy these shares, guys? We bought them on 16th August 24. When are we transferring these shares? 11th December 2024. Pause. This date of transfer, before amendment, after amendment? Clearly on or after 23rd July 24. Now margin, how many things will you think about? Same 4 things, guys. Will section 50AA apply over here? Listed shares. 50AA will not apply. After amendment, how many periods of holding are possible? Only 2, 12 and 24 months. These are listed shares. So your relevant period of holding will be 12 months. Then will you get indexation benefit? After amendment, guys, so therefore no indexation benefit. So now tell me, the 12 months, is it more than 12 months? Is this period more than 12 months? No, it is within 12 months. So therefore what kind of asset? Short-term capital asset. Section 111A STCG, guys, because it is listed equity shares and you are paying STT on transfer, so therefore section 111A STCG. Now comes your computation. Full value consideration is 11,66,000. Only 2 adjustments are possible over here, your 50C and 50CA. Both will not apply over here. It is not immovable property. It is not unlisted shares. Then there are no expenses on transfer. Remember, STT can never be an expense on transfer in capital gains. So no expense on transfer. This itself becomes your net consideration. Then you will subtract cost of acquisition. Then will you apply your grandfather clause, your 31st Jan 2018, all that discussion? No, all that is only in 112A. This is 111A. So no grandfather clause, no indexation also over here. I'll take the cost of acquisition as it is, 2,65,000. So your net number will now be 11,66,000 minus 2,65,000. 9,01,000 will become your STCG under section 111A. This was an easy adjustment over here. So 9,01,000. And remember, this is section 111A STCG. That's all, guys. So we can go ahead and close our working notes one by one. First, can you please add, subtract and give me the PGBP number? You'll get a loss, guys. You'll get a loss of 2,33,750. And what do you do with the losses? You take them to the margin. So you have business loss of 2,33,750. Then give me your net IFOS number. IFOS net number would be 12,96,000. Take this also to your main answer, 12,96,000. Then chapter 6A. Chapter 6A ATTTB we have 50,000. ATQQB we are yet to do the computation. So come on, tell me 3 steps we do over here generally. So your step number 1, royalty. What's your royalty income? Royalty income is 4,25,000. Then if it was in percentage, you would have restricted it to 15%. But here it is not talking about percentage and all, so no question of restricting it to 15%. That's your first step. Then your second step is, we will see if it is earned from outside India, it has to be remitted to India within 6 months from the end of the year. The question says it has been brought into India. So even that step is done. Then your third step is that in case you have any expenses, you're supposed to subtract the expenses. So how much is the expense with respect to the royalty? 75,000 of expense. So what's your net number after these 3 steps now? 4,25,000 minus 75,000, 3,50,000. Now you will compare this with, tell me, in ATQQB what's your maximum limit? Your maximum limit is 3 lakhs. So out of these 2 numbers, you will pick whichever is a lesser number. So 3 lakhs will become your ATQQB deduction. So your total chapter 6A will be 3,50,000. You're able to recall, right? We'll see how much is the royalty income. If it is in percentage, we will restrict it to 15%. If it is earned from outside India, then we will see how much has been remitted to India within 6 months from the end of the financial year, and then we'll subtract whatever expenses we have earned, whatever expenses we have incurred to earn the royalty. So after all these 3 numbers, we'll take our net number. Here it is 3,50,000. So 3,50,000 or 3 lakh, whichever is lesser, 3 lakh will be your ATQQB. So your total chapter 6 is 3,50,000. Okay, guys, that's it. Now come on, let's go ahead and close your total income under the normal regime. Close your solution now. So we have 2 losses, loss from house property and business loss. So I'll remove this first of all. Now tell me, I have lost from house property. First, I will try intra-head adjustment, guys. Do I have any income from house property left? No. So, no intra-head is possible. Now, business loss intra-head. Do I have any PGPP left with me? No. So, no intra-head is possible. So, if no intra-head is possible, then next you will try inter-head. And multiple times I've told you, when you have loss from house property and business loss, out of these two, you always give first priority to which loss? Always first business loss. Why? Because business loss has a lot of restrictions, like it can't be adjusted against salary set. Then if you file your ITR late, you can't carry it forward. You have multiple restrictions over here. So let's finish off business loss first. It can be adjusted against IFOS also. It can be adjusted against capital gains also. So let's say I adjust it against your IFOS head. So 2,33,750. Then you have, so this is fully exhausted. Then loss from house property, normal regime, guys. You can do inter-head adjustment, but maximum 2 lakhs only. Yes, it is not more than 2 lakhs anyways. So I'll adjust my loss from house property also over here. 1,68,750. Guys, make one small correction now. So basically in IFOS head, no, I wrote one number wrongly. Royalty income is 4,25,000. I wrote 4,50,000 by mistake. So correct it, okay. So 4,25,000 minus 75,000 expense. Your net royalty income will be 3,50,000. So your net IFOS will be, total IFOS will be 12,71,000. So please make this small correction. 12,71,000 is your IFOS. So now after setting off the losses, your net IFOS income will be 8,68,500. Okay, and then you have this capital gains of 9,01,000. So assessee's GTI will be 17,69,500. Do you get these numbers? Yes, guys. Then after this we have our chapter 6A. So chapter 6A give reference to working note number 3. By the way, PGBP was working note number 1. IFHP was working note number 4. So chapter 6A was 3,50,000. Remember, 3 lakhs of 80 QQB and 50,000 of 80 TTB. So your total income number under the normal regime is 14,19,500. Already in multiples of 10, therefore no need of any rounding off also. Okay, so this is half my answer, guys. This is as per the normal regime. Now we'll have to redo, we'll have to compute the total income as per the regular, as per the default regime also. Total income as per the default regime. Any tension? No tension, guys. What will we do? We will simply take our total income number as per the normal regime, that is this 14,19,500, and we'll make changes one by one. Okay, let's go one by one. So here if you see, first of all, loss from house property. Default regime, self-occupied property interest is always supposed to be 0. You can't adjust interest for self-occupied property in default regime. In default regime, let-out property, no difference, guys. In self-occupied property, you can't subtract interest. Self-occupied property answer will always be 0. But self-occupied property, you have subtracted 168,750 loss. Let's reverse that now. So loss from house property relating to self-occupied property, we'll reverse this loss. So we'll add back 168,750. Okay, then what else? Your chapter 6A. Chapter 6A 3,50,000. Under default regime, only 3 sections are allowed in chapter 6A: 80JJAA, 80CCD subsection 2 and 80CCH subsection 2. But in chapter 6A, in this question, you were claiming 80QQB and 80TTB. None of these 2 sections is allowed under default regime. So we'll reverse chapter 6A fully. We'll add it back. We'll add back 3,50,000. Then what else? Let's go through working note by working note. In PGBP head, anything to be reversed? Anything to be reversed over here? Nothing. But remember, guys, in PGBP head, we had contribution to outsiders, 35,000. Contribution to outsiders under section 35. If you follow the default regime, in-house scientific research, we will still allow. But contribution to outsiders, we don't allow. So contribution to outsiders, 35,000. We will add it back. It is disallowed, guys, under the default regime. Okay, then IFOS had anything to do? IFOS head, family pension number will change. No, because family pension in default regime, your maximum deduction will be 1/3 of the pension or 25,000, whichever is less. So 1,20,000 or 25,000, whichever is less. 25,000 will be the lesser number. So 25,000 deduction you will get. But here I have enjoyed 15,000 deduction only in normal regime. So in default regime, how much more deduction you will get? 10,000 more deduction you will get for family pension. So family pension deduction, 10,000 more deduction I will get. So I'll subtract 10,000 extra. You understood, right? In family pension, in default regime, your deduction is 1/3 of the pension, same 1/3, or 25,000, whichever is lesser. So 1,20,000 or 25,000, 25,000 will be lesser. So 25,000 will become your deduction. But here I deducted only 15,000. So extra, under the default regime, 10,000 extra deduction you will get. That is what I subtracted. Okay. Anything else will change? IFHP, I already reversed your self-occupied property interest. Capital gains, no change in default regime, guys. So that's all. If your assessee follows the default regime, then what will be the total income of your assessee? Total income will be 19,63,250 under the default regime. This is again in multiples of 10, therefore no need of any rounding off also. Simple, guys. Understanding. So this was an amazing question, total income question, guys, covering quite a lot of adjustments. So before I close this adjustment, can I quickly summarize for you all the major learnings that we had from this question? Come on, see. The first big learning, I would say, was a family pension point. Basically the family pension point with respect to your default regime. So in normal regime, how much deduction do you get? 1/3 of the pension received or 15,000, whichever is lesser. But in default regime, same 1/3 of the pension received or 25,000, whichever is lesser. So 10,000 extra deduction we enjoyed over here. Then royalty was fine, guys. We removed it from PGBP, we took it into IFOS head, and then we also thought about ATQQB. This was not a new adjustment for you. Then dividend, we remembered to gross up. FD interest, we thought about ATTTB. Then I will say that this was another interesting adjustment over here, expenses relating to dividend. Only interest expense is allowed, other expenses are not allowed. But here they did not say which expense is it. So you're free to make an assumption. If you assume it is interest expense, then up to 20% you will allow. But here I assumed it is not interest expense, and therefore against dividend I did not allow this expense. Okay, so this I will say was one interesting point over here. Then anything else new? Of course, yes, this rule 6DD point, I'm not sure if you were aware of it. So this also becomes another new point for us, that no doubt under mode of payment we do think about 40A subsection 3. No doubt, if you're making the payment more than 10,000 in non-specified mode, we disallow under 40A subsection 3. But rule 6DD gives us an exception. Rule 6DD says if we have to make a payment to a farmer or to a fisherman or to a poultry farmer, dairy farmer, or to a person selling meat, animal skin, animal hides and all these payments, even if it is more than 10,000, it is okay. Pay in whatever mode you want. So we applied rule 6DD over here. Then a one-time deposit. This was a deposit. It was not an expense. So therefore we had disallowed the deposit. This was another new adjustment for us. Then 40A subsection 2 and all, you were aware of all this. Then this interest adjustment also, I will not call it as a new adjustment, but however on this building part, remember we gave 10% depreciation. This I will highlight, guys. This is a silly mistake possible in the examination. My assessee had a building on in which he is carrying on his business or profession. So I should of course remember to enjoy depreciation on the building. So this I will definitely mark as one silly mistake area in this question that is possible. Alright. Then interest was fine over here. IFHP head, PGBP head. We spoke about 43B and all. Then electric vehicle was an interesting adjustment. Most of the students will immediately think about ATEEB. But ATEEB will come into the picture only if we pay interest on EV loan. Here there is no loan itself. So no question of ATEEB. And then finally we had, and one more thing was new over here. Some of you may not be aware of this. Electric vehicle, what is the depreciation rate? 40% was the depreciation rate for electric vehicle. This might have come as a surprise for some of you. And then our capital gains computation was pretty straightforward, nothing new to learn. So a lot of new learning in this question. I hope you're comfortable. Can I take you to the next question straight away, guys? Come to question number 8. Question number 8 is a case-based MCQ question. Simple question only, nothing to worry, relating to IFHP head. Okay. So question number 8. 1 minute. Here. Come on, let's read the question. So the question says, Reenu, a resident individual aged 48 years. So at this stage itself, you will conclude that Reenu, you are not a senior citizen, only 48 years old. She owns two flats, flat A and B in Hyderabad. Okay, so we have flat A and flat B, both are in Hyderabad. She lives in flat A. So flat A is self-occupied property, guys. Okay, and she is giving flat B to her in-laws for their residential purpose. So you tell me first of all, flat B is self-occupied or let out? Only two possibilities. Is it self-occupied or is it let out? She is giving it to her in-laws for residential purpose. So it will be as if it is self-occupied. Understand? Self-occupied property means either assessee himself or herself is occupying the property for residential purpose, or assessee's family is occupying. Basically, you're not having any rental income from that property. It is not a let out property, so it becomes a self-occupied property. She does not charge any rent from them. See, they've given you a hint also. She does not charge any rent from them. It indicates it is not a let out property. It is being used for her self-occupation or for her family's residence, so therefore self-occupied property. So A and B both are self-occupied properties. Then what happened? In the month of April 2024, she entered into an agreement to buy flat C. So one more flat she has now, flat C, from a builder in the same area as her other flats are situated. Then, in the month of September 2024, she took possession of this flat C and she started spending her weekends there after paying a token amount of 11,000 to the builder. So, flat C is also self-occupied property now. Agreeing. Why self-occupied property? Because the question says she is spending her weekends over here. So she is herself occupying this property. She is not giving it on rent and all. So flat C is also self-occupied property. Come on, now read the question carefully. In the month of September 24, she took possession. She took possession of this flat. She paid token amount of 11,000, some advance amount she has paid. However, flat C is still not registered in her name. So is she owner of this house, guys, first of all? Is she an owner of this flat C? See, she is not the legal owner because her flat is not registered in her name. But however, in IFHP head, we have the concept of deemed owner. In deemed owner, we have one of the points relating to 53A of Transfer of Property Act. As per 53A of Transfer of Property Act, condition number 1, there is a written agreement between the buyer and the seller. Condition number 2, either the buyer has paid the consideration or the buyer is willing to pay the consideration. And condition number 3, the seller has given the possession of the property to the buyer. So if all these conditions are fulfilled, then in that case, even though the registration of the property is still pending, still the buyer will be deemed to be the owner of the property, guys. Yes, so are the conditions fulfilled over here? See, is there a written agreement between the parties? Yes, there is an agreement between the parties. Has the buyer paid the consideration? See, the question says that she has only paid a token sum of 11,000. She has only paid an advance. So the condition says either you should have paid the consideration or you must be agreeing to pay the consideration. So she has paid token money. That itself indicates she is willing to pay the balance consideration also. And is the possession given to the buyer by the seller? Yes, she is spending her weekend in that particular property. So she is only enjoying the possession of the property. So all my 3 conditions are fulfilled. Hence, even though the flat is still not registered in your assessee's name, still she will be deemed to be the owner. So yes, she is an owner of flat C also. Alright guys, so here a little bit of deemed owner concept was also involved. So now flat A is also self-occupied, flat B is also self-occupied, flat C is also self-occupied, but you know very well, maximum how many self-occupied properties you can have? Maximum only 2 self-occupied properties you can have. So the remaining one has to be deemed to be let out property, right guys? So maximum 2 self-occupied properties, one of them will be deemed to be let out. So which of the following statements is correct as far as the taxability of the income from house property is concerned? Option A, any 2 flats of her choice will be treated as self-occupied, whereas a third flat will be treated as deemed to be let out. Sounds right, guys? Then 1 flat of her choice will be self-occupied, whereas the other 2 flats will be deemed to be let out. No, 2 flats self-occupied, 1 of them deemed to be let out. Then flat A will be treated as self-occupied, flat B will be treated as deemed to be let out, and flat C will not have any impact on her income as flat is not yet registered in her name. See, this option students will get confused if they don't know the deemed owner concept. Flat C, even though it is not registered in her name, still she will be deemed to be the owner. So even option C is not correct. Then all 3 flats self-occupied. This is terrible, guys, because maximum only 2 self-occupied properties you can have in your name. If you have more than 2 self-occupied properties, one of them has to be deemed to be let out. So option A. Alright guys, easy this was. So this is only new learning for us in this question. The reason why I am doing this question for you, the new learning is this 53A of TOPA. So if all these conditions are fulfilled, then even though the registration is not complete, still the buyer will be deemed to be the owner. What are the 3 conditions? There's a written agreement between the parties. Second condition, either the buyer has paid the consideration or buyer is willing to pay the consideration. And condition number 3, the possession of the property is with the buyer. So if all these conditions are fulfilled, even though the registration of the property is still not completed in the buyer's name, still the buyer will be deemed to be the owner. Alright guys, this was your question number 8. Moving on to the next question now, question number 9. This is from your clubbing chapter. I'll give you a quick reminder of the provision, okay? Very simple concept only. So in clubbing, you must have learned that, let's say there's an entity. In this entity, Mr. A, he along with his relatives put together is having substantial interest in this entity. And in the same entity, A's spouse is employed without professional or technical qualifications or experience and is getting salary from this entity. So how many conditions, guys? 3 conditions. Condition number 1, A along with his relatives is having substantial interest. Condition number 2, in the same entity, A's spouse is employed without qualifications and experience. Condition number 3, from that entity, A's spouse is getting salary. If all these 3 conditions are fulfilled, then the salary will be clubbed with A's income. This is a provision that you have learned, guys. Keep this provision in your mind. And now come to my question. The question says Sudipto is engaged in the business of retail trade as a proprietor. So he is having a sole proprietorship. He is a proprietor of an entity. Proprietor means what, guys? Full 100% stake he is having in the entity. Forget about substantial interest. He is having full 100% interest in the entity. He is a proprietor of the entity. Then they're giving us old information. During 21-22, long back, he paid 25,000 per month to his wife Swati as salary, being the marketing in charge. Swati does not have any professional qualification or experience for the job. So till here, if you see, do you agree with me that in this story, if I apply this provision as it is, Mr. A will be Mr. Sudipto over here. He along with his relatives in this entity, forget about substantial interest. Full 100% interest is there. So definitely substantial interest is there in this entity for Mr. Sudipto. Substantial interest because he's a proprietor of the entity. So full 100% interest he will be having. In the same entity, his spouse Swati is employed. She is employed without any qualifications or experience and she's getting salary from this entity. So all the 3 conditions are fulfilled. Therefore, whatever salary she's getting, that salary should be clubbed with Sudipto's income. That is what they have done. This income was clubbed in the hands of Sudipto as per clubbing provisions in 21-22. So correct only. What they have done is correct only. This situation is applicable. So whatever is Swati's salary income from this entity, it is clubbed with Sudipto's income. Perfect. Then what happened? Swati started her MBA studies and did not get any salary from 1st April 22 to 1st December 24. So because she was pursuing her MBA, in this period of around 1.5 years, 2.5 years, she was not getting any salary. Then what happened? She completed her MBA in marketing. So which means, guys, now she does have qualifications. So now the second condition will not be fulfilled. No, because now she is having qualifications. She completed her MBA on 1st December 24 and again joined her husband's business and again started getting 55,000 per month salary, which is as per the market norms. Now tell me, now also will you club the salary income? No, now also are the conditions fulfilled? No, guys. See, condition 1 is still fulfilled. Sudipto along with his relatives is having substantial interest in the entity. In fact, full 100% interest is having in the entity. But condition number 2 is not fulfilled. Condition number 2 says his spouse is employed in the same entity without qualifications or experience. This condition is not fulfilled anymore because now Swati is having qualifications or experience. So now the second condition is not fulfilled anymore and hence the salary income should not be clubbed anymore. Earlier, when she was not having qualifications or experience, we were clubbing the salary. But now she is having the qualifications or experience. This provision will not apply anymore and therefore you will not apply any clubbing provisions. The salary will not be clubbed. If salary is not clubbed, Swati herself will pay tax on the salary. That's all, guys. See which of the statements is correct now. Salary of Swati will continue to be clubbed in the hands of Sudipto. No. Salary of Swati will be taxed in her hands as now she has a required qualification. Yes, guys. Then salary of Swati will be taxed in the hands of Sudipta or Swati, whose income is higher. No provision like this. As a part of tax planning, Swati has the option to decide in whose hands the salary will be taxable. No. The income will be taxed in Swati's hands only. No clubbing provisions. She herself will pay tax on this. Okay guys, that's all. So this was one small simple clubbing adjustment that we got we had over here in this question. Now come to your question number 10. So question number 10 is from your TDS discussion. Okay, the question says Aryan, a resident individual engaged in retail trade of auto parts through various stores across Delhi NCR, had total turnover of 15 crores during financial year 23-24. So we have this person, Mr. Aryan, 23-24 turnover they have given, guys. Preceding previous year turnover they have given, it was 15 crores. Okay. Then the question tells us he purchased goods, which means Aryan is a buyer. So he purchased goods for 105 lakhs. So he is purchasing goods for 105 lakhs excluding GST 18%. So 105 lakhs plus 18% GST. So this is the total purchase that he is making during the year. When is he making the purchase? On 21st May 2024 from Diva LLP, an LLP resident in India. So the seller over here is Diva LLP. The seller. Out of these purchases, goods worth 5 lakhs excluding GST were returned on 20th July 24. So the first transaction he made the purchase. Then later after that second transaction he returned the goods. He returned goods worth how much? He returned goods worth 5 lakhs plus 18% GST on 20th July 2024. And why did he return? He returned because of some quality issues, for which Diva LLP refunded the money on 20th February 25. Assumed turnover of Diva LLP during 23-24 was 8 crores. So Diva LLP, the seller, their preceding previous year turnover is equal to 8 crores. Now come on everybody, which TDS, which TCS? So they're talking about goods over here. So therefore first you will try 206C1F and 206C1. These sections will not apply because it is not motor vehicle, it is not atoms. So then you will come to 194Q. Now in 194Q, what are your conditions? Tell me. Condition number 1, the buyer, his preceding previous year turnover has to be more than 10 crore. Is this condition fulfilled, everybody? Please check. My buyer is Mr. Aryan. His preceding previous year turnover is 15 crores. Yes, it is more than 10 crores. Then condition number 2, no other TDS should apply, no other TCS should apply. Yes, 206C1F, 206C1 are not applying. Condition number 3, the aggregate transaction between the buyer and the seller has to be more than 50 lakhs, guys. Yes, here it is more than 50 lakhs. So all your 3 conditions are fulfilled. Therefore, 194Q will apply. Under 194Q, what's your TDS rate now? Your TDS rate is 0.1%. But 0.1% of what? 0.1% of the excess above 50 lakhs. So what is the excess above 50 lakhs? 105 minus 50. This is going to be 55 lakhs. So 55 lakhs into 0.1%. 5,500. This will become your section 194Q TDS, guys. When do you deduct this? At the time of payment or credit, whichever is earlier. And by the way, should I have included GST? You know very well, in 194Q, only if payment is earlier, only then you include GST. If credit is earlier, then you don't include GST. Now here guys, in this question, they have not given me the date of payment. They've only told me that the transaction, the purchase happened on 21st May 24. So this is the date of credit. They have not even given us a date of payment over here. So you can't say that payment happened before credit. So therefore, we did not include GST. If payment was earlier, if payment was first, then you would have included this GST number also. On that only you would have deducted TDS. But here, because payment is not earlier, we have taken 105 lakhs as it is without including GST we have taken. Okay, simple. Till here it is pretty fine. Then why are we doing this question? The reason is the second part. The question says that first, on 21st May 2024, we did the purchase, guys, 105 lakhs. And on this 21st May 2024, 5,500 rupees TDS was deducted. Little later, on the 20th of July 2024, the buyer has returned goods to the seller. He has returned goods worth 5 lakh rupees to the seller. So now, on this 5 lakh rupees, what's your TDS? same 0.1%, 550 rupees, guys. So this becomes extra TDS that you have deducted, right? On 21st May 24, on the basis of the entire 105 lakh sale, on this basis you've deducted TDS 5,500 rupees. Later, 5 lakh rupees of purchase you're returning. So to this extent, your purchase has become lesser. Now, what will happen to this TDS amount? Will you ask the government to give this much money back to you? No, nothing of that sort will happen. Instead, very simple, guys. This 550 rupees extra TDS which you have deducted now, this will simply be adjusted against the next purchase. So whenever your buyer, whenever Aryan purchases goods again from Deva LLP, subsequently whenever again he purchases, that time against the next purchase, this 550 rupees will be adjusted. Okay, so what's your learning point over here? Two learning points. Learning point number one, why we did not include GST? Only if payment is earlier in 194Q, only then you include GST. Learning number two, for now we have deducted tax on the full 105 lakhs. Later, when my assessee, when Mr. Aryan, when he returns goods worth 5 lakh rupees, at that time the TDS on that purchase return, this 550 rupees, will simply be adjusted against the next purchase. So to this extent, you will not ask for a refund from the government and all, you will simply adjust it against the next purchase. Okay, so this was your question number 10 with respect to purchase return, 194Q plus purchase return. Okay, now come to question number 11. Question number 11 is from your capital gains. Let's read the question and then we'll work this question out fully. The question says, Mr. Money, a resident individual aged 45 years. So at this stage, you can conclude, Mr. Money, you are not a senior citizen. You're only 45 years old. He acquired a plot of land. So we're talking about a plot of land. He acquired it in March 2002. So March 2002 becomes your date of acquisition. He purchased it for 12,25,000 rupees and he paid stamp duty of 1 lakh on registry of the land. So what is his total cost of acquisition now? When he has purchased the land, he has spent total 13,25,000 rupees. Okay, 12 lakh 25 for the land and 1 lakh for registration, stamp duty. Then the question says he sold this land on 10th October 24. This becomes your date of transfer. He sold it for 80 lakh rupees. This becomes your full value consideration. Then they've given you the stamp duty value, which means of course you will think about section 50C. So stamp duty value assessed by the sub-registrar was 83,50,000. This is the SDV. Advise Money about which option of computation of capital gains is more suitable for him as far as his tax liability is concerned, on the assumption that he has no other income chargeable to tax and he has not opted out of the provisions of 115 BSE. So be careful over here, guys. He has not opted out of 115 BSE. So your entire computation over here will be as per 115 BSE. They're asking you to find his tax liability. Come on, guys, let's begin our game. So our usual capital gains computation, we will start with the capital asset transferred. What are we transferring over here? What's our subject matter? Our subject matter is a plot of land. Then we will see the period of holding. Tell me, when did your assessee buy the asset? The date of acquisition. He purchased it in March 2002. And when is he selling away the asset? What's the date of transfer? Your date of transfer here. Date of transfer is 10th October 2024. 10th October 2024. At this stage, I always make you pause, check and think. Before amendment, after amendment. Clearly on or after 23rd July 24, after amendment. So now come on, guys, come to the margin. Will section 50AA apply over here? Plot of land, 50AA will not apply. Then how many periods of holding are possible after the amendment? Only 2 periods of holding are possible, 12 months or 24 months. This is immovable property, guys. So your relevant period of holding will be 24 months. And will you allow indexation? The transfer has happened after the amendment, so therefore no indexation. Now come on, come back, 24 months. Is this period more than 24 months? Definitely it is more than 24 months. Therefore this becomes a long-term capital asset. First you will of course try section 112A, but this is a plot of land, not listed equity shares and all. So 112A will not apply, 112 will apply. Now come on everybody, as soon as you conclude 112 will apply, you immediately think about your 4 conditions. Same thing I had made you do in the question earlier as well. You think about your 4 conditions. If all these 4 conditions are fulfilled, then by chance you have to compute tax, then extra drama. What are the 4 conditions? Come on. It will be a second revision for us. Sometime back only we spoke about the 4 conditions. Condition number 1. Who is the assessee? The assessee is a resident individual or HUF. Then condition number 2. The capital asset has to be some immovable property. Condition number 3. The date of transfer should be after the amendment. So on or after 23rd July 24. And condition number 4. The date of acquisition. When did you buy the asset? That should be before 23rd July 24. Tell me, are your conditions fulfilled? Is your assessee a resident, individual or HUF? Yes, yes, yes. Then is the capital asset immovable property? Yes, yes, yes. Is the date of transfer after the amendment? Yes, of course it is after the amendment. And did you purchase the asset before the amendment? Yes. All your conditions are fulfilled. Welcome to a little bit of drama now. If at all you have to compute tax on this LTCG now, whatever capital gains you compute without indexation on that 12.5%, then you will have to recompute capital gains for the purpose of tax. You will have to recompute with indexation, and on that recomputed capital gains 20%, and out of these two, whichever is lesser, that will become your basic tax, guys. Yes, so come on, let's begin. First, our usual computation, guys. A full value consideration. 2 sections will come to your mind over here, 50C and 50CA. Here, I can't talk about 50CA because you're not talking about unlisted shares and all. We will talk about 50C. They have given us the STV and all. So tell me 50C, I always tell you, don't straight away jump to the section. Check your conditions. Condition number 1, the capital asset has to be land, building or both. Yes, it is land, building or both. Condition number 2, the STV has to be more than 110% of your full value consideration. Okay, full value consideration over here is 80 lakhs. So 110% of 80 lakhs will be 88 lakhs. Your STV is 83 lakh 50,000 only. Tell me, is your STV more than 110% of FVC? No. So therefore, will 50C apply? 50C dustbin. So full value consideration will be your actual FVC only. Your actual FVC is 80 lakhs. Understanding? Yes, guys. Please don't jump your steps. Don't skip your steps. Don't skip your sequence. When you come to FVC, you always think about 2 sections, 50C and 50CA. When it comes to 50C, don't straight away take the STV number. Check your conditions. Otherwise, your answer paper will be filled with silly mistakes, guys. Little things like these. Ensure you remember. Condition number 1, capital asset has to be land, building or both. Condition number 2, STV has to be more than 110% of FVC. Here, only if both the conditions are fulfilled, only then 50C will apply. Here, STV is not more than 110% of FVC. So therefore, 50C will not apply. So therefore, I am continuing with my actual FVC number only. Then, any expenses on transfer have they given? No. So this itself becomes my net consideration. Then from this, I will subtract cost of acquisition. Tell me, will your grandfather clause apply? That 112A, the 31st Jan 2018, all that will not apply, guys. Then can I please index the cost of acquisition? That we've already concluded. No indexation. So therefore, I'll take my cost of acquisition as it is, 13,25,000. We'll take our cost of acquisition as it is. No cost of improvement, guys. So therefore, the capital gains of your assessee will be 66,75,000. This will become your section 112 LTCG. Okay. But the thing is, in this question, they have not asked us to find just LTCG. They have asked us to find tax liability. And they're also saying that assume that he has no other income. So which means this capital gains is the only income. Okay. So if this is his only income, then what is the assessee's total income? Same 66,75,000 will become the total income. Okay, guys. Now I'll enter into my tax computation. So tax computation, come and recall your rule 0. Your rule 0, you will start with the regime. Which regime are we following over here? 115 BSE. And in 115 BSE, what's your basic exemption limit? Your basic exemption limit will be 3 lakh rupees, guys. So come on, let's find the basic tax of the assessee first. But be careful. We have already done this discussion. Our 4 conditions are fulfilled. So therefore, to compute tax on this 112 LTCG, a little bit of drama. So come on. Without indexation, we have computed 66,75,000 on that 12.5%. Then we'll have to recompute our capital gains with indexation on that 20. And out of those 2 numbers, we will pick whichever is lesser. So to compute my basic tax, let's finish off this part first. So 66,75,000 is my LTCG without indexation. Slow down. My basic exemption limit is 3 lakhs. I don't have any normal rate income. Can I adjust my basic exemption limit against my 112 LTCG? Yes, provided my assessee is a resident, and my assessee is a resident. So I can adjust my basic exemption limit. Now this will become your balanced taxable LTCG. On this 12.5%, how much will be your tax? You will get 7,96,875. This is left side without indexation on that 12.5%. Now we will have to recompute our LTCG with indexation, and on that 20% we will take, guys. So come on, let's do the recomputation now. My full value consideration, my net consideration remains 80 lakhs. My indexed cost of acquisition, I will index the cost of acquisition now. So your cost of acquisition is 13,25,000 into CII of the year of transfer. When did the transfer happen? 24-25. 24-25 your indexation is 363. Divided by 2001 to your indexation is 100. So your indexed cost of acquisition will be 48,09,750. So 48,09,750. So your capital gains will be the difference of 31,90,250. Now answer one small question before I take you to the tax computation. In your total income, can this number ever be a part of your total income? No, guys. Remember, you're doing all this computation over here only for the purpose of tax. Your actual capital gains number is this capital gains number without indexation only. You are recomputing with indexation only for the purpose of tax computation, not for the purpose of your income computation. So as a part of your income, this number which you have calculated without indexation, this only will form a part of your total income. When you are recomputing your capital gains with indexation, this will not form a part of your income. This is only for the purpose of your tax computation. So come on, now bring this number to your tax computation. So with indexation, your capital gains is 31,90,250. So against this you will subtract your same basic exemption limit of 3 lakhs on this 20%. So this will work out to 5,78,050. So you will pick whichever is lesser. So 12.5% on capital gains with indexation, 12.5% on capital gain without indexation, or 20% on capital gains with indexation, whichever is lesser will be your basic tax. So clearly this 578,0850 is your lesser number. This will become your basic tax. No other income assessee has. No rebate you will get, guys, because your assessee's total income is more than 7 lakhs. But then will you have surcharge? Of course, yes, you will have surcharge. Assessee's income is more than 50 lakhs. So surcharge will be at the rate of 10%. 57,805 will be your surcharge. No marginal relief. So straight away you will add cess. So 6,35,855 will be your tax after surcharge, plus 4% cess. After adding cess, 6,61,289. This will be your tax liability. Of course, you will remember to round it off to the nearest multiple of 10. So 6,61,290. This will become your final tax liability, including surcharge and cess after rounding off. Understanding? So if you're noticing, we're doing multiple questions on this 112 LTCG, right? Because in the last few attempts, multiple times they've asked this, guys. So be careful about your tax computation. Are you noticing? As soon as I identify 112, here itself I check whether my conditions are fulfilled. If conditions are fulfilled, if I have to compute tax, then all this extra drama will apply. But don't forget, you're recomputing capital gains only for the purpose of tax. So this recomputed capital gains number will never form a part of your total income. It's only for the purpose of tax. Alright, everybody, and don't forget to subtract your unadjusted basic exemption limit. Don't forget to adjust that against capital gains if assessee is a resident. Alright, by the way, this unadjusted basic exemption limit over here like this, can you adjust against lottery income also? No. Can you adjust against your cash credit unexplained incomes also? No, not in all those places. You can adjust like this your unadjusted basic exemption limit only against capital gains. 111A STCG, 112A LTCG, 112 LTCG. Against these three you can subtract provided assessee is a resident. That's all, guys. Easy. Yes, simple. Now come to the next question. No tension. It's all easy. Come to question number 12. One small advanced tax discussion I wanted to have with you over here. Now, with respect to advanced tax, let me remind you about the provision first. I've always told you, before you even do the hard work of doing any computation under advanced tax, we have a rule, guys. What is the rule? Tell me. For advanced tax, we will check two things, right? If any of the two things are applicable, then advanced tax will not apply for the assessee, right? What are the two things? Tell me. Thing number one, the assessed tax. If the assessed tax happens to be less than 10,000 rupees, then in that case, advanced tax will not apply for the assessee. Or if assessee is a senior citizen or a super senior citizen, and if this assessee is not having PGBP, then also advanced tax does not apply to the assessee. So this is a basic rule that we have made for ourselves. If any of these two rules apply in your case, then advanced tax will not apply for that assessee. Keep this in your mind and come to the question. Which of the following statements is true regarding the liability to pay advance tax? The first sentence says, advance tax is payable only if the total income exceeds basic exemption limit. No, there is no such rule. Even if the total income exceeds basic exemption limit, still, if any of these two situations are applicable, then advance tax will not apply. This statement is wrong. Then advance tax liability arises only for those who have income from business or profession. No, this sentence is not right for every assessee. It is right only for senior citizen, super senior citizen. For other assessees, whether they have PGBP or whether they don't have PGBP doesn't matter. So even this sentence is wrong. Then Ramesh and Sons HUF has to pay advance tax if the advance tax payable is rupees 10,000 or more in a financial year. Correct, guys. Because if the advance tax payable is less than 10,000, then you don't have to pay advance tax. Only if it is 10,000 or more than 10,000, only then you have to pay advance tax. So option C is correct. Then Mr. Suresh opting for presumptive taxation under 44 ADA is required to pay advance tax in 4 installments. Wrong. If you are following presumptive taxation under 44 AD or under 44 ADA, then you still have to pay advance tax. Full 100% advance tax you have to pay, but only in the last installment, remember. But if it is 44 AE, then you have to pay all the 4 installments. But in these two presumptive taxation sections, you have to pay only in the last installment. So option D is wrong. So therefore option C. Okay. So just wanted to give you a reminder of this rule that we had made for ourselves, that when it comes to advance tax, you will not even do any hard work unless your basic rules give you a green signal. Only if none of these two situations are applicable, only then advance tax will apply. If any of the two situations are applicable, then advance tax will not apply. Okay. Now come to question number 13. This is a small adjustment with respect to TCS. I'll give you a reminder of the provision first. We have section 206C1C, right? 206C1C talks about lease. Lease or license of 4 things, guys. Lease or license of a quarry, or lease or license of a mine, or lease or license of a toll plaza, or lease or license of parking. So in case any of these are given for lease or a license is given for any of these, then against a consideration 2% TCS will be collected, guys. This is 206C1C. But however, the person from whom we are collecting TCS, that is, like for example, let's say the state government is giving you a mine on lease. Okay, now you are going to be paying consideration for this mine. So along with the consideration, you'll also have to pay 2% TCS, right? But however, this person from whom we are collecting the TCS should not be a public sector company. Should not be a public sector company. So if the person from whom we are collecting TCS in 206C1C, if this person happens to be a public sector company, then TCS will not apply. Okay, this small point only. Can now come to the question. XYZ Limited, having an idle parking lot, opted to lease it through a public bidding process. PQR Limited, a PSU, a public sector undertaking, emerged as a highest bidder and will utilize the premises for its business operations under the lease arrangement. So here we have two people, guys. We have XYZ Limited and we have PQR Limited. PQR Limited is a public sector undertaking. So XYZ Limited has a parking lot. They wanted to give it on lease, and PQR Limited is the highest bidder. So they are going to give the parking lot on lease. So parking lot, guys, clearly 206C1C. They're going to give the parking lot on lease to PQR Limited. So of course PQR Limited will pay consideration for this lease. Now along with this consideration, applying 206C1C, will you also ask for TCS at the rate of 2% under 206C1C? No. Here TCS at the rate of 2% will not apply. Why? Because the person from whom we are trying to collect, this person is a public sector company. Getting it, guys? Simple point. So the person from whom you are collecting the money under 2061C, if that person happens to be a public sector company, then 2061C will not apply. Alright, that's all. This is a simple point with respect to question number 13. Now coming to the next question, question number 14. Let me give you one small reminder over here, okay? See, if your assessee files the income tax return within section 139 one date, then the assessee has an option. By default, assessee will be filing under 115 PSE. But if assessee wants, assessee can opt out and the assessee can even follow the normal regime. But, if the assessee files ITR late, that is if the assessee files the ITR after section 139 one date, then no choice for the assessee. Assessee's computation has to be under the default regime only. Okay. So this is one small concept which is applicable in this question. Let's read the question. The question says Mr. Shahid, an individual who is resident and ordinarily resident. He's an ROR, guys. So global income will be taxable for him. He has earned a salary income of 8,25,000. So during the financial year 24-25, he is eligible to claim deductions under ATC, ATD, ATG amounting to 2,75,000. So two numbers he have given to us. Number one, his salary income is 8,25,000. They have not used the word computed. So therefore, I will subtract standard deduction over here. And they've said that his total chapter 6A, all his deductions put together will amount to 2,75,000. Two numbers they have given to us. Now on 30th July 2025, he approaches you for assistance in filing his return of income. As a tax consultant, what would be your advice regarding the filing of his return of income? Till here, let us handle first. So see guys, when is he coming to you? He's coming to you on 30th July 2025. What are the possible 139 one dates? The possible 139 one dates are 31st July or 31st October 2025 or 30th November 2025. Now he is coming to you on 30th July 2025, which means doesn't matter what is his 139 one date, he is definitely coming to you within 139 one date, guys. So if he is filing the ITR within 139 one date, then in that case, both the options he is having, either 115 BAC or normal, any of the two he can follow. See, you know, right, if assessee does not have PGBP, assessee can keep jumping between these two regimes. You put a little restriction on the assessee only when the assessee has PGBP. Here he has no PGBP, guys, he has only salary income. So he can keep jumping between the regimes every year, no problem in that. So he has come to you within the ITR date. So therefore, your first rule will apply over here. We'll do the computation under 115 BAC. We'll do the computation under normal regime. We'll see where is his tax lesser. That is what we will suggest to him. So if you do the computation under the default regime, let us say, only two adjustments, easy only. Salary first of all. So salary income is 8,25,000. How much standard deduction will you give him? Default regime, guys, you will give him 75,000 standard deduction. So his taxable salary will become 7,50,000. Then he has chapter 6A. Chapter 6A, ATC, ATD, ATG and all not available under 115 BSE. So therefore this assessee's total income will be 7,50,000. Now on this, how will you compute his tax now? So for basic tax, basic exemption limit will be 3 lakhs. So 0 to 3 lakhs, there will be no tax. Then 3 lakh to 7 lakhs. On this 4 lakh, 5% tax, which will be 20,000. Then on 7 lakh to 7 lakh 50,000. On this 50,000, 10% tax, which will be 5,000. So his total basic tax will be 25,000, guys. And then you will think about 87A rebate. No 87A rebate because his income is more than 7 lakhs. Even relief with respect to rebate will not apply over here. Income is way above 7 lakhs. Then surcharge also will not apply because income is within 50 lakhs. No marginal relief, nothing. Straight away you will add cess at 4%. So cess 4% will be 1,000 rupees. So his tax liability will be 26,000 under the default regime. Okay, so this computation was entirely as per the default regime. But then because he's coming to you within 139 one date, he does have the option of opting out of the default regime and doing computation under normal regime. That option also he has. So under the normal regime, if you see, his salary income 8,25,000. Here 50,000 standard deduction only you will give him. So his taxable salary will be 7,75,000. But under the normal regime, chapter 6A also you can enjoy. Chapter 6A is 2,75,000 over here. So his total income will be 5 lakh rupees. So now on this 5 lakh rupees, if you have to compute his tax, he's not a senior citizen and all. So his basic tax will be up to 2,50,000, no tax. 2 lakh 50 to 5 lakhs, 5% tax, that will be 12,500. Then you will think about 87A rebate, guys. So he is an individual, he is a resident and his income is within 5 lakhs. So 87A rebate you will get. Maximum 87A rebate possible is 12,500. So his tax liability will be 0. So if this assessee follows the default regime, then he'll have to pay 26,000 tax. But if the same assessee follows normal regime, then he'll have to pay no tax. So they're asking you, what would be your advice? What would be your advice, guys? Your advice would be, please opt out of the default regime. Please follow the normal regime, because under normal regime you will have to pay no tax. Under default regime you will have to pay 26,000 tax, but under normal regime you will have to pay no tax. So therefore your suggestion to this assessee will be that please opt out of the default regime. Please follow the normal regime, because this will result in 0 tax in nil tax. Okay, so this was our first subdivision, guys. We suggested the assessee to follow the normal regime. Now they're asking us one more thing. What will be your advice if he approaches you on 1st August 2025? Now listen to me. He is having only salary income. First of all, help me find out his 139.1 due date. See, I've taught you the sequence of thinking for finding 139.1 due date. You always try 30th. You go in the reverse order, right? You always try 30th November 25 first. But this will apply only if assessee is a transfer pricing assessee. If assessee has specified domestic or international transactions, nothing of that sort over here. Then you will next try 31st October 2025. This will apply only if assessee is an audit assessee, or if you are a partner of a firm for which audit is applicable, or if you're a company, then only 31st October will apply. None of those cases over here. So for all other assessees, 31st July 2025 will apply. So what is your assessee's 139.1 due date over here? 31st July 2025. But in my second situation, assessee wants to file ITR on 1st August 2025, guys. So clearly assessee wants to file ITR late. So if you're filing ITR after 139.1 date, if you're filing ITR late, then in that case only one option you have, and that is you will have to follow the default regime only. You don't have the option of opting out and coming to the normal regime. That option itself you don't have. So in this case, assessee, your tax liability will be 26,000, what we computed over here. But in addition to tax of 26,000, you will also have to pay section 234F fees, guys. You're filing your ITR late, right? So you'll have to pay 234F fees also. How much 234F fees you have to pay? That depends upon the total income of the assessee. If total income is within 5 lakhs, then you have to pay 1,000 rupees. If total income happens to be more than 5 lakhs, then you will have to pay 5,000 rupees. So what is the assessee's total income over here? Under default regime, total income is 7 lakh 50, guys, which is more than 5 lakhs. So assessee will have to pay 5,000 rupees 234F fees. In addition to this, assessee will have to pay 234A interest also when you file your ITR late. But here the question says ignore 234ABC interest. Therefore, we are ignoring. But otherwise, please know that not only will 234F fees apply, 234A interest will also apply when you file your ITR late. Okay, so first part was okay. The second part was interesting. They told you, they were saying, what if assessee comes to you on 1st August? So first of all, we realized that his 139.1 date is 31st July and he's filing return on 1st August. That itself means late return. So if it is a belated return, if it's a late return, then no option of coming to the normal regime. You have to be under the default regime only. But not only that, you will also have to pay 234F fees and 234A interest. Okay, so this was your question number 14. Now come to question number 15. Another capital gains question, guys. Let's carefully read the question first. It's a case-based MCQ. It's a really important question, guys, because through this question, your rights issue concept, rights issue plus capital gains, that will get covered for you through this question. Okay, carefully let's read the question. So we have Mr. Kishan. He holds 1,000 shares in Venus Limited, an unlisted company. So Mr. Kishan, first of all, he has 1,000 shares. Can I say these are 1,000 unlisted shares, guys? Okay, now these unlisted shares he acquired in the year 2001-2. So for these 1,000 shares, we are first talking about these 1,000 shares. 2001-2 will become your date of acquisition. He acquired them for 75,000. This will become your cost of acquisition. Then what happened? In April 2024, the company offered him the rights shares at 160 rupees per share in the ratio of 2 for every 5 held. Careful now. If he holds 5 shares, he will have the right to buy 2 rights shares, guys. He is holding totally 1,000 shares. So tell me how many rights shares he will get the right to buy? 1,000 into 2 by 5. So 1,000 into 2 by 5, this is 400 rights shares. And you know very well, are rights shares for free? No, you have to pay some consideration for these shares. So he has a right to buy 400 shares. Now tell me, is it mandatory that he has to buy these 400 shares? Like, is it an obligation or is it an option, guys? It's an option for him that if he wants, then he can buy these 400 shares. 1 minute. So he has an option to buy 400 shares. Now what did he do? Mr. Kishan decided to retain only half of the rights shares. So out of 400, only 200 he is keeping for himself. What about the balance 200? The question says he is renouncing the remaining. So how many is he renouncing? The balance 200 rights he is renouncing in the favor of Mr. Kush for 30 rupees per share in May 2024. Understanding? He first had 1000 unlisted shares, then he got the right to buy 400 rights shares. Out of this, he exercised the right to buy 200 rights shares. So now totally how many rights shares he has? Totally how many shares he has? Totally 1200 shares he has. But he had the right to buy 400 shares. Only 200 he exercised. What about the balance 200 rights, guys? The balance 200 rights he renounced to Mr. Kishan. Sorry, he renounced to Mr. Kush. Assessees Mr. Kishan 200 rights shares. He exercised the right, balance 200 rights he renounced to Mr. Kush. So then what happened? Later, all the shares were sold by Mr. Kishan. All the shares means what? How many shares is he having? 1200 shares he is having. No, 1000 original shares and 200 rights shares. So all the 1200 shares he sold at 300 rupees per share. This will become his full value consideration. He sold on 15th July 24. This will become your date of transfer. While Mr. Kush is having how many shares? Mr. Kishan has renounced 200 rights to Kush, right? So Mr. Kush will be having now 200 shares. So he sold his shares in December 24. So this is the date of transfer for Mr. Kush. He sold at 280 rupees per share. This is full value consideration for Mr. Kush. Crystal clear with the story. Now come on guys, let's begin now. So let's talk about them one by one. 1000 unlisted shares. When did Mr. Kishan acquire these shares? He acquired these shares in 2001-2. In 2001-2 he acquired these shares. And when did he sell away these shares? He sold the shares on 15th July 2024. Now come on, pause. 15th July 24 guys, he has done the transfer before amendment, before 23rd July 24. So come on, come to the margin now. 4 things I make you think about every time. First of all, will section 3 things. Will section 50AA apply? 50AA will not apply to unlisted shares. Then how many periods of holding are possible before the amendment? 3 periods of holding guys, 12 months, 24 months and 36 months. Unlisted shares, 24 months will be a relevant period of holding. Then after that, will you get indexation benefit? Come on everybody, before amendment. Yes, I will get indexation benefit also. Now come enter into the answer. 24 months guys. Is this period more than 24 months? Yes, it is more than 24 months. Therefore, it is a long-term capital asset. You will of course first try section 112A, but it is not listed shares. So 112A will not apply. 112 will apply. Now if it is 112, then in that case you check your 4 conditions, and if your 4 conditions are fulfilled, then when you have to compute tax, you will do with indexation, without indexation, whichever is lesser, all that you will do. No, will that apply in this question guys? Tell me your conditions. No. Condition number 1, assessee should be resident individual or HUF. Condition number 2, capital asset should be immovable property. Here we're talking about shares guys. So all that extra drama, the 4 conditions, recomputation, all that will not apply. 112, simple story over here. Then 200 rights shares. These 200 rights shares, when did he get? Company gave him these shares in April 2024. So April 2024, and he sold all the shares on the same date, 15th July 2024. Now this period, however guys, is less than 24 months. So therefore this will be short-term capital asset. Now if it is short-term capital asset, you first try section 111A, but 111A will apply only for listed shares. These are unlisted shares, so therefore 111A will not apply. This will be your normal rate STCG. Okay, then you remember he renounced 200 rights, isn't it? He renounced the right to buy 200 rights shares to Mr. Kush. When he is renouncing the rights, I don't care about the period of holding, it will always be short-term capital asset only. Okay, now come on everybody, totally 3 assets he is transferring. So 3 computations of capital gains we will have. Let's carefully do them one by one. No tension guys, slowly, nicely we will do it. First we will do 1000 shares, 1000 unlisted shares, then these are the original shares, then 200 rights shares, and then the 200 rights which he renounced to Mr. Kush. 3 transactions. So we'll start with full value consideration. 2 sections you think about, 50C and 50CA. 50C will not apply over here because it is not immovable property. See, it's unlisted shares. 50CA will apply actually, but they've not given us a fair market value number, so no 50CA also. So I'll take my consideration as it is. The consideration is 300 rupees per share. So 1000 shares into 300 rupees per share, 3 lakhs. Then 200 shares into 300 rupees per share, 60,000. Then what about the 200 rights that he renounced to Mr. Kush? He renounced it for how much? He renounced it to Mr. Kush for 30 rupees per share. So 200 rights, he renounced it for 30 rupees per share. So 6,000 will become your consideration. No expenses on transfer. This itself becomes net consideration. Then comes cost of acquisition. Come on, step by step. Let's talk about just these 1000 shares alone first. For these 1000 shares, first of all, will the grandfather clause apply? Is it 112A, 31st Jan 2018? No, guys. So, no grandfather clause. Then tell me, can I please index the cost of acquisition? Yes, we've already concluded that we can index the cost of acquisition. It is long-term capital asset also. So, for 1000 shares, I can index the cost of acquisition. Also, it is not bonds, debentures, slump sale, depreciable asset, 112A case and all. So, I can index the cost of acquisition. So, come on, what's your cost of acquisition? 75,000 into CII of the year of transfer. Year of transfer is 2425. 2425, my indexation is 363 divided by CII of the year of acquisition 2001 to 2001 to my indexation is 100. So how much will this work out to? This will work out to 2,72,250. Okay. Now come to 200 shares, these 200 rights shares. Here can I index the cost of acquisition, guys? See, the transfer has happened before amendment, but it is short-term capital asset. So I can't index the cost of acquisition. So I'll take the cost of acquisition as it is. So for these 200 shares, what's the cost of acquisition? How much are we going to pay to the company? Company offered the shares at 160 rupees per share. Right price is 160 rupees per share. So 200 shares into 160 per share, 32,000 will become your cost of acquisition. I did not index it because it's a short-term capital asset. Then what about the rights? The right to buy rights shares. We're renouncing the rights shares, right? So the renunciation of rights, your cost of acquisition will always be 0. You did not pay anything to get these rights. So therefore for rights, your cost of acquisition will always be 0. Now come on, find the net number. So what's your LTCG? For 1000 original shares, you will have LTCG of 27,750. Right? This is the only long-term capital asset. The remaining two, if you see, the remaining two assets are short-term capital asset only. So our next line, I'll write STCG. For your 200 rights shares, your STCG is 28,000. For your 200 rights, your STCG is 6,000. So the total LTCG of your assessee is 27,750 and the total STCG of your assessee is 28,000 plus 6,000, which is 34,000. So all this computation was for Mr. Kishan. What's your learning over here? Learning number 1, rights. When you're renouncing the rights, the cost of acquisition will always be 0 and it will always be short-term capital asset only. Okay. So this is your computation for Mr. Kishan, guys. Now same way, let's do the computation for Mr. Kush also, because he is also selling away the shares. No, Kishan had renounced to him a right to buy 200 rights shares, and those shares Mr. Kush is later selling it off. So even he will have capital gains. So what is the capital asset transferred by Mr. Kush? 200 shares, guys. 200 unlisted shares these are. And when did he get these shares? See, when did Kishan renounce the right to Kush? In May 24. So he got these shares in May 24. He's selling away these shares in December 24. So pause over here. Pause, check, think. December 2024, guys. He is transferring after the amendment, on or after 23rd July 24. Again, come to the margin. Will 50AA apply? 50AA will not apply. How many periods of holding will you have after the amendment? Only 2, 12 and 24 months. These are unlisted shares, guys. 24 months will be a period of holding. And then will you get indexation benefit? The transfer has happened after the amendment. No indexation benefit. Whether first question, whether last question, whether MCQ question, whether descriptive question. Sequence. It's a sequence of thinking, the method of thinking that will always save you. So don't skip your steps. So come on everybody, tell me, is this period more than 24 months? No. It's clearly within 24 months. So because it is within 24 months, what does it become, guys? It becomes a short-term capital asset only. And short-term capital asset will triple 1A apply over here. Triple 1A will not apply over here because it is not listed shares. So these are your normal rate short-term capital gains only. So now come on, let's start with the computation. So we'll start with the full value consideration. 200 shares he's selling for how much? He's selling at 280 rupees per share. So 200 into 280. This will be 56,000. I don't have any expenses on transfer. This itself becomes my net consideration. Then less cost of acquisition, no indexation because of two reasons. Number one, the transfer happened after amendment, and number two, it is short-term capital asset. So no indexation. Now comes another learning. What will the cost of acquisition be? See, what are the amounts which Mr. Kush has paid? For the rights shares, he will pay to the company 160 rupees per share, guys. Plus, to get the rights, to Kishan he has paid 30 rupees per share. So from Mr. Kush's point of view, he will have two costs to buy these shares, guys. He will have to pay to Mr. Kishan 30 rupees per share. He will have to pay to the company 160 rupees per share. So 190 rupees per share will become his cost of acquisition. This into 200 shares. So 190 into 200. 38,000 will be his cost of acquisition. So for Mr. Kush, his STCG will be the balance 18,000. Alright everybody, so the learning over here is only with respect to the rights. So point number one, when you sell away the right to buy the rights shares, it will be short-term capital asset and cost of acquisition will be 0. Then when you purchase the right, like over here Mr. Kush has purchased the right from Mr. Kishan. So when you purchase the right, you will have two costs of acquisition. Number one, what you pay to the company, and number two, what you have paid to Mr. Kishan to get this right. So 190 will become your cost of acquisition. So his STCG is 18,000. Now come on guys, let's have a look at the question. Compute the amount of capital gains on the sale of shares in the hands of Mr. Kush. So for Mr. Kush, the capital gains will be 18,000 rupees. Then compute the amount of capital gains in the hands of Mr. Kishan. For Mr. Kishan also we have computed. For him, his LTCG is 27,750 and STCG is 34,000. So STCG 34,000, B or D. LTCG 27,750. So option B would be your answer. So this was your question number 15. Just wanted to give you a revision of the rights issue point. Okay. Now come on everybody. Let's go to the next question. Question number 16. This is from your PGBP. The question says Mr. R of Desai has two business units. Unit 1 is engaged in manufacturing of textile. During the year 24-25, he incurred an interest expense of 1,50,000 payable to Mr. Raj, resident. So interest expense 1,50,000 payable to Mr. Raj, a resident. However, tax was not deducted at source. Immediately, some section will come to your mind. 40A1, 40A1A, these sections will come to your mind. Your golden rules of PGBP, guys. When they talk about tax deducted, not deducted, these are the two sections that will come to your mind. TDS was later deducted on 15th April 25 and was deposited with the government on 17th May 2025. What is the amount of disallowance, if any, attracted for the non-deduction of TDS on the interest payable to Mr. Raj? Disallowance they're asking you, and will you straight away say what the disallowance is? Just because resident, will you straight away give me 30% disallowance? No, you will sing your song. What's your song in these two sections, guys? 3, 2, 1. Right, guys? Come on, tell me. First of all, you will talk about 3 conditions. By the way, tell me 40A1 or 40A1A? 40A1A, right? Because resident. So come on, sing the song. 3 conditions. Condition number 1, assessee has incurred an expense relating to business or profession. Then condition number 2, the other party happens to be a resident and the payment is in India. And condition number 3, on this expense, TDS is applicable. Tell me, are your conditions fulfilled? Is your assessee incurring an expense? Yes, guys, he's incurring an expense. He's incurring interest expense relating to his business. Then is the other party a resident? Yes, it is payable to Mr. Raj, a resident. Let's assume it is in India also. But tell me, on this interest of 1,50,000, is TDS applicable? Which section TDS, guys? Interest expense. It is not interest on securities. So therefore, section 194A TDS will apply. In 194A, your limit is 50,000, 40,000, 5,000, 3 limits you have. If bank, cooperative bank, post office, if they are paying the interest, then 50,000, 40,000, those limits will apply. Here, not bank, guys. Mr. R of Desai is paying the interest. Limit is going to be 5,000. Are we paying more than 5,000? Yes, yes, yes. So TDS also will apply. So all my 3 conditions are fulfilled. 3, 2, 1. Now come on, all 3 conditions are fulfilled. Now you will put on me two responsibilities. What are the two responsibilities you will put on me? Responsibility number one, assessee, you are supposed to deduct tax. But when are you supposed to deduct tax? In the previous year. Responsibility number two, assessee, you are supposed to remit the tax. When are you supposed to remit the tax? Within 139 date. Now, so three conditions, two responsibilities, any one violation. Tell me guys, has my assessee committed any one violation out of these two responsibilities? Any one violation, is it there? See, the question says that the TDS was remitted on 17th May 25. Your 139 dates are 31st July, 31st October, 30th November. We have remitted on 17th May 2025 itself. So yes, we have remitted within 139 date, but did we deduct tax in the previous year? No guys, we deducted tax on 15th April 25. We deducted the tax in 25-26. My year in the examination is 24-25. Did we deduct in 24-25? No. So is there a violation? Any one violation is there? Yes. One violation is there. Any one violation. That's all guys. Three conditions fulfilled. Two responsibilities you put on me. Any one violation is there. Now you will conclude that yes, there will be disallowance. 30% will be your disallowance over here. So how much is the amount of disallowance? 1,50,000 is your interest. Interest into 30% will be your disallowance. Guys, don't make a mistake. TDS into 30% or expense into 30%. You've done this mistake multiple times during our practice sessions. Tell me, not TDS into 30%. Interest into 30%, expense into 30%. 30% of the expense will be disallowed. So that will be how much guys? 45,000. 45,000 will be disallowed. But any good news that you will give to the assessee? You will tell the assessee, don't worry. Once you deduct and remit, then we will reverse the disallowance for you. So when have you rectified the default? 17th May 2025 you have rectified the default. So previous year 25-26 you have rectified. So in 25-26 the same amount will be allowed again for you. For now, in previous year 24-25, for now I am disallowing it for you, but don't worry, later whenever you rectify the default we will allow it again for you. So anyways, current year how much is the disallowance? In 24-25, 45,000. Option C, 45,000 will be your disallowance. Okay guys, so three conditions, never skip your song. Three conditions, two responsibilities, any one violation, only then disallowance. Here assessee has fulfilled second responsibility, but he did not fulfill the first responsibility. He was supposed to deduct tax in the previous year. He deducted tax after the previous year. Therefore, any one violation, hence welcome to disallowance. Okay, this was your question number 16. Now come on everybody, no slowing down, come to question number 17 next. Question number 17 is again from your clubbing chapter. Now here the question says, Mr. Rakesh gifted 6 lakh rupees to his daughter-in-law Sudha. So I'll draw my diagram. So we have Rakesh and we have Sudha. Who is Sudha? Sudha is daughter-in-law. So can I say as son's spouse? Okay, so Rakesh has gifted 6 lakh rupees. It's a gift. So which means in return, did he get any consideration or inadequate? Which means I can say in return he got no consideration or he got inadequate consideration. Then what did Sudha do with this 6 lakh rupees? Out of the 6 lakh rupees, she invested 3 lakhs in shares in April 2024. So 3 lakh rupees she has put in shares in April 24. Then she started a business in May 24 with 5 lakh rupees. 3 lakh received from Mr. Rakesh and 2 lakh from her own savings. So can I say the balance 3 lakh rupees, this plus her own 2 lakh rupees, total 5 lakh rupees she has put in her business guys. This happened in May 2024. Understanding? So Rakesh has given 6 lakh rupees to Siddha. So out of the 6 lakh rupees, 3 lakhs she has put in shares. So 3 more lakh rupees she has now. That 3 lakh rupees plus her own 2 lakh rupees, total 5 lakh rupees she has put in the business. Then what happened? During the year, Sudha has earned the following income. Business income 90,000. So from this business, she has earned 90,000 rupees. Then from the shares, she has earned 18,000 rupees dividend. Okay, now listen. I'm not sure if you remember, so therefore I'm going to take you back to my first question. When I taught you the first question in this session only, I had told you when assessee gives an asset to his spouse, or when assessee gives the asset to his son's spouse, or when assessee gives an asset to its HUF for no consideration or for inadequate consideration, whatever is the income from the transferred asset, we club with the transferor assessee guys. So over here, This point will apply. Yes, so Rakesh has gifted asset to his spouse, to his son's spouse, for no consideration or inadequate consideration. So whatever income she earns from this transferred asset will be clubbed with Rakesh's income, guys. So tell me, this 18,000, two incomes only, 18,000, 90,000, two income only, so no tension. Listen to me, 18,000 dividend income, this is entirely from 3 lakh transferred asset. So this 18 lakhs will be clubbed with Rakesh's income. He will pay tax, right guys? See, transferred asset is 6 lakhs cash. This transferred asset has changed form into 3 lakh shares and 3 lakhs investment in business. So whatever income the transferee earns from the transferred asset in the same form or in the different form will be clubbed. So over here the 6 lakh transferred asset has changed form into shares and investment in business. So from this whatever income she earns will be clubbed. So from the 3 lakh shares, what income she has earned, guys? 18,000 income. This will be clubbed with Rakesh's income. Now from this 3 lakh investment in business, how much income has she earned? From the business she has earned 90,000 income. But 90,000 income, is it fully from the transferred asset, guys? No. She has put in the business 5 lakh rupees. Out of this 5 lakh rupees, only 3 lakh is from transferred asset. So come on, we have a formula for this, right? We will see what is the PGBP from this business into investment out of transferred asset divided by total investment in the business, right guys? And remember, this numerator denominator has to be as on the 1st April of the previous year. But however, when you start the business in the year, then not 1st April, you will take the numerator and denominator on the date on which you commenced the business. So here she started the business in May 24. In May 24, what is the investment out of transferred asset? 3 lakhs. And what's a total investment? 5 lakhs. And what's a PGBP of the business? 90,000. So 90,000 into 3 lakh by 5 lakhs, 54,000. So 54,000 of this PGBP will be clubbed with Rakesh's income. So what is her balance PGBP, guys? 36,000. This will be taxed as Sudha's own income, right? Now they are asking us in the question, what is the total income of Sudha? 2 incomes only she is having. Her business income 90,000 and dividend income 18,000. Dividend income is going to be fully clubbed with her father-in-law, with Rakesh, so it will not be taxed in her hands. Out of 90,000 business income, 54,000 will get clubbed. So only the balance 36,000, that only will be taxed as her income. So her total income in the question will be 36,000. Okay, so through this question I'm just reminding you that this transferred asset concept will apply not only for assessee to spouse. See, this point you know very well, but it will also apply when assessee transfers to son's spouse. It will also apply when assessee transfers the asset to HUF. So from the transferred asset, whatever income the transferee earns in same form or in different form, whatever income you earn from the transferred asset, that will be clubbed. Alright, so 18,000 we clubbed. Then from this 3 lakh investment, what is the income that she earned? 54,000. Even this 54,000 was clubbed. So only the balance PGBP 36,000, only that was taxed as Sudha's income. Okay, so this was question number 17. Now come on everybody, come to question number 18. Now question number 18 is relating to your maturity proceeds. Alright, so the question says Mr. Rohan took a life insurance policy on 10th May 2014. So this is your date of policy. With a sum assured of rupees 18 lakhs, annual premium of 1 lakh 50. The policy matured on 9th May 2024 and 22 lakhs is due to be received by him. What will be the tax treatment of the maturity proceeds? Now listen everybody. Let me remind you about the provision with respect to maturity proceeds. See, if we receive maturity proceeds upon death, then in that case it will be exempt. If the life insurance policy happens to be a term life insurance policy, then also it will be exempt. But however, if it is scheme and insurance policy, then it will always be taxable. This is our preliminary point. Then after this we learnt about 4 situations. We have a method of thinking for this. Right guys, what's your method of thinking? Tell me what's your sequence of thinking. First you will check your first point. It is not term life insurance policy, it is not keyman insurance policy, and money is not received upon death also. But however, the premium happens to be more than the limit. If this situation is applicable, then the maturity proceeds will be taxable for you. Then your second situation, same thing, it is not term life insurance policy, it is not KMIP, money is not received upon death, but premium is within the limit. However, the date of policy is on or after 1st April 23 and the aggregate premium happens to be more than 5 lakhs. If all these conditions are fulfilled, again the maturity proceeds will become taxable. Then number 3, it is if it's a keyman insurance policy, then the proceeds will always be taxable. And number 4, remember in section 80DD also you have a policy for the maintenance of the dependent disabled. There if the dependent disabled pre-deceases ESSE, whatever money you get back from the insurance company, that will be taxable. So if your maturity proceeds come under any of these 4 situations, then it will be taxable. All other cases, it will be exempt under section 1010D. This is what we have learnt. Let us check, guys. Here, have we received the money upon death? No. Is it a term life insurance policy, KMIP? No. So therefore, I will enter into my 4 situations. Tell me, is it term life? It should not be term life insurance policy. It should not be KMIP. Money is not received upon death. Yes, fulfilled. Is premium more than the limit, guys? The limit will depend upon the date of policy. Policy is taken on 10th May 2014. So the policy is taken on or after 1st April 2012. So what's your maximum premium, guys? Maximum limit is 10% of the sum assured. Sum assured is 18 lakhs. 10% of 18 lakh will be 1 lakh 80. That's your maximum limit. But your premium is only 1 lakh 50. It is within 1 lakh 80,000. So is premium more than the limit? No, guys. So first situation will not apply. Then come to the second situation. It should not be term life insurance policy. It should not be keyman insurance policy. And money should not be received upon death. Yes, fulfilled. Premium should be within the limit. Yes, fulfilled. Date of policy should be on or after 1st April 23. Is the date of policy on or after 1st April 23? No, guys. So second situation is also not applicable. Then is it a KMIP? It is not KMIP. Third situation is also not applicable. Is it relating to some dependent, disabled, relative and all 80DD policy? No, guys. So none of these 4 situations are applicable. Therefore, what will be your answer? The maturity proceeds will be exempt. The entire maturity proceeds will be exempt under 1010D. Understanding? So maturity proceeds, no tension, guys. You are just unnecessarily having one roadblock kind of a thing in your mind that maturity proceeds is difficult. It is not difficult. Simply, this is your method of thinking. You will first, I've simplified it for you to a great extent over here. This is your preliminary checking. Here itself you might get the answer. But if this is not applicable for you, then enter into your 4 situations. Any of the 4 situations applicable, then only it will be taxable. If none of these 4 situations are applicable, general answer will be exempt under 1010D. Okay, guys, so don't worry about this. One more question, we will be having this same thing. There it will become second revision for you. Okay, so this was your question number 18. Now come to question number 19. Now this is an amazing question. This is from your residential status. Okay, so the question says, Miss Priya, a person of Indian origin. So she's a person of Indian origin and she's a citizen of Canada. So she's not an Indian citizen, guys. She's a Canada citizen. She got married to Mr. Aaron, an Indian citizen residing in Canada. So Miss Priya is a person of Indian origin and she's not an Indian citizen. Then she got married on 24th Jan 2024. She came to India on 25th March 24 and she left for Canada on 10th July 2024. So then she returned to India with her husband on 24th February 2025 to spend time with her parents-in-law for 30 days and then she returned to Canada. So guys, a lot of information they have given. In my current year, that is in 24-25, first tell me, how many days has she been in India, guys? She came to India on 25th March 24, that is last year in 23-24, and she's leaving India in the current year on 10th July 24. So current year 24-25, if you see, April she is in India, May she is in India, June she is in India, July 10th she is leaving. So 10 days in July. Even the day on which you leave India, I will count as if you are in India. So this is going to be how many days now? This will be totally 101 days. Then she returned to India with her husband on 24th February to spend time with her parents-in-law for 30 days. So she again came to India for 30 days. So her total stay in India during the previous year will be 131 days, everybody. Okay, then what happened? She stayed in India for a total of 400 days in 4 preceding previous years. During the previous year 24-25, Priya, while in India, she received the following gifts from her husband's relatives and friends. 3 gifts she has received. From her husband's parents, 1,51,000. From husband's sister, 21,000. From very close friends of her husband, 16 lakhs. See, if you get any gift From relative, it is exempt. Relative means what? An electric pole diagram will come to your mind, guys. Relative, for the purpose of gift, this is the meaning of relative, right? Which means if I am the assessee, then my brother, my sister, my parents brothers and sisters, then my parents, grandparents, great grandparents, and so on, my children, grandchildren, great grandchildren, and so on, then my spouse's brothers and sisters, my spouse's parents, grandparents, great grandparents, and so on, my spouse's children, grandchildren, great grandchildren, and so on, my HUF, and then we'll write the letter S everywhere, which means we will also cover spouse of all these persons. Right, guys? Now here see, Priya got a gift from her husband's parents. Husband's parents will indicate her spouse's parents. Spouse's parents covered as relative, so this gift will be exempt. Then from husband's sister, so from spouse's sister, spouse's brothers and sisters are covered in relative, even this will be exempt. But from close friends of her husband, 16 lakhs, guys, this will be taxable. Also, it is more than 15 lakhs, it is more than 50,000, therefore it will be taxable. They're asking you to find Priya's residential status for assessment at 25-26. She does not opt out of the default regime, which means she is following 115 BSE. They're asking you to find residential status. Come on, everybody. First of all, you will think about the special provision, the 120 days provision, but that will apply only if 3 conditions are fulfilled. Condition number 1, your assessee Priya should be an Indian citizen, or she should be a person of Indian origin. Yes, she is an Indian citizen or a person of, she's not an Indian citizen, but she is a person of Indian origin over here. So condition 1 fulfilled. Then condition number 2, she should be visiting India in the previous year. She is visiting India, guys, because if you notice over here, she returned to India with her husband on 24th February to spend some time with her parents-in-law for 30 days, and then she returned to Canada. So she did visit India for 30 days. So yes, she is visiting India. And then comes your condition number 3. Condition number 3 says that her total income minus her income from foreign sources, this balance income should be more than 15 lakhs. Now here if you see, only one income she is having, guys, that is gift from her husband, gift from her husband's friends, 16 lakh rupees. Now where will be the source of this income? See, total income minus income from foreign sources means we're talking about income from Indian source. Income from Indian source means number 1, incomes which are earned in India. Then number 2, business incomes from businesses controlled in India, and professional incomes from professions set up in India. See, only one income she is having, the 16 lakh rupees. First of all, it is not business income, it is not professional income. But tell me, is it an income which is earned in India? Remember, whenever you receive a gift from an ROR or from an RNOR, the gift is deemed to accrue in India. So she's getting a gift from friends of her husband. So let's assume that the giver of the gift, the friends, they're ROR or RNOR. So whenever you get a gift from a resident, from ROR or from RNOR, that gift is deemed to accrue in India. So therefore here 16 lakhs will accrue in India, guys. So her total income minus income from foreign sources will be 16 lakhs, which is more than 15 lakhs. So therefore total income minus income from foreign sources is more than 15 lakhs. So welcome to special provision. Now special provision says basic condition 1, in the previous year you must have stayed in India for at least 182 days. Is this fulfilled, guys? No, she has stayed in India for only 131 days. Basic condition 1 not fulfilled. Then basic condition 2, will you pause, check, think, crew member, Indianship, then leaving India for employment outside India? No, all that is only in regular provision. So basic condition 2 straight away you will apply. Previous year she should be in India for at least 120 days. 4 preceding previous years she should be in India for at least 365 days. This is fulfilled, guys. Previous year she's in India for 131 days, definitely at least 120 days. And 4 preceding previous years she's in India for 400 days, which is at least 365 days. Basic condition 2 is fulfilled. Therefore, your assessee will become a resident. Now, once your assessee becomes a resident, you will check ROR or RNOR. 3 additional conditions you will have in the special provision. The first additional condition is that your basic condition 1 has to be fulfilled. Basic condition 1 is not fulfilled over here. So, additional condition number 1 not fulfilled. So, assessee becomes RNOR. Right, guys? Any one additional condition also not fulfilled, assessee becomes RNOR. So, basic condition 1 is not fulfilled. So, additional condition 1 is not fulfilled, assessee becomes an RNOR. So they were asking us about residential status. See, the rest of the question was all fine over here. The only reason why I'm doing this question for you is for the 15 lakhs calculation. Did you notice? I considered this gift. I did not consider this gift because it was received in India. I considered this gift because this gift is earned in India. How can I say it is earned in India? Whenever I get any gift from ROR or RNOR, that gift is deemed to accrue in India. So that is why this gift is earned in India, and that's why I considered this gift under point 1. Okay, this was your question number 19. Now come on everybody, come to question number 20. Question number 20 is a nice interesting question. A lot of concepts will get covered for you over here. A little bit of IFHP, then a little bit of your insurance maturity proceeds, just now that we learned, your 1010D, all that also will get covered for you over here. It's a nice interesting question. It's a September 2025 RTP question. Let's carefully read the question first. The question says Mr. Manish is a real estate developer. So he's a real estate developer, so therefore for Mr. Manish, his stock in trade will be land, building, both guys. His main business is construction, development and sale of residential properties. He developed a project named Ashiana Heaven, which has both residential and commercial units. He obtained certificate of completion on 1st February 2023. So construction completion certificate he has obtained on 1st February 2023. Then the question says, he sold majority of the units. However, 15 residential units and 10 commercial units were not sold and they were held as stock in trade. So how many units is he left with? How many residential units is he left with? How many commercial units is he left with? What is his stock in trade? So the question says 15 residential units he is left with and 10 commercial units he is left with. He was not able to sell them. To earn some income from such units, he let out 10 residential units and 5 commercial units. So out of the stock in trade, he has given some of them on rent. He has let out some of them, not all of them. He has let out 10 residential units and he has let out 5 commercial units. Now, when did he let them out? Only from 1st May 2024. That is current year. If you see how many months has he let them out, guys? Current year, if you see, only 11 months he has given them on rent. How much rent? 15,000 per month and 20,000 per month respectively. So residential units he has let out at 15,000 per month rent, and these 5 commercial units he has let out at 20,000 rupees per month rent. So all of this will become your IFHP discussion. IFHP or PGPP we will see. Then they have mentioned over here the expected rent for each residential unit is 14,000 per month and 22,000 per month for each commercial unit. All the units are identical. So listen to me. They are giving you a little more information now. They are giving us the expected rent. Expected rent for the residential units is 14,000 per month, and for the commercial units the expected rent is 22,000 per month. Okay, then he has taken 4 life insurance policies. So this is the information about your life insurance policies, and now they are asking us the MCQ questions one by one. Listen to me. Let me discuss a little bit of provisions with you. See, my assessee is having rental income, right? 15,000 per month, 20,000 per month, he's having rental income. This rental income will go to which head? Now, because it is relating to your stock in trade, you may be tempted to say PGBP head, but please remember, your property will go into the PGBP head only in 2 situations. Situation number 1, when the assessee's business is to let out commercial properties, and number 2, when the assessee is self-occupying the property for his business or profession. Here, tell me, in this case, is the assessee's business to let out commercial properties? No, he is into real estate business. He is not in the letting out business. Not the first situation. Also, he is not self-occupying the property for business or profession, guys, which means the PGPP head will not come into the picture. Hence, it has to be the IFHP head only. However, in IFHP head, you have a provision. In that provision, it is mentioned that in case your assessee's house property happens to be stock in trade, okay, and if it is a newly constructed property, and if it is lying vacant till when? We'll see when did your assessee get the construction construction completion certificate. We will see what is the end of the year of the construction completion certificate. To that date, we will add 2 years. Like in this question, construction completion certificate we obtained on 1st February 23, guys, which is 22-23 previous year. So end of this year would be 31st March 2023. From this date, 2 years would be 31st March 2025. So till this date, if the property is lying vacant, then the IFHP will be 0. Are your conditions fulfilled in this scenario? See, yes, my assessee is having stock in trade over here. Yes, it is newly constructed property. If you notice, some of the properties are lying vacant. Like out of the 15 flats, only 10 are let out. Remaining 5 are lying vacant. Out of the 10 commercial flats, only 5 are let out. Remaining 5 are lying vacant. And even these 15 flats which are let out, they let out only from the 1st of May. April month they are lying vacant. And if you notice, till 31st March 25 we're talking, right? My current year is 24-25 only, which is till 31st March 25. So yes, my property is stock in trade. Yes, it is newly constructed property. Yes, some of the properties, some of the units are lying vacant. And yes, we are talking about this date only within 31st March 25. All my conditions are fulfilled. So in this entire unit set, in this entire units, whatever units are lying vacant, for those vacant units, my IFHP will be 0. Understanding, everybody? So therefore, listen to me now. If I have to give you a proper clarity, residential units, how many units are remaining vacant? Tell me. Out of 15, only 10 are let out. The remaining 5 are remaining vacant. Then commercial units, how many have you let out? You have totally 10. Only 5 you have let out. The remaining 5 are remaining vacant. Now these are being vacant for the entire year, for all 12 months. That is from April to March. For April to March, they are fully remaining vacant. Then in addition to these, how many of these units, one second, how many of these units are let out? If you see, residential units, 10 units are let out, and commercial units, 5 units are let out. But they let out only May month onwards. But however, what about the April month? April month, they are remaining vacant. So for these periods, for these units, the IFHP will be 0. Right, guys? Why? Because assessee, for the assessee, all of these units are stock in trade. They are newly constructed. They are lying vacant, and we are talking about this 2 years period only. We are within 31st March 25. So all these conditions are fulfilled. So for these units, for these periods, the IFHP is 0. But however, for these 10 residential units and for these 5 commercial units, which I am letting out May month onwards, for these two units, for these two categories, guys, May onwards, whatever income we have, that income, yes, it will be taxable, but it will be taxable under which head? Under IFHP head only, not PGBP head, because you will put it under the PGBP head only for assessees in the business of letting out commercial properties, or if assessee self-occupying the property for business or profession. But it is neither of that case. So in May month onwards, once we start letting out these properties, then these properties that we are letting out, for those properties, whatever income we are getting, it will be assessed under the IFHP head. Crystal clear, guys? Yes. So come on, let's do this computation of IFHP for these units, 11 months, May onwards. So 11 months, what is the IFHP? Let us compute. So we are having residential properties and we are having commercial properties. We are having how many of them? I think 10 residential properties and 5 commercial properties. This is what we are letting out, right? We're doing the computation only for 11 months. Why not for April month? April month, my assessee owns a property, but then April month it is lying vacant. So because it is lying vacant, this provision is applicable, and April month also the answer will be 0 only. So therefore, we are doing the computation only for 11 months. Now the let out properties, guys. Let out properties, you start with GAV, right, guys? Now in GAV, tell me what are your steps. Your first step is municipal value or fair rent, whichever is higher. Then your step 2 is your step 1 number or standard rent number, whichever is lesser. And you know, right, this step 2 number is also called as your reasonable expected rent. This expected rent number they have given to us in the question, guys, over here, 14,000 per month for residential property, 22,000 per month for commercial property. So come on, for residential properties, your reasonable expected rent will be 14,000 per month into 11 months into how many properties? 10 units. So 14,000 into 11 into 10. This will be 15,40,000. Similarly, for commercial properties, 22,000 is your expected rent into 11 months into 5 units only over here. So here your expected rent will be 12,10,000. Okay, then what's your step 3? Your step 3 is actual rent minus unrealized rent. The actual rent is how much? You're letting out the residential properties for 15,000 and commercial properties for 20,000. So actual rent will be 15,000 into 11 months into 10 units. So this will be 16 lakh 50,000, and for commercial properties you're letting them you're letting them out for 20,000. So 20,000 rupees is the rent into 11 months into 5 units. So this would be 11 lakh rupees. Okay, then what is your step 4, guys? No unrealized rent. Your step 4 is step 2 number or your step 3 number, whichever is higher. So your step 2 number is 15 lakh 40,000. Your step 3 number is 16 lakh 50,000, whichever is higher. So 16 lakh 50. Here 12 lakh 10,000 is your step 2 number. 11 lakh is your step 3 number, whichever is higher. So 12 lakh 10,000. Then comes step 5, vacancy loss. There's no vacancy loss over here. You can't say April month vacancy loss because April month answer is 0. We've already concluded because these conditions were fulfilled. Okay, so you can't say April month is vacancy loss over here. So step 6 is your GAV, your step 4 minus step 5. So you have 16 lakh 50,000 for the residential units and 12 lakh 10,000 for the commercial units. Now when you start computing your IFHP, the GAV of these units 16 lakh 50,000, 12 lakh 10,000. Then from this you subtract municipal taxes paid. We read the whole question, we did not have any municipal tax paid. So 16 lakh 50,000 and 12 lakh 10,000, this will become your NAV. From this you will subtract your 30% standard deduction and you will subtract your interest on borrowed capital. You don't have any interest. Give me your standard deduction numbers. Standard deduction would be 4,95,000 for residential units and 3,63,000 for your commercial units. So with this you will be able to find your IFHP number. This would be your IFHP number, 11,55,000 for your residential units and 8,47,000 for your commercial units. So your total IFHP would be 20 lakh and 2,000, and this would be your IFHP number May month onwards, 20 lakh 2,000. Understanding, guys? So tell me till here what was your new learning. This is the most interesting part of this question. If you've understood till here, rest of the question is easy breezy, guys. Come on. So your first learning was, when does your house property go into the PGBP head? Only in 2 situations. None of the 2 situations were applicable for us in this question, so therefore no PGBP head, we stayed under IFHP only. Then second learning, in IFHP head, if you see in this question, the property is stock in trade. It is newly constructed property. It is lying vacant, and we are talking about within 2 years. Within 2 years from the end of the year of construction completion certificate, all these conditions are fulfilled. Therefore, IFHP will be 0. For the vacant units during the vacancy period, the IFHP will be 0. So only May month onwards, only for the units which we are letting out, only for those units, May month onwards only you will have IFHP. Alright everybody, now come to the question. The question is asking you, first of all, how much amount would be taxable in respect of income earned by Mr. Manish for letting out the residential and commercial units and under which head? So how much is taxable for residential units and for commercial units and under which head? So here this column, the first column was residential units, second column was commercial units, and both are under IFHP head only. So see, IFHP head. Here also we are talking about IFHP head. Here PGBP head. So it can't be option C. Then option D is also talking about PGBP head. It can't be option D. So A or B. A says 11,55,000 from residential units, 8,47,000 from commercial units. Yes guys, same numbers even we have. Option B says 11,55,000 and 7,70,000. No, 7,70,000 is not the right number. Option A would be your correct answer. Understanding? Yes, then come to the second subdivision. So here they are saying, what would be your answer to MCQ 1? If Mr. Manish is not a real estate developer, but instead he's in the business of letting out properties, then what will happen? Come on. See, if he is in the business of letting out commercial properties, that will only come under the PGBP head, guys. But if he's in the business of letting out residential properties, that will still stay under the IFHP head only. So residential properties 11,55,000 will be the same answer only. Only your commercial properties answer will change. Instead of IFHP head, it will go into PGBP head. But in PGBP head, no expected rent, nothing. I'll straight away take the actual rent number that will go into PGBP head. That's all. Story over. So for these commercial units, what is your actual rent? The actual rent is 11 lakh rupees, right? 20,000 per month. So that 11 lakhs will be taxable for you under PGBP head. Understanding? So if my assessee is in the business of letting out properties, only commercial properties will go under the PGBP head. Residential properties will still stay under IFHP head only. Because try to recall, just now I told you, when does your property go into the PGBP head? Only if assessee is in the business of letting out commercial properties, not residential properties. So residential properties will still stay under IFHP head. So residential properties, your 11,55,000 number will still be the same only. Commercial properties alone will go into PGBP head. And when you put into PGBP head, you will not have your IFHP calculation over there. What is your rental income? 20,000 per month is your rental income. That's all. That will be taxed under PGBP head. So 11 lakh and 11,55,000. Option D, guys. 11,55,000 from residential units, IFHP head, 11 lakhs from commercial units under the PGBP head, option D. Okay. Then comes your third subdivision. What would be the tax treatment of the vacant residential and commercial units held as stock in trade? The vacant units, remember we already spoke about it. We have 5 residential units, 5 commercial units, full year they are vacant. Then we have 10 residential units and 5 commercial units, April month they are vacant. For when they are vacant, we are applying this provision, and because of this provision, till 2 years from the end of the year of construction completion certificate, we are saying IFHP will be 0. So we have to look for that option now. So look at this, look at option A. No tax treatment would be there as the units were not let out and held as stock in trade, and 2 years have not lapsed from the end of the financial year in which certificate of completion is obtained. Sounds correct, guys? No tax treatment 2 years from the end of the financial year. Then option B says vacant units would be deemed to be let out. No. Then vacant units would be deemed to be let out. No, no deemed to be let out and all. Vacant units would be deemed to be let out for 2 months. No. So option A, no tax treatment, IFHP will be 0. Why? All these conditions are fulfilled. They are held as stock in trade, newly constructed property, lying vacant, and we are talking about this period only within 2 years from the end of the year of construction completion certificate. Please notice, guys, are we adding 2 years to the date of construction completion? No, we're adding 2 years to the end of the year of construction completion. So till this date, if your conditions are fulfilled, IFHP will be 0. Okay, yes guys, interesting question. This was your biggest new learning through this question. Now come to your question number 4, your subdivision 4. This is relating to your life insurance policies. So come on, it will be a second revision. Just some time back only we saw the 1010D discussion. Let's see if you're able to apply that same thing even over here. So he has 4 life insurance policies. They've given you the details of the policies. So policy A, B, C, D. Now date of issue, annual premium is given to you, date when the premium falls due, I don't care about this information, date of maturity they have given to you, consideration received on maturity. So this becomes your maturity proceeds. Either this number will be exempt or it will be taxable, and sum assured is given to us. Now we'll think about these numbers in which sequence, I mean which policy will we think about first. Wherever we receive the maturity proceeds first, that's going to be a sequence. So look at the date of maturity. Where are we receiving the money first? 31st March 2030, policy A. So we'll think about policy A first. Then where are we receiving the money next? Policy B, guys, 31st March 2032. Then both of these are 2033. Which of them are we receiving first? Policy C, 31st Jan. So this will be your third in sequence, and finally policy D. Okay, now let me give you the revision. What was your sequence of thinking, guys, for the maturity proceeds? First, preliminary thinking. If it is term life insurance policy, maturity proceeds will be exempt. If money is received upon death, maturity proceeds will be exempt. If it is KMIP, then the maturity proceeds will be taxable. Okay, if none of these preliminary points are applicable, then you will come to your sequence. 4 points you have in the sequence. In the first point, it is not term life insurance policy, money is not received upon death, and it is also not keyman insurance policy, and the premium happens to be more than the limit. So if both of these conditions are fulfilled, then your maturity proceeds will be taxable. Then in your second situation also, it is not term life insurance policy, not keyman insurance policy, money is not received upon death, but premium is within the limit. The date of the policy is on or after 1st April 2023 and the aggregate premium has to be within 5 lakhs. So if all these, the aggregate premium is more than 5 lakhs. If all these conditions are fulfilled, then whatever maturity proceeds you receive, that will be taxable. Then comes your third point. If it is keyman insurance policy, the proceeds will be taxable. And then comes your last point. If the policy is if the maturity proceeds are relating to an 80DD policy, then also it will be taxable. So come on everybody, tell me, any of these policies, are they term life insurance policy? No. Money is not received upon death, also not KMIP. So my 4 points in the sequence only will apply. So we're talking about policy A first, right? This is our sequence 1, 2, 3, 4. So we're talking about policy A first. So tell me, is it term life insurance policy? Money is not received upon death and also not KMIP? Yes guys. Is the premium more than the limit? Let us check. When was a policy taken? 1st April 2021. So the policy is taken on or after 1st April 2012 guys. So what's your maximum limit? Maximum limit is 10% of sum assured. 10% of sum assured will be 3,50,000. How much premium are we paying? 4 lakh rupees guys. It is more than the maximum limit. So therefore, is a premium more than the limit? Yes guys, premium is more than the limit. So here your maturity proceeds will be taxable. This 40 lakhs will be fully taxable, no exemption. Understanding? Very simple. So it is not term life insurance policy, not KMIP, not death. Money is not received upon death. Premium is more than the limit. The limit depends upon date of policy. Date of policy is on or after 1st April 2012. So your maximum limit is 10% of sum assured, which is 3,50,000. But we are paying 4 lakh premium, which is more than 3,50,000. Hence, therefore, this situation applies. Therefore, your maturity proceeds are taxable. Situation A simple. Policy A simple. Now come to policy B. Same way we will think guys, it is not term life insurance policy, it is not KMIP and money is not received upon death, fulfilled. Then is the premium more than the limit? Let us check. When was the policy taken? 1st April 23. So here also policy is taken on or after 1st April 2012. So what's your maximum limit now? Your maximum limit will be 10% of sum assured. 10% of 14 lakh will be 1,40,000. This will be your maximum limit. How much premium are we paying? 1,50,000, which is more than the limit. Yes, premium is more than the limit. So in policy B also, I fall in my first bucket itself. So even over here, your maturity proceeds will be fully taxable. Then as per the sequence, third, we will talk about policy C. Again, same thing. Is it, it should not be term life insurance policy. Money is not received upon death. It is not KMIP. Yes. Is the premium more than the limit? Now, the limit will depend upon the date of policy. Policy is taken on 1st February 24 on or after 1st April 2012. So, which means your maximum limit will be 10% of sum assured. 10% of 22 lakh will be 2,20,000 guys. This is your maximum limit. But we are paying 2 lakh premium only. Is the premium more than the maximum limit? No, premium is not more than the limit. So, my first situation will not apply over here. So therefore, I'll come to my second situation now. It is not term life insurance policy. Money is not received upon death. Also, it is not KMIP. Yes. Premium is within the limit. Yes, yes. Premium is only 2 lakh. It is within 10% of sum assured. Then the date of policy should be on or after 1st April 23. Yes, yes, yes. Date of policy is on or after 1st April 2023. And the premium has to be more than 5 lakhs. Premium is only 2 lakhs, guys. Premium is within 5 lakhs. It is not more than 5 lakhs. It is only 2 lakhs. So therefore, one condition is not fulfilled. Second situation will also not apply. It is not KMIP. It is not 80DD policy. So therefore, none of these situations apply, guys. So therefore, what will you conclude? Exempt. Exempt under section 1010D. Okay, and then comes finally your policy D. So come on, same way we will think even over here for policy D also. Same sequence, guys. It is not term life insurance policy. It is not KMIP and money is not received upon death. Fulfilled. Is the premium more than the limit? The limit will depend upon the date of policy. The date of policy is 1st July 2024. Date of policy is on or after 1st April 2012. So your maximum limit will be 10% of sum assured. 10% of 31 lakh will be 3,10,000. This is your maximum limit. But we are paying only 3 lakh premium, guys. It is well within the limit. So is the premium more than the limit? No. Premium is within the limit. So first situation will not apply. Then come to my second situation. Just follow the same sequence, guys. You will never go wrong. Come on, tell me. It should not be term life insurance policy. Money is not received upon death. Also not KMIP. Yes. Premium is within the limit. Yes. Limit is 3,10,000. We are paying only 3 lakh. Premium is within the limit. Is the date of policy on or after 1st April 23? Yes. Date of policy is 1st July 2024. Yes, it is on or after 1st April 2023. Now come on, this is where the most interesting part of the question is. No tension, just listen to me carefully. Tell me which other policy, we have to check aggregate premium, right? Aggregate premium means multiple policies put together. So which other policy is fulfilling these three conditions? Which other policy is fulfilling the first three conditions? Come on, let us check. Let us hunt for the policies now. Policy A, if you see, is it fulfilling these conditions? No guys, here premium has to be within the limit. But policy A and policy B, the premium was more than the limit. So not policy A, not policy B. But what about policy C? Policy C fulfilled all these conditions. It was not term life insurance policy. Money is not received upon death. It is not KMIP. Premium also was within 10%. It is within the limit. Date of policy is also on or after 1st April 23. And here the aggregate premium was within 5 lakhs only. So until now, which other policy in this category you have enjoyed exemption? Only category C you have enjoyed the exemption. It is fulfilling all these conditions. Now see guys, category D also is fulfilling, your policy D also is fulfilling the first three conditions. Now if I take policy D also, will the aggregate premium be within 5 lakhs or will it be more than 5 lakhs? Will it be more than 5 lakhs? No, it will be exactly 5 lakhs. It will not be more than 5 lakhs. So these kind of policies, if the aggregate premium crosses 5 lakhs, then only taxable. But these kind of policies, in our situation over here, the aggregate premium is exactly 5 lakhs only. So therefore, is it more than 5 lakhs? No. So therefore, I will not fit under the second category also. And it is not KMIP, it is also not ATDD. So my policy D does not fit under any of these four categories. So general answer, the maturity proceeds will be exempt under section 1010T. Understanding, if your aggregate premium crosses 5 lakhs, then those policies because of which it crosses 5 lakhs, those policies it will become taxable. Here, if you see policies which are fulfilling these three conditions, only policy C and policy D you have. All these policies put together, if it crosses 5 lakh premium, then it will become taxable. But here it is exactly 5 lakhs. It is not crossing 5 lakhs. So therefore, my fourth condition over here, aggregate premium should be more than 5 lakhs. That condition is not fulfilled. So therefore, none of these four categories, hence exempt. Okay guys, now you've understood till here, but can I make one small change? But wait, before I make the change, let's finish off the answer to the question. Which of the life insurance policies would be exempt? We have concluded only C and D are exempt. A and B are taxable. So only C and D are exempt. So option C. This is fine. Now see, let's make one small change. We're going to spend just 5 more minutes in this question. These 5 more minutes will change everything for us. Let us restart with policy D. I'll just make some changes in the numbers. I just want to give you a little extra clarity. Listen to me. Let us say policy D, your number was 3,50,000. By chance, it was 3,50,000. What would have happened? Then tell me. Again, same sequence you will think. Is it term life insurance policy? Money is not received upon death. Also not KMIP? Yes. Is premium more than the limit? No. Premium is within the limit. So therefore, I'm not fitting under bucket 1. Then it's not term life insurance policy, not death, not KMIP. Yes. Premium is within the limit? Yes, premium is within 10% of sum assured. Is the date of policy on or after 1st April 23? Yes, it is. Is the aggregate premium more than 5 lakhs? Tell me guys, these kind of policies, which other policy do you have fulfilling these three conditions? Only policy C. So there the premium was 2 lakhs. So if I take policy D also along with policy C for exemption, the aggregate premium is becoming how much now? Aggregate premium is becoming 5,50,000. Is it more than 5 lakhs? Yes, it is more than 5 lakhs. So all your 4 conditions are getting fulfilled if policy D was 3,50,000 over here. So in that case, policy D, your answer would have become taxable. See, policy C will still be exempt. Why? Because up to 5 lakh, the maturity proceeds will be exempt only, right? So only 2 lakhs is a premium over here. So this is within 5 lakhs only. So here it will be exempt only. Those policies, because of which aggregate crosses 5 lakhs, those policies, the maturity proceeds will become taxable. Understanding? See, now listen. Let's continue the story. Let's say we had one more policy, policy E. Even this was taken on or after 1st April 23, let us say. Let us say the premium was within the limit even over here in policy E. And here the maturity proceeds was 2,50,000, let us say. Okay, then what would have happened? It's not term life insurance policy. Money is not received upon death, not KMIP. Is premium more than the limit? Let us say premium is within the limit, which means I'm not fitting under the first bucket. Then it is not term life insurance policy, not KMIP and all. Let us say premium is within the limit. date of policy is on or after 1st April 23. Now tell me, in this bucket, how many policies have you already enjoyed exemption in this bucket? Only policy C you have enjoyed exemption. Policy D you made the proceeds taxable. So if policy C you have enjoyed exemption and policy E also if you enjoy exemption, tell me, does the aggregate premium exceed 5 lakhs? No, aggregate premium will be only 4 lakh 50 guys. So is it more than 5 lakhs? Not more than 5 lakhs. So now are you understanding? Policy E, not KMIP, not ATDD, none of these 4 buckets. So policy E, my maturity proceeds would be exempt. Alright, so those policies because of which the aggregate crosses 5 lakhs, those policies only the maturity proceeds will keep becoming taxable. Other policies wherein the permutation or combination is such that the aggregate premium is within 5 lakhs, those policies you will keep enjoying exemption. Okay, so only those policies where it crosses 5 lakhs, there only it will be taxable. But this was only extra discussion for us over here. Here they had asked us about policy C and policy D only. Aggregate premium, if you see, is within 5 lakhs. It's exactly 5 lakhs, not more than 5 lakhs. So therefore policy C and policy D both were exempt. Okay, just wanted to give you some extra clarity. So now come on guys, let's go forward. Let's go to question number 21 now. Question number 21 is from a residential status. Okay, in residential status chapter, you have two places, right, where you do this 15 lakh calculation. Total income minus income from foreign sources should be more than 15 lakhs. This calculation you do in two places. One is the special provision, basically a 120 days set provision, and second is deemed resident. In both these places you do the 15 lakh calculation. So something about that I want to show you over here. Have a look at the question. The question says, Mr. Varun, an Indian citizen, he is engaged in consultancy business in India. So where is the consultancy business? It is in India. He shifted to Dubai in the year 2019 to expand his consultancy business overseas. Now see, is he leaving the India business and going and setting up a business in Dubai? No, the business is in India only. The business is set up in India only. He is just going and expanding the business in Dubai. So the business continues to be in India. In Dubai also he is going to expand his business. Okay guys, so can I say that over here the business is set up in India? Alright, so he's engaged in consultancy business in India. He shifted to Dubai in the year 2019 to expand his consultancy business overseas. So he has a business in India that also is continuing. It is set up in India. He is expanding it in Dubai. He visits India every year to supervise his office in Delhi. They've given us all his incomes. They're asking us to find total income less income from foreign sources. So total income less income from foreign sources means what? It means nothing but income from Indian source. And for this purpose, Indian income from Indian source will be totally three things. Number one, you will have incomes which are earned in India. Then number two, you'll have business incomes from businesses which are controlled in India, and professional incomes from professions which are set up in India. Now come on, let's see one by one. Income from consultancy business in India. So the consultancy business is in India. So where is the source of income? Its source of income is in India guys. It becomes an income which is earned in India. So in this first point, you will take this 10 lakh rupees. It is business in India. So it is an income earned in India. This is done. Now comes the most interesting part of the question, income from consultancy business in Dubai. Slowly, no tension, no hurry, calm mind. Tell me, is it income earned in India? Income from consultancy business in Dubai. So the business is in Dubai guys, business is outside India. So is it earned in India? No, it is earned in Dubai. So it will not fit under the first point. But however, income from consultancy will come under profession guys. Even though they've used the word business over here, consultancy comes under profession. I'll give you the reason why. Even in section 44 ADA, when you talk about specified profession, there you have technical consultancy, right? So consultancy generally comes under profession. So income from consultancy business in Dubai, is it okay, fine, it is not income earned in India. Okay, fine, it is income earned in Dubai. But is it business income from business controlled in India or profession income from profession set up in India? Tell me, is this Dubai work of your SSE independent of the Indian work? No, it is an expansion of his Indian consultancy business. So therefore, can I say that his consultancy profession is actually set up in India? So this Dubai income that he is having, it is income from profession which is set up in India. So this 4 lakh rupees I will consider in my 15 lakh calculation, not in my first point, but in my last point over here. It is professional income from a profession which is set up in India. Okay, I am earning this income in Dubai. Where am I earning the income? Income is from Dubai. So is it income earned in India? No, it is income earned in Dubai. It's an expansion of the business which is set up in India. So it is professional income which is earned outside India, no doubt, but from a profession which is set up in India. No doubt it is earned outside India, but it is relating to a profession set up in India. That's why I will consider. Alright, guys. So this was your important point. Then agricultural income from land situated in Kerala. This will be exempt. Your equation, guys. Agricultural income plus agricultural land plus in India will be exempt. So I will not take this. Then dividend from an Indian company received in Dubai. It's from an Indian company, so the source is in India. So income is earned in India. I'll take this number. Then interest expenditure on investment in above shares. Tell me, against dividend income, only one expense you can subtract, interest expense. Maximum how much you can subtract? Maximum 20% of your dividend income. 20% of 50,000 will be 10,000. This is the maximum expense which you can subtract. So it is 15,000 interest expense, but you will subtract only 10,000. So what's your total income minus income from foreign sources now? 10 lakh plus 50,000 minus 10,000 plus 4 lakhs, you will get 14 lakh 40,000. That's it, guys. So the actual question was asking for residential status and all, but only the 15 lakh calculation was interesting. So that is all what I wanted to do for you in this question. Okay. Now come on, let's move on. Let's move on to question number 22. Capital gains. We are back to capital gains. We've traveled quite a lot and now we are back to capital gains. Come on, guys. So the question says Mr. Aryan is a resident individual. He is working in Nischay Limited and he earns salary of 90,000 rupees per month during 24-25. So salary 90,000 rupees per month. Then he holds 20,000 equity shares of Alpha Limited, an Indian company, purchased on 1st January 2016 at 200 rupees per share. They were acquired through recognized stock exchange. STT was paid on both acquisition and sale. Then in August 2024, Mr. Aryan transferred a plot in Chandigarh for 70 lakhs, which was acquired by him in May 2016 for 22 lakhs. He paid brokerage 1% on transfer. Then in November 2024, Alpha Limited decided to buy back 50% of the shares at 250 rupees per share. Alpha Limited bought back proportionate shares of Mr. Aryan. Then finally, in May 2025, Mr. Aryan acquired a residential house property in Kanpur for rupees 40 lakhs. FMV of equity shares on 31st Jan 18 was 190 per share. You are required to compute the total income of Mr. Aryan if he is paying tax under the default tax regime. Be careful, guys. They're asking us to find total income under the default regime, not normal regime. Under the default regime, we have to find the total income of the SSE. No tax liability, only total income. Come on, guys. Let's get to work. We'll read the question once again. As we read the question, we'll keep doing our calculations. Okay. So we're doing total income computation as per the default regime. Come on, slowly, no tension. Step by step we'll go. First of all, he's earning salary income. Now salary income is how much? 90,000 rupees per month. So 90,000 rupees into 12. No other adjustment relating to salaries, guys. Only standard deduction I will allow over here. How much? Default regime, no. So I will allow 75,000 standard deduction. So what will be your taxable salary now? Taxable salary will be 10 lakh 5,000. This was simple. Okay. Then after this, he holds 20,000 equity shares of Alpha Limited. 20,000 shares he has. Purchased on 1st Jan 2016. So this becomes your date of acquisition of these shares. He purchased them at 200 rupees per share. This will become your cost of acquisition. They were acquired through stock exchange. STT was paid on both acquisition and sale. Then relating to this, you have an adjustment over here. In November 2024, Alpha Limited decided to buy back 50% of its shares at 250 rupees per share. So 250 rupees per share becomes a buyback price. The company is buying back 50% of the shares. So Mr. Aryan is holding 20,000 shares. So out of 20,000 shares, 10,000 shares, 50% will get bought back, guys. So come on, guys, buyback. Whenever you have buyback, you will first look at the date. Here the date of buyback is November 2024. So buyback happened on or after 1st October 2024. So if the buyback happens before 1st October 2024, you have buyback distribution tax, all that concept. But here, because the buyback has happened after 1st October 2024, no buyback distribution tax, no tax implications for the company. Tax implications will be for the shareholder only. For the shareholder, tax implications, two tax implications you will have. Number one, the entire buyback price will be taxed in the IFOS head. And number two, you will have capital gains calculation also. Two tax implications for the shareholder. So come on, everybody. So talking about your IFOS computation now. What do you tax in IFOS? 222 222F guys, in 222F, whatever is your buyback price will get taxed over here. So 10,000 shares are getting bought back at 250 rupees per share. So 10,000 into 250, 25 lakhs as it is will get fully taxed for you under IFOS under 222F. No limit over here. See, generally for dividend you have a limit, right, up to accumulated profits and all that. No limit over here. Whatever is the buyback price as it is, it will get fully taxed under IFOS. This is the first tax implication. Alright guys, so now comes your second tax implication, capital gains. So let me do a separate working note for you, capital gains relating to buyback. Normal usual capital gains computation guys, just like how we always do. See, in this question actually buyback is not a new concept altogether. It's something that we already know. Just I wanted to give you one revision. Only one thing changes, right, because of buyback in capital gains, and that is your full value consideration. It will be 0. So therefore you'll always have a negative number only. So come on, let's do a usual computation. First of all, what's a capital asset transferred? 10,000 shares guys. Listed shares or unlisted shares? STT and all is paid, they are saying. So therefore it is 10,000 listed shares. Then what's the period of holding? When did we get these shares? Date of acquisition is 1st Jan 2016. And when is the transfer happening? When is the buyback happening? In November 2024. Pause, check, think. November 2024 on or after 23rd July 2024 guys. So come to the margin. 50AA, will 50AA apply to shares? No. Then how many periods of holding will you have after the amendment? Only 2, 12 months and 24 months. These are listed shares, so therefore your relevant period of holding will be 12 months. And will you get any indexation benefit guys after the amendment? No indexation benefit also over here. So therefore let's get back now. 12 months. So is this more than 12 months? Yes, it is more than 12 months. So therefore this will be long-term capital asset. If long-term capital asset, first you will try 112A. 112A will apply over here because it is listed equity shares and STT is paid both acquisition and transfer, they are saying. So therefore 112A will apply over here. Okay. Now you will start your usual computation, full value consideration. Two sections only will come to your mind at this point, 50C and 50CA. None of the two sections are applicable over here. So I'll take my full value consideration as it is. But remember, in buyback cases, full value consideration will always be 0. Why? Because what are you getting in return? You're giving back your shares to the company. What are you getting in return? Buyback price. Buyback price you have already taxed in IFOS head guys. I will not make it taxable again for you in capital gains head. So full value consideration will always be 0 in buyback cases in capital gains head. Okay. No expenses on transfer. This itself becomes a net consideration. Now come on everybody, slow down over here. This is the interesting part. Less cost of acquisition. Tell me, I always make you think about 2-3 things over here. Tell me first of all, will the grandfather clause apply? Tell me. Is it long-term capital asset plus 112A plus date of acquisition on or before 31st Jan 2018? It is long-term capital asset. It is 112A. Date of acquisition is on or before 31st Jan 2018. So therefore your grandfather clause will apply guys. What does the grandfather clause say? Come on guys, 112A, grandfather clause. Your cost of acquisition number will get revised. Your cost of acquisition number will now be whatever is the actual cost of acquisition or FMV on 31st Jan 18 or your FPC number. So out of these two numbers you will pick whichever is a lesser number, and out of these two numbers you will pick whichever is a higher number, and that is how you will get your revised cost of acquisition. Right everybody? So under 112A it is long-term capital asset. It is 112A. Date of acquisition is on or before 31st Jan 2018. So therefore I will revise my cost of acquisition. So come on everybody. What's your actual cost of acquisition? Actual cost of acquisition is 200 rupees. What is your FMV on 31st Jan 18? See, it's given to us over here. FMV on 31st Jan 2018 was 190 per share. But what is the full value consideration? Full value consideration is 0. So come on, careful. Out of these two numbers, which is a lesser number? 0. Now out of 0 and 200, which is a higher number? 200. So your revised cost of acquisition will be 200. So 200 shares into 10,000 shares, your total cost of acquisition will now be 20 lakh rupees. So no indexation possible. Why no indexation? Because you've already concluded after amendment no indexation. Also it is 112 guys, so therefore no indexation. So therefore you will get a net negative number. You'll have a loss of 20 lakh rupees, your long-term capital loss. Understanding? Yes. So actual cost of acquisition or FMV, FVC, whichever is lesser. Then out of these two numbers, whichever is higher. So your FMV on 31st Jan 18 was 190, FVC was 0. So out of these two numbers, which is lesser? 0. Then the 0 or 200, whichever is higher, 200. So 200 becomes your revised cost of acquisition. This into 10,000 total number of shares. 20 lakhs is your total cost of acquisition. So 0 minus 20 lakhs. 20 lakhs is your LTCL. And what do you do with the losses? You take them in the margin. So LTCL 20 lakhs. Understanding? Yes, guys. So this was your buyback adjustment. So with respect to buyback, how many tax implications? 2 tax implications. Number 1, entire buyback price as it is you will tax in the IFO asset. Number 2, you will have capital gains. And in capital gains, you will always have a loss over here. Why? Because your full value consideration will be 0. Why? Because you have already taxed the buyback price in IFOS. So therefore, in capital gains, your full value consideration will be 0. Okay, don't forget the grandfather clause, guys. When you come to cost of acquisition, I always make you check 2 things. Number 1, the grandfather clause, and number 2, your indexation benefit. Don't skip your steps. All right, now come back to your thinking. So we are done with this para, and this para. Now come to this in between point over here. In August 2024, Mr. Aryan transferred a plot in Chandigarh. So we're talking about a Chandigarh plot of land. He transferred when? In August 2024. So this becomes your date of transfer. Transferred for 70 lakh rupees. This becomes your full value consideration, which was acquired by him in May 2016. This becomes the date of acquisition. It was acquired for 22 lakh rupees. This becomes your cost of acquisition. And the question says he paid brokerage of 1% on transfer. So we have expenses on transfer. Okay. And then the question says that in May 2025, he also acquired a house. So come on, guys, any exemption section? He sold a piece of land and he's buying a house. See, when you buy a house, only 2 exemption sections are possible. Either section 54 or section 54F, guys. See, 54 will apply only if you sell a house and buy a house. Yeah, here you're not selling a house. You're selling a land. So therefore, it is not section 54. 54F will apply if you sell any long-term capital asset other than house and if you buy a house. So here you are selling an asset other than a residential house and you're buying a house. So if at all some section is applicable over here, 54F only will apply for exemption. Of course, you have to check other conditions and all, but at least one basic preliminary thinking we have done that maybe 54F exemption is possible. So come on everybody, let's do another capital gains calculation now. This capital gains calculation will be with respect to the sale of plot in land. With respect to the sale of plot of land. So what's your capital asset transferred over here? A plot of land. Then what's your period of holding? When did you buy this plot of land? Date of acquisition is May 2016. And when are you transferring this? The transfer happened in August 2024. So pause, check, think. Did you transfer before the amendment, after the amendment? You have transferred on or after 23rd July 2024. Come to the margin now. Will 50AA apply to immovable property? No. Then period of holding, you will have only 2, 12 and 24 months. This is immovable property, guys. 24 months will be a period of holding. And will you get indexation benefit after the amendment? No indexation benefit. So come on, get back 24 months. It is definitely more than 24 months. Therefore, long-term capital asset. Therefore, you will first try 112A, but it is not shares, guys. It is plot of land. So therefore, section 112 will apply. Now, if it is 112, immediately something comes to your mind. 4 conditions. If 4 conditions are fulfilled, then if you have to compute tax, then with indexation 20% and without indexation 12.5%, and whichever is lesser, all that drama will apply. But all that drama will apply only if they ask you to compute tax. Are they even asking you to compute tax over here? No, only total income. So will I waste my time in the examination thinking about all this in this question? No, I will not. Understanding? All that computation with indexation, without indexation, all that extra drama applies only when they ask me for tax. Here, no tax, guys, only total income. So therefore, when thus no tension, I can start off with my capital gains calculation. I'll start with my full value consideration. 2 sections will trouble me here. 50C, 50CA. 50C will apply only if they give me STV number and all, not given. 50CA will apply only for unlisted shares. Here, immovable property. So I'll take my full value consideration as it is. No adjustment, 70 lakhs. Then I do have expense on transfer finally over here 1%. So 1% of your actual consideration, this is going to be 70,000 rupees. So 69 lakhs 30,000. This will become your net consideration. Now less cost of acquisition. Come on, guys, 2 things I make you think about over here. First of all, tell me, will your grandfather clause apply? Is it 112A No, it is 112. So no grandfather clause. Then tell me, will I have to index the cost of acquisition? No guys, we've already concluded the transfer happened after the amendment, no indexation. So I'll take my cost of acquisition as it is. What is our cost of acquisition over here? Our cost of acquisition is 22 lakh rupees. No cost of improvement, nothing. So my LTCG, as of now, my LTCG will be 47 lakhs and 30,000. Okay. Now come, let's think whether section 54F is possible or not. What are all your conditions? Condition number 1, assessee should transfer any long-term capital asset other than residential house property, guys. Yes, he has transferred a long-term capital asset other than residential house property. Then he has to buy another residential house property in India. Yes, he is purchasing a residential house property in Kanpur. So even that condition is fulfilled. He must make the purchase within 2 years from the date of transfer, or if he is constructing, he must complete the construction within 3 years from the date of transfer. Here, if you see, the transfer happened in August 2024 and he made the purchase in May 2025. So yes, he has purchased within 2 years from the date of transfer, and he has also purchased within the 139(1) date. So no requirement of CGD and all also over here. Okay guys, then what else? On the date on which you purchase a new house, on that date you should not be owning any other property. Let's say even that condition is fulfilled. Assessee should be an individual or HUF. So all my conditions are fulfilled. Therefore yes, 54F will apply. But 54F guys, F for formula, you will have to use a formula over here. How much exemption will you get? LTCG into, amount invested in the new asset into LTCG by net consideration. What is the amount that you're investing in the new house? 40 lakhs. This into your LTCG, 47 lakh 30,000 divided by your net consideration, 69 lakh 30,000. Pause and check once. In 54F, you have a limit. This amount invested number can't be more than 10 crores. Yes, it is not more than 10 crores. That's all, guys. So find out the exemption for me now. How much do you get? What's your 54F exemption? You will get 27 lakhs 30,159. So now your final taxable LTCG will be 19,99,841. This will be your taxable LTCG. Tell me, are we crystal clear? Yes, guys. Understanding? Yes. So 54F was a new point over here. After a very long time, we saw 54F, amount invested into LTCG by net consideration. So your amount invested in the new property was 40 lakhs. It is within 10 crores into LTCG by net consideration. This is your 54F exemption. So your taxable LTCG now, your LTCG under section 112, it's how much? 19 lakhs 98,000. 19 lakh 99,841. No other income, guys. We've done it all. Now we have LTCL of 20 lakhs. I can adjust my LTCL against LTCG, right? LTCL can be adjusted only against LTCG. I do have LTCG over here. It is 20 lakhs loss, guys. But sorry, assessee, 19,99,841 only I can adjust. So you will still be left with how much loss? You will still be left with 159 rupees loss. That no option. You can't adjust against other heads and all. You have to carry forward this loss. Okay. So your net taxable capital gains will be 0. So come on, tell me now, what will be the GTI of your assessee? GTI will be 35 lakh 5,000. No chapter 6 in this question. So this itself will become the total income of your assessee also. That's what they had asked us, total income. Got it, guys? So what were your new learnings over here? Number 1, we revised buyback through this question. Even your grandfather clause, your 112A, all that revision you got through this question. Then the interesting part over here was 54F. Even that you got as a revision over here. So actually, if you see nothing new in this question, just a lot of interesting points were there. So I thought I'll do this question for you, because through this one question, multiple provisions will indirectly get revised for us. Alright, guys. So this was your question number 22. Now come to your next question. No, we are not slowing down. Come to question number 23. One more capital gains adjustment over here. This is interesting. See, this question, this adjustment is relating to one question which I've actually done for you in class as well. It's relating to a Jan 2021 old syllabus examination question. In Jan 2021, we had the opt-out examination, COVID times. So in that total income question we had, and this adjustment is same adjustment from there. But the thing is, when I did that adjustment for you in class, when I worked out the Jan 2021 total income question for you in class, I do remember that you all were a little uncomfortable when I did this adjustment for you. So that is why I thought I'll bring it for you once again over here, so that through this, at least now, second revision, you'll get a little better. It'll feel a little more comfortable. Okay, and if you actually notice, all these kind of adjustments are real proof that what we've done, the kind of preparation we have done, all these old questions and RTPs and MTPs and previous year questions that we have done, it's actually relevant and it's actually good practice that we have done. Because if you're noticing, even though it's an old syllabus question, that too an opt-out question paper, okay, even that adjustment they have found to be relevant enough to put in your September 2025 RTP. So yes, this again is, this again reinforces our belief in our kind of preparation, that yes, what we've done was actually, required and relevant. So come on everybody, let's read this question. Let's see how many of you can recall this adjustment, okay? The question says, Mr. Shobit had sold a house long back on 30th March 2022. He had sold a house and he had deposited the long-term capital gains of 25 lakhs in capital gains account scheme by the due date of filing return of income for that year. So long back, guys, on 30th March 2022, which is previous year 21-22. So long ago, he had sold a house. He had transferred a house property and he had deposited LTCG 25 lakhs. He had put this in his capital gains deposit account. Now tell me guys, when are you going to revisit this account? When you put money in CGD, you will revisit the account for a house. You will revisit the account after 3 years. So 30th March 2022, you will revisit after 3 years. So which means you will revisit on 30th March 2025. Now on this date, you will check if there is any unutilized money in CGD account. If there is unutilized money in CGD account when you revisit, then that unutilized amount will be taxed as capital gains for you. Right guys, so remember, you will come back and check on 30th March 2025, which is in the current year guys, our current year 24-25. Okay, then what happened? On 1st July 24, which is current year, on 1st July 2024, he sold another house property in which he resided for 1 crore. And here he earned long-term capital gains. Without indexation benefit, he earned 50 lakhs on sale of this property. So, 1st July 2024 is the date of transfer. What has he transferred guys? He has transferred a house property. See, the date of transfer is 1st July 2024, which means the date of transfer is before the amendment guys. It is before 23rd July 24. Now, before 23rd July 2024, indexation benefit you do get. But they are saying that he sold the house for 1 crore, which means full value consideration is 1 crore. They are saying he has earned LTCG, but LTCG without indexation benefit they have given guys. So this number will be irrelevant for us because the transfer has happened before amendment. So indexation will apply. I want LTCG with indexation benefit, not without indexation benefit, because indexation is applicable. Then what happened? On 5th Jan 2025, he withdrew the whole money out of his CGD account and he invested 60 lakhs on the construction of a house in Mumbai. So we are constructing a new residential house property. For this new residential house property, we have spent how much? We have spent 60 lakh rupees. We'll keep this adjustment pending. We'll come back to this adjustment a little later. So let's finish off the last sentence first. The indexed cost of acquisition of the house property is 60 lakhs. See, full value consideration is 1 crore. We had already concluded indexation benefit should be given to us. They have given to us the indexed cost of acquisition. So indexed cost of acquisition is 60 lakh rupees. So what is your LTCG with indexation benefit now? LTCG with indexation benefit is 40 lakh rupees. Alright. So now careful. See, 25 lakhs is there in CGD account and current year we have LTCG of 40 lakhs. Now the question says, on 5th Jan 2025, he withdrew the whole money out of the capital gains account. So 25 lakhs I have in CGD account. So this 25 lakhs he has withdrawn from the CGD account when on 5th Jan 2025 itself. So you tell me, when you come to revisit the CGD account on 30th March 2025, do you find any unutilized amount? No guys, full 25 lakhs is withdrawn on 5th Jan 2025 itself. So therefore the unutilized amount is 0. So when you come on 30th March 2025 to check the balance in CGD account, you're not finding anything. So therefore CGD account well utilized. Alright guys, well utilized, properly utilized. So with respect to CGD account, there will be nothing taxable in the current year. So, in the new house, we put 60 lakhs, 25 lakhs came from CGD account. So, obviously, where did the balance 35 lakh come from? His own money, guys. 25 lakhs came from CGD account. A balance 35 lakh extra money he has put, own money he has put. Total 60 lakhs he has put in this new house. So, 5th Jan 25, he withdrew the money out of capital gains account and he invested 60 lakhs on the construction of the house in Mumbai. Construction is completed on 23rd March. So, CGD account, we already spoke about it. When you come back on 30th March, nothing is unutilized, so nothing is taxable. Now, what about this 35 lakhs, guys? Think. See, my assessee is selling a house in the current year. He is constructing a new house in the current year. He is an individual. He is having long-term capital gains. Any exemption section comes to your mind. He is selling a house. He is constructing a house. Section 54 exemption will come into your mind, guys. Yes, check your conditions. Section 54 says you can either buy a new house or you can construct a new house. Here we are constructing. If you're constructing, you must complete the construction within 3 years from the date of transfer. The date of transfer over here is 1st July 24 and you're completing the construction on 23rd March 25. So even this condition is fulfilled. You have spent the money on 5th Jan 2025. You have spent the money for construction within the 139 date also. So therefore all your conditions are fulfilled over here. So 35 lakh rupees I will get as my section 54 exemption. So 5 lakhs will be my taxable LTCG in this question. Understanding? So this question was a combination of your CGD concept and your section 54 concept. So earlier I had put money in CGD. That has been fully utilized. So no tension over there. In addition to utilizing that money, extra 35 lakhs also we have spent on a house. So this extra 35 lakhs I can enjoy section 54 exemption. So 40 lakh minus 35 lakhs, 5 lakhs will become my taxable LTCG. See, all this is fine over here. According to me, I would say that the most interesting part in this question was how we ignored the LTCG that they had given to us without indexation benefit, and instead we concluded indexation benefit we should get, and we took the indexed cost of acquisition and recomputed the LTCG. This, I think, was the highlight of this question. Okay, so this was your question number 23. Now come on guys, come to question number 24. Question number 24 is like a nice mixture of questions, a little bit of IFHP, a little bit of capital gains, and once again your insurance policy maturity proceeds, that also once again will get revised for you. Come on, let's see how comfortable we are over here. So question number 24. Come on everybody, let's read the question. The question says, Mr. Vivek Malhotra, this is a recent, your Jan 2026 RTP question only. Mr. Vivek Malhotra, an Indian resident, he has 4 residential house properties in India. 2 of them are in Delhi. Okay, so Delhi, he has Delhi house 1, Delhi house 2. Okay, total 4 houses he has. 2 of them are in Delhi, of which one is self-occupied and second is let out. So Delhi, let's say house 1 is self-occupied property, second property is let out property. Let out for a monthly rent of 1,40,000. So here 1,40,000 per month is a rent to Mr. Sushil, a salaried individual. So the tenant is a salaried individual. Then the other 2 properties are in Mumbai. So Mumbai 1, Mumbai 2. Total 4 properties he is having. To reduce his tax liability, he gifted one of the residential house properties in Mumbai to his wife, Mrs. Anika. Tell me everybody, this house which he is gifting to his wife, the computation will be in whose hands? Assessee is transferring a house to his spouse for no consideration or for inadequate consideration. The transferor assessee will be deemed to be the owner. So for this Mumbai house, even though he is not the legal owner, he has gifted the house to his spouse, still for this Mumbai house, he will be the deemed owner. See, I will not apply clubbing concept. I will apply deemed owner concept. In the beginning of this entire discussion itself, I told you when clubbing and deemed owner both are applicable, one rule will come to your mind. One rule we had made for ourselves. We first try deemed owner. Only if deemed owner is not applicable, then only we go to clubbing, guys. So here deemed owner concept will apply. Then what happened? The second one he gifted to his minor daughter Miss Pooja without adequate consideration in April 2024. So even this second Mumbai house, even for this he will be deemed owner, because he is transferring the property to his minor child for no consideration or inadequate consideration. So even though he is not the legal owner of the house, even then still he will be deemed to be the owner. So when assessee transfers the house to spouse, or when assessee transfers the house to minor child other than minor married daughter, in these cases for no consideration or inadequate consideration, then the transferor assessee is deemed to be the owner. So for both the houses, deemed owner concept we applied. Okay, then what happened? Expected monthly rent of self-occupied property in Delhi. This property expected monthly rent. So expected rent they have given is 50,000 rupees. Expected monthly rent. So 50,000 rupees per month is the expected rent of the Delhi house. Then expected monthly rent of property in Mumbai is 75,000 each. So one second. These two properties deemed owner. So Mumbai, two houses, both the houses expected rent is 75,000 per month. Okay, then he paid municipal tax 1,20,000 for the let out property. So we have a let out property, right? The Delhi property. So for this property, he has paid municipal tax of 1,20,000. This is the information given to us, guys. Let's do a little bit of interpretation now. Delhi house is self-occupied house. Okay, no problem. Delhi house, second house is let out house. Even here, no problem. What about the Mumbai house, guys? Two houses, are they self-occupied or are they let out? See, had they been let out, then they would have given us the actual rent. Have they given us the actual rent for these two houses? They've only given us the expected rent. They've not given us the actual rent. Therefore, the Mumbai house and both the Mumbai houses will also become self-occupied houses, guys. So now you are having three self-occupied houses. Self-occupied property you can have only 2 nil NAV. Balance, the third one, has to be deemed to be let out property. Now the whole question will obviously be that which out of these three will be deemed to be let out. Very simple, guys. So deemed to be let out property, either it will be Delhi house 1, or it will be Mumbai house 1, or it will be Mumbai house 2. Deemed to be let out property, you will do computation as if it is let out. Let out means you will start with GAV. And you know, right, in deemed to be let out property, for GAV calculation, you will stop with your step 2 number. You will stop with your reasonable expected rent, and expected rent they have already given to us over here. So Delhi house 50,000 rupees per month is your expected rent. Then your Mumbai house 75,000 rupees per month is your expected rent, and here 75,000 rupees per month is your expected rent. So this expected rent number itself will become our GAV, guys, because we don't have any actual rent. You know, right, deemed to be let out property, GAV you stop with expected rent step itself. So come on, calculate and tell me. 50,000 into 12, you will get 6 lakh rupees for your Delhi house. Then 75,000 into 12, 9 lakh rupees for your Mumbai house. So this becomes your GAV number. Then from GAV you will subtract municipal taxes paid. Now in this question they have given us municipal tax, but they have given us municipal tax only for Delhi house too. They have not given for the other. One second. They have not given for the other houses. So municipal tax is 0 only. So therefore what's your NAV now? The same 6 lakh number, 9 lakh number. This itself becomes your NAV. Then less deductions under section 24. Standard deduction you will have 30%. So 6 lakh into 30%, 1,80,000. 9 lakh into 30%, 2,70,000. There's no interest in this question. So therefore what's your IFHP for each of these deemed to be let out properties? You will have 4,20,000, 6,30,000 and 6,30,000. Okay, everybody. So what did we do over here? Deemed to be let out property calculation we have done. Now 2 of them have to be self-occupied and 1 of them have to be deemed to be let out. So if the property is self-occupied property, then in that case what will the computation be? Same 3 houses, guys. NAV will be 0 and no interest over here. So final answer also will be 0 only. So now tell me, which combination will you pick? Which combination will give you the least IFHP? See, self-occupied property, anyways, it is 000 only over here. So, deemed to be let out property, which out of these three will you pick as deemed to be let out property? Of course, the least one, Delhi House 1. Okay. So, what's your final conclusion now? Which property is deemed to be let out and which property is self-occupied? So, your D1, your Delhi House 1 will be deemed to be let out, and your Mumbai House 1 and Mumbai House 2, this will be your self-occupied property. Okay, everybody? Yes. So, if I do like this, what will my IFHP be? For Delhi House 1, deemed to be let out will be 4,20,000, and for my self-occupied houses, 0 plus 0. So, your total IFHP will be 4,20,000 from these three houses. Now, we have one more house. Remember, we have a let out house, Delhi House 2. Let's finish off that also. So, Delhi House 2, this is a let out property. So, you will start with GAV. Now, for this property, they have not given you municipal value, fair rent, standard rent. They have not given expected rent also. So, I'll use a shortcut. I'll take the actual rent as it is. The actual rent was 1,40,000 per month. So, 1,40,000 into 12. This will become your GAV. 16,80,000. For this house, they have given us municipal taxes paid as well. The municipal tax paid for this house was 1,20,000. So your NAV will now be 15,60,000. All right. Then from this you will subtract deductions under section 24. You will first try standard deduction at 30%. This will be 4,68,000. Then you will subtract your interest. We don't have any interest in this question. So your IFHP from the let out property will be 10,92,000. Okay. So now if I have to compute my total IFHP from these three houses, it was 4,20,000, and then from my Delhi house 2, just now we computed 10,92,000. So our total IFHP would be 15,12,000. Understanding? Yes, we had three self-occupied houses. So one of them we deemed to be let out, two self-occupied houses and one let out house. Total IFHP is 15,12,000. Alright, then let's see guys, let's go ahead and let's see what else are they asking us. In addition, Mr. Vivek sold a plot of land in Bangalore on 19th December 24. So clearly capital gains. So come on, no tension. What are we talking about? Plot of land sold on 19th December 24. This becomes your date of transfer. It was sold for 49 lakhs. This becomes your full value consideration, for which he has paid 1% as brokerage on sale consideration. So we have expenses on transfer. Expense on transfer is how much? 1% of your sale consideration. Sale consideration is 49 lakh. That into 1%, 49,000 will become your expense on transfer. Then stamp duty value on the date of sale was 55 lakhs. So they have given us the STV number also. Then the plot of land was purchased by him in 1992. So this becomes your date of acquisition. It was purchased for 3 lakh rupees. This becomes your cost of acquisition. Then they have given you FMV and stamp duty value on 1st April 2001. So 7,20,000 is the fair market value. Fair market value on 1st April 2001, and 7 lakh rupees is your SDV on 1st April 2001. Then the question says that Mr. Vivek has invested 12 lakhs in RECL bonds, your Rural Electrification Corporation bonds. So of course immediately section 54EC comes to your mind. Come on guys, let's do a capital gains computation. Don't overthink. Straight away start your usual process. We will start with the capital asset transferred. What are we transferring over here? A plot of land. Then comes your period of holding. When did you buy this? What's your date of acquisition? Date of acquisition here. Date of acquisition is 1992. And when are you transferring? You're transferring on 19th December 2024. So pause, check, think everybody. The date of transfer is clearly on or after 23rd July 2024. So therefore you will be taking, you will come to your margin first of all. First of all, will section 50AA apply? No guys, it is land. Then you will think about in the period of holding. How many periods of holding are possible after the amendment? Only 2, 12 months and 24 months. This is land, immovable property. 24 months will apply. Then after that, will you get indexation benefit after the amendment? No indexation benefit. Now come on, come back guys, 24 months. Is this period more than 24 months? Clearly, it is more than 24 months. So therefore, it is long-term capital asset. Therefore, which section will you think about first? 112A, but this is land, so it has to be section 112. Now, if it is section 112, then immediately that whole drama comes to your mind. 4 conditions, guys. If all the 4 conditions are fulfilled, then by chance we have to compute tax. Then you will do the recomputation with indexation, without indexation, all that. Let's see over here, are they asking us to compute tax? So they're asking income taxable under IFHB head, income taxable under capital gains head, tax credit, that is TDS credit. Then they're asking tax liability also. So yes, we have to do our entire thinking. So come on everybody, come on, stop being lazy, let's do the thinking. Condition number 1, the assessee has to be a resident individual or HUF. Is this condition fulfilled? The question says he is a resident and yes, he's an individual. So condition 1 fulfilled. Condition 2, capital asset has to be immovable property. Yes, it is immovable property. Condition number 3, the date of transfer has to be on or after the amendment. So on or after 23rd July 24. Yes, the date of transfer is after the amendment. And condition number 4, the date of acquisition should be before the amendment, before 23rd July 24. Yes, the date of acquisition is before 23rd July 24. So all my conditions are fulfilled. Therefore, for the purpose of tax computation, what will I do? Whatever capital gains computation I have done without indexation, on that capital gains 12.5% tax, then I'll have to recompute the capital gains with indexation for the purpose of tax on that capital gains 20% out of these, whichever is lesser. But all this drama will apply only when I do tax computation. Right now, I'm going to do computation of capital gains. This is going to be my usual computation only. All this drama only at the time of tax computation. Okay, so come on, tell me what's your first step, guys? Full value consideration. 2 sections you will think about, 50C and 50CA. They have given us the STV over here. STV and all they have given to us over here. STV on the date of transfer. So therefore 50C will apply. So section 50C, what does it say, guys? Come on, don't skip your steps. How will you start? You will start by checking your conditions. Condition number 1, capital asset has to be land, building both. Yes, it is. Condition number 2, the STV has to be more than 110% of your FVC number. What's your FVC? FVC is 49 lakhs. So 110% of 49 lakhs. STV is 55 lakhs. Check, guys. Is 55 lakhs more than 110% of 49 lakhs? 110% of 49 lakhs is 53 lakhs 90,000. Is 55 lakhs more than 53 lakh 90,000? Yes. So condition 1, condition 2, both the conditions under 50C are fulfilled. Welcome to 50C. Because of 50C, whatever is your actual full value consideration, I will ignore. Instead, the STV of 55 lakhs, this will become my deemed full value consideration. So my FVC will be 55 lakhs. Then from this I will subtract expense on transfer, which we have already computed and kept, 49,000. Be careful, guys. Expense on transfer is always a percentage of your actual consideration, not the percentage of your STV number. Because of 50C, my FVC number changed, but expense on transfer will always be a percentage of my real consideration. So 1% of real consideration, 49 lakhs. Okay, so 55 lakhs minus 49,000, 54 lakh 51,000. This will become your net consideration, right? Less cost of acquisition. Come on, do the thinking. Will grandfather clause apply over here? Is it 112A? No, it is 112. So no grandfather clause. Then will indexation concept apply over here? We already concluded no indexation because transfer happened after amendment. But tell me, guys, did I purchase the asset before 1st April 2001? Yes. So therefore my cost of acquisition number will change, right? Had it been intangible assets, I will take the number as it is. I will not revise the cost of acquisition. Here it is immovable property. So therefore, I am getting reminded of something over here. If you are a Jan 26 live workout batch student, then the grandmother joke which all had cracked in class, that concept will apply over here. So tell me everybody, how will you revise the cost of acquisition? Immovable property, it is purchased before 1st April 2001. Come on. You will take the actual cost of acquisition. Okay. You will compare this with FMV on 1st April 2001. STV on 1st April 2001. Right. See now. What is your FMV on 1st April 2001? 7 lakh 20,000, guys. And what is your STV on 1st April 2001? 7 lakhs. Now tell me, out of these two numbers, which number will you pick? Whichever is lesser, which is 7 lakh rupees. Then what's your actual cost of acquisition? Your actual cost of acquisition is 3 lakhs. So 3 lakhs or 7 lakhs, whichever is higher. See, FMV or STV, whichever is lesser, then that lesser number or your actual cost of acquisition, whichever is higher. So which is higher over here? 7 lakhs. So your revised cost of acquisition will be 7 lakhs, no indexation because transfer happened after amendment. So what is your LTCG now? 54 lakh 51,000 minus 7 lakhs, 47 lakhs 51,000. Okay, then your assessee purchased 54 EC bonds, so you will think about section 54 EC, but don't blindly write the number, check your conditions. Assessee can be any assessee, even company assessee, no problem. It should be, assessee should be transferring any immovable property, fulfilled. We should be having long-term capital gains, fulfilled. We should be buying bonds. RECL bonds is covered in that list of specified bonds, but we should be purchasing the bonds within 6 months from the date of transfer, guys. Now here tell me, have we purchased within 6 months from the date of transfer? The date of transfer is 19th December 2024 and we purchased the bonds on 15th July 2024. We have made the purchase after the 6 months, guys. So therefore, no 54 EC exemption. So my taxable LTCG will be 47 lakh 51,000 only. Alright, so this was your LTCG computation. Now come on, let's continue reading the question. What else are they saying? Only one para is left over here, two paras in fact. He has taken life insurance policy A on 15th May 23 and policy B on 1st July 23 for 10 years, sum assured of 35 lakhs and 25 lakhs respectively. Annual premium payable on this policy is 3,50,000 and 2,50,000 respectively. So he has two life insurance policies, policy A and policy B. What is the date of the policy? Policy A was taken on 15th May 23. Policy B was taken on 1st July 23. Sum assured. They have given us the sum assured value. Sum assured for the first policy is 35 lakhs. For the second policy it is 25 lakhs. And what is your annual premium on each policy? 3,50,000 and 3,50,000 and 2,50,000. Okay, Mr. Vivek has opted out of the default regime, guys, which means he's following the normal regime. They've given us the CII numbers. Let's see what are they asking us. First of all, they're asking us to find IFHP. All that hard work we have already done, guys. What is the total IFHP of your assessee? The total IFHP was 15,12,000. Option B. Then what is the income taxable under capital gains? Even this hard work we have already done. Our capital gains income is 47,51,000. So option D. Then they are asking us what is the amount of tax credit available to Mr. Vivek if tax has been deducted by the deductors. So TDS we have to think about. Let's talk about this. What are the TDS that are possible over here? Basically they're asking us about tax credit, which means TDS which others have deducted against our assessee. So what are the incomes assessee is having? See, first of all, he's having rent income. So Mr. Sushil, when he is giving rent to your assessee, Mr. Sushil would have deducted tax. So come on, Sushil is paying rent to your assessee. How much rent? 1,40,000 per month, guys. So rent, you will first think about section 194I, but then guys, he's a salaried individual, so therefore 194I is an R hijack section, right? R hijack section means this section will apply for you only if preceding previous turnover is more than 1 crore or gross receipt is more than 50 lakhs. But he's a salaried individual, so forget about 1 crore turnover. He will not even have any turnover at all. So 194I will not apply. And also one more reason 194I will not apply over here, it's personal rent, it's house rent, right? He's a salaried individual. This rent will not be for business purpose. It will be for his personal rent. So 194I will not apply. Therefore, you will think about 194IB. 194IB, any tension? No tension. Why no tension? 4 entry points you have. 4 checkpoints you have. Tell me. Condition number 1. The deductor has to be an individual or HUF. Is a deductor an individual or HUF? Yes, guys. Then condition number 2. Section 194I should not be applicable. Yes, 194I is not applicable. Then why is 194I not applicable? Either because preceding previous turnover gross receipt condition is not fulfilled, or because it is personal rent. We have the word or in between, but in this question we have both the reasons. Turnover gross receipt criteria is also not fulfilled and it is personal rent also. Both conditions are fulfilled. And condition number 4, the last condition, is that this has to be rent relating to land or building only. Basically this cannot be rent relating to furniture, fixtures, plant and machinery. No, only land, building, rent. So all your 4 conditions are fulfilled. 194IB will apply. Now in 194IB, what's the limit? The limit is the rent has to be more than 50,000 rupees per month. Yes, the rent is more than 50,000 rupees per month. So when will we deduct tax? March month we will deduct tax 194IB, right? Last month we will deduct tax. So 1,40,000 is March month rent. Against this, you will deduct TDS. So 1,40,000 into 12 months into what's the TDS rate? Come on, 194 IB. Before 1st October, the TDS rate is 5%. After 1st October, the TDS rate is 2%. So you're going to deduct in March 25, right? So after October, so your TDS rate will be 2%. 1,40,000 into 12 months into 2%. 33,600 will be your TDS. So the net rent which Sushil will pay to your assessee in March month will be 1,06,400. So they are asking us for TDS credit. So under section 194 IB, against your assessee, the tenant Sushil would have deducted how much TDS? He would have deducted 33,600 TDS. Okay. Any other TDS credit possible for your assessee, guys? Any other TDS credit, any other income that he is having? See, he is selling a plot of land. So don't you think the buyer would have deducted 194 IA TDS? You're agreeing with me. See, there's a buyer who is paying consideration to your assessee, right? Assessee transferred a plot of land to the buyer. So against this, buyer is giving consideration 49 lakhs. So consideration or SDV, 55 lakhs. Out of these two numbers, whichever is higher is what you check. The higher is 55 lakh number. 55 lakhs is at least 50 lakhs. 194 IA will apply. So the buyer will deduct tax at the rate of 1% on this 55 lakhs. So 55,000 will become your TDS credit under 194 IA. Right, guys? Any other section? See, apart from this, the only other adjustment is about insurance. See, for insurance, you have TDS only for two transactions. Either for insurance commission or for insurance maturity proceeds. Here, neither, guys. We are only paying premium over here. Neither is it insurance commission nor is it insurance maturity proceeds. So only two TDS credits assessee will be having. 194 IB 33,600, 194 IA 55,000. So the total TDS credit that he will have will be 88,600. Alright, so that is option A. Then they are asking us the next subdivision. Read this carefully. In financial year 2033-34, way later, Mr. Vivek received maturity proceeds from both the policies, 40 lakhs and 27 lakhs respectively. So come on. They are giving us some more information about this insurance concept. Third time we will be seeing it in this session. This time correctly we should get answers. So from policy A also we are getting maturity proceeds. From policy B also. So maturity proceeds from policy A is 40 lakhs. From policy B is 27 lakhs. Both we are getting when? In financial year 2033-34. Okay. Considering the most beneficial to Mr. Vivek, which of the following statements is correct? Tell me, guys. Which of the maturity proceeds will be exempt? Two policies we have. Which policy will you think about first? Whichever policy we received the proceeds first. That's how we did even in the last question, remember? We had 4 policies. So we saw which policy are we receiving the money first. That's in that order, in that sequence only we do the thinking of the policies. But here they haven't given date. They are just saying both the policies we are receiving the money in this year. That's all. They've not given us the date. So which policy will you think about first now? Wherever you're getting more amount, that is where you will want exemption first, right? So I will think about policy A first, then I will think about policy B. Okay. Now come on, your preliminary thinking first of all. Wait, I think I need more space. Can I bring it to a fresh page? Now listen. So first we'll do our preliminary thinking, guys. I'm thinking only about policy A first, okay? So our preliminary thinking, if it's a term life insurance policy, then straight away it will be exempt. If money is received upon death, here also it will be straight away exempt. If it is KMIP, straight away you will say it is taxable. But here it is none of this, guys. It is not term life insurance policy, money is not received upon death, it is not KMIP also. So now you have your usual sequence. Your first situation is, it is not term life insurance policy, it is not KMIP, and money is not received upon death also, and the premium is more than the limit. Then your second point in the sequence is, it is same thing, it is not term life insurance policy, it is not KMIP, and money is not received upon death, and this time the premium is within the limit. And your third condition is that your date of policy is on or after 1st April 2023, and lastly the aggregate premium has to be more than 5 lakhs. Then in your third situation, it is a KMIP, and in your fourth situation, it is section 80DD policy. So if any of these conditions, any of these situations, if they apply, you will see the proceeds will be taxable. If none of them are applicable, general answer will be exempt. The majority proceeds will be exempt under 1010D. Okay, so come on, let's check now. Let's talk about policy A. Let's see. Situation by situation, no jumping. It is not term life insurance policy. It is not KMIP. Money is not received upon death. Condition 1 fulfilled. Premium should be more than the limit. The limit will depend upon the date of policy, guys. Policy is taken on 15th May 23. Policy is taken on or after 1st April 2012. So your maximum limit will be 10% of sum assured. 10% of sum assured is 3,50,000. We are paying premium 3,50,000 only. Is premium more than the limit? No. Premium is within the limit. So therefore my first situation will not apply over here. Then come to the second situation. It should not be term life insurance policy. It should not be KMIP. Money is not received upon death. Yes. Premium is within the limit. Yes. Just now we checked premium is within 10%. Date of policy should be on or after 1st April 2023. Yes. Date of policy is on or after 1st April 2023. Now tell me what's the premium. The premium is only 3,50,000. Is it more than 5 lakhs? No, it is not more than 5 lakhs. It is within 5 lakhs. It is only 3,50,000. So therefore, situation 2 also will not apply for you. Then is it a KMIP? It is not KMIP. It is not 80DD policy. None of these are applicable, guys. So therefore, what will your answer be? Policy A, the maturity proceeds will be fully exempt, guys. So policy A will be fully exempt. Now after this, next you will think about policy B. Come on, same sequence of thinking, no skipping steps, please. Policy B. It should not be term life insurance policy. It should not be KMIP. Money is not received upon death. Fulfilled. Is premium more than the limit? The limit depends upon date of policy. Date of policy is 1st July 2023. Date of policy is on or after 1st April 2012. So your maximum limit will be 10% of sum assured. 10% of 25 lakh is 2,50,000. We are paying 2,50,000 premium only. It is within the limit. So is premium more than the limit? No. So it is not situation 1. Now come on everybody. Situation 2. It is not a term life insurance policy. Not KMIP. Money is not received upon death. Fulfilled. Premium is within the limit. Fulfilled. Date of policy is on or after 1st April 23. Fulfilled. Now come on, same thinking. In this category, any other policy you have taken exemption? Is there any other policy which is fulfilling these 3 conditions? Yes, guys, your policy A. Even here, premium is within the limit. Even here, policy is on or after 1st April 23, and you have already enjoyed 3,50,000 premium over here. Exempt maturity proceeds. Now tell me, if this also you take as exemption, aggregate premium will become how much? Aggregate premium will become more than 5 lakhs. Aggregate premium will become 6 lakhs. So now is your aggregate premium more than 5 lakhs? Yes, aggregate premium is more than 5 lakhs. So the policy because of which the premium exceeds 5 lakhs, this policy here, the proceeds will become taxable. So policy A exempt, policy B taxable. So choose the correct option now. Both are exempt? No. Policy A is exempt, policy B is taxable. Yes, option B. Understanding all that extra discussion we did in the last question helping you now? Yes, policy A, I enjoyed exemption. Policy B also, if you see, total aggregate will become more than 5 lakhs. So therefore, if the aggregate is more than 5 lakhs, all your conditions are fulfilled. Now this will become a taxable policy. Alright everybody, so policy A exempt, but policy B taxable. Up to 5 lakh premium exempt. Once it crosses 5 lakhs, the policy because of which it is crossing 5 lakhs, that policy, the maturity proceeds will become taxable. Okay, and finally they are asking you to find the tax liability of Mr. Vivek. Come on everybody, let's do this. Nice, amazing question this was. Tax liability. Rule 0. What's your rule 0? Which regime are we following? We are following the normal regime. And what's the basic exemption limit? 2,50,000, guys. Assessee is not senior citizen and all. So what are the incomes assessee is having, by the way? Before you compute tax, first you compute the total income, right? So assessee is having IFHP. See, the first para was all about IFHP. So assessee's total IFHP was how much? IFHP here, 15,12,000. This number. So IFHP 15 lakh 12,000. Then this para was all about capital gains. So we had section 112 LTCG. That was here 47 lakh 51,000. 47 lakhs 51,000. Then your third para was all about insurance policies. Insurance policy current year, so we will have premium, insurance premium we will be having 3 lakh 50 and 2 lakh 50. So here we will enjoy section 80C. See, maturity proceeds I will not put in my total income calculation, because maturity proceeds when are we receiving? Only in 2033, 34, not in my current year, right? So maturity proceeds I will not put in my total income calculation, but premium I will put in my current year calculation as my ATC. So what's the GTI first of all? GTI will be 62 lakhs 63,000. Then remember to split, guys, because chapter 6 you can't enjoy again special rate income. So I will have normal rate income and special rate income. A normal rate income is 15 lakh 12,000. My special rate income is 47 lakh 51,000. Then section 80C, chapter 6A, guys. Total premium is 6 lakhs, but 80C maximum limit is 1 lakh 50 only. I'll subtract it against my normal rate income. So therefore, your total income will be 13 lakh 62,000 plus 47 lakh 51,000. Your total income will be 61 lakh 13,000. You get this number? Alright, so this is your total income, guys. Now come on, let's compute tax liability. So two types of incomes you're having, normal income and 112 LTCG. So normal rate income, 112 LTCG. So what's your total income? 13 lakh 62,000 normal rate income. 47 lakh 51,000 is your LTCG. Basic exemption limit is 2 lakh 50. You will adjust against normal rate income. Fully you will adjust here itself. Normal rate income is 13 lakh 62. So full basic exemption limit you will adjust here itself. Will you have any unutilized basic exemption limit left with you to adjust over here? No, guys. Fully you will adjust here itself. So therefore tell me your basic tax now. For this normal rate income, how will you find? Up to 10 lakh you'll have to pay 1,12,500 plus 30% of the income in excess of 10 lakhs. How much will this be? Usual basic tax computation, guys. 2,21,100. This is your basic tax on your normal rate income. Now a little bit drama. Section 112 LTCG. Remember we had checked all our conditions were fulfilled. So we computed without indexation. On this number 12.5%. We'll have to recompute capital gains with indexation. On that number 20%. And then only we will pick whichever is lesser. So come on. Let us now recompute the LTCG with indexation. So net consideration will stay the same. 54 lakh 51,000. Your cost of acquisition number will have to be indexed. So 7 lakh rupees is your cost of acquisition. Okay. This into CII of the year of transfer. Year of transfer is 24-25. 24-25 indexation is 363. Divided by CII of the year of acquisition. Acquisition is before 2001-2. So you will take 2001-2's index 100. So 7 lakh into 363 by 100. 25 lakh 41,000. This will become your indexed cost of acquisition. So 25 lakh 41,000. So now what will your LTCG be? With indexation benefit, your LTCG will be 29 lakh 10,000. No 54 EC exemption. So your LTCG will be 29 lakh 10,000. Will this number ever enter into your income computation? No. All this is only for the purpose of tax. Right, guys? So come on, slow down now. Without indexation, on this number, what rate will be your tax? 12.5%. Okay. We don't have any unutilized basic exemption limit over here to adjust. So therefore, straight away I'm calculating tax. 47 lakh 51,000 into 12.5%. This will be 5 lakh 93,875. Then on this number, with indexation, on this number, 20% will be your tax. That will be 5 lakh 82,000. And out of these two numbers, which number will you pick, guys? Of course, whichever is a lesser number, which is 5,82,000. Right? So come to your tax liability. On your 112 LTCG, your tax is 5,82,000. So now tell me, what's your total basic tax? 5,82,000 plus 2,21,100. You will get 8,03,100. This becomes your total basic tax. Then no 87 rebate, income is more than 5 lakhs, but you will have surcharge. Income is more than 50 lakhs, more than 50 lakhs up to 1 crore, 10% surcharge. So 80,310. No marginal relief. Income is far away from 50 lakhs. Straight away you will add cess at 4%. So your final tax liability will be 9,18,746, which you will round off to 9,18,750. Tax liability they asked. They did not ask for tax payable. So therefore I will not adjust my TDS credit and all. I'll just take the number before TDS. 9,18,750 will become your tax liability. Understanding? Yes, guys. Very interesting question. A lot of concepts, a lot of adjustments. I mean, especially the IFHP part also was interesting. Capital gains part, once again, we are having this 112 drama of two rates and picking the lesser number. Life insurance maturity proceeds once again got revised for you. So I think you should be pretty sorted with all these adjustments by now. Alright, now come on, can I take you to the next question? Come on, guys. Let's take up question number 25. Now, in question number 25, we are having a residential status calculation. So here it's a simple question. Miss Anchal, an Indian citizen, she's an Indian citizen and she's a government employee working for the Indian government. So the employer is Government of India. Something comes to your mind. Employee is an Indian citizen, employer is Government of India. Even if she renders services outside India, still her salary income, allowances, perquisites, everything will accrue in India. After accruing in India, salary alone will be taxable, allowances and perquisites will be exempt. You remember that concept may be applicable. Let's see. They've given us a list of adjustments. What are they asking us? Determine the GTI of Miss Anchal, assuming that she has opted out of 115 BSE, which means normal regime. She's assuming she's RNOR or NR. So RNOR and NR, we have to find her GTI. Come on. First point, salary income. So she is having salary income received in Malaysia for services rendered there. Tell me, guys, generally where does salary income accrue? It accrues wherever you render services. But however, condition number 1, you are an Indian citizen. Condition number 2, employer is Government of India. Condition number 3, even though you are rendering services outside India, still your salary income will accrue in India. So this salary income, where does it accrue? It accrues in India. It becomes an Indian income and it will become taxable. It will become taxable for all your assessees, 2 lakh and 2 lakhs. But guys, from salary income, what will you remember to subtract? This is not, they did not use the word computed. So I will remember to subtract standard deduction, guys. Right? How much? Normal regime. So I will subtract 50,000 standard deduction. So what's your net number now? 1,50,000. 1,50,000. This will become your taxable salary. This was easy. Then profit from business carried on in Chennai. The business is in Chennai. So therefore the source of income is in India. This income accrues in India. It becomes an Indian income, taxable for all. So your second point is business income from Chennai business. How much is it? 80,000. 80,000 I am taxing for all. Then we have loss from business carried on in Vadodara. So the loss is from a business carried on in Vadodara. Source of the loss will be in India only, guys. Source will be in India only because the business is from Vadodara in India. So I will consider this loss for both my assessees. So losses we always put in the margin. So we have business loss of 20,000. Business loss of 20,000. Losses we always consider later only. Then we come to the next adjustment. Loss from business carried on in US. So the business is carried on in US. So the source will be outside India, guys. Profits are not received in India. So received also outside India. So therefore, if it's an income, it will be a foreign income. Here it's a loss, so it's a foreign loss. Foreign losses you will consider only for ROR. You will not consider for RNOR, you will not consider for NR. But business is controlled from India, guys. So you will consider for RNOR. For RNOR, you tax Indian incomes. You also tax business incomes from businesses controlled in India and professional incomes from professions which are set up in India. So here if you see, it's not an Indian income. It is not received in India. It is not accruing in India. But it is from a business which is controlled in India. So therefore for RNOR, you will consider this loss. So for RNOR, you have one more business loss now, which is 46,000. For NR, you will not consider. Why? Because for NR, you consider only Indian incomes and Indian losses. That is, either source has to be in India or received has to be in India. Here, neither is source in India nor is received in India. For NR, you will not consider, but for RNOR, you will consider. This was also simple. Then unabsorbed depreciation of business in US. So US business unabsorbed depreciation. This US business you have considered only for RNOR. So for RNOR only you will have unabsorbed depreciation of 16,000. Okay, then what else? The question says profits from business in Bali controlled from Delhi. 60% is deposited in a bank in Bali and 40% is received in India. Slowly. Business is in Bali. So where is the source of income? Source of income is outside India. The business is controlled from Delhi, controlled from India. 60% of the profit is received outside India. 40% of the profit alone is received in India. Let's finish for NR first. It will be easier. For NR, if you see, I am having, one second. For NR, if you see, I am having source outside India, but 40% is received in India. To the extent of 40%, it will become an Indian income, guys. So 70,000 into 40%, 28,000 alone I will consider for non-resident. This is business income from your Bali business. Source is outside India. Only 40% is received in India. To that extent, it becomes an Indian income. What about RNOR now? For RNOR, this is no doubt source outside India. No doubt 40% is received in India. But however, this becomes business income from a business which is controlled in India. For RNOR, not only do you tax Indian incomes, you also tax business incomes from businesses controlled in India and professional incomes from professions set up in India. So this is a business income from a business controlled from India. So full amount, full 70,000 you will take for RNOR. This is also okay. Then we have rent from house property situated in US and received in US. So the source of income is in US outside India. It is received also outside India. So therefore this becomes a foreign income. Foreign income, guys, neither will you take for RNOR nor will you take for NR. Okay, this is also done. Now we only have to handle our losses. Come on, carefully. Let's finish off non-resident first. Here we have business loss of 20,000. Can business loss be adjusted against salaries head? No. Only against business income, guys. So here I'll adjust my business loss of 20,000. So what's your net PGBP number for NR now? 80,000 plus 28,000 minus 20,000, 88,000. So for NR, point A, salary income is 1,50,000. Okay. And point B, PGBP is 88,000. So total income for non-resident will be 2,38,000. Now focus on RNOR. I have business loss of 20,000 and 46,000, 66,000. I'll adjust that against my business income, guys. 66,000. So how much will I still be left with? I will still be left with 84,000. Alright, this much net income I still have. Then I have unabsorbed depreciation. Unabsorbed depreciation also I'll adjust off against my business income itself because can't adjust it against salaries head. So less unabsorbed depreciation. So what's your net PGBP number for RNOR? It will be 68,000. So for RNOR, salary income is 1,50,000. PGBP is 68,000. So your total income 2,18,000 for RNOR. Okay, the only reason why I wanted to do this question for you was If you actually see, there's nothing new, but it's like a nice combination between residential status and set off of losses. So which loss you can consider, what you cannot consider, I just wanted to show you that once. Remember, for RNOR, not only is Indian income taxable, also business income from business controlled in India and professional income from profession set up in India. This was a question targeting more of this particular point. Okay, so this was your question number 25. Now come on everybody, come to question number 26. Now question number 26 is your section 89 relief. Now section 89 relief, it was very surprising that we had a question on this in our Jan 2026 RTP. We have never seen this in the examination ever. But then however, because it is there in a Jan 26 RTP, I don't think we should skip it. Okay, so yes, it might take us a little extra time, but let us spend some time and let us carefully understand this, because I'm very sure many of you would be seeing this for the very first time. Alright, listen to me. Carefully, let's read the question. No tension. Nicely, we will do the question. The question says, Miss Ashima, aged 45 years, has been the HR manager for the past 15 years in Shipra Limited. She gives you the following particulars. So all this information they have given to us. What are they asking us? Compute relief available under section 89 and tax payable for the year. Two things they're asking us, section 89 relief and tax payable. Assume that Miss Ashima exercises the option of shifting out of the default regime, which means she's going to be following the normal regime. Okay, now come on, let's come back to the question. Let's do our usual income computation first. So I'll do this answer in parts for you. So my first part A, we're doing total income computation. And we're doing this computation under which regime? Under the normal regime, because question says assessee is opting out. Okay. So first of all, she's not a senior citizen, guys. She's only 45 years old. So let's begin. We have basic salary 70,000 per month. So 70,000 into 12, which will be 8,40,000. Then she has DA 24,000 per month. DA 24,000 into 12, which is 2,88,000. Okay, 30% is forming part. Then bonus 21,000 per month. That will be 2,52,000. Okay, then Ms. Ashima contributes 18% of basic salary as contribution to RPF. So we have employees contribution to RPF. Immediately, how many steps will come to your mind? 2 steps will come to your mind. So I'll do a very rough calculation over here. First of all, you'll have employees contribution to RPF. How much is the amount? The amount, the question says employees contribution to RPF is 18% of basic salary. So my basic salary is 8,40,000. This into 18%. 8,40,000 into 18%. 1,51,200 is a contribution. So first of all, you will have section ATC, but ATC you will restrict it to 1,50,000 only. And the second thing that will come to your mind is you will see employees contribution to RPF. Is it more than 2,50,000? It is not more than 2,50,000, guys. It is only 1,51,200. Had it been more than 2,50,000, then the interest on the excess you will tax it. But here it is not more than 2,50,000. It is only 1,51,200. So only one adjustment you have. ATC 1,50,000 you will get. Then you will have employers contribution to RPF. Here your 4 plus 1, 5 steps will come to your mind. So employers contribution also we have. Employer also contributed same amount they are saying. So your first step, step 1 will be salary for the purpose of RPF. Salary will have 3 components. Basic salary, then DA forming part, and then employees turnover based commission. So basic salary over here is 8,40,000. Then DA is 2,88,000. 30% is forming part. So 2,88,000 into 30%, you will get 86,400. You don't have any turnover based commission. So therefore 9,26,400. This will become your salary for the purpose of RPF. Then comes step 2, your actual contribution. The actual employer's contribution is 1,51,200. Step 3, what's your exempt contribution, guys? 12% of salary. So 12% of this 9,26,400, which will be 1,11,168. Then comes your step 4. Your taxable contribution will be received minus exempt. So we received 1,51,200, out of which 1,11,168 is exempt. So the balance 40,032 will become your taxable number. Alright, then one more step you check, right? Always you check whether the employer's contribution to RPF, NPS and superannuation fund, is it more than 7,50,000? Not more than 7,50,000 guys, it's only 1,51,200. So nothing is taxable as perquisite. So step 4, what's your taxable number now? Step 4, 40,032 is your taxable number. So employee's contribution to RPF, nothing is taxable. Only ATC we will have. But employer's contribution to RPF, your 40,032 is taxable. Right? You understood this? Employee's contribution to RPF, ATC straight away. Employer's contribution to RPF, up to 12% of salary is exempt. The excess above 12% is 40,032. This is taxable for you under the salaries head. Alright. So what I'll do is, I'll put this in a different page. Now come back. So this is your employer's contribution to RPF. Then what else are they saying? Company pays medical insurance premium. Medical insurance premium paid by the company, paid by the employer for employee or his relatives. It will be fully exempt. Then she received arrears of salary 3,35,000. See, arrears of salary, 1 minute, okay. Listen to me. Arrears of salary, what is earlier, guys? Due is earlier, right? We tax salary, section 15. We tax salary on due basis or receipt basis, whichever is earlier. In arrears of salary, due is earlier. But however, if it was not taxed on due basis, then whenever it is received, that time we will tax it, guys. See, whenever the question is asking you about section 89 relief, your basic assumption is that the arrears was not taxed on due basis. So because it is not taxed on due basis, now when I receive it, current year I am receiving it, no. So current year I will tax it. So arrears of salary, 3,35,000. It belongs to earlier years. Now we are receiving it. Assuming it was not taxed on due basis, now when I receive it, I will tax it. Okay. This 3,35,000 breakup they have given. Relating to 21-22, 1,20,000. Relating to 22-23, 1,10,000. Relating to 23-24, 1,05,000. If you add up, the total arrears will be 3,35,000 only. Easy, guys. Don't worry. Nothing is difficult over here. Step by step. Till here, anything extraordinary we've done? No, normal usual income computation only we are doing. So my total arrears is 3,35,000. Breakup of that they have given. Then for each of these years, they have given us a total income number also and how much arrears we have now received. Okay. Compute the relief available under 89 and the tax payable. Then they are saying for assessment year 22-23, which means for previous year 21-22 and assessment year 24-25, that is previous year 23-24, Ms. Ashima has paid tax as per 115 BSE. This is one unnecessary complication for previous year 21-22 and for previous year 23-24. These 2 years we are following the default regime. Then for assessment year 23-24, which means previous year 22-23, we are following the normal regime. Okay. So 21-22, 23-24 default regime, 22-23 is as per the normal regime. Then they've given us the income tax rates. They are saying rate of tax under normal provisions is same only, same like what we have for the current year. But rate of tax as per 115 BSE, 115 BSE rates they have given for each year. So 22-23 assessee was following normal regime. No, in 22-23 the tax rate is same like what we have in the current year. But 21-22 default regime, 23-24 default regime, these 2 years the tax rates were different. They have given us the default regime tax rates. Okay, come on. First we are doing normal usual computation only. Add up and tell me what's the gross salary of your assessee. Gross salary will be 17,55,032. Then from this we will subtract section 16 deduction. Normal regime, guys. So we'll have standard deduction how much? 50,000 only. So 17,05,032 will become your taxable salary. The question doesn't talk about any other income. So this itself becomes your GTI. Then from this we'll subtract chapter 6A. We have section ATC, no? We have our employees contribution to RPF. So employees contribution, it was more than 1,50,000, 150,200. But ATC, sorry, SSE, maximum you will get 1,50,000 only. So what's the total income of your SSE now? Total income will be 15,55,032, which you will remember to round off to the nearest multiple of 10. So 15,55,030. Okay, this is the total income of the SSE. Nothing special, nothing extraordinary, normal income computation I did. Okay, This was my first part. Then comes point B. I want to compute the tax payable. So, no normal rate income, guys. Normal regime. Rule 0. Which regime are we following? Normal regime in the current year. Basic exemption limit will be 2,50,000 only. Assessee is not a senior citizen and all. So, tell me now. No special rate income over here. So, how will you compute basic tax? Income is more than 10 lakhs. Up to 10 lakh income, you'll have to pay 1,12,500 plus 30% of the income. In excess of 10 lakhs, this will be 2,79,009. Okay, then no 87A rebate, income is more than 5 lakhs, no surcharge, income is within 50 lakhs. So straight away you will add cess at the rate of 4%. Cess at 4% will be 11160. So your tax number will be 2,90,169. They haven't spoken about any TDS, TCS credit, any advanced tax and all. Nothing is mentioned in this question. So therefore, this itself will become your tax payable. And we will stop this number at this stage over here. Yes, I know you might say that, ma'am, we have to round it off. But for now, just let it be as it is for now. Okay. Then comes your point C. This is where the whole game begins slowly. I want to know the total income number without arrears. Basically, I want to know what's the total income number excluding arrears. So that is, what's the total income of your assessee including arrears of salary, guys? So total income including arrears is 15,55,032. Then from this I will subtract the arrears. The arrears included in this number was 3,35,000. So what's the balance? Balance is 12,20,032. This becomes your total income excluding arrears. Now I need to know point number D. What is the tax on this total income excluding arrears? See, first I found the normal total income of the assessee, guys. On that I found the tax payable. Now I found total income excluding arrears. Now on this number I want the tax payable. So what will my basic tax be? Income is more than 10 lakhs. So up to 10 lakh, 1,12,500 plus 30% of the income in excess of 10 lakhs. This will be 1,78,510. And then to this we will add cess at 4%, which will be 7,140. So your total tax will be 185,650. So rounding off and all, not right now, rounding off and all later only. 185,650. Got it, everybody? So four things I have done till now. I first found the total income including arrears. Then I found tax on that income. Then I found total income excluding arrears. And I found tax on that income. So now, see, if I subtract from this, this is a tax on the total income including arrears. From this, if I subtract the tax on the income excluding arrears, then I will get tax on the arrears, guys. Yes, see, what is it? I'll help you understand. What's a tax on income including arrears? When you included arrears, tax on that income was 2,90,169, right? What is the tax on the income excluding arrears? 1,85,650. What's the difference now? 290,169 minus 185,650. You will get 1,04,519. This will become tax on arrears. Till here, did you understand? So this is the tax on my income including arrears. This is my tax on the income excluding arrears. So this difference will become the tax on arrears. Alright. So this was the first 5 steps. First we computed actual income. We found tax on that. Then we found income excluding arrears. We found tax on that. The difference between both the taxes will become the tax on arrears, guys. Now see, these arrears are belonging to 3 years. So each year, one by one, we will take now. Let's start off with previous year 21-22 assessment 22-23. Now see, the question says in previous year 21-22 our assessee was following the default regime. Okay, so the total income of this assessee was 9,50,000. So which regime are we following? The default regime. The total income of the assessee excluding arrears total income was 9,50,000. Okay, so arrears relating to this year is 1,20,000. So if I add them up, what is the income of 21-22 including arrears it will be 10,70,000. Now I want tax on both these numbers. Let's compute tax on 10,70,000 first. Default regime, guys, can we apply current year default regime tax rates? No. The question had very clearly said over here that rates of tax as per 115 BSE for different years are as follows. So earlier years the default regime tax rates were different. So we can't apply current year default regime tax rate. We have to apply 21-22 tax rate. So previous year 21-22 means assessment at 22-23. Assessment at 22-23, these were the tax rates as per 115 BSE. So these rates we have to apply. So come on everybody, let's compute tax on this 10,70,000 first. 10,70,000 means we will be falling under this slab. 10 lakh to 12,50,000. So let's reach till here slowly. Up to 2,50,000, nil. So 0 to 2,50,000, 0. Then 2,50,000 to 5 lakh, 2,50,000 income we have. On that 5% tax will be 12,500. Then 5 lakh to 7,50,000. In between 2,50,000 income we have. On that 10% tax will be 25,000. Then 7,50,000 to 10 lakh. In between we have 2,50,000 income. On that 15% will be 37,500. Now my assessee's income is 10,70,000. So 10 lakh to 10,70,000, 70,000 income. On that 70,000 income, 20% tax will be 14,000. So the total basic tax for the income would be 89,000. And then when you take cess will be 3,560. So including cess, your tax would be 92,560. Okay. Now same way we'll have to compute tax on the income excluding arrears, that is on 9,50,000. So 9,50,000 means which slab am I falling under? 7,50,000 to 10 lakh in this slab. So up to 2,50,000, 0. 2,50,000 to 5 lakh, same 12,500. Then 5 lakh to 7,50,000, same 25,000. Now be careful. My income is 9,50,000. So 7,50,000 to 9,50,000 will be 2 lakhs income. On that 2 lakhs income, 15% tax will be 30,000. So here your total tax will be, just as per the slab rate, we are computing tax, guys, 67,500. So 4% cess would be 2,700. So your total tax would be 70,200. Okay, now be careful. For 21-22, including arrears, tax is 92,560. Excluding arrears, tax is 9,50,000. So in 21-22 itself, if I had paid tax on the arrears, what would be my tax on the arrears? What would be the difference? Tell me. The difference would be 22,360. Are you understanding? Basically, guys, Section 89 relief, the whole logic, the whole concept is that this arrears of salary is belonging to earlier years. It is belonging to different years. Now in those years, tax rates are different. So had you paid tax on the arrears in the respective years itself, how much tax you would have paid? But you did not pay in those years. Now you are paying. In the current year you are paying. So in the current year, how much is the tax on arrears? Both the numbers you will compare. Let's say in those respective years itself, if you had paid, tax on the arrears would have been 100 rupees, let us say. But you did not pay in those respective years. You are asking me to pay in the current year. Current year, let's say your tax is 120. So current year, how much extra are you paying? 20 rupees extra you are paying, right? This is all because of the difference, the change in the tax rates. So this 20 will now become your Section 89 relief. That's the whole logic behind Section 89 relief, that as the years change, the tax rates also change. So the arrears are actually belonging to earlier years. So in those years itself, if you had taxed the arrears, what would be the tax on the arrears? But you did not tax in those years. You are taxing now in the current year. Current year, what is a tax on the arrears? So these two numbers we will compare, and this difference will become your Section 89 relief. All that you will understand as we go forward. Just wanted to let you guys know that what exactly are you doing, because you shouldn't be wondering that, what is even happening over here. So first of all, I computed my total income, my usual computation I did, guys. Then after this, we found our tax payable for our current year's income including arrears. Then we found a total income excluding arrears. Then we found the tax on the income excluding arrears. So we had two tax numbers for the current year. So the difference between both the tax numbers gave us the tax on arrears. In the current year, because of arrears, we are paying so much extra tax. Okay. Then these arrears are belonging to these 3 years. So for each of these 3 years, we will be seeing that had you paid tax in that particular year itself, then on arrears, how much tax you would have paid. So in 21-22, excluding arrears, you have paid tax 70,200. Including arrears, had you paid tax on arrears in 21-22 itself, you would have paid total 92,560. So because of arrears, had you paid tax in the same 21-22 itself, you would have paid 22,360 extra because of the arrears. So tax on arrears in 21-22 year is 22,360. Okay, same way we'll have to do for the remaining 2 years also. In 22-23, which regime you're following? This will be easy. Here you were following the normal regime only. So in this 22-23, what is the total income? 10,90,000. Excluding arrears, your income is 10,90,000. But to this income, if you add the arrears of 1,10,000, your total income will become how much? Including arrears, 12 lakhs. Now the question very clearly says over here that the rate of tax under normal provisions was the same as 25-26. So normal regime, the tax rates are same like we have in the current year. So we can easily compute tax. Income is 12 lakhs. So more than 10 lakhs. So up to 10 lakhs you have to pay 1,12,500 plus 30% of the excess. Usual tax computation in the normal regime, guys. That is 1,12,500 plus 30% of your income in excess of 10 lakhs. How much will this be? This would be 1,72,500 and then 4% says would be 6,900. So your total tax would be 179,400. Now similarly, I want tax on 10,90,000. Same thing, 1,12,500 plus 30% of the income in excess of 10 lakhs. So that would be 1,39,500. Then 4% says would be 5,580. So your total tax would be 1,45,080. So now again, come on, be careful. Had you paid tax on arrears in 22-23 itself, total 179,400 you would have paid. But you did not pay tax on arrears in those respective years. So you have actually paid 145,080 only without considering the arrears. So had you paid tax including arrears also, then how much extra tax would you have paid? So what is the tax on arrears in that respective year? 34,320. The difference between the two tax numbers. Okay, now come on, last year guys, 23-24, come on, don't lose your patience, only 2 more steps you have. In 23-24, which regime are we following? Here we are following the default regime. So same calculation, total income of this assessee is 12,10,000 excluding arrears. But however, if you add the arrears, 12,10,000 plus 1,05,000, your income including arrears will be 13,15,000. In this 23-24, you are following default regime. Default regime tax rates were different. They are saying earlier and all tax rates were different. So assessment year 24-25, these are your tax rates as per 115 BSE. On this basis, we will compute your tax. So let's compute tax on 13,15,000 first. 13,15,000 will be in this slab, guys. So up to 3 lakh, nil. Then 3 lakh to 6 lakh, 5% tax. So in between you have 3 lakh income. On that 3 lakh income, 5% tax will be 15,000. Then 6 lakh to 9 lakhs, we have 3 lakh income in between. On that 10% tax. So 3 lakh into 10%, 30,000. Then 9 lakh to 12 lakh, again we have 3 lakh income in between. On that 15% tax will be 45,000. Then our income is 13,15,000. So 12 lakh to 13,15,000. The gap is 1,15,000. On that 20% tax, you will have 23,000. So total tax as per the slab rate, this is 1,13,000. 4% says will be 4,520. So your total tax will be 1,17,520. Same way we have to compute tax on 12,10,000. 12,10,000 also will fall under this slab, guys. So up to 3 lakh, 0. 3 lakh to 6 lakh, same 15,000. 6 lakh to 9 lakh, same 30,000. 9 lakh to 12 lakh, same 45,000. Then income is 12 lakh 10,000. So 12 lakh to 12 lakh 10,000. 10,000 is my income in between. On that 20% tax will be 2,000. So my total basic tax will be 92,000. Now on this 4% says 3,680. So your total basic tax will be 95,680. Now come on. Same interpretation, guys. Had you paid tax on the income, including arrears, in 23-24 itself, total this much tax you would have paid. But you did not consider arrears. So you paid only 95,000 tax. So had you paid tax on arrears in that respective year itself, how much extra tax you would have paid? What is the difference now? The difference is 21,840. Okay, all the 3 years you've done the computation. Now comes your section 89 relief. Finally, careful over here. Tell me, guys, current year, because of arrears, how much extra tax are you paying? Current year, come on, current year, because of arrears, how much extra tax you're paying? Remember, we did this calculation. Income including arrears, on that this much was a tax. Income excluding arrears, this much was a tax. So because of arrears, how much extra tax are you paying? 1,04,519. So 1,04,519. This is the extra tax that you're paying in the current year because of arrears. Okay. Now, in the respective years itself, if you had paid tax properly, then how much tax would you have paid on the arrears? Take the numbers carefully now. 21, 22. What is the tax on arrears? 22,360. 22,360. Then 22, 23. What is the tax on arrears? 34,320. Then 23, 24. What's your tax on arrears? 21,840. So what's the total? Had you paid tax in the respective years itself, you would have paid 78,520, guys. Now tell me, look at these numbers. Is it fair or is it unfair, guys? In the current year, because of arrears, you are paying 1,04,519 extra tax. Okay, but however, if you had paid tax on arrears in the respective years itself, you would have paid 78,520 only tax on arrears. So in the current year, just because of increase in tax rates, how much extra tax you have to pay? What's the difference? The difference is going to be 25,999, guys. This will become your section 89 relief. Understanding? Same income, just the fact that tax rates are different. So just because tax rates are different, in the current year on arrears you have to pay 1 lakh extra tax. Had you paid tax on arrears in the respective years itself, or you would have paid only 78,520 extra tax. So what is the excess that you are paying over and above 78,520? Excess of 25,999. That becomes your section 89 relief. Okay, now come on. What was the tax payable of the current year, guys? Tax payable current year was 290,169, right? On the income including arrears, we found the tax, we found the cess and all. 290,169 was our tax for the current year. 290,169. From this, I will enjoy the section 89 relief of 25,999. So what will be the net tax payable for my assessee? 2,64,170, already in multiples of 10, therefore no need of any further rounding off also. 264,170, this is the amount of tax that I will ask my assessee to pay in the current year. Understanding? Section 89 relief, the whole logic is this only, that the arrears are actually belonging to earlier years. So had you paid tax in those years itself, how much tax would you have paid? Let's say you would have paid 100. But you did not pay tax in those years. You are paying tax on the arrears now only. So now because of arrears, how much extra tax you are paying? Let's say you are paying 120. So you are paying extra 20 rupees just because of the difference in tax rates. This will now become your section 89 relief. Section 89 relief you can subtract from your tax payable number. Balance only you will be paying. Okay, this final number, this is what you will round off. Here it's already in multiples of 10. Therefore no need of any rounding off also. Getting it, guys? This is your section 89 relief question. Alright, that's all. So this was your question number 26, testing you on section 89 relief. Now come on, guys, one last question, question number 27. Now question 27 says, examine the applicability and determine the amount of TDS question, guys. Vijay Health Solutions Limited, a third-party administrator, makes payments to various hospitals across India towards settling cashless medical insurance claims on behalf of insurance companies. During 24-25, total payment made by Vijay Health Solution Limited to Life Care Hospital for cashless claim is 12 lakh rupees. So, we have an entity over here, Vijay Health Solutions Limited. They are making payment of 12 lakh rupees to this hospital, Life Care Hospital. So I'll help you understand what exactly this concept is, okay? There's this concept of third-party administrator. So basically when we take medical insurance policies, right? Let's say there's a patient. He's come to the hospital for some medical treatment. But this patient has medical insurance policy. So because he has a medical insurance policy, he will not make the payment of the medical bill to the hospital. The insurance company will directly make the payment of the medical bill to the hospital. But the insurance company will not directly do all that. They do all of this through an intermediary. Intermediary is called third party administrator. It's like one agent between the insurance company and the hospital. Okay, understanding. So patient will not directly make the payment of the bill to the hospital. Instead, the insurance company will make the payment to the hospital, but through the third party administrator. So when the third party administrator is making payment of the medical bill for the hospital, then don't you think it will become payment of doctor fees, guys? Professional fees. So professional fees, you will think about section 194J. 194J, the limit is 30,000. Here definitely it is more than 30,000. So 12 lakh into 10%, 1,20,000 will become your TDS under 194J, payment of credit, whichever is earlier. Okay, so the only point that you have to remember over here is when third-party administrators make payment of fees, medical bills and all to the hospitals, 194J will apply to that transaction, and because 194J will apply, 10% TDS will apply on professional fees. Okay, so see, if the patient directly makes a payment to the hospital, then in that case 194J will not apply, because 194J will not apply for personal expenses, right? So in that case, instead of 194J, you will try 194M if the patient himself is making the payment. But if it is a medical insurance case, the patient will not make the payment to the hospital. The health insurance company, through the third party administrator, they will make the payment to the hospital. So when they make the payment to the hospital, for them it's a business transaction, guys. It's relating to their business. So professional fees, 194J, 10% TDS will apply. Okay, that's all. So this was your question number 27. So that is it, guys. These are the extra 27 questions I wanted to do for you. This is like that cherry on the top of your preparation, alright. So they either had an interesting adjustment or they had an adjustment that I wanted to give you a revision relating to. Moving on now, in your case scenario booklet, which ICAI has released for your examination, there are some interesting MCQs. Some challenging ones, I want to discuss them with you as well. So let's begin. Let's start with question number 28, purely relating to agricultural income, guys. So Mr. Kishan is engaged in the following activities on agricultural land situated in India. Total area is 5 acres. First of all, activity A. He grows saplings or seedlings in a nursery spreading over 1 acre land. Sale proceeds of which is 5 lakh rupees. Cost of plantation is 1,40,000. So what's your net income, guys? The sale proceeds from activity A is 5 lakhs and we have incurred costs of 1,40,000. So 3,60,000 is your net income from this activity. Now basic operations are not performed for growing saplings or seedlings. Recall your formula over here. Nursery plus in India plus seedlings or saplings. Whether there is basic operations or not doesn't matter. The income will be fully agricultural income, guys. So here we do have a nursery in India and we're growing seedlings and saplings over there. Whether basic operations are there or not doesn't matter. It will be agricultural income, right? So activity A, my income will be entirely agricultural income. And what's my net agricultural income from activity A? 3,60,000. Okay, then come on, let's move on. Our next activity is activity B. He grows cotton on 3 acres land. 40% of the cotton produce is sold for 4 lakh rupees and the cost of cultivation is 2,25,000. Let's handle till here. So activity B, your second activity. In this, he's growing cotton. Now 40% of the cotton that he's growing, he's directly selling. He's not doing any activity. So same calculation I will do again over here. What is the sale proceeds? He sold the cotton for how much? It is sold for rupees 4 lakhs. And what is his cultivation cost for this? 2,25,000. He did not do any subsequent activity, guys. He just cultivated the cotton and he sold it. So your net number here is 1,75,000. Even this will be fully agricultural income. Alright guys, so activity A is also agricultural income. In activity B, this 40% of the cotton, here 1,75,000 is agricultural income. Then continue reading what happened after that. The cost of cultivation of the balance 60% cotton is 3,37,500 and the market value of the same is 6 lakhs, which is used for the purpose of manufacturing yarn. Now be careful guys, what has he done with the 60% cotton? So he has cultivated the cotton, and once the cotton is cultivated, the cotton is marketable. You can go and sell it in the market, but he has not sold the cotton. He has done further activity. He has manufactured yarn. Remember, whatever you do after the cotton is marketable, after the agricultural produce is marketable, after that whatever you do, whatever subsequent operation you do after that, that will result into business activity, and your income from this activity will be business income. Whatever activity you do till the produce is marketable, only till that stage only you can call it as agricultural activity and agricultural income. So for 60% cotton, I can say that there is composite income, guys. We have agricultural income also, we have business income also. Alright, now the question arises, how will you do the computation? So just now we concluded that for the 60% cotton, we will have agricultural income also, we have business income also. So we will have both. We will have agricultural income also, we will have non-agricultural income also. It becomes composite income. Now how to do the computation? See, I'll show you how to think. Okay, very easy, you will enjoy this. Actually only one assessee, guys, one assessee only has done both the activities. He has cultivated the cotton also, and after cultivating the cotton, he has manufactured yarn also. Actually, one assessee only has done both, but I will imagine as if there are two assessees, okay, just for the purpose of a calculation. Alright, now see, whatever income you are earning till the cultivation of cotton, that will be agricultural income. Once a produce is marketable, once cotton is cultivated, it is marketable. After that, whatever you do, whatever expenses you incur, manufacturing expenses you incur, all that will become your business portion, okay. So you imagine as if your assessee, actually as if there are two assessees, you imagine. So as if one assessee has cultivated the cotton and sold the cotton in the market. So had you sold, in reality you did not sell the cotton in the market. You are using it for cultivating, you are using it for manufacturing yarn. But had you sold the cotton, you would have sold it for how much? What's the market value, guys? You would have sold the cotton for 6 lakh rupees. And to cultivate this cotton, how much expense have you incurred? Cost of cultivation is 3,37,500. So this cultivation cost is what you have incurred before the cotton is marketable. No, for cultivation you have incurred. So therefore this becomes an agricultural expense. So 3,37,500 I'll subtract over here. So your net income of 2,62,500. This will become pure agricultural income, guys. Okay, then you imagine as if assessee has purchased cotton from the market and is manufacturing yarn. In reality, same assessee only, guys, but only for the purpose of calculation, only for the purpose of interpretation, you imagine as if there are two assessees, as if one assessee has cultivated the cotton and sold in the market. That will be fully agricultural income. Then imagine as if another assessee has purchased the cotton and then has manufactured yarn out of it. So now tell me, to manufacture yarn, what are the expenses that you have incurred? First of all, you will have to purchase cotton. Actually, you did not purchase cotton, you cultivated the cotton. But had you purchased the cotton, what's the market value of the cotton? You would have purchased it for how much? You would have purchased it for 6 lakhs. Understanding? Then how much manufacturing expense you have incurred? 1 lakh. See, why am I putting manufacturing expense under this bucket and not under agricultural income bucket? Because whatever you do after the cotton is marketable, manufacturing expenses and all you're incurring after the cotton is marketable, no? So therefore business, it's relating to your PGBP head. So your manufacturing expenses, 1 lakh rupees, and then finally the yarn is sold for 8 lakh 50. So your selling price is 8 lakh 50,000. So what's your PGBP? Your business income, guys, 8 lakh 50 minus 6 lakh minus 1 lakh, 1 lakh 50,000. This becomes your business income. Understanding? Very easy. So when your assessee is having composite income, if it is rubber, tea, coffee, we know how to compute 75-25, 65-35, 60-40, all that we will do. But for everything else, like here cotton, then you have sugarcane example in your ICAI study material illustration, guys. So all these kind of cases, apart from rubber, tea, coffee, everything else, this is how you can do the computation. Actually one SSE only, but you imagine as if there are two different SSEs. Imagine as if one SSE has cultivated the cotton and sold the cotton in the market. This will be fully agricultural income. Then imagine another SSE has purchased the cotton from the market and has manufactured yarn. This will be fully business income. Okay guys, then come on, let's move on. We have one more activity, activity C. So land measuring 1 acre is let out to Mr. Ramesh. So we are letting out the land to Mr. Ramesh on a monthly rental of 15,000 rupees, which is used by Mr. Ramesh as follows. 50% of the land is used for agricultural purpose and 50% of the land is used for non-agricultural purpose. So activity C, my assessee is letting out that agricultural land to Ramesh. Now Mr. Ramesh, 50% of the land he is using for agricultural purpose. Tell me guys, again one equation I taught you. Rental income plus agricultural land plus in India plus used for agricultural purpose. It will be agricultural income guys. Right, so it is rental income, it is from an agricultural land, the land is in India, it is being used for agricultural purpose, so your rental income will be agricultural income. But the balance 50% of the land he is using for non-agricultural purpose, so whatever rental income you're getting from this balance 50% of the land, that will not be agricultural income. So come on everybody, come to this. So rental income from 50% of the land which is used for agricultural purpose. Is it fitting into your equation? It is rental income from agricultural land, and remember guys, the land was in India only and that land is being used for agricultural purposes only. So therefore your rental income will be agricultural income. Now this agricultural income will go to which head guys? It is rental income from a piece of land. See, it can't come into IFHP head because you can put only superstructure in IFHP head. But here I only have a piece of land. It can't be PGBP head also because you're not buying and selling agricultural produce over here. Instead it is rental income. Rental income from a plot of land will go under IFOS head. But under IFOS head it will be agricultural income and hence it will be exempt. How much will the agricultural income be? See, the rent was how much? The rent was 15,000 per month. So 12 months into 50%, only 50% guys, because only half of the land is being used for agricultural purposes. So this is going to be 90,000 rupees. Alright everybody, this will be your exempt agricultural income. Then what about the balance rental income? The question says balance 50% of the land is used for non-agricultural purpose. So from the balance 50% of the land which you're using for non-agricultural purposes, your rental income will be non-agricultural income. Because see, rental income from agricultural land will be agricultural income only if you're using the land for agricultural purposes. If you're using the land for non-agricultural purposes, then the rental income will not be agricultural income. So the balance 50%, that is 15,000 per month into 12 months into 50%, the balance 90,000 rental income will be non-agricultural income. But which head of income guys? It is rent from a piece of land. It can't come under IFHP head because there is no superstructure. It can't come under PGBP head. It's not my business. It will come under the IFOS head. Understanding everybody? Under IFOS, 90,000 will be taxable. No standard deduction, nothing. All that is only in IFHP head. Here your entire rent will be taxed under IFOS head. Okay, now come on, have a look at the questions. The first question over here, what amount of income arising from activity A would constitute agricultural income? So from activity A, what is the agricultural income? 3,60,000. Then what amount of income from activity B with respect to sale of cotton would constitute agricultural income or business income in the hands of Mr. Kishan? Only sale of cotton guys, not sale of yarn, only sale of cotton. So sale of cotton, only 40% of the cotton we sold. So from that 1,75,000 is your agricultural income, option A. Then third question, what amount of income from activity B with respect to sale of yarn? So sale of yarn is the 60% part, agricultural income or business income. So here 2,62,500 is agricultural income and 1,50,000 is business income. So option B guys, 2,62,500 is agricultural income and 1,50,000 is business income. Okay. Then they're asking us what amount of income from activity C will constitute agricultural income or otherwise. This also be computed. 90,000 is agricultural income and balance 90,000 is non-agricultural income. So option D, 90,000 would be agricultural income and 90,000 is taxable under IFOS. Option D, same thing we discussed, 90,000 agricultural income, remaining 90,000 non-agricultural income, IFOS head. So option D. Then they're asking us to compute the gross total income of Mr. Kishan, assuming he has no other income. Gross total income, come on guys. See, activity A, nil, entire amount is agricultural income exempt. Activity B, we have 40% cotton and 60% cotton. 40% cotton is directly sold. Here entire 1,75,000 is agricultural income, exempt guys. But this balance 60% cotton, if you see, only 260 to 500 is agricultural income and exempt. The balance 1,50,000 will be your taxable income, business income. Then from activity C, 50% of the land is used for agricultural purpose. So this 90,000 is agricultural income and exempt. Only the balance 50% of the land is used for non-agricultural purpose. So that 90,000 only is non-agricultural income. So the balance 50%, 90,000 is your non-agricultural income. So what's your total GTI now? 2,40,000. This will become the total GTI of your assessee. Agricultural income, I am giving section 10(1) exemption because the land is in India. That's why we are enjoying section 10(1) exemption. So activity A, fully agricultural income, exempt under section 10(1). Activity B, 40% of the cotton, fully agricultural income, exempt under section 10(1). Activity B, balance 60% if you see, partly agricultural income, partly business income. Agricultural income part exempt under section 10(1). Activity C, partly agricultural income, partly non-agricultural income. Agricultural income part exempt under section 10(1). So only the balance is taxable. So your GTI is 2,40,000. Okay guys, so this was question number 28. One nice revision of agricultural income we got over here. Alright, now come on, let's come to question number 29. Question number 29 is very similar to one of the questions which we've done in this session only in the past. Do you remember we saw a question where assessee is having stock in trade? It is lying vacant 2 years from the end of the year of construction completion, newly constructed property. If it is lying vacant, IFHP is 0. Yes guys, so relating to that concept only, one more similar question I had, so therefore I brought this question also for you. Let's read this and then we will work it out. So the question says, Ram Builders and Developers is a sole proprietorship concern of Mr. Ram. The main business of the concern is construction, development and sale of residential and commercial units. Ram Builders and Developers developed a project named Luxuria Heaven, which has both residential and commercial units with its own funds. It obtained certificate of completion of the said project on 31st March 2024. Okay, so my assessee, Ram Builders and Developers, sole proprietorship concern of Mr. Ram, real estate dealer guys. How do we know that they are a real estate dealer? Because their business itself is constructing, developing and sale of units. That is real estate business. So they are having both residential and commercial units. Certificate of completion was 31st March 24. Then what happened? Ram sold majority of the residential units and commercial units in 24-25. However, 30 residential units and 50 commercial units were held by him as stock in trade on 31st March 25. So how many residential units are his stock in trade? 30 residential units and 15 commercial units are his stock in trade. Then during this period, there was a slump in the real estate sector. To earn some income from these units, Ram incidentally let out some of the units held as stock in trade. He did not let out all the units. The question says he let out some of the units. Details of the units constructed, sold and held as stock in trade are given here under. Look at this now. So residential units, how many are held as stock in trade? 30 units and 15 units. How many units are let out? Not all the units. Only 10 residential units and 5 commercial units are let out. Then, so the balance 20 and balance 10 are remaining vacant only. What is the rent? For how much rent are they being let out? Residential units are being let out for 10,000 rupees per month rent and the commercial units have been let out for 18,000 rupees per month rent. Alright everybody, the balance units are vacant. So how many units are vacant? See, if you look at residential units, total 30 we had, 10 we have let out. So the balance 20 residential units, balance 20 are remaining vacant and commercial units, balance 10 are remaining vacant. Okay, let's do some analysis till here first. Tell me everybody, residential units, my assessee is a real estate dealer by the way. He is letting out residential units and commercial units. So his rental income will go to which head? Will it come into PGBP head guys? Just because he's letting out stock in trade, will it come under PGBP head? No. You know very well, just some time back only we learned that you will put your house properties under PGBP head only in two situations. Situation number 1, when assessee's business itself is to let out commercial properties, and number 2, if assessee is self-occupying the property for his business or profession, only then you will put it under the PGBP head. Here, is your assessee in the business of letting out commercial properties? No. He's into real estate business. So it's not situation 1. Is he self-occupying the property for business or profession? No. So not PGBP head. His rental income will come to which head, guys? His rental income from these units will come under the IFHP head only. Okay. Then what about the vacant units? Come on everybody, think about your conditions. Condition number 1, assessee is into real estate business. So these vacant units are his stock in trade. Okay, and they are lying vacant, and it is a newly constructed property, guys, and 2 years from which date? End of the year of construction completion certificate. So we got the construction completion certificate on 31st March 24, which is previous year 23-24. End of this year is 31st March 24 only. From this date for 2 years, that is till 31st March 2026, guys, if these units are lying vacant, till this date, the IFHP of these units will be 0 only, right, guys? And we are doing the computation for previous year 24-25, which is within this date. So therefore, in this period, your IFHP for these vacant units will be 0 only. Okay, so the let out units, yes, you will be having IFHP income. The rental income that you're having will come into IFHP head, but the vacant units, IFHP will be 0. Why? Because you're vacant, stock in trade, and we are within 2 years from the end of the year of construction completion. So for the vacant units, my IFHP will be 0. Okay, now come on, let's continue reading what else happened over here. Out of the residential units sold, 5 residential units were sold to his friend Mr. Gaurav, who is also a real estate developer. So my assessee is also a real estate developer, and the person to whom we are selling the units, even he is a real estate developer. The transfer happened on 15th February 2025. So see, tell me, for the seller, which head of income will come into the picture, guys? Assessee is selling his stock in trade, so therefore PGBP head of income. Then what about the buyer? For the buyer is also real estate business. Buyer is buying stock in trade, so for him also PGBP head. Okay. So 5 units were sold for 20 lakh rupees each. So 20 lakh rupees each is the selling price of the units. Then the question says stamp duty value on the date of sale was 23 lakhs. So 23 lakhs becomes stamp duty value on the date of transfer. However, the agreement of sale was entered into on 1st November 24, on which the stamp duty value was 22 lakhs. So 22 lakhs is the STV on the date of agreement. Okay. Mr. Ram received 1 lakh by way of account payee check on 1st November 24 from Mr. Gaurav. Come on everybody, what comes to your mind? What should we do over here? They have given us the selling price number, they have given us the STV on the date of transfer, STV on the date of agreement, and it is PGBP head, guys, because real estate business. So don't tell me 50C, we're not talking about capital gains over here, it's not capital asset for us, it's stock in trade. So similar to 50C, in PGBP, you have section 43CA, guys. 43CA is from whose point of view? From the buyer's point of view or from the seller's point of view? It is from the seller's point of view. So for the seller, if 2 conditions are fulfilled, then 43CA will apply. Condition number 1, the stock in trade has to be land, building both. And condition number 2, the STV has to be more than 110% of selling price. Here if you see, yes, my stock in trade is land, building both. Now STV, 2 STV numbers they have given to us, guys. We have STV on the date of transfer also, and we have STV on the date of agreement also. We always prefer which STV? We always prefer STV on the date of agreement, but we can take this STV only if some consideration buyer has paid to the seller on or before the date of agreement in specified mode. All my conditions are fulfilled. Some consideration, 1 lakh rupees, buyer has paid to the seller on the date of agreement in specified mode, account payee bank draft over here. So I will take STV on the date of agreement over here, which is 22 lakhs. Now selling price is 20 lakhs each. So 110% of 20 lakhs will be 22 lakhs. So tell me everybody, is 22 lakhs more than 22 lakhs? No, it is not. Condition 2 not fulfilled. 43CA will not apply. If both your conditions are fulfilled, then whatever is your actual selling price number, I will ignore that. Instead, the STV will become your deemed selling price number, guys. This is what section 43CA says. But we can't do all this over here because my conditions are not fulfilled. Is STV more than 110% of selling price? No, it is not more than 110% of selling price. So therefore 43CA will not apply. So for the purpose of computation of PGBP, your selling price will be your actual selling price only, 20 lakh rupees per unit for 5 units. You can't take the SDV number over here because second condition not fulfilled. Okay. That's it, guys. Come on, let's have a look at the adjustments now. So the first question, while computing the total income of Mr. Ram, the income from residential and commercial units let out. The let out units, basically, these let out units will be taxed under which head? We already concluded it will be taxed under the IFHP head only. So income from house property, IFHP head only. We know that it will go under the PGBP head only in these two situations. Just because it is stock in trade, it will not go into PGBP head. So IFHP head only, your first question. Then comes your second question. What would be the tax treatment of the vacant residential and commercial units held as stock in trade? Vacant units, we have spoken about. All your conditions are fulfilled. We are within 2 years from the end of the year of construction completion certificate. So, and the properties, the units are lying vacant. So, the IFHP will be 0. IFHP head only, but the answer will be nil. Let's read the options. The vacant residential units would be deemed to be let out. No deemed to be let out. Vacant units, both residential and commercial, would be deemed to be let out. Wrong. The annual value of both vacant residential and commercial units would be nil for 25-26. Hence, no income is chargeable under the head IFHP. Option C, guys. The NAV will be 0. IFHP will be nil for both residential units and commercial units. Then they are asking us what would be the full value consideration in respect of the sale of units to Mr. Gaurav for the purpose of computing PGBP. For the purpose of computing PGBP, assessee sold 5 units to Gaurav, but the selling price will be 20 lakh only per unit, 20 lakh into 5, 100 lakhs only. Basically, 43CA is not applicable because second condition is not fulfilled. So 100 lakh, option A. Now come on, okay, question number 4. This is very interesting. Assume 1 lakh was paid in cash by Mr. Gaurav to Mr. Ram on 1st November 24 instead of by way of account pay bank draft. So basically, over here, 1 lakh was paid by the buyer in account payee bank draft, right? Specified mode. That is why we took STV on the date of agreement. But here they are saying instead of account payee bank draft, let's say the payment was in cash. Then in that case, non-specified mode. So we can't take STV on the date of agreement. We will take STV on the date of transfer, which is 23 lakhs, guys. Yes, now continue reading. So what would be the income chargeable under 56.210 in the hands of Mr. Gaurav? See, who is Mr. Gaurav? Slowly, no tension. Who is Mr. Gaurav? He is a buyer. And this Mr. Gaurav is a real estate dealer. Remember? So, for him, the 5 units which he is buying, those 5 units, what is the SDV? STV is 23 lakhs. I will not take STV on the date of agreement anymore because 1 lakh advance is paid in non-specified mode. So I'll take STV on the date of transfer or date of registration, which is 23 lakhs. And how much consideration did he pay for each unit, guys? He paid for each unit 20 lakhs. So basically, you're understanding in which direction they are trying to take you. They are saying that the buyer has purchased units worth 23 lakhs for only 20 lakhs. So basically, 3 lakhs inadequate consideration, guys. Okay, so immovable property you purchase for inadequate consideration, you will come into IFOS head, right? That is 56.210. Basically, your IFOS gift, guys, immovable property inadequate consideration. But however, you can tax it under IFOS head only if it is a capital asset for you. But good morning, your assessee Mr. Gaurav is a real estate dealer. So for him, those units are stock in trade. So because it is stock in trade, you can't put it under IFOS. So under IFOS, your answer will be nil. Nil, since 56.210 is not applicable in this case. It can't be option C. Option C says nil because stamp duty value is within the permissible limit. That's not your reason. It is nil because 56.210 is not applicable. Why 56.210 is not applicable? Because for the buyer, this is stock in trade. You can put something under IFOS only if for the buyer it is capital asset. But here for the buyer, this gift of immovable property, this inadequate consideration of 3 lakh, this is relating to stock in trade. So it will go into PGBP head. It will not come into IFOS head at all. So your answer will be nil. Alright everybody, yes, so this was just to remind you that you do calculations under IFOS head for gift only if for the recipient the goods are capital asset. Here it is stock in trade for him, therefore no IFO asset. Alright, this was your question number 29. Nice, interesting question. You had your second revision with respect to these vacancy in IFHP head, and then we also spoke about 43 CA over here. Now come on everybody, come to question number 30. This is a majorly IFHP question again, but you do have some other adjustments as well over here. The question says Mr. Ganesha, he's a salaried person. He has 3 houses. One in Thane, Maharashtra, second in Jaipur, Rajasthan, and third in Ratlam, Madhya Pradesh. Details of the flats and houses are given to you. So he has 3 houses. He has a Thane house, then he has a house in Jaipur, and then he has a house in Madhya Pradesh in Ratlam. So Thane flat, it's a 3 BHK flat purchased in April 2001 for 90 lakh rupees, okay. Afterwards, interior work was done in 2006 for 15 lakh rupees. So this will become your cost of improvement, guys. 15 lakh rupees interior work you've done. Mr. Ganesha took a loan of 65 lakhs for the purchase of this flat in 2001 and settled the loan in 2021 itself. So this loan adjustment will become irrelevant for me because the loan is not even outstanding in the current year. It was settled in 2021 itself. Loan becomes irrelevant for me. Then Jaipur house, this one was purchased in July 2019 for 62 lakh rupees and interior work was done in September 2020 for 10 lakh rupees. So even over here, this is your cost of acquisition, your date of acquisition, and 10 lakh rupees your interior work, this will become his cost of improvement. Loan taken for purchase of this house was 15 lakh rupees in June 2019. As per interest certificate, he paid 12 lakh 500 and 43 500 towards principal and interest in the current year. So we have principal repayment also, we have interest also for the Jaipur house. Then they're giving us information about the Ratlam house, the Madhya Pradesh house. This one was purchased in December 2021. This becomes your date of acquisition. It was purchased for 70 lakh rupees. This becomes your cost of acquisition. And when you purchased that time, the stamp duty value was 65 lakh rupees. For acquiring this house, he took a loan of 40 lakh rupees from Canara Bank. Loan was sanctioned on 1st August 2021. He pays EMI of 38,100 per month. As per interest certificate for the year, he paid 60,900 and 396,300 towards principal and interest respectively. So 60,900 is principal repayment, 396,300 is your interest payment. This is about the Ratlam house. Then after that, what happened? They've given us for Thane house, for Jaipur house and for Ratlam house. They've given us a municipal tax, municipal value per month, fair rent per month, standard rent per month. All these numbers they have given to us. But Jaipur house, why have they given me only till December? Only for 9 months they have given me. Let's continue reading. We'll find out. Other details are as follows. He sold the Jaipur house on 1st Jan 2025. Now you understand why they have given us information for 9 months only. So the Jaipur house, my assessee owns a Jaipur house for 9 months only. 1st January, he is selling away the house. So for Jaipur house, all computation will be for 9 months only. Okay, now this Jaipur house he sold on 1st Jan 2025. So this becomes your date of transfer. He sold it for 90 lakh rupees. This becomes your full value consideration. Then he invested 15 lakhs in RECL bonds issued by the central government on 10th August 2025. REC bonds, guys. So of course you will think about section 54 EC. Alright, then Mr. Ganesha is working in Windor Exports Private Limited in Mumbai and he self-occupied the Thane house. So the Thane flat is a self-occupied property. He earned salary of 22,50,350 for the previous year. He has no other income from any other source. He has given Ratlam house on rent for financial year 24-25 to Mr. Pratap on a monthly rent of 8,500. So the Ratlam house is let out property. The rent is 8,500 per month. And Jaipur house, even this house he gave on rent. So even this is let out property for April to June. So April, May, June. For 3 months only it was given on rent to Mrs. Madhura Mahato on monthly rent of 7,100 per month rent. And then it was lying vacant for the remaining period, July to December. So 3 months it was let out and 6 months it was remaining vacant. July, August, September, October, November, December. Then he wants to exercise the option of shifting out of the default tax regime, which means he wants to follow the normal regime. CII numbers they have given to you and now they're asking us the questions. First question is net annual value for each house. Then they're asking you about IFHP and all. So normal usual computation, full computation we have to do. So 3 houses we have, guys. We have the Thane house, we have the Jaipur house and we have the Ratlam house. Simple question only, nothing to worry. So Thane house is a self-occupied property. Jaipur house is a let-out property. Even the Ratlam house is a let-out property. Jaipur property, don't forget, you will do all computations for 9 months only, because we do the computation for the period for which my SSE owns the property, right? So Jaipur house we own only for 9 months. Alright, now how do you start? You start your computation with your GAV number, right? So GAV number, municipal value, fair rent, all this is given to us. So come on everybody, no skipping steps. Step number 1 is municipal value or fair rent, whichever is higher. See, Thane house is self-occupied house. I will not do all this calculation for the self-occupied house. Self-occupied house will enter the scene at the NAV step only. So I'll do this calculation only for the let-out units. So Jaipur house, what's your municipal value? 6,800 per month. You will calculate for how many months? Jaipur house full computation for 9 months only. So 6,800 into 9 months, this will be 61,200. And Jaipur house fair rent is 7,000. 7,000 into 9 months, 63,000. Out of these two numbers, which is higher? 63,000 is higher. Similarly, Ratlam house, municipal value is 7,200 per month. For all 12 months, we will calculate, guys. So 86,400, and the fair rent is 7,500. 7,500 into 12 will be 90,000, whichever is higher. 90,000 is higher. Then comes your step 2. Step 2 will be your step 1 number, which is 63,000 for the Jaipur house and 90,000 for the Ratlam house. Your step 1 number or your standard rent number, whichever is lesser. This step 2 only is called as your reasonable expected rent also. So the standard rent is for the Jaipur house 8,000 rupees per month. Only for 9 months you will calculate. So 72,000. And for Ratlam house 7,300 per month. For all 12 months, guys, 87,600. Now out of these two numbers you will pick whichever is lesser. So 63,000 and 87,600. Then comes step 3, your actual rent minus unrealized rent. There is no unrealized rent and all in this question. So I'll take the actual rent as it is. See, how much is the actual rent? The Jaipur house was let out for 7,100 per month. See, the question says Jaipur house, it was let out only for 3 months. Remaining 6 months it was lying vacant. But still we always take actual rent for the period for which my SSE owns a property, because vacancy will anyways get taken care of in the vacancy loss step. Alright, so actual rent I will calculate how much? 7,100 per month. I'll calculate for all 9 months, guys. No doubt 6 months it's vacant, but that will anyways get taken care of in the vacancy loss step. So 7,100 into 9, this is 63,900. And what about the Ratlam house? Ratlam house, here the rent is 8,500. So 8,500 into 12. That will be 1,02,000. Okay, no unrealized rent. Then comes your step 4. Step 4 is step 2 or step 3, whichever is higher. So your step 2 number is 63,000. Your step 3 number is 63,900, which is higher. 63,900. Then for the Ratlam house, your step 2 number is 87,600. Step 3 number is 1,02,000. Whichever is higher, 1,02,000. Then comes step 5, vacancy loss. We do have vacancy loss for the Jaipur house. The Jaipur house is vacant for 6 months. See, we can subtract vacancy loss only if in step 4, step 3 is higher. Yes, step 3 is higher. So against this, I can subtract vacancy loss for 6 months, guys. So 7,100 into 6 months, 42,600 will be your vacancy loss. We don't have any vacancy loss for the Ratlam house. That's all. Step 6, what's your GAV number? 63. GAV will be step 4 minus step 5. So 63,900 minus 42,600, 21,300 for the Jaipur house and 1,02,000 for the Ratlam house. See, handling the vacancy loss, each of you will have your own method of computing, but your answer will be the same only at the end of the day, 21,300 and 1,02,000. Alright, basically in my method of computing, I don't consider vacancy in step 3 itself. Step 3 I calculate for the period for which my SSE owns a property. Okay, because vacancy loss I have a separate step altogether. But I will subtract vacancy loss only if in step 4, step 3 is higher. If step 2 was higher, then even though I have vacancy loss, I will ignore the vacancy loss. Okay, so we have the GAV numbers. Now come on, guys, usual computation. So GAV is 21,300 and 1,02,000. From this you will subtract municipal taxes paid. How much municipal tax have we paid? See, for the Jaipur house, 8,090. For the Ratlam house, 6,909. So your NAV guys, this is where the self-occupied house will enter the scene. So your net number, your NAV for the Jaipur house will be 13,210. And for Ratlam house, it will be 95,091. From this, you will subtract deductions under section 24. So first of all, you will have standard deduction 30%, 0 for the self-occupied house. For the Jaipur house, 30% will be 3963. And for the Ratlam house, 30% will be 28527. Okay, and then we'll have our interest calculation. Come on, have a look at the numbers. What is the interest number for the Thane house? Thane house, no loan itself, guys. Loan is fully repaid, so no interest. For Jaipur house, the interest is 43,500. No pre-construction interest and all over here. Only current year interest. And for the Ratlam house, the interest was 396,300. So the IFHP will be nil here. Then for the Ratlam house, it will be negative number, negative 34,253. And for your last, 34,253 is for the Jaipur house. And for the Ratlam house, it will be, even here it's a negative number, 329,736. Alright, so this was our entire IFHP computation. So they are first of all asking us the net annual value for each house. So net annual value numbers are here. 0 for the Thane house. Then for Jaipur house, 13,210. We have that in two options. And Ratlam house, 95,091. So option A, guys, Thane nil, Jaipur house 13,210 and Ratlam house 95,91. Then what would be the income or loss under house property? So total loss only, the total loss will be 3,63,989. This is your total loss from house property, option D. Then they are asking us how much amount will be carried forward as loss from house property for the subsequent assessment year. See, loss carried forward, we have to see first of all how much adjustment is possible in the current year itself. We do have some other income over here. We do have capital gains, guys. The Jaipur house has been sold. So against the capital gains, let us see how much loss are we able to set off. Then balance only we can say that, balance will be carried forward. So let's compute the Jaipur house capital gains. Capital asset transferred, Jaipur house property. What's the period of holding? When did we buy this house? Usual computation, guys. The date of acquisition is July 2019. And when did the transfer happen? Date of transfer is 1st Jan 2025. Pause, check, think. Transfer happened before amendment, after amendment. The transfer has happened on or after 23rd July 24. Come to the margin. 50AA will not apply to immovable asset. Period of holding 2 you will have 12 months, 24 months. Immovable property 24 will be your period of holding. And indexation benefit you will not get after the amendment. So come on everybody, come back, 24 months. This period is definitely more than 24 months. Therefore, it becomes long-term capital asset. Therefore, first you try 112A, but it is immovable property. It has to be 112. And if it is 112, full drama. We have to check whether 4 conditions are fulfilled. If 4 conditions are fulfilled, then for the purpose of tax, whatever capital gains you have computed without indexation on that 12.5%, then you have to recompute capital gains with indexation on that 20%, whichever is lesser. But all this extra drama will apply only if they're asking me to compute tax. Let us check, are they asking for tax, guys? They're asking for the amount of capital gains and GTI. They're not asking for tax. So all this extra drama not relevant for us in this question. So come on, let's start with the computation now. Full value consideration. We sold the house for how much? The full value consideration is 90 lakhs. Only 2 sections come to your mind at FVC stage, 50C and 50CA. None of those 2 sections will apply over here because 50C STV numbers and all, they have not given to us. No expense on transfer. This itself becomes my net consideration. Less cost of acquisition. A grandfather clause, your 31st Jan 2018, all that will not apply. It is not 112A. And indexation also will not apply. We've already concluded. So I'll take my cost of acquisition as it is. So the Jaipur house, cost of acquisition was 62 lakh rupees. Then we do have cost of improvement also. The interior decoration, guys, 10 lakh rupees. So what's your assessees LTCG now? The balance 18 lakhs. 18 lakhs will become the LTCG from this house. But wait. We did purchase 54EC bonds also, REC bonds. So let us check. See, I always tell you, don't blindly take the exemption. Check your conditions. Assessee can be any assessee. Assessee should be having long-term capital gains. Assessee should be transferring any immovable property and buying the specified bonds. Yes, REC bonds are specified bonds, but you should buy the bonds within 6 months from the date of transfer. The transfer happened on 1st Jan 2025. You've purchased the bonds on 10th August 2025. Have you purchased within 6 months from the date of transfer? No. So therefore no 54EC. So 18 lakhs will be your taxable capital gains. So going forward now, computing the GTI of the assessee, we have section 112 LTCG of 18 lakh rupees. Then we also have salaries income, by the way, in this question. Remember, here we had salary income, see. So we are having salary income of 22 lakhs 50,350. So we'll subtract standard deduction, normal regime, guys. So you will subtract 50,000 standard deduction. So 22 lakhs and 350 will be the taxable salary. Now tell me, we have loss from house property. How much? Loss from house property, we have 363,989. Now first of all, we will try intrahead. Intrahead is not possible, guys, because we don't have any IFHP. So then you will try interhead. Interhead, you can adjust it against 112 LTCG also. You can adjust it against salary income also. Now 112 LTCG will be 12.5% tax rate. Even if you do with indexation, 20% tax rate only. But salary over here is 22 lakh 350. It is normal rate income. It is more than 10 lakh. It will be 30% slab, no? So you always adjust losses first against those incomes which have a higher tax rate. So here LTCG is either 12.5% or 20% only, but my salary income more than 10 lakhs, guys. So therefore this will be 30% slab. So of course I will adjust my loss from house property against salary income only. But how much, guys? Interhead, in normal regime, only 2 lakhs you can adjust. So your net taxable salary will now be 20 lakhs and 350, and your assessee's GTI will be 38 lakhs and 350. And we do have principal repayment and all, so we can get ATC deduction also. So this is our GTI. Okay, so how much loss are you still left with now? 2 lakhs loss you have adjusted. 1,63,989 you are left with. This you will carry forward. Had your assessee been following 115 PSE, then in that case you can do only intrahead. No interhead, no carry forward, no bring forward, nothing. But this is normal regime, so therefore we can do interhead, but maximum 2 lakhs only. Okay, now come on, have a look at the question. How much amount will be carried forward as loss from house property? 163,989, guys, carried forward. Then what would be the amount of capital gains chargeable to tax? Capital gains 18 lakhs LTCG. So LTCG of 18 lakhs, option B. And what's a GTI? GTI is 38 lakhs and 350, option D. Alright, that's it. So this was your question number 30. Nice MCQ question. Now come on, come to question number 31. PGBP question, guys. Depreciation question this is. So small question only. Let's read the question. So the question says, Lux Enterprise, a proprietorship firm of Mr. Lucifer Morningstar, a resident individual in Maharashtra, engaged in the business of printing and publishing. This is the highlight of this question, guys. You'll understand as we go ahead. The following details pertain to the assets of the business. Total 3 assets only. So office building, it was purchased on 30th September 24, put to use on 30th December 24 for 1 crore 85 lakhs. Then we have BMW car, purchased on 23rd August 2019, not current year, long back, put to use also in 2019 only, 94 lakh 80,000 BMW card. And then machineries used in printing and publishing process, purchased on 25th September 24, 15th October 24, put to use 9 lakh 12,500. So out of these 3 assets, I can say that these 2 assets were purchased during the year, guys. Purchased during the year, put to use during the year. But the car, old asset, 2019 asset. Then written down value of plant and machinery on 1st April 24 is 1 crore 45 lakhs. So they have given opening WDV on 1st April 2024 for the plant and machinery 15% block 1 crore 45 lakhs. What are they asking us? We'll do step by step. First, they're asking us what is the amount of depreciation on plant and machinery, 15% for 24-25. Come on everybody, no tension, slowly we will handle it. So they're asking us about plant and machinery, 15% block. So usual steps guys, we will start with opening WDV in the beginning of the year. 1st April 2024, our opening WDV in the beginning of the year is 1 crore 45 lakhs. Then we will add actual cost of assets acquired. In the current year, how many assets you have acquired? 2 assets you have acquired. One is this office building and the other is this machinery. Will office building enter into my 15% plant and machinery block? No, this is 10% building block. And what about this machinery? Yes, this will enter into this block. For how much have you purchased it? For 9,12,500. Now, whenever you purchase a new asset into the block, you always check. Did you put it to use for at least 180 days? And will you get additional depreciation? See, it was put to use on 15th October 24. So definitely it is put to use for less than 180 days, guys. Now, will you get additional depreciation? Tell me, what are the conditions for additional depreciation? Assessee should be a manufacturer, or the assessee must be in the business of printing, publishing books. Assessee must be following WDV basis. Then it should be plant and machinery. Then we have ineligible plant and machineries, right? It should not be ineligible plant and machineries like second-hand plant and machinery, road transport vehicle, ships, aircrafts, machineries used in office, guest house and all. Then machineries which are already fully debited in the P&L account. It should not be ineligible plant and machinery. And lastly, assessee must not be following 115 BSE. These are your 5 conditions. Over here, tell me, is assessee a manufacturer? No. But he's in printing and publishing business. Therefore, condition 1 fulfilled. So the whole reason, the one and only reason why I'm doing this question for you is for this point to remind you that additional depreciation is not only for manufacturers, it is also for assessees who are into printing and publishing. Even for them, additional depreciation is eligible. Okay, then yes, assessee is following WDV basis. This is plant and machinery. It is not ineligible plant and machinery, and we are doing as per normal regime, let us say. So therefore, all the conditions fulfilled, I will get additional depreciation. But because put to use for less than 180 days, only 10% additional depreciation I will get. Okay, then less money is receivable for assets sold. Have we sold any asset during the year? We have not sold any asset during the year. And what is our closing WDV now? On 31st March 2025, our closing WDV will be 1 crore 54 lakh 12,500. Okay, then you will claim depreciation. So we always split our WDV into 3 parts. Tell me, in this WDV, do you have any portion which is put to use for 0 days? No. Then do you have any portion which is put to use for less than 180 days? Yes, guys, less than 180 days is 9,12,500. On this, compute your normal depreciation first. So 9,12,500 into 15% into 1 by 2. Less than 180 days, no? So only half year's depreciation you will get. This will be 6,84,038. Then additional depreciation, you will get additional depreciation. We just checked all our conditions are fulfilled, but only 10% additional depreciation you will get, which is 91,250. So your total depreciation for the new asset will be 1,59,688. Okay, then what is your balance WDV? So out of 1 crore 54 lakh 12,500 WDV, you have computed depreciation on 9 lakh 12,500. So your balance WDV is 1 crore 45 lakhs. On this normal depreciation of 15%, guys. So 1 crore 45 lakhs into 15%. This will be 21,75,000. No additional depreciation because additional depreciation is only for new machineries. So what's your total depreciation now? Total depreciation is 23,34,688 on your 15% plant and machinery block. So the opening WDV for the next year, the opening WDV will be 1 crore 30,77,812. Okay, now what are the learnings that we've had till here? Let me remind you about that first. Point number 1, printing and publishing. Even this is eligible for additional depreciation. Learning number 1. Learning number 2, whenever we put a new asset into the block, we always check for 2 things. Was the asset put into use for at least 180 days or not? And will I get additional depreciation or not? So here it was less than 180 days. And printing and publishing, my assessee is eligible for additional depreciation. Then when you're computing depreciation, you will split your WDV into 3 parts, guys. 0 days, less than 180 days, and balance WDV. We always do fill it in the sequence. First 0 days, then less than 180 days, and then balance WDV. On less than 180 days, only half year's depreciation and only half additional depreciation. Don't worry, SSE. Balance additional depreciation you can claim in the next year. Okay. So now tell me, what is the amount of depreciation on plant and machinery 15% block? It is 23,34,688. 23,34,688. Option B. And then what would be the WDV of the plant and machinery on 1st April 2025? So after depreciation, WDV for the next year is 130,77,812. Okay. Then what else are they asking us? What would be the WDV of the office building superstructure for 1st April 25? So the building block also they are asking us. So let's begin that. Our building, 10 office building guys, so 10% depreciation rate. Same thing, we'll start with opening WDV on 1st April 2024. We don't have any opening WDV because we purchased the building during the year only. They have given us opening WDV only for plant and machinery, not for the building block. Then we will add actual cost of assets acquired. We have acquired a building during the year. So the question says we have purchased it for 1 crore 85 lakh rupees. Now whenever you purchase a new asset, same thing. Was it put into use for at least 180 days, guys? It was put to use on 30th December 24. So definitely it is put to use for less than 180 days. And will I get additional depreciation? Additional depreciation is only for plant and machinery. This is building, so no additional depreciation. Then you will subtract monies receivable for assets sold. You have not sold any asset. So 1 crore 85 lakhs. This becomes your closing WDV. Now you will compute your depreciation. Same thing now, you will split your WDV into 3 parts, into 0 days. Do you have any WDV put to use for 0 days? No. Then do you have any WDV which is put to use for less than 180 days? Yes. This full 1 crore 85 lakhs is put to use for less than 180 days. So on this your normal depreciation will be 10%, but only for half a year, guys, because put to use for less than 180 days. So this will work out to 9,25,000. No additional depreciation because this is not plant and machinery. No other WDV you have. So your opening WDV for the next year will be 1 crore 75 lakhs 75,000. This will become your opening WDV for the next year on 1st April 2025. So they were asking the opening WDV only for the office building for the next year, 1 crore 75 lakh 75,000, option C. Okay, all this is done. But I'm very sure some of you are curious that ma'am, what about this BMW car? We haven't even spoken about this. In this entire question, it was irrelevant for us. But let me give you some reminders. See, in case assessee purchases a car, okay, for car, what is the depreciation rate generally? The depreciation rate is generally 15%, okay. But however, if the car is purchased and put to use in this period, 23rd August 2019 to 31st March 2020, then the depreciation rate is 30%, guys. Yes, so this car, if you see, it is purchased and put to use in this period of 23rd August 2019 to 31st March 2020. So this car will fall under plant and machinery 30% block. It will not even fall in the 15% block. It was not even relevant for us in this question because in this question they were asking us for depreciation and the opening WDV. If you saw in this entire question, we did not even talk about this car, okay, and there was no adjustment about it. But by chance there is an adjustment about it, just giving you a reminder that for car general depreciation rate is 15%, no doubt. But however, if it is purchased and put to use in this period, then the depreciation rate is 30%. So this is a car which is purchased and put to use in the specified period. So therefore this car will not even form a part of my 15% plant and machinery block. It will be a part of my 30% plant and machinery block. Alright, so this was your question number 31. Alright, now come on everybody. Come to question number 32. One more depreciation question, guys. So here the question says Mr. X has set up a manufacturing unit. Manufacturing unit, guys, so definitely my SSE will have additional depreciation in Chittoor, Andhra Pradesh on 1st April 2023. During 23-24 and 24-25, he purchased the following assets. So 1st April 2023 only, that is in previous year 23-24 only, he set up this unit. And in 23-24 and in 24-25, both the years put together, these are the assets which your assessee has purchased. So 7th June 23, which means previous year 23-24, 25th July 23, This is also previous year 23-24. 14th Jan 24. This is also previous year 23-24. But 15th May 24, this will be previous year 24-25. So the last year my SSE has purchased these 3 assets. Current year my SSE has purchased 1 asset. What is the total amount of depreciation for 24-25? Current year depreciation they are asking us while computing PGBP. So come on everybody, step by step we will go. So, see, we have to start our block computation from 1st April 2023 over here, because current year is 24-25 no doubt, but they have not given me opening WDV for 24-25. Instead, from 23-24, they have given us information. So, for 23-24 also, for 24-25 also, for both years, we'll have to do the computation. So, we will start with 1st April 2023. Okay. So, what is your opening WDV on 1st April 2023? Plant and machinery block, guys, 15% plant and machinery block. Opening WDV on 1st April 23 is 0, because that day only we started the business. So then we will add actual cost of assets acquired in 23-24. So in 23-24, 3 assets we have acquired. These 3 we will take. Okay, first we are calculating for 23-24. So we have plant and machinery X. This was purchased for how much? 14,75,340. Tell me guys, was it put to use for at least 180 days? It is put to use on 7th June 2023. So definitely it is put to use for at least 180 days. And will I get additional depreciation? Manufacturing unit, guys, and plant and machinery, not ineligible plant and machinery, I will get additional depreciation. Full 20% additional depreciation I will get, because at least 180 days. Then what about office furniture? See, office furniture, will it come into my 15% plant and machinery block? No. For this, I have to do a separate block computation altogether. Furniture block, 10% furniture block, separate computation we will do. This will keep us pending. Then we have one more machinery, plant and machinery Y. This is purchased for 5 lakh rupees. And this is purchased on 14th Jan 2024. Put to use on 14th Jan 24. Definitely put to use for less than 180 days. So here also I will get additional depreciation, but only 10% additional depreciation, because less than 180 days. Then you will subtract monies receivable for assets sold. Have you sold any asset during the year? No, we have not sold any asset during the year. So what is our closing WDV on 31st March 24 now? The total of 19,75,340. Okay guys, now come on, you split the WDV into how many parts? Into 3 parts. First of all, do you have any WDV which is put into use for 0 days? No guys, nothing. Then do you have any WDV which is put into use for less than 180 days? Always same sequence. Less than 180 days, I do have a number. How much? 5 lakhs. Now on this 5 lakhs, how will you calculate normal depreciation? 5 lakhs into 15% into 1 by 2. Only half year's depreciation you will get, because it is put to use for less than 180 days. So that will be how much? 37,500. 37,500. Then additional depreciation we've already concluded, 10% guys. So 5 lakh into 10%, which is 50,000. So this is about my less than 180 days. Then balance WDV. So our balance WDV is how much? From 19,75,340, I have already computed depreciation on 5 lakhs. My balance WDV is 14,75,340. On this normal depreciation, full year's depreciation guys, which is 15%, that will be 2,21,301. And then will I get additional depreciation also? Yes, on this 14,75,340, we have already concluded that we will get 20% additional depreciation, which will be 2,95,068. So therefore, our opening WDV 1st April 2024, be careful, find out. Opening WDV for next year will be, that is our current year, 13,71,471. Okay guys, now see, we claimed only 10% additional depreciation. So would you like to make any observation over here? Can I say that, don't worry SSE, balance 10% you can take in the next year? Right guys, so this is my opening WDV for my current year. Now same thing, we will add actual cost of assets acquired in the current year 24-25. In 24-25, have we purchased any asset in the plant and machinery block? Yes, we have purchased machinery Z. We have purchased it for 8 lakh rupees. Same thing now, tell me, did I put it to use for at least 180 days? 15th May 24, guys. So definitely put to use for at least 180 days. And I will get additional depreciation. Assessee is a manufacturer. It's not an ineligible plant and machinery. So full 20% additional depreciation I will get. Then less money is receivable for assets sold. Have I sold any asset during the year? No, nothing is sold. So what is our closing WDV now? Closing WDV on 31st March 2025. So to eliminate confusion, what I'll do is my current year calculation, let me put in a different color so that there is no confusion. Okay, this is my current year computation. So closing WDV on 31st March 2025 will be 13,71,471 plus 8 lakh, which will be 21,71,471. Okay, now come on everybody. Split the WDV into 3 parts. Do you have any WDV which was put to use for 0 days? No. Then do you have any WDV which was put into use for less than 180 days? Less than 180 days? No, guys. We have at least 180 days only. Then what is my balance WDV? My balance WDV is 21,71,471. Now be careful. Silly mistake area, guys. Be careful. So first of all, you will compute normal depreciation on this number. So 21,71,471 into full 15%. This will be 3,25,721. Okay. Then additional depreciation. See, additional depreciation you have already concluded 20% on this 8 lakhs. So 8 lakhs into 20%, which is 1,60,000. Then last year we had an asset which was put to use for less than 180 days. You had given me only 10% additional depreciation and you had told me, don't worry assessee, balance 10% you can take in the next year. This is the next year. Now give me the balance 10%. So the balance 10%. So 5 lakh into that balance 10% of 50,000. That also I will claim now. So now tell me, what's my opening WDV for 1st April 2025? My net number. You will get 16,35,749. Okay, now this was a depreciation. So what's a total depreciation now? Plant and machinery block. Current year total depreciation will be 5,35,721. But in addition to this, we'll also have to do the furniture block, guys. This will be simple. Here, no major computation. See, it was purchased last year. In previous year, 23-24. See, I'll do a shortcut over here. I purchased it for 7,65,400. In 23-24, how much depreciation you would have claimed, guys? Furniture. 10% depreciation you would have claimed. Put to use for at least 180 days. No additional depreciation also. So 76,540 you will claim. So your WDV after claiming last year's depreciation will be 6,88,860. Okay, then you will claim 24-25 current year's depreciation. So current year's depreciation will be 10%, which is 68,886. So now tell me, plant and machinery block current year total depreciation is how much? 535,721. And this furniture block current year depreciation is 68,886. So therefore, total depreciation for my current year will be 6,04,607. Option D. Understanding. This is a very interesting question. Multiple new adjustments you might be seeing for the first time over here, especially the way we remembered to take the balance 10% in the current year. This is the highlight of this question, guys. Alright, so they had given us information for 2 years. So we did the calculation for the first year. We found the opening WDV for the current year. Current year we gave our depreciation number. and we found the opening WDV. So we did for plant and machinery block separately and for office furniture separately. Office furniture is 10% block, plant and machinery is 15% block. Okay, this is the reason why I always tell you, whether it is a full-fledged descriptive question, whether it is an MCQ question, don't skip your steps. Don't think if it is MCQ, I will simply use my calculator, do tuck 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 calculation and give the numbers. No, it will not always work out. You will not be confident that your answer is right. So therefore, only thing is, if it's a descriptive question, you will write nicely, neatly, you will present the answer properly. If it is MCQ question, you will scribble and you will work out and you will, then only shade your answer. So if just because it's an MCQ doesn't mean it's a green signal for you to skip steps. No, always you follow the sequence. Don't try to do too much mental calculation in MCQs. It will not work out. Okay guys, so this was your question number 32. Now come to question number 33. One more question from PGBP. This is a nice question about partners. I really wanted to do this question for you because if you notice, in the descriptive questions that we did till question 27, even over there we did not have any question from section 40B, right? So at least one question on 40B I wanted to give you a reminder, and that's why I picked question number 33. Let's read the question. The question says ABC & Co. is a partnership firm engaged in the business of sale of footwear. The partnership firm consists of 3 partners, A, B and C. A and B are working partners, C is a sleeping partner. So if you're a sleeping partner, only one thing will change, salary. Interest and all, same treatment only, salary only will change. The firm is liable to tax audit under 44AB of the Act. It has a book profit of 11,50,000. So I have a partnership firm. This partnership firm has 3 partners, A and B. They are active partners. Partner C is sleeping partner. Then for this firm, section 44AB tax audit is applicable. So tell me guys, what will be the 139-1 date for the firm? 139-1 date for the firm will be 31st October 2025 because 44AB tax audit is applicable. What will be the 139-1 date for the partners A, B and C? For all the partners, also the 139-1 date will be 31st October 25. Right guys? If for the firm, partnership firm or LLP, for them if tax audit is applicable and if the due date is 31st October, then for that firm's partners, all partners, whether active partner, whether sleeping partners, for the partners also the 139-1 date will be 31st October 25. Okay. Then they have given us a book profit. Book profit means what guys? Book profit means normal usual PGBP after considering all chapter 4D adjustments, which means after considering all your PGBP adjustments, interest, all PGBP adjustments are covered. Just before subtracting, just one adjustment is not considered, that is before salary to partners. So they have given me the book profit. What is book profit? Book profit is normal usual PGBP as per chapter 4D after considering all PGBP adjustments, just that it is before considering salary to partners. So the book profit is 11,50,000. This is the information given to us. Then following payments were made to the partners authorized by the partnership deed. To A and B, to the working partners, we paid 32,000 per month to each partner salary. To C, sleeping partner, we paid 10,000 rupees per month. Then interest on capital, 19.5%, 7%. Interest on capital maximum, how much is allowed guys? Maximum 12% of capital only is allowed. Then the firm has following brought forward losses of past years. So we have brought forward business loss, we have brought forward unabsorbed depreciation, and we have brought forward long-term capital loss. These are your brought forward loss numbers. They are asking us what would be the income under the head PGBP in the hands of ABC and company for assessment in 25-26. Alright guys, so are you ready for the game? Come on, let's begin. They're asking us PGBP of the partnership firm. Alright, now see, they have already given us the book profit number. Alright, now this book profit number is full PGBP calculation guys. Only thing is, it is before salary. So from book profit number, if I subtract the salary number, then I will get the PGBP of my partnership firm. Right, but it's not so simple also. You'll understand as I take you forward step by step. But first let's find out how much salary is allowable. See, how much maximum salary is allowed, that depends upon your limit. The maximum limit guys, section 40B limit. So the limit depends upon the book profit. So what's the book profit of your firm? That hard work we don't have to do. They've given us a book profit number already. 11,50,000. So how do you compute now? On the first 6 lakhs of the book profit, either 90% of the 6 lakhs number or 3 lakh rupees, whichever is higher. So 90% of 6 lakh will be 5 lakh 40 or 3 lakh, which is higher, clearly 5 lakh 40,000 rupees. Then what's your balance book profit? So 11 lakh 50 minus 6 lakhs, your balance book profit is 5 lakh 50,000. On this, straight away 60%, that will be 3 lakh 30,000 rupees. So what's your maximum allowable working partner salary? Maximum allowable working partner salary, 5 lakh 40 plus 3 lakh 30. This is a maximum allowable working partner salary. What is your actual working partner salary? See, I will not consider the salary of the sleeping partner because sleeping partner salary is anyways fully disallowed. Okay. And I will not add that back also because they have given me the book profit number, which means they have given me the number before salary. Alright, this number is anyways before subtracting salary. So I'm going to subtract salary now only. So sleeping partner salary I will not subtract because sleeping partner salary is not allowed in PGBP computation. Only active partner salary is allowed. Now to the active partner, how much salary are you actually paying? You're actually paying them 32,000 per month per partner. So 32,000 into 12 into 2 partners. So your actual working partner salary is totally 7,68,000. Which is within the limit, guys. So therefore full 7,68,000 I will allow. Okay, so what will be your net number? 11,50,000 minus 7,68,000, 3,82,000. Okay guys, tell how you have understood. Now see what else is there in the question. They've given us interest on capital. But will I subtract that over here? No guys, they have given me the book profit number, which means book profit number is after subtracting interest. So it is basically book profit number is after adjusting all PGBP adjustments. Interest is also PGBP adjustment. So as allowed under Income Tax Act 12%, that much only they would have allowed. So they've already considered the interest number and all. So therefore now I will not subtract interest again. Then they have given us the brought forward losses, brought forward business loss, brought forward unabsorbed depreciation and brought forward LTCL. See, LTCL can be adjusted only against LTCG. So I don't have any LTCG over here. So this will not have any role to play for me. Only business loss and unabsorbed depreciation. This is where the trick starts. No shortcuts. I want you to understand in the correct manner. See, book profit means your PGBP as per chapter 4D, considering all PGBP adjustments except salary. Is business loss a PGBP adjustment? No. It's a set off and carry forward chapter adjustment. But is unabsorbed depreciation a PGBP adjustment? Yes guys, unabsorbed depreciation is a chapter 4D adjustment. So when they have given me the book profit number, unabsorbed depreciation has already been adjusted guys. So therefore I will not adjust it again. But however, tell me, out of these two numbers, which number are you always supposed to adjust first? First, business loss, because it has a life of only 8 years, then only unabsorbed depreciation. So I will first reverse the unabsorbed depreciation because unabsorbed depreciation is already adjusted because you have given me book profit number. Book profit is after considering all PGBP adjustment. Unabsorbed depreciation is a PGBP adjustment. So this they have already adjusted while giving me the book profit number. So first I'll reverse it. I'll add it back. Total unabsorbed depreciation is how much? Total unabsorbed depreciation will be 1,01,640. First I will reverse it. Why am I reversing it? Because I want to adjust business loss first guys. Then only I will adjust unabsorbed depreciation because business loss has a life of only 8 years. Okay. So therefore I'm reversing unabsorbed depreciation. So if I reverse unabsorbed depreciation, my PGBP 4,83,640. This becomes my PGBP before loss and also before unabsorbed depreciation. Because I've added it back, no? So it is before loss and before depreciation. Now I will first adjust my business loss brought forward. Total business loss brought forward is how much? 26,000, 78,000, 1,05,670, which is 2,09,670. I'll first adjust my business loss. Yes, we are within 8 years only. So full business loss I'll adjust. So what is my net PGBP? 2,73,970. This becomes my PGBP after adjusting loss but before adjusting unabsorbed depreciation. So now I'll adjust my unabsorbed depreciation How much is the total unabsorbed depreciation? 1,01,640. So my PGBP will be 1,72,330. So total PGBP they had asked us, option D. In the correct way, I want you to understand. So what are your learnings from this question? You have multiple learnings, guys. Learning number 1, when they ask you for book profit calculation, here they had given us a calculation. When they ask you for book profit calculation, when you're subtracting all PGBP adjustments, will you also adjust business loss? No, it's not a PGBP adjustment. But will you adjust unabsorbed depreciation? Yes, it is a PGBP adjustment. That's an indirect learning for us, guys. So in book profit, unabsorbed depreciation should already be adjusted. Then once you find the allowable salary and all, now when you're computing your PGBP, I'll first reverse the unabsorbed depreciation because I'm supposed to adjust business loss first. Only then unabsorbed depreciation, that's your basic sequence. So therefore, I reversed unabsorbed depreciation. I found the PGBP number before loss and before depreciation. Then first I'll adjust loss, then I'll adjust depreciation. So 172,330 becomes your PGBP number. Okay, this was question number 33. Now come to question number 34, guys. Question number 34 is one small TDS question. I wanted to give you a revision of section 194, TDS on dividend. See, the dividend can be 222 A, B, C, D, E, F, doesn't matter, any kind of dividend. The TDS rate will be 10%. If the company is paying the dividend in cash, then there's no limit. Irrespective of the amount, 10% TDS will apply. But if the assessee is making the payment of, if the company is making the payment of the dividend in non-cash mode, okay, then in that case, up to 5,000 dividend, there will be no TDS. For more than 5,000 dividend, you will have TDS at the rate of 10%. Alright, this is all what I want you to remember, and TDS will be deducted at the time of payment over here, not payment or credit, whichever is earlier, at the time of payment. Alright, now come on, have a look at the question. So assessee is active in equity share trading after coming to India. Following are the details of his portfolio. So various companies, shares he has purchased and sold. Rainbow Limited declared interim dividend 200% on 28 February 2025. Face value of each share is 10 rupees. So 200% dividend. Face value is rupees 10. Record date is 31st Jan 2025. Record date means what? Little bit of Companies Act. So whoever is holding Rainbow Limited shares on 31st Jan 2025, for those shares you will get dividend. So First Smile Limited, I don't care, only Rainbow Limited, guys. So we are bothered only of 0.2, 0.7 and 0.8. Okay, now 0.2, assessee purchased 50 shares of Rainbow Limited on 10th December 2024. Is it before 31st Jan 25? Yes. So you will consider these shares. Then on 28th December 2024, he purchased 200 shares. Is this before 31st Jan 2025? Yes, you will consider these shares also. Then he purchased 100 shares of Rainbow Limited on 3rd Jan 2025. So is he having these shares on 31st Jan 2025? Is it before 31st Jan 2025? Yes. So whichever shares of Rainbow Limited your assessee is holding on this date, on those shares he will get dividend. So total how many shares, guys? 50 shares, 200 shares, 100 shares, total 350 shares he is holding. On these 350 shares, what's the face value per share? Face value is 10 rupees. You know, dividend is always a percentage of your face value. And what's your dividend percentage? 200%. So total how much dividend will he be getting? He will be getting total 7,000 rupees dividend, guys. Question doesn't say dividend is being paid in which mode. Let's say the dividend is being paid in non-cash mode. This is a general answer. Is it at least, is it more than 5,000? Yes, it is more than 5,000. So 7,000 into 10%, 700 rupees. This will become your TDS under section 194 at the time of payment. Deducted at the time of payment. When the company is giving the dividend, at that time they will deduct 700 TDS and they will give the balance 6,300 rupees only. Okay, so just wanted to show you this record date point. On 31st Jan 2025, how many ever shares you're holding of Rainbow Limited? On those shares, face value is 10 rupees, 200% dividend, total dividend is 7,000 rupees. 7,000 is more than 5,000, therefore 10% dividend will apply, 700 rupees. Okay, this was a small question. Now come to question number 35, guys. This is majorly a gift related question, IFOS question, guys. So the question says Mr. Akshay Biani celebrated his 26th birthday on 15th May 2024 and he arranged a grand party at Radisson Blu Hotel. So what is the occasion? The occasion is his 26th birthday. So he is not a senior citizen also. On this occasion, he invited his friends, his relatives, his distant relatives to attend the party. Ceremony was very grand. Feast was also very spectacular. All the arrangements and decorations were absolutely wonderful. At the end of the party, Mr. Akshay was awarded gifts and flower bouquets as infra. So they have given us details about all the gifts. So a gift from mother. Mother gave a 22 carat gold chain. She purchased it on the same day for 37/8/2022 and she gave this gift. Gift from mother, guys, gift from relative, hence a gift will be exempt. Then gift from father. Father gave 122 carat gold bracelet. Even he purchased it on the same day. Gift from father, even this will be exempt. Then gift from wife. 4 gold rings. She purchased these rings on 15th May 2023 for 35,500 each. FMV on 15th May 24 is given to us. Gift from spouse, even this will be exempt. Gift from relative. Then gift from sister. Sister gave a painting. This painting is made by her. FMV is 45,000. Even this will be exempt. Sister will also come under relative. Come on, guys. Who is relative for the purpose of gifts? Your electric pole diagram will come to your mind. This is a diagram that will come to your mind, guys. You'll put arrows and then you will write the letter S everywhere. So the meaning of this diagram, we already spoke about this in one of the questions earlier as well. So all of these are relatives. Then father's brother, come on, if I am the assessee, my parents, brothers and sisters also we are covering. So father's brother will also be relative. Even here the gift will be exempt. He gave a gold chain. Then his cousins, his close cousins, mother's sister's son and daughter. See, if I am the assessee, my mother's brother and sister are relatives. But their children, they are not my relative. So the close cousins, first of all, they are not relatives. So they gave a car. But car, guys, this will become a personal effect. It is movable. It is used for personal purpose. It's a personal effect. It is not a capital asset. So even over here, you will not put this under IFOS. Even this will become an exempt gift. It's not a taxable gift under IFOS. Even though it is not from relatives, but it is not a capital asset. Therefore, it will not come under IFOS. From friends and other relatives, cash gift 1,51,000. This is not from relatives. This is from friends and distant relatives. It is more than 50,000 also. Cash gift. This will definitely be taxable. Alright. Then what happened? Mr. Akshay desires to set up a new manufacturing unit with his friend in partnership on 1st December 2024. So 1st December 2024, he wants to set up a partnership firm. For making investment in the firm, he sold the following jewelry, which he received on his 26th birthday celebration as gift. Mother's gifted gold chain he sold. Father's gifted gold bracelet he sold. Father's brother's gifted gold chain he sold. 3 things he sold. Listen, which 3 things he sold? He sold what his mother gave, what his father gave, and what his father's brother gave. All of these gifts, when he received, they were exempt for him under IFOS. When I received a gift, it was exempt for me under IFOS. Same thing when I sell away later. Section 49 subsection 1 will apply, because of which previous owner's cost of acquisition, cost of improvement, period of holding you will consider. Right, guys? So he is selling away these 3 capital assets. You will have capital gains. To compute capital gains, here 49 subsection 1 will apply. Previous owner's details you will take, because when I got these assets as gift, they were exempt for me. Same thing when I sell later, 49 subsection 1 will come into the picture. Okay. Let's do this computation first. So there are totally 3 assets that are being transferred. Let's take them one by one. No tension. We will first start with the gold chain. The gold chain was gifted to him by his mother. This is a capital asset transferred. Now, the usual way of thinking. What's the period of holding? Because it is 49 subsection 1, I will include even the mother's period of holding. So when did the mother purchase it? The question says she purchased it on the same day. That is on the birthday. So on 15th May 2024. And the transfer is happening on the 1st of December 2024. Same thing, guys. You'll pause over here. The transfer is after the amendment, on or after 23rd July 2024. So first of all, you will think about 50AA. 50AA will not apply to gold chain. Then how many periods of holding are possible, guys, after the amendment? Only 2, 12 and 24. Gold chain, the relevant period of holding will be 24 months. Then will you get any indexation benefit? After the amendment, no indexation benefit. So come back. Is this period more than 24 months? No, guys, it is within 24 24 months. So therefore this will be short-term capital asset. This will result into normal rate short-term capital gains. Okay. Then what else is he transferring? He's transferring a gold bracelet. Now this one was given to him by his father. So when he received it, it was exempt under IFOS. Now when he transfers it, 49 subsection 1 will apply. Even the father, even the previous owner, the father's period of holding will be considered. So father had purchased it on the same day, that is on his birthday, same 15th May 2024. All the transfers have happened on the same date, 1st December 2024. Even this is after the amendment, guys. Same 24 months is the period of holding. Even here it is not exceeding 24 months. Therefore it is short-term capital asset. Again, normal rate STCG. Alright, then what else is he transferring? The gold chain. The gold chain was gifted to him by whom? Gold chain was gifted to him by his father's brother, by his uncle. Even that gift was exempt for him. So now when he transfers, because of 49 subsection 1, you will consider the previous owner. Now see, when did his father's brother buy the gold chain? Even he purchased it on the same day. So same on the birthday itself, 15th May 2024. All the transfers happened on the same date. Even over here, the transfer has happened after the amendment. Even over here, it is the period of holding is within 24 months. Therefore, short-term capital asset, your normal rate STCG. Okay. Only these three assets he's transferring. So come on, let's do the computation now. So we have the gold chain which his mother had given him. Then we have the gold bracelet which his father has given him. And we have one more gold chain which his uncle has given him. So usual computation, guys, full value consideration. He sold for how much? Mother's chain he sold for 42,150. The gold bracelet he sold for 60,180 and another gold chain for 20,600. No expenses on transfer. This itself becomes a net consideration. Then you will subtract cost of acquisition because transfer happened after the amendment. No indexation. Also it is short-term capital asset, guys. So no indexation. We'll subtract the cost of acquisition as it is. But whose cost of acquisition will you take over here? 49 subsection 1. So previous owner's cost of acquisition you will take. So come on. The mother had purchased the gold chain for how much? She had purchased it for 37,822. Then the father had purchased the gold bracelet for 56,075 and his uncle had purchased the gold chain for 18,200. It is 49 subsection 1. So previous owner's cost of acquisition we have taken. That's all, guys. So what's your STCG now? You just have to find the difference. You'll get 4,328. You will get 4,105 and finally 2,400. This will be your STCG from these transfers. Alright, this was easy. Now come on, let's go ahead. Let's see what else has happened over here. So then after all this happened, his wife gave him 1 lakh rupees as gift. So even this 1 lakh rupees gift, even this will be exempt, guys, because his gift is from his spouse. So his wife gave him 1 lakh gift so that he could invest sufficient money in the unit. Remember, he was starting a manufacturing unit with a partnership firm. So so his wife gave him 1 lakh rupees for that, and he has changed form of that 1 lakh into investment in the manufacturing unit. Then on 1st December 2024, he invested 6 lakhs, including the amount received on the sale of the above gifts and the amount received from his wife, and his friend invested rupees 4 lakh in the firm. Alright, then what happened? On 1st February 2025, his wife again gave him 1 lakh gift. So this also will become an exempt gift for him to invest such money in the firm. And apart from that, he invested 50,000 more from his individual savings. So both of these paras, guys, are just about his wife giving him more money and he investing money in the partnership firm which he has recently joined. On this date, his friend also invested 1 lakh in the firm. Then, since the firm is a manufacturing unit and at initial stage, firm requires sufficient fund. So Mr. Akshay sold his wife's gifted gold rings for 40,250 rupees each on 31st March 25 and he deployed the funds as partner's capital in the firm on 1st April 2025. Guys, there's one more transfer. His wife had given him gold rings. Remember, 4 gold rings. His wife had given him 4 gold rings. Even this he's selling. Same thing guys, even over here 49 subsection 1. When he got the gift from his wife, it was exempt for him under IFOS. So same thing when he sells away now, even over here 49 subsection 1 you will apply. You will consider the previous owner, that is the wife's cost of acquisition, the wife's period of holding, all that you will consider. So come on, let's finish that off. All the 4 gold rings he has sold. So tell me the period of holding. You will start from the wife's period of holding. She purchased these rings on 15th May 2023. And when is he transferring? He is transferring in March 2025. So even over here, the transfer has happened after the amendment, guys. The transfer has happened on or after 23rd July 2024. And again over here, the relevant period of holding will be 24 months. And this is clearly less than 24 months. So this will also be a short-term capital asset. It will result into normal rate STCG. Okay guys, easy. One second. Then listen. So let's do the computation now. So full value consideration, 4 rings. He sold the 4 rings for 40,250 each. So the total full value consideration will be 1,61,000. No expenses on transfer. So this itself will become your net consideration. Then cost of acquisition, because of 49 subsection 1, you will take previous owner's cost of acquisition. Wife had purchased these rings for 35,500 each. So 4 into 35,500. See, to confuse you, they have given you the FMV and all. Doesn't matter. We will simply take the previous owner's cost of acquisition. So 4 into 35,500. This will be 1,42,000. So your short-term capital gains will be 19,000 over here. Now come on, are you ready for the shock of your lives? Listen to me. So on one side we have the assessee's spouse, and on the other side we have assessee. Assessee's spouse has given to the assessee some rings. In return, she got no consideration or inadequate consideration. So what is a transferred asset now? Transferred asset is rings. Whatever income the assessee earns from the transferred asset, that income will be clubbed. Whatever income the assessee earns from the transfer of transferred asset will also be clubbed, guys. So assessee is transferring the rings, assessee is transferring the transferred asset and is earning capital gains of 19,000 rupees. This capital gains of 19,000 rupees will be clubbed with the assessee's spouse. Right? Income from transferred asset, income from the transfer of transferred asset, you club both, guys. So here your assessee is transferring the transferred asset and he is earning capital gains that will be clubbed with the transferor assessee's hands. That is, it will be clubbed with the assessee spouse and it will not be assessee's capital gains. This was the interesting part over here. I mean, this point should strike us in the examination. Alright, now come on guys, have a look at the question. What is the amount of capital gains taxable in the hands of Mr. Akshay? For Mr. Akshay, only these 3 capital gains will be taxable. Right guys, this 19,000 will be taxed in spouse's hands, it will be clubbed. So total how much capital gains taxable for Mr. Akshay? This will result in 10,833. Option A. Then your second question is, what is a gift amount not considered as income? He had received multiple gifts, guys. Some of the gifts were exempt and some of the gifts were taxable. They're asking us what is a gift not considered as income under 56.210. Basically, they're asking what are your exempt gifts. Okay, so total value of exempt gifts we need. Let's see one by one. Mother had given a gift which was exempt. This was a chain. She purchased it for 37,82022. See, we need the value of the gift, the fair market value of the gift. It is exempt, but they're asking us a total exempt gift, total exempt value. So the when it comes to the gold chain, which his mother had given to him, the value of the gift was 37,822, but it was exempt. Then his father had given him a gold bracelet. So that gold bracelet, what was the value? The value was 56,075. Then his wife had given a gift, even this was exempt. All the exempt gifts we want. So here she had given 4 gold rings. Now be careful, what is the value of these 4 gold rings? 2 options you have. Either you will take the purchase price, the price at which she had purchased the rings, or you will take the FMV on the date on which she gave the gift. See, right now I want to find the value of the gift. So when she gave the gift on that day, what is the value? On that day, the value was 37,429. 37,429 into 4, this will be 1,49,716. Are you noticing when I was computing his capital gains, cost of acquisition was previous owner's cost of acquisition. So I took the cost at which the wife had purchased the gold rings. But now when I'm finding the value of the exempt gift, in IFOS, you take the fair market value of the asset, right? That's the value of your gift. That's why I'm not taking her cost. I'm taking the fair market value on the date on which she gave the gift. Okay. Then even sister's gift was exempt. So she had given a painting. The fair market value of that painting was 45,000 rupees. Then what are the other exempt gifts? Her Assessi's father's brother gave another gold chain, and the value of that gold chain was 18,200. Then his cousins had given him a car. Now this car, because it was a personal effect, that is why we had not taxed it. The value of that car was 4,10,000. Then friends gave a gift that was taxable, so that I will not take in this calculation. Apart from that, his wife gave 1 lakh rupees, 1 lakh rupees 2 times, guys. So 1 lakh and 1 lakh. That's all. So these are your total exempt gifts. So if you add up, the total will result in 9,16,813. Your total exempt gift, option C, 9,16,873. Then what is the gift amount taxable? Taxable gift, only one taxable gift he had, right? This 1,51,000 which he got from his friends. So 1,51,000, option A. Then they're asking you, is any amount taxable in the hands of Akshay's wife in respect of sale of jewelry by Mr. Akshay? If yes, what shall be the taxable amount in her hands? He had sold the rings, right, that his wife had given him. And for that, we had discussed that 19,000 capital gains will be clubbed with wife's income. So 19,000 would be the capital gain that will be clubbed. So option C. Understanding? So this was your question number 35. It was like a nice combination of IFOS, capital gains and clubbing. Alright. And in fact, they could have complicated it a little more. See, the wife is giving the assessee money, right? And the assessee is putting that money into a partnership firm as his investment. So the transferred asset is money which is changing form into investment in partnership firm. So from the partnership firm, whatever interest on capital the assessee earns, even on that interest, clubbing provisions will apply. So that also they could have, put in this question to complicate it, but that adjustment we did not find. So one more clubbing adjustment was possible over here from the point of view of interest from the partnership firm. Understanding? Assessee is giving money to the the spouse is giving, wife is giving money to the assessee. So transferred asset is money. The transferred asset is changing form into investment in partnership firm. So from that investment, proportionate, whatever interest on capital he gets, that will also get clubbed with the wife's income. So that also they could have asked. That same concept, guys, we had a question even sometime back, right? The numerator, denominator and all, we take PGBP into investment out of transferred asset divided by total investment. We did a question with this even some time back. The numerator and denominator both will be on the 1st of April of the previous year. But however, when you do the investment, when you start the business, only in between the year, then you will take the date of commencement of business instead. So same concept will apply even on interest on capital. So by doing this proportionate calculation, whatever interest on capital you get the net number, that much will be clubbed with the wife's income. Only the balance interest on capital, on the balance only assessee has to pay tax. So that same concept will apply even over here had they given you interest on capital from the firm, but all that information was not given, so we escaped. Alright, now come to question number 36, guys. Another question with respect to clubbing. So the question says, Mr. Rajesh gifted 15 lakhs to his wife Ravi on her birthday on 23rd February 2024. So this gifting happened long back. It happened in previous year 23-24, not in my current year. Ravi lent 6 lakhs out of the gifted amount to Karuna on 1st April 24. Come on, guys. So we have Mr. Rajesh on one side and we have his wife Ravi on the other side. He gave Ravi 15 lakh rupees. So what is the transferred asset, guys? The transferred asset is 15 lakh rupees. Ravi lent 6 lakhs out of the gifted amount to Karuna. So she gave a loan a loan of 6 lakh rupees to Karuna. So can I say that the transferred asset of 15 lakhs, out of this 6 lakhs has changed form into loan to Karuna? Okay, she gave this loan when on the 1st of April 24, and she gave this loan for 6 months, and she got interest of 30,000 rupees from Karuna. So interest income 60,000 rupees. So first of all, tell me step by step, this 60,000 rupees, who will pay tax on the 60,000 rupees, guys? Will Ravi pay tax or will Rajesh pay tax? Come on, it is transferred asset. Transferred asset changed form into loan to Karuna. So from Karuna, whatever interest income Ravi earns, this interest income becomes income from transferred asset in same form or different form. So this will be clubbed with Rajesh's income. Rajesh will have to pay tax on the 60,000. Then what happened? Not 60,000, sorry. The interest is 30,000. Interest of 30,000. Okay, then what happened? The said sum of 30,000 was invested in shares of a listed company on 18th October 24, which were sold for 66,000 on 25th March 2025. STT was paid on purchase and sale of the shares. So let's do capital gains computation now. So we usual steps, guys. First of all, capital asset transferred. Who is transferring over here? See, the question says Ravi got 30,000 interest, right? That 30,000 interest she put in the shares of a listed company. So what is she transferring now? She's transferring listed shares. Period of holding. When did she buy these shares? She purchased these shares on 18th October 2024. She sold these shares on 25th March 2025. The transfer is clearly after the amendment. The transfer is on or after 23rd July 2024. So therefore 50AA will not apply to listed shares. Then period of holding, you will have 12 and 24. Listed shares, 12 will be your period of holding, and because the transfer happened after amendment, no indexation. So 12 months, guys. This is clearly within 12 months. So therefore it will be short term capital asset. Will 111A apply or will it be normal rate STCG? Question says STT was paid, guys, on purchase and transfer. So section 111A will apply. Section 111A just says you must pay STT at the time of transfer. Whether you pay at the time of purchase or not doesn't matter. It is 112A only which says that you must pay STT both at the time of purchase and transfer. Okay. Anyways, coming back now, full value consideration. She sold for how much? She sold for 66,000. There's no expenses on transfer. This itself becomes net consideration. Less cost of acquisition. Will you apply the grandfather clause that 31st Jan 2018, all that? No. All that you do only in 112A. This is 111A. And no indexation also. It is short-term capital asset. So I'll take the cost of acquisition as it is. What is the cost of acquisition? How much did she invest in the shares? The same 30,000 rupees. So her STCG is 36,000 rupees, guys. Now I want you to tell me, will this 36,000 be clubbed with Rajesh's income? See, no confusion, okay. What do you club? You club income from transferred asset. You also club income from the transfer of transferred asset. That's all. You club income from transferred asset. It can be in same form or it can be in different form. And you club income from transfer of transferred asset. Here, this capital gains is from shares. You tell me, guys, the transferred asset was 15 lakh money, which changed form into 6 lakhs loan to Karuna. So this is your transferred asset in different form. So from this, whatever income Ravi gets, that will be clubbed. Is this 36,000 income from loan to Karuna? No. From loan to Karuna, the income was 30,000 interest that we clubbed. This 36,000 income is from this 30,000 interest, guys. This 36,000 is from transfer of listed shares. These listed shares we purchased using the interest income. So is this 36,000 in any way connected to the transferred asset? No, it is not income from transferred asset. Is it income from this 15 lakhs? No. Is it income from Karuna? No. So therefore, it is not income from transferred asset. Also, it is not from transfer of transferred asset. So therefore, it will not be clubbed. Who will have to pay tax on this capital gains? Ravi herself will have to pay tax on this capital gains. In fact, we often call these kind of incomes as income from income. She had 30,000 rupees income from the transferred asset. This we are clubbing. From this income, she is earning more income of 36,000. This becomes income from income, second level income, guys. Therefore, it will not be clubbed. Okay. So don't mug up. Like in the last question, we clubbed capital gains. Doesn't mean every time we will club capital gains. In the last question, why did we club capital gains, guys? Because assessee's spouse had given rings to the assessee. The transferred asset was rings. So income from transfer of transferred asset. Assessee had transferred the rings. No, assessee had transferred the transferred asset. So when you transfer the transferred asset, whatever capital gains you get, that you will club. But here, is she transferring the transferred asset? Is listed shares a transferred asset? No. So therefore, there will be no clubbing. On the capital gains, Ravi herself will pay tax. Okay. Then what happened? The balance amount of the gift. Which balance gift? Rajesh had given 15 lakhs gift. No, only 6 lakhs they had given us information. So what is the balance gift now? Your balance gift will be 9 lakhs. They're giving us information about that now. This was invested on 1st April 24 as capital by Ravi in her new business. She suffered loss of 22,000 in the business in financial year 24-25. So this 9 lakhs she has invested in her business. So 9 lakhs has changed form into investment in business, and from this business she has a loss. She has a loss of 22,000 loss. Okay. See, when did she invest the money in the business? On 1st April 2024. Now everybody pay attention. I'll do the calculation for you over here. See, whenever the transferred asset is invested into business, or remember, even over here I had written about that interest on capital for you. So whenever the transferred asset is invested into business, or whenever the transferred asset is invested into a partnership firm or into an LLP as capital contribution, then how much will be clubbed? You have a formula. You will see the PGBP into investment out of transferred asset divided by total investment. Now, the numerator and denominator will be on the 1st April of the previous year. But if you commence a business in between the year, the numerator and denominator will be on the date of commencement. Here, if you see, the question says, balance amount of gift was invested on 1st April 24 as capital by Ravi in her new business. They haven't told us what is the date of commencement. But then the investment happened on 1st April 24 itself, guys. So, 1st April of the previous year itself. So, therefore, I'll take it as it is. What is the PGBP from this business? You have a negative 22,000 into what is the investment out of transferred asset? 9 lakhs is the investment out of transferred asset. And have they mentioned that she has put her extra money also? No, total investment is 9 lakh only. So what's the net number now? Negative 22,000. So this becomes income or loss from the transferred asset. So the transferred asset was 9 lakh rupees cash, which changed form into investment in business. So whatever income you earn from the transferred asset in same form or different form, you will club. So this 22,000 becomes income from transferred asset or loss from transferred asset. Whenever you club income, you will also club losses. So this 22,000 loss will be clubbed with Rajesh's income. It will be clubbed. Understanding? Yes, guys, are you getting this point? Yes, so from the transferred asset, whatever income or loss you have, you will club. From 9 lakhs, you're having a loss of 22,000, it will be clubbed. Just like how you apply clubbing provisions to income, you will also apply clubbing provisions to losses. Okay. Then what happened after this? Ravi is working with a private company as sales executive and her salary is 62,000 per month. She paid 3,500 per month towards tuition fees for her daughter Ria studying in St. Thomas School, Mumbai. Tuition fees, guys, you will get section 80C deduction under the normal regime, maximum for 2 children only. The education has to be in India. It can be school education, college education, doesn't matter. And she's getting salary 62,000 per month. Then Rajesh is working with an MNC on a monthly salary of 64,000. He has gifted 1,25,000 to Ria on her 13th birthday. So daughter is minor daughter. This amount is deposited as 2 years term deposit with SBI Bank in her name, on which interest of 11,500 is earned during the previous year. So Ravi is also having salary income and Rajesh is also having salary income. Rajesh has given a gift to his minor daughter. Minor daughter has put that money into a term deposit, into a 2-year FD, from which she is having FD interest, which of course will get clubbed. Okay. Then both Mr. Rajesh and Mrs. Ravi want to pay tax under the default tax regime. So as per 115 BAC. So come on everybody. Let's do some computation now. We have 2 people in the story. We have Rajesh and we have Ravi. Let's compute their incomes first. See, what are the incomes one by one? The first income, Ravi lent 6 lakhs to Karuna. First income was, she had interest income of 30,000. That interest income from Karuna 30,000. We will club. We already discussed it. We already concluded it that the interest income of 30,000 will be clubbed. Then any other income she's having, guys, that 30,000, that same 30,000 interest income she put in shares and she sold the shares. So from the sale of shares, she had capital gains of 36,000. This we said we will not club. Ravi herself will pay tax. So we have STCG, 111A STCG, we have 36,000. On this, Ravi herself will pay tax. Any other income, guys? Apart from this, she's having a loss of 22,000. This loss of 22,000 came from the 9 lakh investment in business. This loss of 22,000 came from transferred asset 9 lakhs. So this also we concluded will be clubbed with Rajesh. So it's a loss. Losses we put in the margin. So for Rajesh, you have a business loss of 22,000. Simple. Then after this, what else? What are the other incomes? Ravi is having salary income. Let's finish that off now. Salary income for Ravi, how will you compute? Be careful. 62,000 per month, guys. So 62,000 into 12. And how much standard deduction will you give? Default regime. So 75,000 standard deduction. So this will be 6 lakhs 69,000 for Ravi. Then even Rajesh is earning salary income 64,000. So 64,000 into 12. He is also following the default regime. So he will also get 75,000 standard deduction. So this will be 6 lakhs 93,000. Okay. The only other income that we are left with is the minor child's interest income of 11,500. Rajesh had gifted 1,25,000 to his daughter, and that money was invested into FD, from which she got FD interest. Now this FD interest will be clubbed with whose income? Tell me. I've taught you about this. The first question we did in this session, guys, the first question there itself we had seen this point. Just because Rajesh has transferred money to his minor child, for that reason alone, will you club this with Rajesh's income? No. When it comes to minor child's income, there are only 2-3 provisions, guys. The minor child's income, if it is because of skill, talent, labor, you will not club. If the minor child is disabled, you will not club. Here, neither of those two cases. So which means you will club. You will club with which parent? With that parent who has higher income. That is our provision, right, guys? So here, just because Rajesh has transferred the money to daughter, doesn't mean because of that reason you should club with Rajesh's income only. There's no such reason. We will see which parent's income is higher. Whichever parent's income is higher, that is where we will club. Alright, guys. So we have loss of 22,000. I'll adjust this loss. See, this loss of 22,000, I can't adjust against salary income, but I can adjust against this interest income. So against the interest, I'll adjust the business loss of 22,000. So the net interest income will be 8,000. So now if you see, 7,01,000 is Rajesh's income and 7,05,000 is Ravi's income. So whose income is higher, guys? Ravi's income is higher. So this is where the minor's income will get clubbed. Are you noticing? You should not think that just because Rajesh transferred it to the minor, the income will be clubbed with Rajesh's income. No. Doesn't matter which parent has transferred the asset to minor. Minor's income will always be clubbed with mother or father, whoever's income is higher. Okay. Here Ravi's income is higher. So you will club this 11,500 interest over here. I would have given 1,500 exemption, section 1032, if it was normal regime. This is default regime. Therefore, I will not give that interest. I will not give that 1,500 exemption also. That's all, guys. So Rajesh, if you see, his total income is 7,01,000 and Ravi's total income will be 7,16,500. Alright. Now come on, let's come to the questions one by one. See, are you noticing when it comes to case-based MCQs and all? I read the question and then I straight away start solving the question like it's a full-fledged total income question, because somewhere or the other the adjustments will get covered. So the first question is, in whose hands the interest income received from Karuna and interest on FD in the name of Riya would be included. So Karuna's interest income is taxed in Rajesh's hands and the FD interest is taxed in Ravi's hands. So let's see the options. Both interest income to be included in Rajesh's hands? No. Both to be included in Ravi's hands? No. Interest income from Karuna to be included in Mrs. Ravi's hands? No, guys. Interest income from Karuna is with Rajesh's income. Interest income from Karuna is to be included in the hands of Mr. Rajesh, and interest on 2 years term deposit is to be included in the hands of Mrs. Ravi. Yes, option D. Alright, so this was your first question. Then they're asking you in whose hands loss from business and capital gains would be included in the assessment year. Loss from business you put in whose hands? In Rajesh's hands. But what about the capital gains of 36,000? That was in Ravi's income only. So both loss and capital gains in the hands of Mr. Rajesh? No. Both loss and capital gains in the hands of Mrs. Ravi? No. Loss from business included in the hands of Mr. Rajesh and capital gains included in the hands of Mrs. Ravi? Yes. Option C. So, loss to be clubbed with Mr. Rajesh and capital gains Ravi's income. Then what would be the total income of Mrs. Ravi? Total income of Ravi we have already computed, 7,16,500, option A. And then what would be the total income of Mr. Rajesh? Mr. Rajesh's total income is 7,01,000, option C. Got it, everybody? Yes. So this was another clubbing question. 2 clubbing questions we have done back to back, the last one and this one. So I'm hoping you're getting a little comfort. I think almost the entire clubbing chapter we have covered except one adjustment, which also will come in one of the upcoming questions. Alright, come on everybody. Let's go forward. Let's go to the next question now. Let's come to question number 37. This is from your IFHP head. So let's read the question. The question says Miss Hethel transferred to her husband Mr. Hemant a residential property worth 45 lakhs in Nagpur without any consideration. So this is a Nagpur property, guys. Assessee has transferred it to her husband for no consideration or inadequate consideration. Even though legally she is not the owner anymore, even though legally Hemant is the owner, but assessee has transferred a house to spouse for no consideration or inadequate consideration, deemed owner concept will apply, because of which even though Miss Hethel is actually not the owner of the property anymore, she will be deemed to be the owner, guys. Right? And hence all the computation will be in her hands only. So I will basically no change. I will treat as if she only is the owner. The expected rent of the property is 5 lakhs. So expected rent of the Nagpur property, 5 lakhs. Then what happened? Municipal tax of 5,000 paid by Miss Hethel for this property during the year. So municipal tax for this property is 5,000. Has she paid the money? Yes, the question says she has paid it. Then, Miss Hethel has 3 residential properties in Mumbai. So, Mumbai 1, Mumbai 2 and Mumbai 3. The expected rent from the 3 properties situated in Mumbai is 10 lakhs, 11 lakhs and 12 lakhs respectively. 10 lakhs, 11 lakhs and 12 lakhs. This is the expected rent from your Mumbai properties. She purchased the properties out of her own funds. Municipal tax is due 15,000, 20,000 and 25,000. The same, however, have not been paid this year in respect of these 3 properties. So for these 3 properties, no municipal tax has been paid. Alright, so now see, they're asking you to compute IFHP. 4 houses, guys, are they self-occupied or are they let out? See, had they been let out, they would have given us actual rent. But have they given us the actual rent? No. Only expected rent they have given to us. So which means all the 4 are going to be self-occupied property, guys. So if there are 4 self-occupied properties, only 2 of them you can have nil NAV. Only 2 of them you can treat as self-occupied. The remaining 2, even though they are self-occupied, they have to be deemed to be let out. So this is what we'll have to find first, that which property will be self-occupied and which property will be deemed to be let out. So come on guys, let's begin. If they are self-occupied, what will be the numbers? So we have a Nagpur house, we have Mumbai house, we have Mumbai house 2 and we have Mumbai house 3. Self-occupied property NAV will be 0. Then only one deduction we will allow under section 24, which is interest deduction. Question doesn't talk about interest, guys. So your answer will be 0 only over here. Self-occupied properties, answer will be 0 only. Then coming to my let out property, deemed to be let out property. Actually it is self-occupied, but we will treat as if it is deemed to be let out. So we have 4 properties, Nagpur and the 3 Mumbai properties. Deemed to be let out property, we will start with our GAV computation. Now you know very well, if it is a deemed to be let out property, your expected rent will be your GAV. You will stop with step 2. You will stop with expected rent. And expected rent numbers are given to us. 5 lakh, 10 lakh, 11 lakh and 12 lakhs. Okay. Then from this we subtract municipal taxes paid. We have paid municipal tax only for one house, only for the Nagpur house. So with this, we will have our NAV. So 4,95,000 for the Nagpur house, 10 lakh, 11 lakh and 12 lakh as it is for the other houses. Then we'll subtract our deductions under section 24. Standard deduction 30%, 4,95,000 into 30%, 1,48,500, 3 lakh, 3,30,000 and 3,60,000. And interest, we don't have any interest in this question, so therefore your net IFHP will be 3,46,500, 7 lakhs, 7,70,000 and 8,40,000. Alright everybody, now see. Self-occupied property, does it matter to you which of them is self-occupied? Two can be self-occupied. Everywhere the number is the same, 0 only. So you're indifferent which of the two is self-occupied. But deemed to be let out, each property is having a different number. You will obviously choose that combination which gives you the least IFHP. So therefore, where am I having the least number in deemed to be let out? 346,500 Nagpur house, 7 lakhs for the Mumbai house. So conclusion, I am going to take my Nagpur house and Mumbai house 1 as deemed to be let out, these two. Mumbai house 2 and Mumbai house 3, these will be your self-occupied property. So when I do this, okay, my Nagpur house I'm going to treat as deemed to be let out. Mumbai house I'm going to treat as deemed to be let out. But Mumbai, the remaining two houses I'm going to treat as self-occupied. Self-occupied, my answer will be 0. Nagpur deemed to be let out 346,500. Mumbai deemed to be let out 7 lakhs. So my total IFHP will be 10,46,500. This will be your least combination possible, your IFHP number. Now listen to me. You have done these kind of questions even in the past, guys. Your ICAI study material already has a question. I think Mr. Ganesh, that question, wherein you have multiple self-occupied houses. So only 2 of them self-occupied, balance deemed to be let out. In those questions, what do? You have 4 houses, so you will have 4 options. So each of the 4 options you will calculate and see what is the IFHP, and out of the 4 you will pick whichever is the least, right? We do that in all those questions which you have done in the past, because in all those questions, if you see, you will have some number over here for self-occupied property. It will not be all 0, 0, 0. It will not be like that. You will have some number over here. So therefore, you'll have to see which combination is giving you the least IFHP. But do you remember something very similar we did even in this session sometime back, guys? Even over there, same way we had done like what I did for you now. The reason why we don't have to do 4 options and then pick the least in these kind of questions is because here my self-occupied property, the number is 0 only. So therefore, no point wasting time doing 4 options and picking the least number. We can straight away pick the least number right by looking at the deemed to be let out numbers itself, because self-occupied is anyway 0. So that's going to be indifferent for me. My decision making criteria will be the deemed to be let out numbers, right? See, if over here for self-occupied property, even over here if you have numbers, then can you simply pick the 2 with the least IFHP numbers over here as deemed to be let out? No. In that case, you have to see various options. There are 4 houses, so there will be 4 options. You have to see in which option IFHP is the least. That option is what you will pick. Like for example, option 1. In option 1, let's say house 1 and house 2 is self-occupied and house 2 and house 3 is deemed to be let out. So you will find in this option what's the total IFHP. Then you will take one more option. Let's say house 1 and house 3 are self-occupied, and let's say house 2 and house 4 are deemed to be let out. So in this option, what will be the total IFHP? Like this, you will find the IFHP for all the 4 options and you will find the least IFHP. That is what you will do if you had numbers even over here. But in this question, my self-occupied numbers are 0 only, guys. So my decision making criteria is deemed to be let out only. So here, wherever I am having the least numbers, I am picking them as deemed to be let out and the remaining 2 as self-occupied. Understanding? If you think you need practice on these options, calculation and all, for this you can see your ICAI study material itself. If you've attended my regular batch or my workout batch, we've already done that kind of question in class as itself. If you've not attended any of my batches, you will find a very similar question even in your study material, wherein SSC has 3 houses, so 2 houses self-occupied, 1 of them deemed to be let out. We'll do 3 options. Which option is having the least number? That is what we will suggest. So all that, those questions are existing questions. They are not new new questions. So this way of thinking, I thought I'll show you once, okay? Because it's a kind of a shortcut, right? Self-occupied numbers are 0. So this is not even my decision-making criteria. My decision-making criteria are these deemed to be let out numbers. Wherever I have least numbers, those properties I will pick as deemed to be let out. The others will become self-occupied. Alright, so this was your question number 37. Now come to question number 38. This is a question relating to your residential status chapter, guys. So the question says, Mr. Zuccaro owns a manufacturing unit in Singapore. So his business is based out of Singapore. He basically comes to India for procurement of raw material. He has appointed Mr. Manish as a dependent agent. See, if the agent can be of two types. Agent can either be an independent agent or agent can be a non-independent agent, guys. Independent agent means you are an agent of multiple principles. Not independent agent means you have only one single principle only. If the agent is an independent agent, then he is not a business connection. But if your agent is not an independent agent, then he is a business connection. So here your assessee is having Mr. Manish, dependent agent. Dependent agent means what? Not an independent agent. So Mr. Manish will become a business connection in India. So whatever income the assessee earns through Mr. Manish in India, whatever income your assessee earns through business connection in India, that income will be deemed to accrue in India. Okay. So what does Mr. Manish do? He procures raw materials from India and then exports it to Singapore to his manufacturing unit and sells a finished product over there. So the only work is buying material from India and exporting, buying, exporting, buying, exporting. There is no processing happening over here. There is no manufacturing happening over here. So whatever income you earn from this activity of buying raw material from India and exporting it, the income will be deemed to accrue outside India, guys. Yes, see, there are multiple points for us to, observe in this first para itself. Point number 1, the agent, Mr. Manish, is a dependent agent, which means he's a business connection. Had he been an independent agent, he would not be a business connection. So because he is a business connection, whatever income we earn from Mr. Manish is accruing in India. But however, there are some exceptions, no? Some 3-4 exceptions you have. Like, for example, you're just coming to India, collecting and transmitting news. Income is not deemed to accrue in India. Then just displaying diamonds. Income is not accruing in India. Then just coming to India, purchasing raw materials and exporting them outside India. No manufacturing activity is happening. These kind of incomes are deemed to accrue outside India. Not in India, outside India. Okay. Then income of 8,75,000 was received in Singapore out of this activity. So the income is 8,75,000. It is accruing outside India. It is received also outside India. So this 8,75,000 income will become foreign income, guys. Okay, then what happened? Mr. Zuccaro had also purchased an agricultural land in India and leased it out to a tenant. The tenant shares a portion of his agricultural income with Mr. Zuccaro as a consideration for rent of the land every year. So my assessee is having rental income. This rental income is from an agricultural land. The agricultural land is in India and the tenant is using the land for agricultural purposes. Guys, all the points in your equation are getting ticked over here. Assessee is having rental income. It is from an agricultural land in India which is being used for agricultural purposes. So therefore this rental income will be agricultural income and it will be exempt under section 10(1). Whether this rent happens to be in cash, in money, whether this rent happens to be in kind doesn't matter. This will be agricultural income and it will be exempt. So this full 6,50,000 will be agricultural income and exempt. Now what are they asking us? 2 questions, guys. If Mr. Zuccaro is a non-resident in India, would income of 8,75,000 earned through the activity of procuring raw material for manufacturing unit in Singapore, will it be taxable or not? Assessee is a non-resident, guys. So therefore only Indian incomes will be taxable for your assessee. But however, this 8,75,000 we concluded it is a foreign income. It is accruing outside India, received also outside India. So will it be taxable for your non-resident, Mr. Zuccaro? No. So either option B or option D. So option B says it is confined to purchase of goods in India for further export and hence not an income deemed to accrue in India. Option B. So remember your exclusions. Income confined to buying raw materials from India and exporting. No processing, no manufacturing. That income is not deemed to accrue in India. Then income from collecting and transmitting news and views from India. not deemed to accrue in India. Then just displaying diamonds, just displaying uncut diamonds, even this income is not deemed to accrue in India. And lastly, you have learned one more exemption. A person comes to India, just shoots a movie and goes back, shooting a cinematographic film in India. There you have some conditions that if it's a company, not even one shareholder should be an Indian resident or an Indian citizen, all that. So if those conditions are fulfilled, then these are all exclusions. These incomes are not deemed to accrue in India. So the answer is option B over here. He's a non-resident, only Indian income will be taxable for him. This is a foreign income, it will not be taxable for him. Then the question is asking us, income earned from agricultural land given on lease is taxable in the hands of Mr. Zucaro? No, it is exempt. It is exempt agricultural income we discussed. So option A, no, such income is exempt since it is agricultural income. Rental income plus agricultural land plus in India plus used for agricultural purposes will be fully exempt. Alright guys, so this was your question number 38 from residential status. Now come on everybody, one last MCQ, question number 39, a nice revision of section 80 JJAA you will get through this question. So the question says Messrs. Abhinav and Sons opted out of the default tax regime. So which means assessee is following which regime now? Assessee is following the normal regime. It has employed total 150 employees in 23-24. Not 24-25. Last year guys, 23-24 they have given information we had 150 employees with an annual increment of 10% in their monthly salary. So last year whatever salary they were getting, current year they will get 10% more. Details of the same are given to you. So this is your previous year 23-24's details guys. 23-24, 150 new employees he had. Those employees, he has the question has given you information and this was their salary last year. Current year they will get 10% increment from this. Then it has employed further 50 employees during 24-25. So last year 150 new employees, current year 50 new employees. And the details of new 50 employees of the current year also they have given to us over here in this table. So this is the information for my current year, previous year 24-25. Okay. Emoluments to all the employees are being paid by account paycheck only. No employees have left the job, so all the employees are continuing. Compute 80 JJAA deduction. Come on guys, I hope you're ready for some light bulb moments over here. See, listen to me. If you want deduction under 80 JJAA, you have to fulfill some conditions guys. See, first of all, it's a chapter 6A. Part C section. So because it's a chapter 6A part C section, only if you file your ITR on time, only then you will get this deduction, otherwise no deduction. Then this is one of those sections which you can enjoy both under the normal regime also, under the default regime also, under both the regimes you can get this deduction. Okay guys, now listen very carefully. See, under 80 JJAA, some conditions have to be fulfilled. Condition number 1, assessee must be having PGBP and for that assessee 44AB tax audit should be applicable. Then condition number 2, assessee must be having additional employees. To these additional employees, whatever salary we are paying, whatever additional employee cost we have, the salary only we talk about under 80 JJAA. Then condition number 3, the salary we should be paying to these additional employees only in specified mode. See, in chapter 6A, wherever we talk about mode of payment like 80D, 80 GGB, 80 GGC and all, we say non-cash mode. But 80 JJAA, we say specified mode. Then condition number 4, how much salary are you paying them? Salary should be within 25,000 rupees per month. Then condition number 5, these employees should not be casual employees. That means they must be participating in RPF. And condition number 6, they must work for us for at least 240 days in the year. But however, in case our assessee is, in the apparel sector. See, apparel sector is not the same as textile sector. Apparel sector is your ready-made garment sector, or if the assessee is in your leather sector, or if the assessee is in a footwear sector. In these businesses, then it is enough if the employee has worked for us for at least 150 days. So only if all these conditions are fulfilled, only then to these additional employees we'll see how much salary we are giving. That salary into 30% will become your 80 JJAA deduction. Till here everybody knows. But that small tiny point which gets hidden in the middle of all this discussion is that this 30% deduction you get for 3 years. So 30% in year 1, 30% in year 2 and 30% in year 3. So total this section gives you 90% benefit guys spread across 3 years. This point right now you will not understand the significance. Only when I work the question out for you, you will understand. That's why be ready for one light bulb moment over here. Let's talk about previous year 23-24 first. Now in previous year 23-24, employees joined on 1st May 2023. So definitely in 23-24 they have worked for at least 240 days, guys. Then they're regular employees, they're not casual employees, so they're participating in RPF. But salary is 26,500, guys. Salary is more than 25,000, which means first category not eligible for 80JJAA. Then comes second category, they're casual employees, so which means they will not participate in RPF, not eligible for 80JJAA. Then third category, 1st July 23. So in 23-24, definitely they have worked for at least 240 days. Then regular employees, so they are participating in RPF. Salary also, if you see, is within 25,000, guys. And let's say my assessee is having 44 AB tax audit. Let's assume this condition is fulfilled. Yes, they are additional employees. They are new 150 employees. They are additional employees. And yes, we are paying them salary in specified mode account pay check. And yes, their salary is within 25,000 per month. It's only 22,500 per month. Yes, participating in RPF. Yes, they have worked for at least 240 days. All my conditions are fulfilled. So in 23-24, guys, what is your 80JJAA deduction now? Total how many employees? Careful. 35 employees. To each employee, how much salary are you paying? 22,500 you are paying. Then for how many months? July onwards. So July, August, September, October, November, December, Jan, Feb, March. So 9 months. This into 30%, guys. This will be your 80JJAA deduction. How much does this work out to? This will be 35 into 22,500 into 9 into 30%. This will be 21,26,250. Now the point is, this 30% you will not get only in 23-24, guys. You will not only get this, listen to me, in 23-24, you will also get this deduction in 24-25. You will also get this deduction in 25-26. Understanding? The same amount in 25-26 also. So how much is the amount? The amount is 21,26,250. The same amount will be your deduction across 3 years. Okay. So total how much deduction are you actually ending up enjoying? 90%. Alright. Then let's talk about 24-25. So when I talk about previous year 24-25, see how many employees are we having? 50 new employees we are having. 20 of them joined on 1st April 24. Definitely at least 240 days. They're regular employees, so they're participating in RPF. Salary also is within 25,000, guys. All my conditions are fulfilled. I will be eligible for 80JJAA with respect to these employees. But the second category, salary is 26,000, more than 25,000, guys. So the second category will not be eligible for 80JJAA. So 24-25, how many additional employees I'm having? 20 additional employees. I am paying them 21,000 per month. For how many months? From 1st April they joined us. So all 12 months into 30%. So how much will this work out to? This will work out to 15,12,000. Now this 15,12,000 I will get as a deduction not only in 24-25. For total 3 years I will get this deduction. Which means 15,12,000 I'll get in 24-25. I'll also get in 25-26. I'll also get in 26-27. Okay, so now tell me, in my current year in 24-25, total, what's my total 80JJAA deduction? My total 80JJAA deduction will be 36,38,250. This will become your total 80JJAA deduction for the current year. Then you will wonder, ma'am, what about the 10% increment? Doesn't matter. Whatever is the amount that you calculated for 23-24, no, that same amount only you will get across 3 years. So basically now in 24-25, I will only calculate my current year number. This last year's number will be copy paste only. I won't do computation over here again. This number won't change. Okay, so even though the salary is increasing, it's okay. You will not again and again change this number. This number will stay the same only, same copy paste only across 3 years. Alright, getting it. Now you will ask me a question that, ma'am, why haven't we done like this in any other question in the past? We have questions in our ICAI study material. We have so many previous year question papers and RTP and MTP questions relating to 80JJAA. Why haven't we done like this in any other question in the past? Because if you see, guys, in all the other 80JJAA questions, either they will mention that this is a first year, or they will mention ignore 80JJAA of the last years. You go and see. One out of these two you will find. So if it is the first year, do I have any calculation of the last year which is being copied and pasted? No. Or in the question itself they will say ignore the deduction which is relating to the earlier years. So that is why in all the questions which you would have worked out, all the other ICAI questions which you would have worked out, you would have not done like this. But this question I found, guys, in your case-based MCQs, and I really wanted to do this question for you. This would have been one nice light bulb moment for you. I hope you've understood this and grasped this point. Okay, so total in 80 JJAA, you don't get only 30%. 30 you get across 3 years. Total 90% you get actually. Alright, so this was your question number 39. Alright, so now we're going to start the third part of this marathon, guys. In this third part, some other adjustments. Let's say the whole question was fine, but only one specific adjustment was interesting over here. So these kind of new and challenging adjustments I've compiled together, and I've made 3 new questions with these weird adjustments. Alright, these 3 questions we're going to take up one by one. Okay, come to question number 40. So these are like your compilation of weird adjustments. Look at this. The first question, Mr. Gupta, a resident individual aged 65 years. So what would you like to conclude over here? That Mr. Gupta, you are a senior citizen. He earned pension, computed pension of 7,50,000 during 24-25. Okay, so he has computed pension. Now because they are using the word computed, it will indicate all computations, all deductions, all exemptions, all calculations already done. I just have to take this number and put this number. So 7,50,000. Easy breezy. And by the way, which regime are we following? Compute total income of the assessee under the normal regime. Okay. Then what else happened? He was also carrying on a manufacturing business in an SEZ. So immediately what comes to your mind? Immediately 10AA will come to your mind. But I always tell you 2 things should come to your mind. Number 1, whatever income you have from this business, it should go into PGBP head also. Then only you will think about 10AA. Okay. He began manufacturing. So he's manufacturing. So therefore even additional depreciation will come to your mind. Okay. He began manufacturing in April 2020. Net profit of the business was 50 lakh rupees. 10AA will come to it later. Let's finish off PGBP first. So PGBP, I'll give reference to working note number 1. So my working note number 1 is PGBP. Net profit of the business was 50 lakhs. They have given me the net profit number 50 lakhs. So therefore I will use the indirect method to compute my PGBP. That is, I will use my 5 steps. So I will add expenses which are debited but not allowed. Then I will add incomes not credited but taxable. Then I will subtract expenses not debited but allowed, and finally I will subtract incomes credited but not taxable. Okay, come on, let's begin. 10AA is still pending, we'll come to it later. So he's carrying on a manufacturing business. Net profit is 50 lakhs. Export turnover is 120 lakhs. Total turnover is 350 lakhs. Additional information, not debited or credited, additional information. Industrial power tariff concession of 2,50,000 received from the central government. In the PGBP head, this is your business income. You're getting a concession, a power tariff concession. It's like a subsidy or a grant. Very broadly, if you want to say, you can say it's something like a subsidy or a grant relating to your business. Under PGBP, it should be taxed. And they are saying it is not debited, not credited. So I will now credit it. I will now tax it. So it's an income not credited but taxable under this industrial power tariff concession, 2,50,000. I will now credit it. I will now tax it. Easy. Then expenditure pertaining to previous financial year. So expenditure relating to the last year was allowed on due basis in that last year, but paid in the current financial year in cash on 18th Jan 25, 35,000. Now listen to me. 2 formula I have taught you. Let me give you a revision. Formula number 1. Assessee has incurred expense in the previous year. Plus, assessee is making the payment of this expense also in the same previous year. Plus, it is more than 10,000. Plus, it is in non-specified mode. So how many points in my equation? 4 points. Expense in the previous year, payment is also in the same previous year, more than 10,000, and it is in non-specified mode. If all these conditions are fulfilled, then under section 40A subsection 3, you will disallow the expense fully, guys. Okay. Then one more equation I have taught you, if you remember, in that second equation, expense is incurred in some preceding previous year, some earlier year. Payment is made in the previous year, more than 10,000 in non-specified mode. In that case, not 40A subsection 3, guys. Under 40A 3A, it will be deemed income. Remember. Here, if you see the amount, see, first of all, why am I even thinking about all this? Because they are saying mode of payment is cash. Here, 3 golden rules of PGBP. When they talk about mode of payment, immediately 40A subsection 3 is what comes to my mind. So 40A 3 or 40A 3A will come to my mind. 40A 3 will come to my mind if same year only is involved. Here, if you see, the expense belongs to earlier year, but payment is made now in the current year. So 2 different years are involved. So yes, it is expense belonging to preceding previous year 23-24. Yes, payment is made in the current year 24-25. Yes, it is more than 10,000. And yes, it is in non-specified mode gone. Under 48.3, it will be deemed to be income. Deemed income means what? I will treat it as if it is income. So therefore, under section 40A 3A, this amount of 35,000 will be added. See, listen. Is it an expense? Am I disallowing it as an expense? No, I am taxing it as an income. So it's going to be deemed to be income under 40A 3A. Okay, if you remember your equations, then you will never go wrong in identifying which section. Okay, so don't skip your steps. Then comes your third adjustment. Audit fees for the previous year 23-24 is 75,000. TDS deducted but not deposited in the relevant previous year. However, TDS was deposited on 31st December 24. Again, a golden rule relating to PGBP, guys. Whenever in PGBP they talk about TDS deducted, not deducted, what do you talk about? You talk about 40A1 and 40A1A. These sections come to your mind. And remember, 3, 2, 1, this is a song that you will sing. No, come on. This audit fees belongs to 23-24. It belongs to last year, not current year. Still, we will sing our song. First 3 conditions, guys. So, condition number 1, assessee must have incurred an expense relating to business or profession. Condition number 2, this expense, the other party has to be resident and payment has to be made in India. And condition number 3, on this expense, TDS is applicable. Let's see whether the conditions are fulfilled or not. Yes, assessee has incurred an expense, audit fee expense. The other party should be resident and in India. Question is silent. I'll assume this is fulfilled. On this will TDS apply. Audit fees, guys. You're paying to a chartered accountant. You're paying to a professional. So therefore, professional fees. Therefore, 194J. 194J puts a limit of 30,000 on you. This is more than 30,000. So yes, 194J TDS is applicable. But the question says TDS was not deducted. TDS was deducted, sorry. They said TDS is deducted, but it is not deposited in the relevant previous year. So TDS is applicable. So all my 3 conditions are fulfilled. So because the 3 conditions are fulfilled, you will put 2 responsibilities on me, guys. Responsibility number 1, you will ask me to deduct the tax in that respective previous year. Here, when did the expense get incurred? When was the expense incurred? In 23-24. So you will ask me to deduct the tax in 23-24 itself, and you will ask me to remit this tax within 139-1 date. Now tell me, for 23-24 year, what are the 139-1 dates possible? Either it will be 31st July 24, or it will be 31st October 24, or it will be 30th November 24, one out of these 3 dates. Now here the question says, TDS is deducted, but it was not deposited in the relevant year. It was deposited only on 31st December 24. So was it deposited within these 139-1 dates? It was deposited on 31st December 24, guys. So whatever be the 139-1 date, it is clearly deposited after the 139-1 date. So 3 conditions were fulfilled. You put 2 responsibilities on me. Any one violation is there? Yes. You did not remit the tax within 139-1 date. One violation is there. So because there's a violation, under 40A1A, how much you will disallow, guys? 30% of the expense you will disallow. So 30% of 75,000 you will disallow, which will be how much? Which will be 22,500. And all this song you would have sung in which year? All this you would have sung in the previous year 23-24. But that time you would have given some good news also to the assessee. You would have told the assessee, don't worry. Later, whenever you deduct and remit in that year, we will allow it again. So when was it remitted? 31st December 24. This is when it is rectified. which is previous year 24-25, which is your current year. So in your current year, the same 22-500 should be allowed. Understanding, no skipping steps, always follow your sequence. Okay, yes, this is my favorite dialogue. Yes, I will say it in every question because, guys, this is the only method of learning. Trust me when I say this. This is the only method of learning that actually works when it comes to DT. Sequence, method of thinking, steps, sing the songs, stay calm, one by one, no tension. Understanding. So I put 3 conditions on my SSE. All the 3 conditions were fulfilled. I put 2 responsibilities on my SSE. One of the responsibility is violated. So 3, 2, 1. There is one violation gone, disallowed. But don't worry, SSE. Whenever you rectify that year, it will be allowed again. In the last year, we would have disallowed. So now in the current year, when it is rectified, we will allow it. So it has not been debited or credited. So I will now debit it. I will now allow it. It's an expense not debited but allowed. So over here we have audit fees, 22,500. I will now allow. Okay, this was a third subdivision. Then the question says, as per the restructuring agreement with the bank has converted unpaid interest of 6 lakh rupees into a new loan account repayable in 20 equal annual installments. The first installment was paid in March 2025. Then the question says Mr. Gupta debited the entire interest amount of 6 lakhs as an expense while computing his business income. No tension, I will discuss this with you slowly, calmly, listen to me. See, the question says bank has converted unpaid interest. So first of all, we have unpaid interest, guys. How much is the unpaid interest? 6 lakh rupees. Now, assessee was not able to pay interest to the bank. Section 43B will come to your mind. 43B says there are some expenses. These expenses you have to make the payment within 139 date. Only then that expense will be allowed for you. One of those expenses is interest. Any interest which you have to pay to a bank or to a financial institution or to NBFC or to State Finance Corporation or to State Industrial Investment Corporation. To this interest, section 43B will apply. 43B says you have to make the payment within 139 date. Here we have interest which we have to pay to the bank. It is unpaid interest. So only if you pay the interest within 139 date, only then I will allow for you. How much is the unpaid interest? 6 lakh rupees. Banker has converted unpaid interest into loan. Question number 1. Any unpaid interest, if it is converted into loan, does this conversion result into payment? Can I say conversion of unpaid interest into loan is equal to payment? No. Conversion alone does not result into payment. You actually have to make the payment. Only then I will consider it as paid. Okay. So the question says this loan will be equated in 20 annual installments. So 20 annual installments, equal installments. So each installment will be how much, guys? 6 lakhs divided by 20. Each installment will be 30,000 only. The first installment was paid in March 2025. So every year one installment will be paid. Equal annual installments. So the next installment will be paid in March 2026. Then after that an installment will be paid in March 2027. Each time we will pay 30,000 rupees. So this is how this unpaid interest will be paid, everybody. Now what did your assessee do? He debited the entire interest amount of 6 lakhs as an expense. Wrong assessee. See, how much can we allow? We can, because of section 43B, only whatever is paid within 139 date I can allow. So within 139 date, how much have you paid, guys? Only this 30,000 you have paid, because the next payment you will make in March 2026. March 2026, guys, which will definitely be after the 139 dates. Because see, what are the 139 dates possible for you? Either it can be 31st July 2025, or it can be 31st October 2025, or it can be 30th November 2025. So the next installment is only in 2026. Definitely after the 139 dates. So within 139 date of the current year, how much have you paid? 30,000. Only this should be allowed. But what has your assessee done? He has debited the entire interest. So what will I do now? I will disallow. I will add back the whole of 6 lakhs and I will allow only 30,000. In simple words, can I say that I will disallow the excess that he has debited. I will disallow 5,70,000. Right? Only 30,000 should have been allowed, but he has debited the full 6 lakhs. So the excess of 5,70,000 which he has debited, I will disallow. I will add it back. So coming back now, add expenses debited but not allowed. Interest 5,70,000. I will add back. Understanding? Point number 1. Conversion of unpaid interest into loan. That conversion itself does not result into payment. Only when you actually make the payment of the interest, only then it will be allowed. Because of 43B, you have to make the payment within 139 bund. So within 139 bund, in our case, only 30,000 has been paid. So whatever you pay within 139 bund, 30,000, only that will be allowed. So balance will be disallowed. This was your next adjustment. Okay. So with this, we are done with the whole of our PGPP discussion. Now come on, be ready for another light bulb moment. Let's talk about 10AA. Now 10AA, I've always told you, even over here, sing the song. Even over here, I've always told you, you have 5 conditions. Check your 5 conditions, only then you will proceed with the calculation. Right guys, what are the conditions? Tell me. Condition number 1, assessee must be having a unit in SEZ. Condition number 2, assessee must be either manufacturing goods over here or assessee must be rendering services from here. Condition number 3, assessee must have commenced this work on or before 31st March 2020. Yes guys. However, in case of letter of approval, if letter of approval has been obtained before 31st March 2020, then in that case, you can also commence the manufacturing by 31st March 2021. Otherwise, you're supposed to commence the manufacturing by 31st March 2020 only. Then comes your condition number 4, that assessee must be following the normal regime, which means assessee must not be following 115 BSE. And condition number 5, assessee must file ITR on time. So only if all of these 5 conditions are fulfilled, only then you will get 10AA tax holiday. Now in this question, is your assessee having a unit in SEZ? Yes, he is having. Is he manufacturing goods or rendering services from here? Yes, he is manufacturing. But tell me, did he commence the work within 31st March 2020? Come. Welcome to the question. The question says, come on, open your eyes and read. He began manufacturing in April 2020. He began manufacturing after 31st March 2020. So did he commence within 31st March 2020? No. You can allow 31st March 2021 date only if the question says letter of approval was obtained by 31st March 2020. Nothing of that sort is given to us over here. This condition is not fulfilled. 10AA dustbin, no 10AA deduction over here at all. Understanding? And if you're wondering, ma'am, where are you bringing all these questions from? This exact same adjustment is there in your case-based MCQ, one of the questions. I took this adjustment from there. Okay, you can talk about 31st March 2021 only if letter of approval was obtained by 31st March 2020. Here no letter of approval and all. So therefore 31st March 2020 will be your applicable date. But your assessee started manufacturing in April 2020, which means after 31st March 2020. Therefore no 10AA tax holiday. Alright everybody. So this was your entire adjustment with respect to PGPP. Now let's see what else are they saying. He was a partner in a partnership firm, Excel and Company. 19% share he had. Share of profit was 38,000. Share of profit will always be exempt. Simple. His wife received salary of 2,40,000 from a partnership firm, Excel and Company. Same Excel and Company, where she's an accountant. She does not have any professional qualification relating to accounting. Something comes to your mind. Some diagram comes to your mind. Some clubbing provision comes to your mind. Come on. Listen, everybody. Tell me the whole diagram first. There's an entity. In this entity, A plus his relatives put together are having substantial interest. Substantial interest means at least 20% interest they are having. In the same entity, A's spouse is employed without professional or technical qualifications or experience and gets salary from this entity. If all these conditions are fulfilled, this salary will be clubbed with A's income. This is what I've told you. Let's check whether these conditions are fulfilled. Assessee is a partner in this entity. In the same entity, wife is employed without qualifications or experience. She is getting salary from this entity. So yes, she is employed without qualifications or experience. Yes, she is getting salary. Only thing I have to check is, in this Excel and Company, does your assessee have substantial interest? Guys, substantial interest is 20% interest, but he has only 19% share. 19% is it at least 20%? No. So therefore your condition of substantial interest is not fulfilled. Therefore no clubbing provision. On the salary, the wife herself will pay tax. Understanding? So draw a diagram. Check your conditions. Only if your conditions are fulfilled, only then club. Here, no clubbing provision because there's no substantial interest. Substantial interest is at least 20%. But here, your assessee is having only 19% interest, not 20% interest. Therefore, condition not fulfilled. Hence, no clubbing. Okay, then come to the fifth adjustment. He received 5 lakhs as advance towards sale of shop, which was later forfeited as a buyer could not comply with the conditions specified in agreement of sale. Advance money forfeited, guys. If advance money is forfeited before 1st April 2014, you will reduce it from the cost of acquisition. But if the advance money is forfeited on or after 1st April 2014, then you will tax it in the IFOS head. So here it is forfeited in the current year, definitely after 1st April 2014. So you will tax it in the IFOS head. So I'll come to my main answer. IFOS, let's say working note number 2. So after working note number 1, I'll open working note number 2 for IFOS head. Here I have advance money forfeited. How much? 5 lakhs. Then he possesses 2 cars, one of which he uses exclusively for personal purposes. Other is let out to a friend on rent for 20,000 per month. Rent from car, IFOS head. No IFHP head. IFHP only if you have a superstructure. Rent from car and all, IFOS head. How much is the rent? 20,000 per month. So 20,000 into 12, 2,40,000. Okay. Then he contributed 6,000 towards during the year towards central government health scheme. This will go to section 80D, guys. So you have chapter 6A, 6,000. You should make the payment in non-cash mode. Only then 80D is allowed. In 80D, preventive health checkup you can pay in whatever mode. Other things you have to pay in non-cash mode only. And also the limit. The assessee is a senior citizen. So the limit under 80D will be 50,000 for the assessee. But this is clearly within 50,000. So under 80D it will be allowed. Then he earned an income of 50,000 from owning and maintaining racehorses. IFOS head, guys. Income from owning and maintaining racehorses 50,000. And to earn this income he incurred an expense. He incurred an expense of 5,000. So net 45,000. Now see, is this special rate income? Is this lottery income? No. If it is lottery income, betting income, casual incomes, you can't adjust expenses. This is not casual income, so I can adjust expenses. That's all, guys. Come on, go ahead. Close your working notes. Tell me the net PGBP first. The net PGBP will be 58,32,500. Then IFOS, if you add up, you will have 7,85,000. So the GTI of your assessee will be 73,67,500. From this you will subtract chapter 6A. I'm not splitting the income into normal rate and special rate because no special rate income over here. Only one chapter 6A we have. 6,000 section 80D. So your balance number 73,61,500. This becomes your total income already in multiples of 10. Therefore, no need of any rounding off also. Okay, so this was your question number 40. Now, what were the good morning points over here? The biggest and the most important moment of this question was our 10AA discussion, guys. We did not give any 10AA tax holiday because assessee started manufacturing after 31st March 2020. Okay, then industrial power tariff concession under PGBP taxable. Then you learned to differentiate between 40A3 and 40A3A. Then 40A1A, that good news, the reversal part we saw over here. Then this was an interesting adjustment, 43B, conversion of unpaid interest into loan does not amount to payment. So only whatever interest is actually paid, that much only I will allow. Then this was also interesting, just because no professional qualification, you should not blindly club. You should check whether your conditions are fulfilled or not. Here, if you see condition was not fulfilled, substantial interest condition was not fulfilled, therefore we did not club. And then advance money forfeited, I clubbed. Advance money forfeited, I taxed under IFOS head. Then rent on car, I taxed in IFO asset. Then central government health scheme, whatever payment you make will go to section 80D. And activity of owning and maintaining racehorses, it is not casual income. So I can subtract expenses against this. Alright everybody, this was your question number 40. Now come to question number 41. One more question filled with weird adjustments. Come on. So the question says Mr. Suraj has 2 children. One married daughter, Ria, age 17 years, minor married daughter. So Ria is a minor married daughter. And he has a son, Raj, age 16 years. So Raj is a minor son. So my SSE has minor married daughter and he has a minor son. Okay. Interest income of Ria and Raj is 1,200 per annum and 2,000 per annum respectively. So the minor married daughter's interest income is 1,200 and minor son's income is 2,000. See guys, minor married daughter, whatever income she has earned, it's not because of skill, talent, labor, and also she's not disabled. So you will apply clubbing. Yes, clubbing will apply. See, if minor married daughter, deemed donor concept will not apply, IFHP head. But clubbing provision will still apply. So this 1,200 will also be clubbed. Minor son's 2,000, this will also be clubbed. Okay. Clubbed with whom? With Mr. Suraj or his wife. Basically father or mother, whoever's income is higher. We'll have to go read the question and accordingly decide that. Then what happened after that? He transferred a flat to Ria on 1st April 24 on account of natural love and affection. The flat was let out from that date and generated rental income of 5,000 per month. See, when assessee transfers a house to minor child for no consideration or inadequate consideration, you apply the deemed owner concept. But however, the deemed owner concept is not applicable to minor married daughter. So you can't apply the deemed owner concept. Hence, you will apply the clubbing concept. Understanding? Are you again noticing? I always try deemed owner first. If deemed owner is not possible, then only I come to clubbing. So here also I check deemed owner first, but minor married daughter, deemed owner concept will not apply. So therefore you will apply clubbing concept. It is a let out flat guys. Rental income is 5,000 per month. So 5,000 into 12 minus 30% standard deduction. So the IFHP will be 42,000. So even this will be clubbed. No deemed owner concept, instead clubbing concept will apply. Then Mr. Suraj had sculptures in the form of capital assets. And by the way, it will be clubbed with whose income? Just because Mr. Suraj has transferred it to Ria, so will it be clubbed in Mr. Suraj's in Mr. Suraj's hand only? If it was deemed owner concept, then yes, it would be treated as if Mr. Suraj is the owner and computation would be in his hands. But this is clubbing concept guys. Minor child's income will be clubbed with whichever parent who has higher income. Just because Suraj has transferred to Ria doesn't mean you will club with Suraj's income only. No. Whichever parent has higher income, that is where you will club. Okay. Then, Mr. Suraj had sculptures in the form of capital asset acquired in Jan 2015. So, Jan 2015 becomes your date of acquisition. He acquired them for 1,80,000. This becomes your cost of acquisition. Later in 23-24, he started sculpture business and he converted these capital assets into stock in trade for his business. So, there is a conversion guys. Capital asset has been converted into stock in trade. This conversion itself will result into transfer and hence there will be capital gains. But when will you tax these capital gains? Only upon the sale of stock in trade. Okay. So he converted these capital assets into stock in trade for his business. FMV at the time of conversion was 3,50,000. So 3,50,000 is FMV upon conversion. Then he sold the stock in trade on June 10, 2024. So this becomes your date of sale of stock in trade. It was sold for 5 lakh rupees. This becomes a selling price. Okay. So come on, let's handle this adjustment. So first of all, I'll do the capital gains adjustment. We'll have capital gains and PGBP both, right? Because conversion of capital asset into stock in trade will result into capital gains. And later when he sells the stock in trade, there will be PGBP. So I'll do the capital gains part first. So usual steps guys. Capital asset transferred. What are we transferring over here? Sculptures. What's the period of holding? When did he buy it? He bought it in January 2015. And when did he sell? The conversion itself results into transfer. So the conversion happened in 23-24. They have not given the date. somewhere in 23-24 is where the conversion has happened, but clearly the conversion has happened before 23rd July 2024. So come to the margin. 50 AA will not apply to sculptures. Then relevant period of holding 12, 24, 36. 3 periods of holding you will have before the amendment. This is sculptures, so therefore 36 months. And then after that, will you get indexation benefit? The transfer happened before the amendment, so you will get indexation benefit. So come on guys, 36 months. This period is definitely more than 36 months. So therefore, yes, it becomes a long-term capital asset. You will first try 112A, but 112A will not apply to sculptures, so therefore section 112 will apply. Now, if it is section 112, that full drama will come to your mind, but you will do all that only if they are asking you for tax computation. Here they are only asking you for taxable income of Mr. Suraj and Mrs. Suraj under the regular provisions. Regular provisions means normal regime, not 115 PSE. Okay, so no, they're not asking you for tax, so I won't even think about my conditions and all over here. Now come on, your usual computation. Full value consideration, you sold for how much? See, actually you did not sell, actually you converted. So when you convert your capital asset into stock in trade, the FMV on the date of conversion will be deemed to be your full value consideration. So 3,50,000, no expenses on transfer, this itself is your net consideration. Less cost of acquisition, you will index the cost of acquisition over here. The grandfather clause will not apply. It is not 112A, it is 112. So straight away I will index the cost of acquisition. The cost of acquisition is 1,80,000. See, by the way, why am I indexing? We already concluded over here, we will get indexation because transfer happened before amendment. Also, it is not bonds and debentures, it is not slump sale, it is not 112A, it's not depreciable asset. So I can index it. So 1,80,000 into CII of the year of transfer. The year of transfer is 23-24. 23-24, the indexation is 348 divided by CII of the year of purchase. 2014-15 guys. 14-15, the indexation is 240. So my indexed cost of acquisition will be 2,61,000. No cost of improvement. So our LTCG under section 112, this will be 89,000. Okay, so when I start computing Suraj's income, he has section 112 LTCG of 89,000. Alright, then in addition to that, when you sell the stock in trade, you will have PGPP also. So the selling price, you sold the stock in trade for 5 lakh rupees minus the FMV on the date of conversion, the same FMV number we subtract in PGPP also. So we'll subtract this 3,50,000 over here. So 1,50,000, this will become your PGPP. See, in PGPP, if your assessee had incurred some more expenses, let us say, even that we would have subtracted. But your question doesn't say anything of that sort. So we sold for 5 lakhs. The same FMV number will come into the picture in two places. The same FMV number you will tax as FVC in your capital gains, and that same FMV number you will subtract in your PGPP calculation. Okay, so 1,50,000 will be Suraj's PGPP. 1,50,000. Alright, so this was just a reminder of conversion of capital asset into stock in trade. Then after that, what happened? He authored an investment portfolio book and he received royalty income of 4,10,000. Royalty income, guys, so it will come to your IFOS head. So let's say I open a working note for this. Working note number 1. IFOS head. So he has royalty income. How much is the royalty income? 4,10,000 during the previous year from a publisher in Germany. The royalty is calculated at 16% of book sales value. He incurred 60,000 as expenditure for earning this income. So his expense is 60,000. So what is his net taxable royalty now? 3,50,000. So once again, he has royalty from books. The amount is 4,10,000. It is 16%. It is from Germany. He has incurred 60,000 expenditure to earn this income. Out of the total royalty, 2,90,000 was remitted to India by 31st August 25. The balance remained abroad till 30th September 25. Royalty income, yes, we have taxed it in IFOS. In addition to that, you will get deduction under section 80 QQB also. Royalty on books, 80 QQB. Royalty on patents, 80 RRB. Now under 80 QQB, 3-step approach, guys. First of all, you see what is your royalty income. Your royalty income is how much? It is 4,10,000. Okay. Now comes your first step. If it happens to be in percentage, if it is in percentage, restricted to 15 percentage. Yes, here it is in percentage, it is 16 percentage. So I will restrict it to 15 percentage, guys. So 4,10,000 into 15 by 16. So this will be 3,84,375. Don't do 4,10,000 into 15%. No. If it is in percentage, we have to restrict it to 15 percentage. So here this 4,10,000 is 16 percentage. So what is 15 percentage? I found over here. This is your first step. Then comes your second step. In case your royalty is earned from outside India, it has to be remitted to India. That is, it has to be brought to India within 6 months from the end of the year. That is by 30th September 25. So out of this much royalty, how much has been brought to India within 6 months from the end of the year? Only 2,90,000, guys. So I will consider only 2,90,000 royalty. Then after that, in case there are any expenses, you subtract the expense. So from this 2,90,000, what is the expense that we have incurred? 60,000. So your net number now is 2,30,000. Now this 2,30,000 you will compare with the maximum limit of 3 lakhs. So whichever is lesser, 2,30,000. This will become your 80QQB deduction. So 3-step approach, guys. You first see, if it is in percentage, you will restrict it to 15 percentage. Then you will see out of the royalty, how much has been remitted to India within 6 months from the end of the year. Then from that number, you will subtract the expense. That number or 3 lakhs, whichever is lesser, will be your deduction. One small point over here, remember, if it is 80 RRB, okay, same thing. Only thing is, your first step will not be there. Step 2 and step 3 will still be there. You still have to see how much is remitted within 30th September. You still have to subtract expenses. But if it is 80 RRB, there is no requirement of restricting it to 15%. That requirement itself will not be there. Okay, so 80 QQB is 2,30,000. This is also done. Then what happened? He is constructing a building in Mumbai during 24-25. Mr. Raju, a film director, took on rent the building under construction. The building is still under construction. The film director took it on rent at 5,000 rupees per month for 2 months for his film shooting. Construction of the said building would be completed only in April 25. So construction will be completed only in 25-26, and he is not in the business of letting out properties. Tell me, guys, my assessee is having rental income. 5,000 rental income for 2 months he is having. Can I put this under IFHP head? No, guys. If the property is still under construction, it will not be assessed under IFHP head. It will go into the IFOS head instead. Understanding? You will put your property in the IFHP head only once the house is ready. Here it is still under construction, so no IFHP head, IFOS head only. So under IFOS, you will have one more adjustment over here. Rent from under construction building, 5,000 into 2, 10,000. No standard deduction, nothing. All that is only in IFHP head, not in IFOS head. Okay. Then, he contributed a sum of 2 lakhs to an electoral trust. Let's talk about this, guys. See, if you look at Chapter 6A, in this question, we already have section 80QQB. How much is it? 2,30,000. Now, when you give money to an electoral trust, this will go into section 80GGB and 80GGC. 80GGB for companies, 80GGC for others except local authority and AJP. So assessee is others, individual, guys. So 80GGC, electoral trust, 2 lakhs you will get as a deduction. Listen to me now. We have 2 sections, 80GGB and 80GGC. 80GGB is for companies, 80GGC is for other assessees but except local authority and except AJP. Okay, under 80GGB for companies, if they make any donation to electoral trust, you will get a deduction. Then if they make any donation to political party, they will get a deduction. Also, if they give any advertisement in newspaper, souvenir, any magazine, any publication of a political party, even that they will get 80GGB deduction. In both guys, there is no maximum limit. Only thing is the payment has to be made in non-cash mode. That is the only criteria. Okay. 80GGC on the other hand, here you have only the first 2 points, guys. Which means, if your individual, HUF and all, if they make an advertisement in newspaper of political party, under 80GGC it will not be allowed. Okay, so electoral trust, I gave deduction under 80GGC. Then the question says, he incurred expenditure 30,000 on advertisement in a brochure of a political party. ATGGC, I will not give that as a deduction. Had your assessee been a company, then under ATGGB, assessee would have enjoyed. But here assessee is an individual, so therefore under ATGGC, the deduction I will not give. Then what happened? Mrs. Suraj has earned interest on FD 80,000 rupees. The FD of 10 lakhs was gifted to her by her father-in-law on 1st April 24. She has no other income. Come on everybody, draw a diagram. So we have Mrs. Suraj and then we have her father-in-law. For father-in-law, Mrs. Suraj will be son's spouse. Right guys? Father-in-law has given to son's spouse FD of 10 lakh rupees. So this 10 lakh rupees FD will become transferred asset. Come on everybody. Assessee to spouse, assessee to son's spouse, assessee to HUF. You will apply clubbing provisions. So father-in-law has transferred an asset to son's spouse for no consideration or inadequate consideration. From this transferred asset, from this FD, whatever income Mrs. Suraj earns, this will be clubbed with the father-in-law's income. So therefore, for Mrs. Suraj, there will be no income. Able to recall? I will apply clubbing provisions and I will simply club it with the father-in-law's income. Income from transferred asset will be clubbed with the income of the transferor. So if you see now, Mrs. Suraj, does she have any income, guys? Mrs. Suraj, she has no income. So whose income will of course be higher? Mr. Suraj's income only will be higher. So the minor children's income will be clubbed with Mr. Suraj's income. Come on, let's close the question now. So we finished our 112 LTCG. Then we had PGBP. Then IFOS. Total IFOS is 3,60,000. Okay. And then after this we have chapter 60 only. Before chapter 60, let's club the income. Minor married daughter. The total income is 43,200. You will get 1,500 section 1032 exemption. So the balance income to be clubbed will be 41,700. Then minor son's income is 2,000. So from this 2,000, even over here you will get 1,500 exemption section 1032. Only 500 will be clubbed. So the total amount to be clubbed will be 42,200. You will club it with the mother or father, whoever's income is higher. Here mother's income is 0. She has FD interest income, but that we are clubbing with father-in-law. So the father's income is higher over here. So we are going to be clubbing the minor's income with Mr. Suraj's income. So his GTI will be now 6,41,200. Okay. See guys, this 1032 exemption you get only in normal regime, not under default regime. And there's no limit of children over here. Any number of children, 1,500 per child, you will get section 1032 exemption. Okay. Which parent? The parent with whose income the minor child's income is getting clubbed, that parent will get this exemption. That's all guys, easy. And then we have chapter 6A. Total chapter 6A is how much? ATQQB and ATGGC put together 4,30,000. Now you can adjust chapter 6A only against normal rate income. So your assessee has a special rate income 112 LTCG. So I will split this into normal rate income and special rate income. 89,000 is your special rate income. So the balance 5,52,200 becomes your normal rate income. Against this I will subtract my chapter 6A, which just now we calculated 4,30,000. So that's all everybody. So your balance normal rate income will be 1,22,200 and your special rate income will be here 89,000. So your total income will be 2,11,200 and Mrs. Suraj's total income will be nil. Alright, so what were our learnings in this question? Come on, let's summarize. Learning number 1, minor married daughter. Okay, deemed donor concept will not apply, but clubbing concept will still apply. Learning number 1. Learning number 2, conversion of capital asset into stock in trade. First time we saw in these questions. Then learning number 3, ATQQB was interesting over here. All the 3 steps with respect to ATQQB we applied in this question. Then learning number 4, if the house is still under construction, no IFHP head. So instead income will go into IFOS head. Then electoral trust, AT, GGB and GGC, we spoke about that. And then here this adjustment was interesting. Ceci transfers an asset to spouse, son's spouse or to HUF. Income from the transferred asset will be clubbed with the transferor's income. So the FD interest we will club with the father-in-law. Understanding, guys? Yes. So this was your entire discussion on question number 41. Now come on, guys. One final question. Give me your 200%. Listen to me. Question number 42. Here the question says, Mr. K has salary income of 15 lakhs computed. Compute taxable income of Mr. K and Mrs. K under the optional regime. Optional regime is nothing but your normal regime. So Mr. K and Mrs. K, both their incomes we have to find. So Mr. K has salary income of 15 lakh rupees. They've used the word computed, which means all adjustments, everything is already over. I just have to copy and paste the number. Then Mr. K took divorce from his wife in April 2024. Divorce. Custody of their minor son is given to Mrs. K. So minor child is being maintained by the mother. Following the divorce, he transferred ownership. Come on, be careful. He transferred ownership of house to his wife. During the financial year, the property generated rental income of 5 lakh rupees. So, your assessee has transferred a house to his spouse for no consideration or inadequate consideration. So, of course, first you will think about deemed owner concept. But deemed owner concept will not apply if there's an agreement to live apart. That is, if there's a divorce proceeding going on, then deemed owner concept will not apply. So therefore, the spouse itself will pay tax on her own income. There will be no deemed owner concept, no clubbing concept. Neither of these two will apply. None of these two will apply, guys, if divorce is going on. So therefore, who owns the house now? The wife owns the house. So IFHP computation will be in the wife's hands only. So how much is the rental income from this house? 5 lakhs minus 30% standard deduction. So 5 lakh minus 30%. 3,50,000. This Mrs. K herself will pay tax. Neither deemed owner concept will apply, nor clubbing concept will apply. This is also okay. Then, Mr. K deposits cash of 50,000 rupees every month into the bank account of his minor son. During 24-25, interest income of 25,000 is generated in his son's bank account. So, the minor child is having an income. Now, the minor child's income, is it because of skill, talent, labor? No, guys, it is simple, interest income. It is not because of any skill, talent or labor. So therefore, you will club. But you will club with which parent's income? Whichever parent has higher income, guys. But however, over here, there's a divorce going on, right, between the parents. So in such cases, you will not club the minor child's income with the parent who has higher income. No. Instead, you will club the minor child's income with the income of that parent who is maintaining the minor child. The minor child is in whose custody over here. The minor child's custody is with the mother, guys, with Mrs. K. So therefore, the minor child's income over here, it has to be clubbed with Mrs. K's income only. Remember, I was telling you with respect to minor child, one concept is pending. This is that concept, guys. So generally, minor child's income is clubbed with the mother or father, whoever's income is higher. But however, whenever a divorce is going on between the parents, you will see which parent is maintaining the minor child. Which parent has custody of the minor child. With that parent's income only, clubbing will happen. If you notice over here, it is Mr. K. It is a father who is depositing money in the minor child's account. Doesn't matter. The income will be clubbed with the parent whose income is higher. But if divorce is going on, it will be clubbed with the parent's income who is maintaining the child. So the minor child's income, 25,000 minus 1,500, section 1032 exemption, 23,500. I will club it with Mrs. K's income because she is the one who is maintaining the minor child. That's all, guys. So Mr. K's total income will be 15 lakhs and Mrs. K's total income will be 3,73,500. Understanding? This is it. So these were all these 42 questions that I wanted to discuss with you. The first 27 questions were, from your RTPs and MTPs and PYQs. And the last few questions, question number 28 onwards, we had from the case-based MCQ booklet, and the last 2-3 questions were a compilation of weird adjustments. Alright, now with this, we can close the third part of the marathon, and now we'll start the fourth part of the marathon, the last part. Here we will not be seeing questions, instead we will be discussing some concepts which are not important but important. Basically, those concepts which we don't see very often in the examination, we don't see these adjustments very often in questions, and therefore they are hidden adjustments. They are adjustments, which if they get asked in the examination, then we will get blown over maybe. So that is why, to prepare ourselves for the toughest question paper possible, we are going to be doing these adjustments. Okay, now come on, let's begin one by one. So point number 1, some special PGBP adjustments. Okay, look at this. Assessee is a practicing chartered accountant. He is paying stipend to his articles, or he is giving incentives to his articles, or he is giving diaries to clients for New Year. All of this will be allowed. So when a practicing chartered accountant gives stipend to articles, or gives incentives to articles, or when you give diaries or any goods for business promotion, like over here in my example, your assessee is giving diaries to clients for New Year, let's say, or you're giving sweet boxes for Diwali. So anything that you give to your clients, to your business customers, with respect to business promotion, by doing this you're trying to create a nice business relationship with them. So all of these will be considered as business expenses and hence allowed. Okay, this is your first point. Then when you give gifts to clients, gift given to clients, understand, when your assessee receives gift from clients, it will not go to IFOS head, guys. It is relating to business or profession. It will come under the PGBP head, and under the PGBP head, this gift will be taxable. Similarly, if the assessee gives a gift to his client, then this gift will become a business expense and it will be allowed in PGBP. Okay, that's your second point over here. Then comes your third point, contribution to approved gratuity fund. See, when the assessee is making a contribution to approved gratuity fund, when the employer is making a contribution to an approved gratuity fund, for the employer it's a business expense, guys, because he's making a contribution into the gratuity fund of the employee. So it's an expense for him. That expense will be allowed provided it is approved gratuity fund. If it is unapproved gratuity fund, it will not be allowed. Similarly, RPF, if the employer is making a contribution to recognized provident fund, it will be allowed for him under a PGBP. It's a business expense for him. But if the employer is making a contribution to unrecognized provident fund, in PGBP it will not be allowed. Alright, so contribution to approved gratuity fund, it will be allowed under PGBP, but subject to section 43B. Subject to section 43B, why? Because 43B does apply to employers' contributions to gratuity fund, superannuation fund, or any other fund for the welfare of the employees. So because of 43B, you have to make the payment within section 139 funded, then only it will be allowed. Okay, so in simple words, if the assessee is making a contribution to gratuity fund, when will it be allowed? It will be allowed if two conditions are fulfilled. Condition number 1, it has to be an approved gratuity fund, and condition number 2, payment has to be made within 139 funded, only then the contribution will be allowed. Okay, this was another small point. Then now listen, come to this point first. Employee has retired. Actual gratuity expense for the year. See, if employee has retired, then we have to pay him gratuity. So this becomes gratuity expense for the current year, guys. So here I'm not making the payment to any fund. I actually have to pay gratuity to the employee. This is an actual expense of the year. This will also be allowed. So in simple words, when it comes to gratuity, it will be allowed if either we are making a contribution to an approved gratuity fund and we are making payment within 139 fund date. Or with respect to gratuity, we will allow the expense if it is actual gratuity expense of the year. But however, if you are simply making a provision on the basis of actuarial valuation, which means the actuary is calculating and telling you how much provision to make, on that basis if you are making the valuation, then that will be disallowed. So with respect to gratuity, only two adjustments will be allowed. Either you are making the payment of gratuity to an approved gratuity fund, or you're actually making payment of gratuity directly to the employee because employee has retired and therefore you have to pay him gratuity. So only actual gratuity expense or payment to approved gratuity fund, only these two will be allowed with respect to gratuity. So if you're making the payment to an unapproved gratuity fund, it will not be allowed. And if you're simply making a provision on the basis of actuarial valuation, even that will not be allowed. Okay, so this is your first 5 adjustments. So first we spoke about stipend to articles, allowed. Incentives to articles, allowed. Then diaries given to clients for New Year, allowed. Business expenses. Then gift given to clients. If I receive a gift from client, taxable under PGBP. Similarly, if I give a gift to a client, it is allowed under PGBP. Then gratuity, we spoke about gratuity. Alright, these were your first 5 points. Now listen to me. The next bucket, these three together, CSR. If the question just says CSR expense, under PGBP it will be disallowed because when you incur CSR expense, it is for the benefit of the society. It is not relating to your business or profession. So CSR expense as such will be disallowed. Alright guys, but however, please know that if the same CSR expenditure can fit under some other section, then under that section it will be allowed. Like for example, let us say my assessee incurred on CSR and this was a contribution to IIT for scientific research. Yes, when you contribute to IIT for scientific research, under Schedule 7 of Companies Act, it is considered a CSR expenditure. So it is a CSR expenditure. Generally, it is not allowed, but however, contribution to IIT for scientific research under Section 35, it will be allowed, guys. Yes, so actually it is CSR expense, which is generally not allowed, but here the same CSR expense is fitting under some other section. Under that section, it will be allowed. But here one small twist is possible. What if my assessee is following default regime? If my assessee follows default regime, under Section 35, only in-house scientific research is allowed. Contribution to outsider will not be allowed. So in that case, if assessee is following default regime and assessee is incurring CSR expenditure in the form of contribution to IIT for scientific research, then how will your answer be? First you will say that ma'am, it is CSR expense, therefore it will not be allowed. Then you will try fitting it under some other section. Because it is contribution to IIT for scientific research, you will think about Section 35. Then you will say, but no, default regime. Because default regime under Section 35, contribution to outsider is not allowed. So it is a CSR expenditure. It is not fitting under any other section also. So hence it will be disallowed. Understanding? So this was our entire CSR bucket. This CSR point has not been tested in the examination until now. Be careful. Alright. Then, if the assessee pays STT or CTT, Securities Transaction Tax or Commodities Transaction Tax, if it is relating to stock in trade, then it will be allowed in your PGBP head. But if the same STT or CTT is relating to a capital asset, then it will go into the capital gains head, guys. If it is relating to capital asset, it will be disallowed. That is, neither will it be allowed in the PGBP head, nor it will be allowed in the capital gains head, nowhere. I'll help you understand. Like for example, let us say my assessee sold some shares. Okay. So because he sold some shares, he also had to pay STT. Now those shares are his stock in trade. Okay. So the income from the sale of shares will go into the PGBP head, and this STT will also come into the PGBP head. Under PGBP head, it will be allowed as an expense. But however, if the same shares are his capital asset, then in that case, when he sells the shares, you will have capital gains calculation, right? But in capital gains calculation, can you consider STT, CTT as an expense on transfer? You can't. So basically, in our entire Income Tax Act, STT and CTT you will allow only in one place, which is PGBP head, and that too only if your shares or your commodities are stock in trade, only then it will be allowed. Under your capital gains head, STT and CTT are not allowed as expense on transfer. You can't subtract. Okay. Then the next point. See, you know very well, when assessee pays income tax or when assessee pays advance tax, you disallow the expense in PGBP head, guys. You say it is a personal expense and therefore you disallow. But there is a small catch over here. If the assessee has incurred expense on carrying on income tax proceedings, like for example, let us say the income tax department has sent a notice to the assessee asking the assessee to pay 1 lakh tax more. Okay, one notice has come from the income tax department. Scrutiny assessment notice has come. Now, in this case, assessee will have to, let's say, go to a chartered accountant, take the service of the chartered accountant to represent the assessee before the income tax department. We might have to hire a lawyer. We might have to pay consultation charges, chartered accountant fees and all. So whatever expenses we are incurring now, these expenses are relating to income tax proceedings, guys. Now, if it is an income tax expense, definitely you will disallow. But however, whatever expenses you incur to carry on these income tax proceedings, like let's say you're taking a chartered accountant service or you're paying the lawyer fees. So let's say you have to file for appeal. So for all this, whatever expenses you incur, it is a part of your business and hence it will be allowed. So income tax expense will be disallowed, but expenses incurred with respect to income tax proceedings, this will be allowed. Alright, so these were some unique PGBP adjustments. So stipend paid to articles, allowed. Incentive given to articles, allowed. Diaries given to clients for New Year, allowed. Gift given to clients, allowed in PGBP. Gifts received from clients, taxable under PGBP. Then contribution to approved gratuity fund will be allowed provided the payment is made within 139.8. If the payment is made to unapproved gratuity fund, it will be disallowed. Then whatever is your actual gratuity expense for the year, that is your employee has retired and now you actually have to pay gratuity to the employee, that also will be allowed. But however, any provision that you make just on the basis of actuarial valuation, that will be disallowed. Then CSR expense is generally disallowed, but it's the same CSR expense, if you're able to fit under some other section, then under that section you can allow it. Then after that we spoke about STT and CTT. Under PGPP head it will be allowed. Under capital gains head it will not be allowed. And lastly, yes, no doubt income tax is disallowed, but whatever expenses you incur relating to income tax statutory proceedings, that will be allowed. Okay, now come on everybody, let's take up a new section now, section 35D, which talks about preliminary expenses. Slowly, without any tension, point by point we will take up and we will understand. Okay, simple 4 to 5 points only. Point number 1, what is the expense over here? When are you incurring the expense? So point number 1 is a timing, that when are you incurring the expense? Either you're incurring the expense before commencing the business, or you're incurring the expense after commencing the business. If you're incurring the expense after commencing the business, then either it is for expanding your existing unit or to set up a new unit. Okay, simple. So when are you incurring the expense? Either before commencement or after commencement. If it is after commencement, either it is for expansion of your existing unit or for setting up a new unit altogether. Point number 1. Point number 2, who are you? Who is the assessee over here? Either assessee is an Indian company or any other resident. Basically, only residents can enjoy this deduction, non-residents can't. Then comes point number 3. If you want deduction under section 35D, for you audit is mandatory. The same point we have in section 35AD also, specified businesses. There also we learned that if you want to enjoy 35AD deduction, then audit is mandatory. Same point even over here we have. So first 3 points clear. First point is when are you incurring the expense, then who is the assessee, and then audit is mandatory. Only then you can enjoy 35D deduction. Then comes my fourth point, that what are these expenses? Give me some examples of these preliminary expenses. Like for example, you're incurring an expense with respect to feasibility report or project report or conducting a market survey or engineering services relating to assessee's business. Let me give you some examples. Let us say you want to come up with a new product. Now see, you will start manufacturing this new product only if there is enough demand in the market. So in this case, you will do a market survey. You will try to find how much supply is already there in the market, how much demand is there in the market, is there a shortfall, is it a case where there is high demand but less supply? Only then you will go ahead and you will start manufacturing the project. That is market survey. So before you can start manufacturing the goods, you will do a market survey. For that, whatever expense you incur, it will become preliminary expense. Okay. Similarly, feasibility report. Let us say you decided to set up one factory in Andaman and Nicobar Islands. Now the climate of Andaman and Nicobar Islands, the environment over here, the people over there, like, are all these factors feasible? Are all these factors making it feasible for you to start a factory over there or not? The terrain of that particular area, is it feasible for you to set up a factory over there? So before you start a new business in a particular place, you will first check whether the environment in that place, the climate in that place, the people who are available over there, the terrain, the government, whether all of these factors are making it feasible for you to start business over there or not. That is your feasibility study. So similarly, all these expenses that you incur, generally you incur before you start a project. So these will become preliminary expenses. Similarly, if you happen to be a company, then in that case, to incorporate the company, we will have to incur incorporation expenses, guys, registration expenses. Then we'll also have to pay the lawyer to help in drafting the MOA, AOA, to help in drafting agreements and all. Or if you're making a public issue, then public issue expenses for shares and debentures, underwriting commission, all of these also will come under preliminary expenses. Now, these preliminary expenses, will they be allowed in PGPP computation? Yes, but there is a maximum limit. The maximum limit depends upon who is your assessee. It depends upon, is your assessee a company or any other person. If your assessee is a company, then the maximum deduction will be 5% of cost of project or 5% of capital employed, whichever is higher. Any other assessee, similarly simply 5% of the cost of project. This is your maximum limit. So what is cost of project now? Cost of project is nothing but your assets, your fixed assets, land, building, plant and machinery, furniture and fixtures of that business all put together will become your cost of project. Capital employed will be issued share capital plus debentures plus long-term borrowings. Please notice, issued share capital, not paid up share capital, okay? Issued share capital plus debentures plus long-term borrowings, and all these numbers you will take as on 31st March of the year in which you are commencing the business. And point number 6, so whatever is your section 35D deduction, that deduction will be allowed across 5 years, starting from the year of commencement of business. For 5 years it will be allowed. In simple words, listen to me. Let us say you incurred all these expenses. Totally it was 1 lakh rupees. Alright. Now this expense, this is your actual expense. So first of all, you will compare this expense with the limit, guys. What will be the limit? If it's a company, 5% of the cost of project or 5% of capital employed, whichever is higher. If any other person, 5% of cost of project. So you did all this calculation and let us say your 5% number, your maximum limit happens to be 80,000 rupees. So now out of these two, tell me, what's your final amount now? How much deduction will you allow? Whichever is lesser, guys, 80,000 is what you will allow. Now this 80,000 will be allowed across 5 years. So 80,000 divided by 5, you will get 16,000 rupees. 16,000 rupees is what you will allow under section 35D across 5 years. Alright, that's all. Simple. Total 6 points. One last revision can we do? Yes, come on everybody, tell me what are the 6 points. Point number 1. When are you incurring the expense? Either you're incurring the expense before commencement or after commencement. If it is after commencement, it is either relating to extension of your existing unit or to set up a new unit. Then point number 2, who are you? Either you're an Indian company or you're a resident. Point number 3, audit is mandatory for your business. Point number 4, some expenses like feasibility study, project report, market report, engineering services, AOA, MOA, drafting charges, then your registration, incorporation expenses, then your share issue expenses, debenture issue expenses, underwriting commission, all this will get covered under preliminary expenses section 35D. Then point number 5, what's the maximum limit? How much maximum will you allow under 35D? Depends upon is your assessee a company or not a company. If assessee is a company, then 5% of the cost of project or 5% of capital employed, whichever is higher. If you're not a company, 5% of cost of project. Cost of project is simple, guys. I'll just take the numbers from the asset side. Your fixed assets, your plant and machinery, your land and building, your furniture, your leasehold, all of that. Then what is capital employed? Capital employed will be 3 things. Issued share capital plus debentures plus long-term borrowings. Please notice it is issued share capital and not paid up share capital. So 3 things: issued share capital plus long-term borrowings plus debentures. Okay. So on this basis you will find the maximum limit. So whatever is your actual expense or maximum limit, whichever is lesser will be your deduction. That deduction you will allow across how many years? Across 5 years. Crystal clear, everybody? So this was your discussion with respect to preliminary expenses section 35D. Then listen, SLM depreciation. Generally all our questions we work out on the basis of WDV, right? But we do have SLM depreciation method also. Now this is applicable for which assessee? It's applicable only for those assessees who are in the business of generation of power or they are in the business of generation and distribution of power. In simple words, SLM is applicable only for electricity entities. But even for these electricity entities, is it mandatory to follow SLM? No, it is not mandatory. When they file the first income tax return, right, in that they have to make a decision. That do they want to follow WDV or do they want to follow SLM? If they decide WDV, okay, forever they will follow WDV now. If they decide SLM, then forever they will follow SLM. Okay, but however, in the first income tax return, if they don't make a decision, if they don't make a choice, then by default we will assume SLM basis. Okay, so point number 1, SLM method is applicable for whom? Only for entities who are in the business of generating power or generating and distributing power. Then point number 2 is even for these assessees, is SLM mandatory? No, it is not mandatory. It's only an option for them that if they want to, then they can follow SLM method. So when do they have to make a decision? In the first income tax return. And in the first income tax return, if they don't make a decision, then by default we will assume SLM method. Then this SLM method is only for tangible assets. Here there is no block method, guys. In simple words, in SLM basis, you will do the computation for each asset separately. And however, if you sell away the asset in the same year in which you acquired it, that is, if your previous year of acquisition and the previous year of sale, if they are the same, then in that case, for that asset, there will be no depreciation. Okay, guys. So 3 points I've told you. Number 1, it's this whole concept of SLM is for whom? It is for electricity entities. That is either they are in the business of generating power or generating and distributing power. Point number 1. But point number 2, even for these entities, SLM is not mandatory. They can make a decision in the first income tax return. But if they don't make a decision, by default we will assume SLM method. Then point number 3, in SLM method there is no block method concept. That is, you will do computation for each asset separately. And in the year of acquisition itself, if you sell away the asset, then there will be no depreciation at all. Okay. Now listen, the fourth part, the most important part with respect to SLM, the most important part is what happens when you sell away the asset. See, I've already told you that if you sell away the asset in the year of acquisition itself, then no depreciation. So no depreciation, you will have normal, usual capital gains calculation. But what if the year of acquisition and the year of sale are not the same? That is, what if you are selling the asset in some subsequent year? Then in that case, there are 3 possibilities, guys. Possibility number 1, Let's take some numbers. Let us say I sold the asset for 100 rupees, okay, and the WTV of the asset was 150 rupees. That is, my selling price is less than WTV number. So if the selling price is less than the WTV number, the difference of 50 rupees, that will be called as terminal depreciation, and it will be allowed in your PGBP head. It will be allowed. Allowed means what? You can debit it. So this difference of 50 rupees, you can debit it in the PGBP head. So my selling price is lesser than the WTV. So in accounting terms, you will call it as loss, isn't it, guys? You will call it as loss on sale of asset accounting terms. So that loss only will be called as terminal depreciation, and it will be allowed in PGBP. Then comes the second point. Let us say my selling price was 100 rupees, okay. My WTV was 75 rupees and my actual cost was 120 rupees. So when I purchased the asset, I purchased it for 120 rupees. Now I'm selling it off for 100 rupees and the WTV is 75. So here if you see, accounting point of view, if you see, it becomes a profit on sale of asset, guys. WTV is only 75. I sold for 100. So I have 25 rupees profit on sale of asset. That 25 rupees profit on sale of asset will be called as balancing charge, and this balancing charge will be taxed for you under the PGBP head. Understanding? So point number 1, accounting point of view, if you have a loss, that is your selling price is less and WTV is high. WTV in the books is 150, but you're selling off for just 100 rupees. So 50 rupees loss you're having, that will be called as terminal depreciation and allowed in PGBP head. But if you're selling at a profit, that is your selling price is more than WTV, then in that case your profit, your 100 minus 75, the 25 rupees will be called as balancing charge and it will be taxed under PGBP head. Coming to the last situation now, the most interesting situation, let us take numbers even over here. Let us see the selling price. I'm selling away the depreciable asset for 100 rupees. The WTV is 75 rupees, which means even over here I'm selling at a profit. If you notice, in the first situation, yes, no doubt I'm selling at a loss, but in my second and in my third situation, in both, the selling price is more than WTV. So in both my second and third situation, I am selling at a profit. But the difference is, in the third situation, my selling price is even more than the cost, guys. Let us say long back when I had purchased the asset, I purchased it for 90 rupees and now I'm selling it for 100 rupees. So in my second situation, even over here I had a profit. Third situation, even here I'm having a profit. The difference is, in my second situation, the selling price was not more than the cost, guys. Cost was 120. I was selling for 100 rupees. So my selling price was not more than the cost. But in my third situation, the selling price is more than my cost. So if I'm selling at a profit and also my selling price is more than the cost, then the third situation will apply. Now here what you will do, first find the profit. What's the profit, guys? Selling price is 100. WTV is only 75. So I made a profit of 25 rupees. Now this 25 rupees, see, what is the difference between selling price and cost? The selling price is even more than the cost, right? So here selling price is more than the cost by 10 rupees. This will go into the capital gains. And the balance profit, that is a balance 15 rupees, will become balancing charge, which will be taxed in your PGBP head. Understanding? So if it's a loss, that is if selling price is less than WTV, the loss will be called as terminal depreciation and allowed in PGBP. Then if it's a profit, that is selling price is more than WTV, then the profit will be called as balancing charge and it will be taxed under PGBP. But however, if there's a profit and also selling price is more than the actual cost, then in that case, whatever is the difference between selling price and the actual cost, the difference will become your capital gains and the balance profit will become your balancing charge taxed under PGBP head. Okay, so this was your discussion with respect to SLM only for electricity entities. Even for them it's an option, it's not mandatory. They have to make a decision in the first ITR. If they don't make a decision, I will assume SLM basis. Then here no block method concept and all. In the year of acquisition itself, if you sell off, then no depreciation, straight away usual capital gains calculation. But if you sell in some other year, first check profit or loss. If loss, terminal depreciation. If profit, balancing charge. But if it is profit and also selling price is more than cost price, then you'll have capital gains also, you'll have balancing charge also. Okay guys, so this was our discussion with respect to SLM method. Now coming to sale of 35AD asset. See section 35AD, your specified business, cold storage, warehousing, fertilizers. You must have seen this adjustment in various questions. But what happens when my assessee sells away this 35AD asset? So this is an important point. They have not tested this in the examination at all. So we will ensure that we know this really well, so that if they ask this in the examination, we are ready. See, very simple point, okay. Generally, I've seen students get terribly confused in this entire thing. So I've made it very simple for you. 3 simple situations, guys. Each of the three situations we'll see what is the tax treatment. So what is my situation? My situation is there's a 35AD asset, which means an asset which I'm using for my specified business. So when I purchase the asset, I got 35AD deduction. Now I'm selling away the asset. Now what will happen? See, be careful. I'm not talking about sale of scientific research asset. I'm talking about sale of 35AD asset. Okay. Now see, before I enter into the three situations, let me give you some preliminary points. Point number one. If I'm claiming 35AD deduction, then for the same asset, will you let me enjoy depreciation under section 32 also? No. You can enjoy any one. You can't have both for the same asset. Then comes my second point. Once you claim 35AD deduction for an asset, you have to continue to use that asset for specified business for how many years, guys? You have to continue to use that asset for specified business for 8 years. So basically, during these 8 years, you can't use the asset for some other purpose. Okay. These are my 2 points. Now listen to me, my first situation. In my first situation, what happened is the second point got violated by my SSE. That is, during the 8 years itself, my SSE started using that 35AD asset for some other purpose, which means there's a violation, guys. So because it's a violation, there will be consequence. So number one, there will be a consequence over here because within 8 years itself, you're starting to use for other purpose. And number two, because you're using it for other purposes, now you should get depreciation also. So what is the consequence, guys? Long back, when you purchased the asset, you would have enjoyed 35AD deduction. From the 35AD deduction, I will subtract deemed depreciation. Now, why am I calling it deemed depreciation? Tell me, all these years, did you give me depreciation on the asset? No, you said that if I'm claiming 35AD, I can't get depreciation. But I will subtract deemed depreciation, which means I will imagine what if I had claimed depreciation. Notional depreciation I will subtract. So from 35AD deduction, I will imagine that I had claimed depreciation all these years. So notional depreciation, imaginary depreciation, deemed depreciation I will subtract. I will find the net number. This net number will be taxed in my PGBP head. This will become the consequence. Understanding, everybody? So point number one, during 8 years itself, if I start using my 35AD asset for some other purpose, there will be a consequence. Consequence is that from the 35AD deduction, I will subtract deemed depreciation. The net number will become taxed under PGBP head. Okay. Now second point, because I'm using it for other purposes, now I want depreciation also. So which means the asset has to enter into the block. So point number one, at what value will it enter into the block? This number that we found just now, this 35AD deduction minus deemed depreciation, this number only, same number only, will enter into the block also, and once it enters into the block, you can start claiming depreciation. Now listen, guys, now where is this asset? It is in the block. Now later, if you now sell the asset, it's a part of the block now. After this, if you sell away the asset, then it becomes a usual sale of depreciable asset. Generally, when you sell the depreciable asset, what do? You check whether the block is empty, block is not empty. If the block is empty, then no depreciation. You will straight away have capital gains. If the block is not empty, you will first try for depreciation. If depreciation is not possible, then only capital gains. So usual depreciable asset. Same thing only you will do even over here. Understanding? So this was my first situation, guys. So first situation, listen carefully. I'm repeating it multiple times because I know many of you are listening to this for the very first time. So whenever you sell away a 35AD asset, three situations are possible. Situation number one, during 8 years itself, you started using it for some other purpose. So there is a violation. Because it's a violation, you will first have a consequence. The consequence will be 35AD deduction minus deemed depreciation. The net number will be taxed for you under the PGBP head. Then number two, because you're using it for other purpose, you will ask for depreciation, which means the asset has to enter into the block. That same number which you taxed in PGBP head, that same number will enter into the block. On that number, you will claim depreciation. Okay. Now later when you sell the asset, what will happen? The asset is now in the block. So you will treat it just like any other depreciable asset. Okay. Then comes my second situation. Come on, everybody. In my second situation, I am using the asset for some other purpose only after 8 years, guys. So now tell me, is there any violation? Now I did not do any violation, guys. In the first situation, I used the asset for other purpose during 8 years itself. So I committed a violation. So therefore, you put consequence on me. But over here in my second situation, I am using it for other purpose after 8 years only. Which means, tell me, am I doing any violation? No, guys. So will you put any consequence on me? No consequence on me. Instead, because I'm using it for other purpose, you will just give me depreciation, guys. So if I'm asking for depreciation, it means asset has to enter into the block. But here, at what value will it enter into the block? At 0 value, it will enter into the block. Okay. Then later, whenever you sell away the asset, what will happen? Now it's a part of the block. So when you sell any asset which is a part of the block, usual depreciable asset sale, same thing only you will do even over here. You will check whether the block is empty, block is not empty. If the block is empty, you will have capital gains. If the block is not empty, you will try for depreciation. If depreciation is not possible, then you will have capital gains. Understanding? Here, you're using it for other purpose after 8 years. So there is no violation. Because there is no violation, there is no consequence. I will not tax anything under PGBP. There is no violation. Just that straight away I will give you depreciation. To give depreciation, first asset has to enter into the block. It will enter into the block at 0 value. Now when you sell it, I will treat it just like any other depreciable asset. Okay, perfect. Now comes my situation 3. In situation 3, I did not use the asset for any other purpose, guys. Only if I use for any other purpose, only then you will think of giving me depreciation and all. No, I did not use it for any other purpose. I directly sold it. Now this point is irrespective of the 8 years, which means there is no rule that you should not sell within 8 years. There is no rule like that. The only rule is that during 8 years, you should not use for any other purpose. You should continue to use for specified business only for 8 years. That's the rule. But there is no rule that you should not sell within 8 years. So whenever you sell the asset, only thing is you sold it directly. You did not use it for any other purpose. You directly sold the asset. Whether you sold it within 8 years, whether you sold it after 8 years doesn't matter, but you directly sold the asset. So when you directly sell away the asset, whatever is the selling price, that will be taxed for you under the PGBP head. That's all, guys. So 3 situations. In my first 2 situations, you're using the asset for some other purpose and then you're selling. In the third situation, you're directly selling. When you use the asset for some other purpose, I will check. Did you use it within 8 years or are you using it for other purpose after 8 years? If you're using it within 8 years, then violation. So consequence also will be there. Depreciation will also be there. But if you're using for other purpose after 8 years, then no consequence, only depreciation. But however, if you don't use the asset for any other purpose and if you directly sell it, then in that case, the selling price will simply get taxed under PGBP. Story over. Alright everybody, so this was about your discussion with respect to sale of 35 AD asset. So I'll give you one final revision. So there are 2 possibilities, guys. Possibility number 1, you used the 35 AD asset for other purpose and then you are selling it. So in this case, you will check that did you use for other purpose within 8 years or did you use for other purpose after 8 years. If you're using for other purpose within 8 years, then there's a violation. So because there's a violation, there will be consequence and also you can claim depreciation. So the consequence will be 35 AD deduction minus whatever depreciation, deemed depreciation, net number will be taxed for you in PGBP head. Then for depreciation, some number has to enter into the block, same number will enter into the block. Then if you're going to use it for other purpose after 8 years, then there is no consequence, there is no violation, no consequence. Straight away depreciation. For depreciation, the asset has to enter into the block, but it will enter into the block at nil value. Okay. Then what if you don't use the asset for other purpose? Instead, what if you directly sell away the asset? Here doesn't matter whether you're selling within 8 years, whether you're selling after 8 years doesn't matter. If you directly sell away the asset, the selling price will simply be taxed for you in the PGBP head. Story over. Alright, now no confusion. Now one last point, guys, one more point under your PGBP head. Now this is about section 28 clause 4. I had spoken to you about this sometime back only, remember? If you get any gift relating to your business or profession, it will be taxed for you in PGBP head under 28 clause 4 only. So not only gifts, guys, any benefit, any perquisite, whether in cash, whether in kind, if it is relating to your business or profession, welcome to PGBP head, it will be taxed under 28 clause 4. Now I want to give you one example, the same example which is there in your ICAI study material as well. See, let us say the assessee is a practicing lawyer. So he is having a profession, guys. He will be having professional income, therefore PGBP. So now let's say he has to go to a client for some work. So the RFA is given to this lawyer by the company, by the client, to whom he renders professional service. So I have a professional, your assessee. He renders services to a company, okay? And the company has given him an RFA. See, this assessee, he is not an employee of the company. He's a professional, he's a practicing professional. Just that the company happens to be his client and the company, his client is giving him a house to stay in. So the company, his client is giving him a perquisite. It is in kind, it is relating to his business or profession. So this RFA will be taxable for him under the PGBP head. Understanding? If the RFA is given to you by employer, it will be taxed for you in salaries head. But if the same RFA is given to you by your client or by your customer, then that will be taxed for you in the PGBP head. It becomes a perquisite for you relating to your PGBP head. Alright. So any benefit, any perquisite you get relating to cash or in kind, but it has to be relating to your business or profession, that will be taxed for you in the PGBP head. This was your 5th point. So with this, guys, All these unique and special points with respect to PGPP head I wanted to discuss with you. I'm done. Now coming to the salaries head, here I want to discuss with you 2 points. See, point number 1, let's talk about this one first. If you have any medical facility outside India, then how do you find the taxable value of the perquisite? See, with respect to medical facility outside India, there will be totally 3 things, guys. Imagine the employee needs a medical treatment in Singapore. So first of all, he'll have to travel to Singapore. There'll be travel expense. Now only the patient will not travel. Along with the patient, one attendant also will travel. Then in Singapore, you will have your treatment expense, so medical treatment expense. Then also till the treatment is going on, you'll have to take some stay. And stay will be not only for the patient but also for one attendant, guys. So whenever you get a medical facility outside India, there will be 3 components of the medical facility: the medical treatment expense, the stay expense, and the travel expense. Now let us say the employer is bearing all the 3 for you. It's definitely a benefit for you, guys. Your medical expense, that too outside India, the employer is bearing for you. It's definitely a benefit for you. Therefore, welcome to salaries head. Now, the medical treatment and the stay put together, we'll have to see how much is the amount borne by the employer. Then you will see what is a limit prescribed by RBI. So up to that limit it will be exempt. Beyond that, excess will be taxable. Like let us say employer has borne 1 crore rupees. Okay. And the RBI limit is, let us say, 85 lakh rupees. So what is the excess above the RBI limit? 15 lakh rupees extra, guys. That extra 15 lakh will become taxable for you as perquisite. Alright, everybody. So when it comes to medical treatment and stay, you'll see put together how much expense employer has borne. You'll see what is the RBI limit. Up to that exempt. Beyond that, excess will be taxable. Then for your travel, whatever expense is incurred by the employer, we'll have to see what's the GTI of the SSE. If the GTI is within 2 lakhs, then the travel expense will be exempt. If the GTI is more than 2 lakhs, then whatever travel expense the employer has incurred, it will become fully taxable. Understanding? That's all, guys, simple. So whenever there's a medical facility outside India, then in that case, there will be 3 parts. There will be 3 benefits that you will get. You will get the medical treatment benefit, the stay benefit, and the travel benefit. The stay will be for patient and one attendant. The travel also will be for patient and one attendant. The patient has to be 3D plus spouse over here. 3D plus spouse, you know how we learn relatives through diagrams. So 3D plus spouse means I will draw a plus. I will write the letter D in 3 places and then I'll write the word spouse. So 3D plus spouse. So which means the patient should be either the employee himself or the employee's dependent brother, dependent sister, or dependent parents, or children of the SSE, or spouse of the SSE. Okay, so if the facility is outside India, the treatment and stay put together, I'll see how much is the expense. I'll see what is the limit prescribed by RBI. Up to that exempt, beyond that excess is taxable. Then the travel expense which is borne by the employer, either it will be exempt or it will be taxable. It depends upon the GTI of the SSE. If GTI is within 2 lakhs, then the travel expense will be fully exempt. If the GTI is more than 2 lakhs, then the travel expense will be fully taxable. Okay, now listen, coming to the next point, very often I get this doubt from students that ma'am, if there is RFA in the question, how will I know I have to index it? Very simple, guys. See, you will index if both these conditions are fulfilled. Point number 1, the same RFA is given to the SSE for multiple years, which means the current year is not the first year of the RFA. Same RFA was given to the employee last year also, okay? And same RFA we are continuing in the current year also, which means it's not like a new RFA given in the current year only. It's an RFA which is a continuation of last year's RFA, okay? And condition number 2, they have to give you the last year's taxable value of the RFA. So when will you do indexation? Only if 2 conditions are fulfilled. Condition number 1, let us say your current year in the examination is 24-25, right? So it should not be a case where freshly new house we're giving in 24-25. No, it should be a continuation of last year's RFA. So let us say in preceding previous year 23-24, the employer had given an RFA to the employee. That same RFA is being continued even in 24-25. So current year is the subsequent year of the RFA. And the 23-24 RFA value they have to give you. So only if both these conditions are fulfilled, you will be indexing. Which means if the current year is the first year, if the current year is the first year of the RFA, or if it's a subsequent year, but they have not given you last year's RFA value, then you will not index. Okay, so when will you index? Only if number 1, the current year is subsequent year and last year's RFA value they have given to you. Okay, guys. So in that case, you will do the indexation. Now, how to do the indexation? You know, I just wanted to show you that when do you do the indexation? Current year is the subsequent year and they have given you last year's RFA value also. So these 2 points I wanted to tell you in your salary set. There is one small point in IFOS, guys. Post office savings interest. You get 3,500 exemption, right? interest plus, post office plus, savings account, you get 3,500 exemption. But this is if it is an individual account. If it is a joint account, then you will be getting 7,000 rupees exemption. So one single person having the account, 3,500, but joint account between two people, 7,000 will become the exemption. Okay, then 10AA, I've already told you this point in one of the questions in the past, that 10AA deduction you will get only if you commence the manufacturing by 31st March 2020. But in letter of approval cases, if you got the letter of approval by 31st March 2020, then you must have commenced manufacturing by 31st March 2021. Okay. Now see, when you compute 10AA, what's your formula, guys? Net percentage is what I generally tell you. That is net profit, nothing but your PGBP number of that particular unit into export turnover by total turnover into the percentage, guys. Sometimes 100%, sometimes 50%. Now see, in this export turnover and in this total turnover, freight should not be included. That you're already aware of. That if there is freight included, you'll have to remove freight from both. Okay. But however, there are some more points also which should not be a part of your numerator and denominator. Any telecommunication charges, then insurance charges, and expenses incurred to provide the services outside India, all these also should not be a part of your numerator and denominator. Just like how you know that freight should not be a part of numerator and denominator, there are these other expenses also which should not be a part of your numerator and denominator. Okay, this was one small point in 10AA. Now listen, I want to do one nice discussion with you touching upon three sections: section 80 triple C, section 80 CCD, and section 80 CCH. Listen carefully, okay? This is that part of the chapter 6A which generally many of you are very confused about. See, listen, 80 CCD, how to compute the deduction you know very well. 80 CCD 1, 80 CCD 1B, 80 CCD 2, how to do the computation you know very well. But in all the three sections, there is not just deduction concept. In all the three sections later, you may also have a receipt of money. That receipt of money, how to treat it? Will it be taxable? Will it be exempt? That is what I want to discuss with you about. See, when you make the contribution to NPS, you will get a deduction in 80 CCD. When you make a contribution to the Agniveer fund, you will get a deduction under 80 CCH. When you make a contribution to annuity plan of LIC, you will get 80 triple C, no doubt. Contribution you make, you will get the deduction. But there is one more transaction under these sections, guys, wherein you are receiving money. So that receipt of money tax treatment is what I want to discuss with you. Okay, slowly, nicely, carefully listen to me. Sit up straight, patiently listen to me. Once you understand, you will not forget. See, let's talk about 80 CCD first. So when you make the contribution to 80 CCD, when you make the contribution to NPS account, you will get deduction in 80 CCD, guys. But however, when you close the account, okay, and when you withdraw the money from the NPS account, whatever money you withdraw from the NPS account will be taxable. Whether the assessee is withdrawing the amount, whether the nominee is withdrawing the amount, it will be taxable. So when you close the account, when you withdraw the money, it will be taxable. But however, in 4 cases, it will be exempt, guys. Let me explain it to you over here. So what's your general answer? Your general answer is from the NPS account. If you're closing the NPS account and whatever money you get from the NPS account, whether you are the assessee or after the assessee's death, if you are the nominee, then this amount will be taxable. But there are 4 cases where this amount will be exempt. Point number 1. In the first point, you are not closing the account, guys. There's no closure of the account. You're just making a partial withdrawal. So how much money you are withdrawing? Let us say you're withdrawing only up to 25% of the contribution. Then this money which you're withdrawing, just within 25%, this partial withdrawal, this will be fully exempt. But please know that this is only for employee. If you happen to be a self-employed person, then this exemption is not available for you. Okay, first point. Then comes the second point. Let us say the assessee died. So when the assessee died, what did the nominee do? The nominee went and closed the NPS account. Okay, so when you close the NPS account, whatever money is there in the NPS account will be given to the nominee. So this money which the nominee gets upon the closure of the NPS account after the assessee's death, this will also be fully exempt. Second exemption. Then comes a third exemption. Let us say the assessee, he itself closed the NPS account. So when he closes the NPS account, whatever money is there in the account, he will get, guys. Now whatever money he gets, 60% of this money will always be exempt. Okay. Then comes the point number 4. The balance 40% is there. No, that will be taxable. But he's saying no, this balance 40% also I want exemption. For that, there's a way out. This balance 40% also will be exempt if he puts this money into some annuity plan of LIC. Then in that case, this balance 40% also will become exempt. Easy, guys. So generally what happens when you withdraw money from NPS, it's going to be taxable for you. But however, in these 4 cases, the money withdrawal will be exempt. Number 1, if you're making a partial withdrawal of up to 25%, but you're not a self-employed person. Number 2, you're closing the nominee, point number 2, the assessee died and the nominee closed the NPS account and took the entire money. So even in that case, it will be fully exempt. Then if the assessee himself closes the nominee, the NPS account, and if he withdraws the money, then 60% will always be exempt. The balance 40% also, if you want exemption, even for that there's a solution. The solution is simply put this money into annuity plan of LIC. Even that will become exempt for you. Okay, same thing I've put for you here also. Alright, now listen. The last part over here, let us say your assessee is not closing the NPS account. The nominee is also not closing the NPS account. Assessee is also not closing the NPS account. NPS account is still existing. From that NPS account, you're getting pension. Whether assessee is getting the pension, whether nominee is getting the pension, for both it will be taxable. Now this point, if you look at the checkmate book, it will be written wrongly. So please correct it. So whatever pension you get from the NPS account, whether the assessee receives or whether the nominee receives, it will be taxable only. Okay. See, be careful. Listen to me. Okay. One confusion is possible for you over here. See, if the assessee dies, alright, and the nominee closes the NPS account and withdraws the entire money from here, that will be exempt, guys. But however, if the assessee dies, but the nominee does not close the NPS account, he just continues to get pension from the NPS account, this pension will be taxable. Understanding? Only when you close the NPS account and get the money, that will be exempt. But if you don't close the NPS account and you continue to get the pension, that will be taxable in the nominee's hand. So pension will be taxable. Whether in assessee's hands, whether in nominee's hand, that will be taxable always. But when you close the account and when you get the money, that also is taxable generally. But in these 4 cases, exempt. What are the 4 cases? Partial withdrawal, 25% number. Then 60% will always be exempt. Balance 40% also, if you want exempt, you can simply put into annuity plan of LIC. And lastly, if the assessee dies and upon his death, if the nominee closes the account and withdraws the entire money, even that will be exempt. But pension will always be taxable. Whether in assessee's hands, whether in nominee's hands, always it will be taxable. Okay. Then comes your next discussion, 80CCC. See, when you put money, when you contribute into a pension fund of LIC, you will get 80CCC deduction, guys. Now, from that same pension fund, when you get pension, whether the assessee receives a pension, whether the nominee receives a pension, it will be taxable under IFOS head. I'll repeat again. Let's say there's a pension fund. Now, in the pension, to the LIC pension fund, the assessee is making a contribution. So, this contribution will go under section 80CCC, guys. You'll get a deduction. Now, from the same pension fund, whether the assessee, whether the nominee, whoever gets the pension will be taxable. So are you noticing, whether you get pension from the National Pension Scheme, whether you get the pension from this pension fund, whether assessee gets a pension, whether nominee gets a pension, the pension will always be taxable. Okay, now coming to the next discussion, section 80CCH. This also I'll explain to you over here, okay. So in section 80CCH, what happens is, we're talking about the Agniveer Corpus Fund. So the assessee will also make a contribution to the Agniveer Corpus Fund. Even the central government will make a contribution to the Agniveer Corpus Fund. Whatever the assessee contributes, full amount, you will get deduction under 80CCH subsection 1. Whatever the central government contributes, there will be 2 tax treatments. First, it will be taxable, guys. It will be fully taxable under the salaries head. And secondly, you will get deduction under section 80CCD, under 80CCH subsection 2, you will get a deduction. The entire amount. There's no maximum limit and all over here. So whatever the assessee contributes, 80CCH deduction. Whatever the central government is contributing, first fully taxed under salaries head, then you will get 80CCH subsection 2 deduction. Okay. Now listen. Later, from this Agniveer Corpus Fund, the assessee will get pension. That pension, whether assessee gets, whether nominee gets, it will be exempt. Are you now understanding why I'm discussing this with you? You understood what is the scope of confusion? Yes, guys, from 80CCD fund, if the assessee or the nominee, if they get pension from this 80CCD fund, that pension will be taxable. From 80CCC fund, whether the assessee or the nominee, whoever gets a pension, the pension will be taxable. But from 80CCH fund, that is Agniveer Corpus Fund, whoever gets a pension, whether assessee or nominee, this will be exempt, guys. Alright, yes, and also remember, ATCC head subsection 2 is one of those unique sections which you can enjoy under both, under the normal regime also, under the default regime also, under both the regimes you will get this deduction. Alright, so this was my discussion with you with respect to the deductions chapter, some unique points. 10AA I spoke to you about, then 80CCD, 80CCC and 80CCH. Contribution I make, I'll get deduction, you all know. But what if I receive money from the same source? That is what I wanted to discuss with you. Okay guys, now listen, coming to our next discussion, a small discussion with respect to reverse mortgage. We are now stepping into a capital gains chapter. In the capital gains chapter, there are two things I wanted to discuss with you. Now first of all, I want to talk to you about reverse mortgage. See guys, in reverse mortgage, there are totally 3 transactions. Okay, transaction number 1, let's say there's an assessee and this assessee wants a loan from the bank. So the assessee will mortgage the assessee's house, let's say, mortgage of the house with the bank, and against this, the bank will now give loan. This loan will generally be, in such cases, the loan will generally be in the form of periodical installments. Okay, and let us say later the assessee is not able to repay this bank loan, so the bank will later sell away the house. Alright, so these are your 3 transactions generally in reverse mortgage. The first transaction, when the assessee mortgages the house with the bank, okay, the first transaction, this will not be considered as transfer, and because it is not a transfer, there will be no capital gains. Then when the assessee gets these periodical installments from the bank, this will be considered as an exempt income and it will not be taxable for the assessee. However, later when the bank sells away the house, at this stage there will be capital gains. Capital gains for whom? Capital gains for the assessee. These are your 3 transactions, guys. We are all aware of it. Now listen, there's one small point I have to talk to you about, the alienation point. In your study material, if you see, there's a true or false question wherein they have asked you something like, if the assessee alienates a property under reverse mortgage, will it result into transfer or not? Something like that. One true or false question is there. Now, if you see practically, this word alienation refers to the fact, to the transaction where the bank later sells away the house. This is generally called as alienation practically. So therefore, alienation, yes, it does result in transfer and there will be capital gains. But however, in our material, this alienation point, they are referring to the first transaction, guys, wherein the assessee is mortgaging the house to the bank. So when you mortgage the house to the bank, this is not considered as transfer and hence there will be no capital gains. So we will follow the ICAI study material blindly. ICAI study material is our Bible. So will alienation in reverse mortgage cases, will it result into transfer? Your answer will be false. So which transaction are we referring to over here? We're referring to the first transaction over here. We're referring to the mortgage transaction. Mortgage will not result in transfer and hence there will be no capital gains. Okay, so reverse mortgage, totally 3 transactions. When you mortgage the property, it is not considered as transfer. There is no capital gains and the ICAI study material is referring to this transaction as alienation. Then transaction number 2, when you get periodical installments from the bank against this mortgage, that will be considered as an exempt income for you. And finally, when the assessee is not able to repay the loan, when the banker sells away the house because of this, now there will be capital gains. Capital gains not for the bank, capital gains for the assessee. Okay, this was about reverse mortgage. Now listen to me. Coming to our next discussion, section 54 EC plus capital gains deposit account. Simple concept only, easy concept, listen to me. See, generally, when you purchase a new asset, you should purchase a new asset within the time limit, guys. Basically, I'm talking about your section 54, section 54B exemption, section 54D exemption, section 54F exemption. In all of these exemption sections, you're buying a new asset, right? Like in 54B, you're buying a new agricultural land. In 54F and in 54, you're buying a new residential house property. So you should purchase a new asset within the respective time limit. Like some sections, you have 2 years time limit. Some sections, you have 3 years time limit. So whatever is the time limit, you should purchase it within the time limit. But you should also purchase it within your 139.1 date, guys. So you should not only purchase it within time limit, you should also purchase it within 139.1 date, which I often call as the earlier date. What is the earlier date? I will tell you. 1 minute you wait. So I should purchase it within the time limit. I should also purchase it within earlier date. If I do that, then the CGT account concept, your capital gains deposit account concept will not apply. But however, if I make the purchase of the new asset within the time limit. But if I make the purchase after the earlier date, then in that case, the CGD account concept will apply, which means I have to put the money in CGD account, only then I will get my exemption. So see, I'm not discussing right now with you what is CGD account, that you would be aware of. I just have to show you one small point comparing 54EC in this entire discussion. So therefore listen to me. My point is, what is earlier date? Wait, I'll tell you. My point is, in these 4 exemption sections, I have not written 54EC. So in these 4 exemption sections, if you purchase a new asset within the applicable time limit and also within the earlier date, then CGD concept itself will not apply. But if you purchase a new asset within the time limit but after the earlier date, then in that case you have to put money in CGD, only then you will get your exemption. Okay. Now what is this earlier date? This earlier date is nothing but whatever is your applicable 139(1) due date. Whatever is your due date to file the income tax return, or when did you actually file your income tax return, whichever is earlier. So what is your 139(1) due date, or when did you actually file ITR, whichever is earlier. So if you buy this new asset within the time limit and also within this earlier date, then no requirement of CGD. But if you buy the new asset after this earlier date, that is after your ITR date, if you file the new asset, if you buy the new asset, then you have to put money in CGD. Okay. Now listen, the whole confusion arises in 54EC, guys, because in 54EC, there is no concept of CGD account. So here there are various possibilities. Now whatever I'm discussing with you over here, again it is something which has not been tested in the exam till now, but you should be aware of. See, if you purchase it within the time limit, and also if you purchase the bonds, 54EC guys, you have to buy bonds. You have to purchase the bonds within the time limit, within 6 months, and you also purchase the bonds within the earlier date, let us say, then no problem. You can enjoy the 54EC exemption. You can enjoy, no problem itself. But however, understand, what if I purchase the bonds within 6 months, guys? But I'm purchasing the bonds after filing my ITR. So after I file my ITR, then in that case, tell me, when I filed the ITR, did I purchase the bonds? No, guys, I purchased the bonds only after filing the ITR. So in the ITR, can I claim any 54EC exemption? I can't claim. But then, however, I purchased the bonds after filing ITR. No. So in that case, what I will do is, I do have an option. I can file revised ITR. Do you have this concept in the other sections? No, because in other sections you have CGD concepts. Other sections are saying, listen, if you want to purchase a new asset after earlier date, put money in CGD account. Then only you will get exemption. But in 54EC, there is no concept of CGD account. So therefore, if I want to buy the bonds within 6 months, but after filing my return, no option of putting money in CGD. So in that case, when I file my ITR, I will not claim 54EC. Then after filing my ITR, when I buy the bonds, then I will revise my ITR and I will claim my 54EC exemption. In the revised ITR, 54EC exemption I will claim. Okay. Now one more possibility is there, which I saw very recently practically, so I want to share it with you. So what happened in that particular case is, this particular client, this particular SSE, he wanted to buy 54EC bonds. Okay. He purchased it within the time limit. Within 6 months from the date of transfer, he purchased the bonds. Okay. And let us say his ITR due date, basically his 139(1) due date was 31st July. Alright, but he purchased the bonds only after 31st July. So he purchased bonds after 139(1) date. Let us say he purchased the bonds only on the 1st of September. Alright, and when he purchased the bonds, no, on that date, he had not even filed ITR. So only after purchasing the bonds, after that only he is going to file his ITR. Let's say on 2nd September only he is going to file his ITR. So first of all, do you agree that he is filing a belated return, guys? He's filing a belated return. His due date was 31st July, but he's filing his return only on 2nd of September. So he's filing a belated return. Okay. Now the question arose that in this belated return, can he enjoy 54EC exemption? The answer is yes, because in 54EC, no concept of CGD, guys. So did he purchase within 6 months? Yes, he purchased within the time limit. Yes, he purchased within 6 months. So okay, even though he purchased the bonds after the 139(1) date, it's okay. The fact is, the most important point is, in 54EC, if you want the exemption, you have to purchase the bonds within the time limit. That's the most important point. So even if you purchase the bonds after 139(1) date, no problem. Even if you purchase the bonds after you file your return, no problem. After filing return, if you purchase the bonds, then in that case, you can simply revise the return and you can enjoy the exemption. If you purchase the bonds after your 139(1) date, and by that date, if you have not filed ITR, that is, if you're going to file belated ITR, in the belated ITR also you can enjoy 54EC exemption, no problem. Understanding? So if it is 54, 54B, 54D or 54F, not only should you purchase a new asset within the time limit, also you should purchase a new asset within the earlier date. Only then you will get exemption. No need of CGD account in that case. But if you purchase a new asset within the time limit but after the earlier date, then in that case you have to put the money in CGD account. Only that much money you will get exemption. But don't forget, what is the earlier date? Earlier date is nothing but your 139(1) due date, or when did you file your ITR, whichever is earlier. Now in 54EC, I gave you three situations. In the first situation, my assessee put the ideal, this is the ideal situation guys, where my assessee should buy the new bonds within the time limit also. He should buy the new bonds within the earlier date also, that is within the ITR date also. So if he does that, then he can claim 54EC exemption, no problem. But if he buys the bonds after filing ITR, then in that case, he can revise the ITR, and in the revised ITR, he can claim the exemption. Then last point was, in the belated return, can you claim 54EC exemption? Yes, in belated return, you can claim 54EC exemption, because in 54EC anyways, there is no concept of CGT account. So therefore, you can file the return late, and in the late return also you can claim 54EC, even that will be allowed. Okay, so this was about your capital gains plus CGT concept, that discussion I wanted to have with you here. Alright, so the same thing is even mentioned over here as well. Now coming to our TDS discussion guys. In TDS, one small concept I wanted to discuss with you. See, you know about section 194N very well guys, cash withdrawals. Now in cash withdrawals, whenever you withdraw money from bank, cooperative bank or post office, the person who is withdrawing money, we check whether he is a defaulter, whether he has filed his ITRs properly, or whether he is not a defaulter, right? So if this person who is withdrawing the money happens to be a defaulter, then in that case, if you're withdrawing money up to 20 lakh, no TDS. If you withdraw money more than 20 lakh but up to 1 crore, then you will have to pay the TDS will be 2% of the excess. And then if you withdraw money more than 1 crore, then the TDS rate will be 5% of the excess. This is what you have learned guys. But however, if you're not a defaulter, that is, if you have filed your returns properly, then in that case, if you're withdrawing money up to 1 crore, then there will be no TDS. And if you withdraw more than 1 crore, then 2% of the excess will be the TDS. Right guys? And by the way, what do you mean by defaulter? Defaulter means our year in the examination is 24-25. Immediately preceding previous year is 23-24. Leave 23-24. See it 3 years before that. So 22-23, 21-22 and 20-21. In all of these 3 years, assessee has not filed the return. Then he will become a defaulter. Which means even 1 year if you file the return, then you are not a defaulter. Okay. Now these are the limits generally. But the person who is withdrawing the money, what if this person happens to be a cooperative society? Then what will happen? In that case, wherever you have the 1 crore number, instead of the 1 crore number, you will write the 3 crore number. That's all. Understanding? See, I'm not saying if you withdraw money from cooperative bank, answer will change. No. I'm saying the person who is withdrawing the money, the account holder, the person who is withdrawing the money, if that person happens to be a cooperative society, then wherever we have the 1 crore number, I changed it into 3 crore. This will become your revised limit. Okay, this was a section 194 endpoint. Alright guys, then we have this gross and net. Now this is something which I want you to be careful about, alright, because a lot of confusion is going on in CA final students also amongst this, about this. So listen to me. So in case the question says interest from FD, gross. So in that case, they've already given you the gross number, so you don't have to gross it up. You can take this number as it is. Okay. Then if the question says interest from FD, and this FD interest is credited in the P&L account, nothing else they have mentioned. Either in the adjustments they have written credited in the P&L, or they have directly put this money on the credit side of P&L account. Then think accounting point of view guys. Accounting point of view, you always put the gross number in the P&L account, right? So if the interest is credited in the P&L account, then it is already grossed up. So take it as it is. You don't have to gross it up now, okay? However, if they use the word net, then this is a net number. You will have to gross it up. So how will you gross it up? 54,000 into 100 by 90. Interest on FD, 194A, 10% TDS. So 100 by 90, 60,000 will become your actual interest income, which will go into your IFOS head. So when the question itself uses the word net, then when I'm putting it in the IFOS head, I have to gross it up. Then, if the question says interest from FD credited in the bank account, or received in the bank account. Like this, they will generally put in the additional information. They will use these words in the additional information. So if they, in the additional information, if it is mentioned interest from FD credited in the bank account or interest from FD received in bank account. So when you're receiving, you will receive the net amount only, guys, after deducting TDS. So therefore you have to gross it up when you put it in the IFOS head. Understanding? So if the question just says interest from FD, the question doesn't say anything else, then it is already gross, guys. You don't have to do anything else. If the question says that, interest from FD, and if they use the word gross in brackets, then it is already grossed up. So you don't have to do anything else. If the question says it is interest from FD and they use the word net, it means they have given you the net interest. So you have to gross it up and then only put it in the IFOS head. If the question says interest from FD is credited to your P&L account, in the P&L account always the gross interest only will be credited. So here you don't have to do anything else. But see, if it is credited in the P&L, but in brackets if they have used the word net, then of course it is net interest, you have to gross it up. Alright. Then if the question says interest from FD and if they say it is credited to your bank account or if it is received in your bank account, they have mentioned this in your additional information. In that case, what amount do you receive in your bank account? The net amount only. So therefore now you have to gross it up. Alright everybody, don't get confused. In the P&L account, they have credited it. But they have used the word net in brackets, then it is net, guys. You have to gross it up. If they just credit it to the P&L account and they don't mention anything, then in the P&L account, generally we credit the grossed up number only. So you don't have to do anything. But however, in the additional information, if they mention that interest income is credited into the bank account or received in the bank account you will always receive the net number only. So now you have to gross it up. Okay, so this was about your grossing and net of grossing up and netting of the interest because of TDS. Now look at this, guys. You have to tell me whether it is agricultural activity or not. I just did basic operations and I'm having income. This will be agricultural income. I did basic operations and subsequent operations. Even this will become agricultural income, guys. Subsequent operation, but you have to put a full stop somewhere. Where? Once a produce is marketable, till there it will be agricultural income. Once a produce is marketable, after that if you do more activity, that will become business income. Alright. But if I do only subsequent operation, then it will not be agricultural income. Basically in agricultural income, basic operation is mandatory. Okay. But however, there's an exception. Nursery. In nursery, even if there is no basic operation, it's okay. It will still be agricultural income. Alright. Then dairy farming. This is not agricultural income. Fishing. This is not agricultural income. Butter and cheese making, poultry farming, all this is not agricultural activity. Then, if I grow flowers, which is called as floriculture, this is going to come under agricultural income. When I grow fruits, which is called as horticulture, even this will come under agricultural income. Growing bamboo, even this will come under agricultural income. And growing pasture for consumption of animals, it is not for consumption of humans, it's for consumption of animals, but this will also come under agriculture. Okay, guys. Then, Rule 6DD. Rule 6DD talks about those cases where Section 40A3 will not apply. What is 40A subsection 3? 40A subsection 3 says, right, that in case you incur expense and if you're making payment of the expense, payment more than 10,000, you should make the payment in specified mode. If you make the payment more than 10,000 in non-specified mode, it will be disallowed for you in PGBP. So, in relation to PGBP is what I'm discussing with you right now. So, Section 40A3 says if you're making the payment more than 10,000, then you should make the payment in specified mode, otherwise it will be disallowed. But that 40A subsection 3 is not applicable in some cases. These exceptions are mentioned in Rule 6DD. Here, if you make any payment to any bank, any LIC or RBI or government, if I have to make payment to the government or to the bank or to the RBI, then 40A subsection 3 will not apply, which means more than 10,000 also, I can make the payment in non-specified mode also, no problem, no disallowance for me. Okay. Similarly, if I make a payment directly to a farmer, or if I make a payment to a fisherman, or if I make a payment to a dairy farmer, or to a poultry farmer, or if I make payment to a person who is rearing livestock, basically he is rearing animals. Like, let's say I am making payment to him because I want to buy animal skin from him or animal hide from him. Here also I can make the payment more than 10,000 in non-specified mode, no disallowance for me. Then if I make payment to a person because I want to purchase goods manufactured without electricity, without power in cottage industry. All these payments I can make in a non-specified mode, guys, no problem. 48(3) disallowance will not get attracted. Similarly, if I make payment to a person who lives in a village which is not served by a bank, so in basically what I'm trying to tell you is, in all these cases, I can make the payment more than 10,000. I can make the payment more than 10,000 in non-specified mode. Still, there will be no disallowance for me. It will be fully allowed. Okay. Now, why have I put these two tables side by side? I want you to notice dairy farming, fishing, poultry farming, all this is not coming under agriculture, guys. Yes. But however, when I make payment to the dairy farmer, when I make payment to the fisherman, when I make payment to the poultry farmer, here 48(3) is not applicable for me, which means here in this rule 60D, whether you make payment to the farmer for agriculture products or whether you make payment to the fisherman, dairy farmer, poultry farmer, same treatment only. Rule 60D will apply, 48(3) will not apply, disallowance will not be attracted. But however, can I say that all of these are agriculture? No. Farmer, agriculture. But fishing, dairy farming, poultry farming is not agriculture. Okay, so the thing is, I've noticed that, students are getting confused between these two lists. That's why I thought I'll, put this in front of you that there's a difference. The dairy farming, fishing and poultry farming is not agriculture, okay? But in Rule 60D, there are some cases where you can make the payment more than 10,000 in non-specified mode, still you will not have any disallowance. Here, we are not talking only about payment to farmer. Here we are covering payment to fisherman, dairy farmer, poultry farmer, we are covering them also. Alright, then ground rent. When I pay ground rent, for me it's an expense. If I pay ground rent, it's an expense for me. This expense you cannot allow in IFHP, guys, because in IFHP you have 30% standard deduction, right? It covers all expenses already. So you can't allow the ground rent. But when I receive ground rent, it means it's an income for me. So when I receive the ground rent, it is rent for land. Rent for land will go under IFOS head. It will be taxable for me. Understanding? So when I pay the ground rent, it's an expense for me. But under IFHP head, it will not be allowed. When I receive the ground rent, it is income for me, income from a plot of land. It will go under IFOS head. Alright. Then just some last few points. Depreciation on computer, 40%, guys. Depreciation on professional books, 40%. Depreciation on electric vehicles is also 40%. Depreciation on windmill is 40%. And depreciation on energy saving devices is also 40%. Then be careful when the question says income from salary. Income from salary, then your income from house property, all these are already computed, guys. So you don't have to now subtract standard deduction. It is already computed. This is the name of the head of income, right? Income from salary, income from house property. So this is your taxable salary number, not your gross salary number. So it's already computed. You don't have to give standard deduction. Income from house property, when they use this language, even this is already your computed IFHP. You don't have to now subtract standard deduction and all. But however, when the question says rent from house property, then this is not computed. So from this you have to subtract your standard deduction of 30%, only then you will get your IFHP number. Understanding? Similarly, if the question says salary credited, or if the question says assessee earned salary, or the question just says salary income, alright. So in all these cases, it is not computed. You have to subtract standard deduction, 50,000 in the normal regime or 75,000 in the default regime. Understanding? But remember, if it is income from salary, this is the name of the head. Income from house property, this is the name of the head. So if they've used this terminology, then it's already computed income. But if they say salary income, or if they say rental income, or if they say salary credited, or if they say he has received the salary or earned the salary, then it is not computed number. You have to subtract standard deduction. Alright, then loss from futures and options. This is non-speculative business loss. Loss from trading in equity shares is also non-speculative business loss. Loss from trading in commodity derivatives, even this will be non-speculative business loss. But however, intraday trading in shares, this will be speculative business loss. I'll tell you how to identify. See, when do you say it is speculative business? Either it is intraday trading, okay, or let's say the question says that assessee just wants to enjoy a fluctuation in price, or let's say the question says assessee is not taking delivery of goods. Only in such cases you can call it speculative business case. But futures and options, just trading in equity shares, commodity derivatives, all this is not speculative, okay? Either intraday trading, or you just want to enjoy fluctuation in price, or you don't take a delivery of goods, only then it becomes a speculative transaction. Alright, then look at this last part. If you borrow a loan to pay municipal taxes, okay, in IFHP head, interest on this loan will not be allowed. In other words, in house property under section 24, you allow interest, right? This interest has to be relating to purchase of the property, or construction of the property, or repair of the property, or renewal of the property, or for reconstruction of the property, or for renovation of the property. It has to be anything relating to the property in these manners. But if the interest is relating to municipal tax, to pay municipal tax, I borrowed a loan. On that loan, if I am paying interest, this interest will not be allowed in section 24. So, interest on loan borrowed to pay municipal tax under IFHP head, this interest will not be allowed under section 24. Okay. Then, cost of living allowance, this is nothing but your dearness allowance. Alright. Then comes your last point over here. Look at this. Let's say the question says, assessee has received salary of 7,20,000 in his NRE account, non-resident external account, maintained with SBI Chennai branch. See, if these 4 conditions are fulfilled, then the salary income will be exempt. See, we all know very well that NRE account interest is exempt, okay? But now we're talking about salary income also. But what are the conditions? Condition number 1, assessee has to be a non-resident. Condition number 2, this assessee has to be a crew member of a ship, alright? Condition number 3, the ship has to be a foreign going ship. I'm not saying the ship is a foreign ship. It can be an Indian ship or a foreign ship. But it's a foreign going ship, which means the ship is leaving from India and going to a different country. Basically international traffic, okay? And lastly, the salary income is received in NRE account, which is maintained in an Indian bank. So if all these conditions are fulfilled, then the salary income will be exempt. We know very well that interest income that we get from NRE is fully exempt. That you must have learnt in your IFOS head as well, that whatever interest income, whatever interest income we earn from NRE account is exempt. Now I'm talking about salary income which is received in NRE account. Even this will be exempt if assessee is a non-resident, assessee is a crew member of a ship, the ship is a foreign going ship, and NRE account is with an Indian bank. So if these conditions are fulfilled, even this salary income will be fully exempt if it is received in NRE account, okay? Then just a last few extra points. When it comes to additional depreciation, who can enjoy additional depreciation? Either assessee must be a manufacturer, or assessee must be in printing or publishing books, or the assessee must be in the business of generating or distributing or transmitting power, guys. So you have this point even in SLM, and you have this point in additional depreciation also. So be careful, there's an overlap. So additional depreciation, either you must be a manufacturer, or you must be in printing or publishing books, or you must be in the business of generating, distributing or transmitting power. Alright. See, manufacturer point you know very well, in multiple questions you must have seen already. Printing, publishing we saw in these questions itself. I just wanted to bring this point also in front of you, because once we have an observation of this point, then we've completed additional depreciation fully. Then comes the next point, guys. What happens when you sell away a scientific research asset? See, sale of section 35 AD asset we saw already. Now coming to sale of scientific research asset, there are 2 possibilities over here. Either I put it into some other use and then I sell the asset, or I directly sell the asset. If I directly sell the asset, this is more common in the examination. In that case, you will see what is the section 35 deduction that you had enjoyed earlier when you purchased the asset, and what is the selling price. Out of these, whichever is your lesser number, this will become your PGBP income. This will be taxed your PGBP. Simple. So whatever your selling price or section 35 deduction, whichever is lesser will be your PGBP. Then one more tax implication you will have. Normal usual capital gains computation you will be having over here. Usual capital gains computation, capital asset transferred, period of holding, full value consideration, usual computation. Only thing is, in this computation, you can't have a loss. So by chance you have a loss, you will simply ignore the loss. Generally capital gains head you can have a loss, guys. But in scientific research asset, when you sell away a scientific research asset, when you sell that away, in capital gains computation you can't have a loss. If you have a loss, you will ignore the loss. Okay. But however, what if I put it into some other use and then I sell the asset? then in that case, when you put it into some other use, it will enter into the block, guys. But it will enter into the block at 0 value. Now it's a part of the block. So later, whenever you sell away the asset, you will treat it just like any other depreciable asset. Just like how whenever you sell away a depreciable asset, you check whether the block is empty, not empty, usual thinking. Okay. So come on, now let's do one nice quick revision. 35 AD asset. When you sell away this one, what do? You first check, did I put the asset into any other use and then I sold the asset, or did I directly sell the asset, guys? If I put it into any other use and then sold the asset, then you will check, did I put it into any other use within 8 years, or did I put it into any other use only after 8 years? So if I put it into any other use within 8 years itself, then in that case, I will have a consequence. Remember the consequence, guys? 3580 deduction minus deemed depreciation, the net number, that will be taxed under PGBP head, and then I'll get depreciation. The same number will enter the block also. But if I put it into some other use after 8 years, then there is no consequence. Straight away, I will get depreciation only. 0 value will enter the block, and I will treat it just like any other depreciable asset. Then, what if I don't put the asset into some other use? What if I directly sell away the asset? If I directly sell away the asset, then whatever is the selling price will be taxed for me in the PGBP head. This is what we learned for 35AD asset. Now we spoke about section 35 asset, scientific research asset. What if I sell away a scientific research asset? Even over here, same thing you will check. Did I put it into some other use and then sell, or did I directly sell? Same thing you will check even over here. If I put it into some other use, guys, and then if I sell the asset, then in that case, you have to be a little careful. When you put it into some other use, it will enter into the block, but it will enter into the block at 0 value, at nil value, and then you will treat it just like any other depreciable asset. But if you directly sell away the asset, this is the most important part. If you directly sell away your section 35 asset, then in that case, I will see the selling price. At what price am I selling the asset? I'll see when I purchase the asset, how much section 35 deduction I had enjoyed. Whichever is lesser, this lesser number will be taxed for us under the PGBP head. In addition to this, we will also have normal, usual capital gains calculation. But in this capital gains calculation, you can't have a loss. You can't have a capital loss. By chance you have a capital loss in this calculation, you will ignore. Alright everybody, that is it. And before I close, one last point, I just wanted to show you the positioning of 87A rebate and 89 relief. See, when you are calculating 87A rebate, it is right after basic tax. It is before cess. But your section 89 relief, remember we did a question on section 89 relief. That's your last step, guys. That is after cess. Okay. Just this positioning I wanted to show you. Alright guys, that's it. This is it with all the 4 parts of our marathon. In the first part, I discussed with you 27 questions which were, unique questions which had some amazing adjustments or some big reminders. Then I discussed with you some case-based MCQs, the most important or the most tricky case-based MCQs from the MCQ booklet released by ICAI. Then I discussed with you 3 questions which were actually a compilation of your weird adjustments, basically some, different adjustments, the compilation of these weird adjustments. Then I discussed with you some not important but important concepts, the hidden concepts from your syllabus, like this salary NRE account. Trust me when I say this, 99% of the students are not even aware of this. So these little points, these tiny points I wanted to discuss with you. That is it, guys. With this, I can say that we are done with the entire marathon that I wanted to do for you with respect to DT. I did not want to do a usual DT marathon of me just running through the concepts with you, because then there's no point. Because in the examination, you don't have to write theory, you have to solve the questions. That is why I wanted to do a good amount of solving for you. And through that, I wanted to give you a revision, and that is what I think we've been able to achieve through this entire discussion. Of course, I will not make a false promise over here and say that no, full syllabus has been revised. Of course, that is impossible. Come on, something that we do in 150 hours, 180 hours in class. We can't finish the entire revision A to Z, every nook and corner in 9 hours. We can't do that. But however, an exam-oriented revision is what I've tried doing for you, covering the most important adjustments, the most repetitive adjustments, the highly expected adjustments from your examination point of view. I really hope that this entire video has added some value to you. I hope there was some new point that you learned through this video. I hope all this hard work was worth it. I hope you did have, multiple light bulb moments and, good morning moments, areas that you realize silly mistakes were possible. And I just hope it was a nice, good learning experience experience for you. So that's it, guys. This entire video is like a cherry on your preparation, alright? It's like the cherry on the top. It just adds that final touch to your preparation. The usual concepts, the usual points, ATC, PPF, the usual points you know very well. The hidden points, the points which you might have missed, I just tried reminding you of all those points through this discussion. That's it, guys. With this, you are done with the last leg of your preparation, and with this, with full on contentment, you can close over here. And do let me know in the comments below if this video was even one bit of help for you. Alright, thank you guys. Bye bye.